Good morning, everybody. Good morning, fools. Good morning, YouTubers who are watching us. It is indeed 8 o'clock a.m. on the East Coast of the U.S. That means it is time for Fool24. I am Jayson Hall, longtime Motley Fool contributor, joined by Rick Munarriz, even longer time Motley Fool contributor and analyst. Morning, Rick. How are you, buddy?
I'm doing all right. It's an honor to have kicked off Fool Live 2 of the last 3 mornings. So good morning to you, Jayson, and good morning to everyone who's up at this hour.
It's a busy day. We're still coming through earnings. It's that weird period where it's a tail of earnings for a few companies, and a few others that report super early have already started to report. So part of what we're going to do this morning is talk about some earnings that have come in. We might try something different we haven't done yet together. Williams-Sonoma releases its reports this morning at some point during this hour, so we might try to grab that and go through it. Five Below reports this afternoon, so we're not going to be able to talk much about that besides expectations. And of course, we always want to answer questions from people watching, whether you're watching on the YouTube stream or you're watching as a Motley Fool member behind the Motley Fool paywall. Get your questions to us at slido.com. Again, slido.com. The event code is Fool24, all one word, Fool24. Get those questions to us. I always want to remind you, too, if we're answering your question, we're not giving you individual investing or personalized financial advice. It might feel that way. Don't project that into it. But that's not what we're doing in this format. We don't know anywhere near enough to provide that sort of feedback to anybody watching this show. And then there's ethical and legal reasons why we're not doing it either. So you can use our answers to inform your choices, but remember, we're not providing you with individual investing advice here. Okay, Rick, middle of the week here. It's hump day. It's the beginning of hump day, so we're just starting to climb up the hump here. What are you thinking about today?
I'm thinking about, I'm not worried about the daily gyrations anymore. Every single day has been pretty wild, so it's not as a matter of this is going to be, and how the day starts isn't always how the day ends, as we've also found out. So I'm not overly concerned with the daily gyrations, but yeah, again, while it's not earnings season, I don't think it's just, there's just a lot of companies reporting this week too. So it's not as if like you can take a breather if you're tracking companies, and not that every quarterly report is important, but some are obviously more important than others. And I know Williams-Sonoma is going to report at some time, probably during this hour, since their earnings conference calls at 10 a.m. And I know they need to give their investors time to digest. I just checked right now, right before we started, and they'd still not filed. But I'm definitely looking forward to that report. And yeah, in general, I don't want to say I'm excited because, again, it's the last 2-3 weeks have been pretty painful for most investors that are along the market. But I am hopeful that at least, the companies that when you do due diligence, if you're picking the right companies, that they'll be able to at least fare better than the market, even the high beta ones that tend to, sink harder with the market. If you choose well, if you choose companies that are going to deliver, not just this month, obviously next month, a month from now, we're going to be starting off the heavier part of the new earnings season that'll kick in mid-April and take us through like mid-May before things start slowing down. It is an interesting time to be in the market, but I'm happy to be in it.
Yeah, I think that's the key. And something maybe a good place to start is we're waiting for questions to come in and getting ready to digest some of these earnings if we get the opportunity with Williams-Sonoma, probably around 8:15 or 8:30 is my guess. If they do, is probably when they'll drop it. Is the hardest thing to do is the most important thing, and that's go through these environments. One of the things that we do a lot in the articles that we write for the Motley Fool is we put in charts. A lot of times those charts will show long periods of time and how the market creates value. I've talked about how October, the first week of October in 2007, if you look back historically, it's probably one of the half dozen worst weeks you could have possibly bought stocks, because that was the top right before the global financial crisis. And it was 2012 before your stocks would have recovered from that 2007 high. So 5 years of losses, right? So the hard thing is living through it, right? And investing through that environment. And one of the things that we're going to do this morning is something that I think can be useful for that, which is studying the companies that you own. Instead of focusing on the market going up and down and trying to guess which way stocks are going to move, to try to avoid losses and trying to catch momentum, trying to trade your way through, learning your way through is something that I've always, not always, but something that after a couple years of learning the hard way, that I found out that, studying the companies you own, and when they give you an update on how their operations are doing and what their plans are going forward, taking the time to try to understand that is, I think, a useful thing to do.
Yeah, agreed 100% on that. Yeah, I mean, do you want to talk about Williams-Sonoma? I mean, again, can we preview the report again? Because I hadn't really looked at Williams-Sonoma in a while, but I knew we were going to talk about it. So I was like, loading it up. And that last report, it's, again, this was a stock that split 2-for-1 last year, and things were going so well. But, not kept negative comps. But again, with Williams-Sonoma, it's not so much you think, okay, Williams-Sonoma, but this is almost like when you think about the Gap, you also have to talk about Old Navy and Banana Republic, all the other appendages. And in this case, the real drag
Pottery
seems to be
Barn.
Pottery Barn, and
Yeah.
to a lesser extent, West Elm. But Williams-Sonoma's comps were basically flat. I think it was 2.7, almost 3% negative comps for the brands, all brands as a whole. But Williams-Sonoma did sort of okay. Pottery Barn Kids did positive comps. But yeah, Pottery Barn is obviously a very different concept than Williams-Sonoma. Williams-Sonoma works where you need stuff for your kitchen. There's like weddings happening, and there's bridal registries. All these things are happening in Williams-Sonoma. Whereas Pottery Barn is almost based on, are people fixing up their homes, or are they sprucing up their furniture? And it's not necessarily a housing play, but it is also very much a housing play, much less than Williams-Sonoma would be, where it's if sprucing up your kitchen is timeless, and it's not the case so much with Pottery Barn, which is more bigger ticket goods sometimes. So sorry.
No, you're good. So here's an interesting thing about Williams-Sonoma as a business that might be surprising to a lot of people, because particularly with that Williams-Sonoma brand, you think of it as a destination, right? To go, because they do like the cooking demonstrations and a lot of very nice things, and a lot of times you want to see those things in person. The home furnishings, I should say, picking out dishes patterns, picking out utensil patterns, that sort of thing. You think of that as things that you do in person, and to a certain extent carrying over to Pottery Barn. Here is a surprising number, and this is something that I first learned about the business actually before the pandemic, as it was growing. But 2/3 of Williams-Sonoma's sales are e-commerce. Does that surprise you, Rick?
It does, because it seems, I mean, at least everywhere I go, there is a Williams-Sonoma and a Pottery Barn. West Elm. I mean, I'm basically within 2 miles of all three of those concepts here in Miami right now. So, it does surprise me, because you think, especially with a retail brand well entrenched like that, you would think most people I want to go in there. I want to see it. I want to feel the merchandise, since they have physical stores there. But yeah, it's impressive. That is something I did not know. So, wow.
Yeah, it's a surprising number. And I was looking through it in their most recent presentation. It was their full investor deck, so it's about 40 pages long. I was trying to find it. One of the things that they historically have included is their comps results, and often as a comparison to their peers, because you mentioned flat sales, and the reality is that it has been a challenging environment. And what we've historically seen from, and I can't find one to show in this case, but historically what we've seen is that Williams-Sonoma's brands almost across the board tend to outperform their competitors. One of the things that they're really good at is product design. They do the vast majority of their product design in-house, which can be advantageous versus just being a retailer and you're buying what some manufacturer is bringing to you, and it's in their pitch deck, and you pick out the things you think that'll fit in your with your store and your go-to-market strategy. So doing a lot of their own product design is key. And then, of course, some of the brands that they carry, fitting really well within the go-to-market strategy for West Elm, for Pottery Barn, for Williams-Sonoma has been a proven strategy. And so talk about e-commerce is that, that 2/3 of their business, but it's built on their omni-channel strategy, because their stores still do serve an important purpose. Even if people aren't necessarily buying in the stores, is because if they might see something, come to the store and see it before they make a final decision, they don't have to go back to the store to buy it. Using their good last mile that they've built, which you wouldn't think of for a business like Williams-Sonoma, but it's become they're an underappreciated, I guess is the best way to put it, building out the tech and infrastructure for e-commerce. Here's the brands: Pottery Barn, Williams-Sonoma, and then
West
you
Elm.
mentioned Gap. It's funny, right? Because you've got, Gap has done like the multiple layers of brands too. We've seen Pottery Barn do the same thing with their teen and kids lineups, and then of course West Elm, which is their primary furniture business as well, in addition to Pottery Barn. So they've expanded. I believe those aren't the only ones anymore. I'm sorry for flipping through this, but okay, here we go. So Mark and Graham, Green Row, Rejuvenation, these are other brands that they're building. And a lot of times this is part of that e-commerce strategy where they've really established themselves as a cross-platform brand. What else do we want to talk about with these guys?
Yeah, so again, and this is a stock that has, over the past month, it's down more than 20%. Not so much any Williams-Sonoma news, just general market weakness. It's still up 20% over the past year. So I think, again, looking at their last report, and again, I hadn't looked at a Williams-Sonoma report in a couple of years. So I was impressed that they're making more out of less. Revenue was, in fact, matched the comps down 2-3% year over year in their fiscal third quarter. But earnings, and one thing, and this is worth noting, I guess it's not a big deal, but it's something that I always like to look at. Williams-Sonoma, they're aggressively buying back their stock, and they had a $1 billion buyback they announced in September. There was still almost $300 million left from the previous stock buyback. So, but they've been buying back stock over the past year. So even though they say, well, earnings per share is up 7% versus comps being down, besides comps and revenue being down 3%, you think, wow, that's a lot of improvement. But it's really up 5% because of their share count has pretty much been reduced by a little more than 2% over the past year. So that does improve earnings on a per share basis. So again, it's not that dramatic where you really have to fine tune and look into it. But I was impressed, and then looking in there, there have been real improvements in how they do things operationally to the point that even though sales have sort of meandered and definitely down in at West Elm and Pottery Barn, the company is finding ways to increase their profit, the profit margin on the bottom line. And I think that's something that's impressive. And I think maybe that's why one of the reasons why there's been a lot of retailers that have been hit hard. You mentioned Five Below. They're going to report after the market closes. That stock's down almost 2/3 over the last year. Whereas Williams-Sonoma is one of the retailers that's actually up double digits in that time. So clearly doing well at this point. Maybe not operationally, maybe not sales wise, maybe you don't see it at the traffic level, but they are doing things behind the scenes to make sure that more of their revenue, more of every dollar they make in sales is working its way down to the bottom line, at least right now.
So I sent the screen share back out, Natasha. I've got 2 more slides I want to share, and we can kind of wrap this up. And this is thinking about like the long term of the business. So talking about things like share buybacks and getting more from less. It's great when you can find a business that is really capital disciplined in a market where the opportunity might be to really try to force growth. Last I checked, 45% ROIC, return on invested capital, is exceptionally good. So you have a management team that I believe is, instead of prioritizing empire building, and a lot of times they get compensated that way, right? They're focusing on creating value with the business for the owners of the business, the shareholders. So I think that's good. But with that said, there still is a lot of opportunity. It's a big market. And this is something they've been talking about for a number of years here, the total market opportunity. And this is the global opportunity that they see in front of the business. So you always have to kind of squint a little bit when you look at these really, really big numbers. And so, well, how much of that is reasonable? And the folks at Pottery Barn, I think, are trying to be reasonable about it. And they're saying, well, look, if we can capture 3%, so they're not trying to say, look, we can get some giant piece of this. If we can just get 3% of it, we only have 1% of it now. Nobody has more than 5%. There is an opportunity here that would result in a business that's 3x its size. And that ignores the regular growth of the global economy that will make this number a little bit larger, a few percentage points larger every year. Again, the point is it is a massive market, and it doesn't take some outsized share of it for Williams-Sonoma to be a larger business. So they have an interesting strategy. they're definitely being affected right now, I think, by the macro environment. This is certainly the vast majority of what they sell you would describe as discretionary spending. For most people, right? There are certainly, they have this economic strata of their customers includes some people that they're buying home furnishings and new sheets and bedding that they might not necessarily think of as a discretionary spend. It's they need them. But still, even those things are so it is the sort of business that is going to be on kind of the leading edge of when the belts start to get tightened or there's a little more economic uncertainty. It could be, it could be affected a little bit more. But historically, it's been affected less than its peers. It is one of the first to recover when the spending cycle does normalize. So this is one that I do try to look at every quarter when they report, just because I'm interested to see if the strength of the business that they've built continues to hold up and deliver the way that it historically has. So you want to set some expectations for Five Below?
Yeah, Five Below, again, it's a stock, as I mentioned, has been hit hard, but their last quarter was surprisingly good. Their fiscal third quarter was well ahead of expectation. Comps took a nice, reversal from where it was earlier this summer. Five Below, for those of you who don't know, is this chain that started off. It was originally the two of the founders from Zany Brainy, a toy store, and they said, "Hey, let's do this concept where it's a big box." It almost feels like you're walking into a Big Lots or an odd like a kind of like a bargain store, but you go in there and it's colorful. There's a lot of things. It's used sometimes outside. They'll have a bunch of these huge inflatable the bouncing balls. And again, these aren't the small ones that you'll see at a supermarket. And it's everything they do there is catered towards a younger audience. Their audience is mostly teens and tweens. So all these things are happening at Five Below. And usually you think, well, hey, dollar store, and this is in a sense a $5 store. Is the kind of thing that would basically be sort of recession resilient, but you do have points where they just are not connecting. And I think with Five Below, they were expanding so quickly that they sort of lost sight of it. And then that's why the stock, I think, has been down for a while. But again, in the third quarter, they did have better than expected results. But unfortunately, when they raised their guidance, and raising guidance is usually like, hooray, this is great. In the case of Five Below, they raised guidance by pretty much the third quarter beat. So it's not like people are expecting much of a difference here in the fiscal fourth quarter. And this is the holiday quarter. But again, this retailer isn't necessarily that holiday, dependent, because again, it's sort of year round. It's kids with their allowance money want to go spend it, or parents want to reward their kids. This is going to happen all 365 days a year. It doesn't have the same kind of seasonality as
You're not going to go in there and buy a Nintendo Switch for your kid for Christmas or something like that, right? Right.
Yeah. And even though they added like a section for 10 below, like a text, so they can go higher on price points. Not so much for inflation, but they wanted to have some electronics, some kind of gadgetry, the kind of thing that you'd say, hey, I need something, and I just don't want something, like just something, a novelty item. I want something that functional. I want a smartphone case. I want some headphones or anything like that. They have them now in kind of like a higher price category, so they can do that. But again, this is a company that obviously, if they're selling a lot of stuff cheap, that means a lot of the stuff is, some of it's closeouts and a lot of it's also imported. So it's also being impacted by what's happening, in the trade war and tariffs. But you have to be watching that with Five Below. But yeah, the stock had a decent quarter, but the market wasn't really overly impressed because of the situation where the expectations looking forward back then for the quarter we're going to find out about in basically 8, 9, 10 hours from now is problematic. And again, there's nothing that happened during the holidays to make you think it was a great quarter, but can they at least keep up some of the momentum that they had in the fiscal third quarter to at least reverse the negative sentiment, which has been, basically burned investors over the past year with Five Below?
Well, yeah, the first half of the year, both the first and the second quarter, comps were negative, substantially negative, -4% or so, maybe a little more than that, and jumped to positive 0.6% in the third quarter. So, I mean, it just goes to show that the expectations had swung so decidedly negative that, like, when your comps growth is far under inflation and it's still viewed as a positive result, it shows you how far that they need to go to get back to the sort of expectation for the business. I'll say this, Rick, this is here's my Five Below story. And no matter what happens with the business going forward, it will always have a special place in my heart, because Five Below is the first place that my son, he was still 6. He hadn't quite turned 7, where he made a decision on how to spend his own money on something. And as a typical 6-year-old would, he walks in the store and they've got these round bins. It looks like a barrel, but it's only like that deep full of merchandise. But he walks in and they've got half a dozen of them right at the front. He's looking at them, and the avarice in his eyes they're just getting bigger and bigger. And he grabs something out of one and he grabs something out of the next one. And we're 30 seconds in the store and he's got his arms like this, holding like 4 or 5 things. And he's looking around and we're kind of walking through, and I'm like, well, you don't have to grab everything that you might want. You can just kind of wait. And he just kind of gives me this look. He's like, what are you trying to do, old man? And we walk through the store a little bit more and we get to the back and we get into like where they do have, some $10. And actually in this store, they had some like $20 items too on an aisle. And they had this electronic basketball game. You go into the arcade and you've got the 2 basketball goals and you kind of shoot. So it's kind of a smaller version of that. And it's basically black PVC pipe that makes it. And it's got the net and the 2 goals side by side. It's probably 5.5 feet tall. And he sees it and it's $25. And he's got all of this stuff. And I'm like, well, you have the money. You just need to make a decision. Do you want that? Or do you want to get all of these other little things that I don't know that you're going to like very much? And he got quiet for a second. And then he walked back to didn't say a word, walked back to the front, put everything back in the bin, walked to the shelf, grabbed that basketball thing, walked straight to the counter, didn't say a word to me, took it straight to the counter and bought it. So that's my story about, learning that little tiny lesson, that little financial lesson for my son. We still have that thing too. And my son's 8 now. So you wouldn't think a store like that, you learn a little delayed gratification about spending and value. So
that's awesome. And a good lesson. 5 Below, don't ever change your name, because 5 Below got your kid through the door.
Yeah.
But 25 Below is technically what he went and picked up. So
well, I mean, 10 Below is the new 5.
Yeah.
But I think you're right. You still got to stay with that number for sure. Rick, we've got some more questions that have come into the queue here. Yeah. So here's one. I want to take Matt's, because Beyond Meat's a company that, I like some of their products. I don't love their products. I like some of their products. I like the Impossible Brands products better, to be honest with you. But Matt's question about the pandemic and Beyond Meat, whether that was a killer to it. Curious your thoughts there. And I can weigh in a little bit here too, but I'd love to hear from you first on it.
Yeah, so Beyond Meats is one that I haven't followed in a while. Again, it was a Rule Breakers recommendation a few years ago, back when the whole Beyond Impossible, the whole meatless patty craze was happening. And the company is Beyond Meats struggled in a major way, especially coming into the pandemic. Things really started to go poorly for them. And again, I haven't followed Beyond Meats in a while, but to me, it's the kind of concept where obviously people are getting more careful about what they're eating, and I know it doesn't always seem that way in this era of Ozempic and Wegovy and Mounjaro and Zepbound, all these injectables that can help you cure those mistakes. Those things ultimately, all they do is just basically curb your appetite, and you eventually have to earn your future beyond that. And in this case, it's the kind of thing where you're paying a premium for something that technically, again, and like in the Beyond Meats and the Impossible, the patties are it's all these great ingredients, but they sort of, just to duplicate the density and kind of like the decadence of meat, are not necessarily really healthier for you. You're not doing it necessarily for a health purpose. You're going Beyond Meats because you believe in a plant-based diet. That's the way you're going. And while they went on, and you always hear stuff for both companies, for Beyond and Impossible, you hear stuff like, KFC's trying out, meatless chicken nuggets and all these things, and different restaurants. Oh, well, we do have our meatless burger. Some of the chains have also started just come out with their own variety, or at least what they're branding it as their own variety. So it's the kind of thing with Beyond Meat. Again, and I haven't followed it. I looked it up in a couple of years, but it is the kind of thing where it struggled from the initial euphoria. And again, if you've ever had a Beyond Meat patty or an Impossible patty, and I've had both, it is a decent substitute. It obviously doesn't taste exactly like a beef patty for us carnivores, but it's the kind of thing you go, wow, this is like, it's not just a bean burger. It's not just a veggie burger. It works better than like the Garden Burger. No offense to Garden Burger, but it duplicates it well. But it's what's the market for that? And that's where I think the market sort of struggled. And again, Beyond Meat has done well and bounced back, but they were one of the hardest hit stocks a couple years ago. So yeah, that's all I know about Beyond Meat. I haven't kept up to it, Jayson.
Yeah, I can weigh in a little bit here too, because I do like their products. And what I found is interesting is a lot of like the ground products they do and some of the sausage and some of those substitutes actually work better even than the burger patty, even though the Impossible, like you said, it's pretty good, especially if you do what I like to do and make something called the Hypocrite, which you take an Impossible patty with cheese and bacon, and it's delicious. But it's pretty hypocritical, right?
Yeah. I think BurgerFi. There's some burger chain. I forget that. I've seen it on a menu, and I've never gotten it because it's like, what's the point? But yeah, it's to me, it's but something hypocrite burger or a paradox burger or something. But yeah,
right.
Yeah.
So, but what I found is where the product works really well is when you're putting it in like the ground meat, in a taco or in something like that, or a meat sauce that you're making for pasta or something like that. So there are applications where the product works well, but the two lessons. Number one, when you come to market with a product like that and you're trying to be disruptive, you need to have some things that are going to create durable competitive advantages, economic advantages. That's where the value for shareholders is going to be created. And the challenge, and we've seen this across the food industry many, many times, is that this is a commodity race. They can get a little bit of a premium to the meat counterparts, to the animal product counterparts for each of the food categories that they have, but it's not substantial. And so far, we haven't seen any of these companies be able to get a consistent premium against their peers, right? Which is really, really important, which means that now you're in a price competing situation with your peers in these replacement products. And nobody's really stormed ahead in that regard and created any real economic moats. And this is the result. Natasha, I've sent a screen share over. So we look at the stock price, and when it comes up on the screen, this will be the purple line. And it clearly, again, we'll go all the way back to the IPO. Wasn't this was this a SPAC or reverse merger or something like that? I can't remember. I'm going to bring it a little bit more short term. Again, we saw
it was either a SPAC or a direct listing. I don't think it was a traditional IPO, but I don't remember the exact route it took. Yeah,
I don't either. So this is, I know this was not long after it went public, but I know it went public before the pandemic, but again, lots of hype. And during that pandemic period, we did see revenue grow, got a lot of shelf space and a lot of distribution and a lot of grocery. There were, like you said, some food service wins with restaurants that it got. But here, since we've started going out in the real world and eating, none of those things have proved durable, and revenue has fallen, by more than $1 billion a year. And despite a brief period where it was generating positive cash flow, has consistently burned cash on a free cash basis again. So it's just a business that struggled to demonstrate any economic advantages that pass on to investors, right? So to me, it's a reminder that every great idea, and I do think that writ large, these products are going to be good for humanity. Environmental benefits of less meat consumption. We know the health benefits are real, even though this is still a very highly processed food and they can be pretty calorie intensive. The data is pretty clear that reducing meat intake is healthy, right? So even if people do use it occasionally, there's societal benefits that I think are pretty clear. And like I said, I like the products. So, but that doesn't make it an investable idea, right? We can look at the vast majority of automakers, with the exception being Tesla and maybe a couple of the Chinese automakers. Toyota's had a good run at times, but broadly, It's a giant industry, and the transition to EVs, again, societally, this is probably really going to be really, really good. Quieter cars, driving down energy costs for all of us, reduce pollution, all of that stuff, right? But that doesn't mean that net across the entire industry, it's going to be positive for shareholders. So to me, that's probably the biggest takeaway of something like Beyond Meat. And we could look at 3D printing, go back 15 years ago when that was kind of all of the early investor interest in 3D printing. Fast forward now, and there's, probably 100 times more 3D printers in people's homes actually getting used for stuff. Most of them are just hobbyist things. But we never saw like the 3D printing revolution come to the household in a way a lot of us were expecting back around 2010, 2011. So every idea is not going to pan out and be investable, but it's also, I think this is the last thing, Rick, and then we can move forward.
Yeah.
Part of the reason that we diversify, particularly when we're looking at rule breaker kind of businesses, disruptors, because they don't all work out for a litany of reasons. We can always identify the things that support our bull case and our thesis, but all it takes is one or two things that we overlook for everything to go sideways or to lose money. So it's an important reminder that's why it's always good to diversify. 25 plus stocks, owning ETFs, cash, holding some bonds or bond funds, things like that, creating diversification of risk and opportunity. Make sure that if we did buy a little bit of Beyond, maybe we also invested in a little bit of NVIDIA at the same time, and it's worked out okay, right?
Yeah, and again with Beyond, so I looked up. Yeah, it was a traditional IPO. They went public in the springtime of 2019. So right before the pandemic, at 25, within 2 years, the stock was up at $221, an all-time high. Today, $3.55. You'll have to pay 3 shares to pick up a Hypocrite burger at your fast food burger, quality quick service burger chain of choice. So, but definitely a sharp fall from grace. That's 98% drop. It's a lot from peak to trough. So, and again, not that this is necessarily the bottom, but yeah, it's sometimes the best stories that seem great don't pan out that way. And again, as you mentioned, if you put your money in NVIDIA and in Beyond Meats, you may have lost almost all your money if you bought Beyond Meats at its peak in 2021. But all you need is a stock to more than double. And NVIDIA, obviously, in the last 4 years has more than doubled since the peak of Beyond Meat to more than offset that. So, yeah. I wanted to answer a question before I forgot. So there was a question that was asked last night, I guess, and I know we're getting some good questions now, but just I wanted to address it quickly. Fool had asked, Nintendo is near all-time high with PEO ratio of 37. How is it valued now? And again, with Nintendo, and I'll just say this, I don't want to elaborate too much on Nintendo, only to say that I want to get more to the fresh questions. I want to get to the stuff we're talking about. But Nintendo is a company that goes in cycles, and right now, trailing revenues look terrible because it's been 8 years since they released a new system. The Switch came out in 2017. And an interesting thing about Nintendo is when the Wii came out, and then when the Switch came out, about 10 years later, after the release comes out, the first year sales spike. Second, third year, the revenues continues to continue to grow dramatically, with earnings per share growing as well. Until about the third or fourth year, which is when sales tend to peak for a system. That's when there's an installed base enough so that everyone has a console and can have more people to buy a game when a new game comes out specifically to that platform. And Nintendo, there's a lot of games that are specific, exclusive to Nintendo. So in those two cases, when the Wii and the Switch came out, from the year before the system came out to where revenue was 3 to 4 years later, or actually 4 to 5 years later, so it was the year before, revenue has tripled and earnings has basically tripled or quadrupled. So yes, it's very expensive right now, Nintendo, on an earnings basis, trailing looking back. But this is, the end of a cycle, the end of a very long upgrade cycle with the Switch. And now the Switch 2 will be coming out later this year and should, pick things back up. But that's it for why Nintendo. You can't view Nintendo just on a looking back basis. But
let's see here. So go ahead. I
heard a pause, so I was going to fill it. But yeah, go.
Oh, you're good. Do you want to take Javier's question? Have you had a chance to look at Sports Radar yet, or we want to wait on that one?
Yes. So again, a Sport Radar had a solid quarter. And yeah, I looked at the pre-market. I mean, it didn't seem like it was the market was acting very well when it first came out, but it's up about 4 or 5% right now. Revenue. So Sport Radar is a company that, and I always lump them with Genius Sports because they're sort of doing the same thing, that they're basically data that they provide for the betting market, for this media market, for the sports fan market, all these things that you need real-time scores, you need real-time everything. And you think, why are these two smallish companies doing it? In this case, Sport Radar out of Europe, and there's a necessity for this. And obviously, the more that people get entangled with fantasy sports and actual online wagering, which is now everywhere now, even the actual arenas that would say that kicked Pete Rose out of baseball for betting on baseball, wouldn't get him in the Hall of Fame. You have the same league is embraced with stuff you see, DraftKings, FanDuel, all these platforms that are essentially an online sports book doing it. So this is something that's growing in scope. Revenue was up 22% for the quarter, slower than the full year. Full year is 26%, so revenue did decelerate. But again, they're buying back stock. They're doing good things on the way up and down. But overall, for the year, what I really like, especially, you don't view this as a cloud-based company, as an enterprise software company, but they do put out their net retention rate, which is basically a figure that says how much are you spending, how much are returning customers, how much are they spending now versus a year ago, and it's up to 127%. So it's a big number, but let's say 100 would be the bare minimum, because 100% means with the customers, your existing customers from a year ago were spending then in those 12 months. It's the same thing right now. So they're saying that the average customer now, and this isn't you and me, these are the companies, the media companies, the online sports books, all these companies that rely on this, the leagues and everything, media companies too. They're spending 27% more now over the last 12 months than they were a year ago. So this is for the year. And you think, well, 26% revenue, that means they didn't really grow their customer base, at least for existing customers. And that's fair. But again, this company's growing at a better than 20% clip, and it's working out. It's doing well financially with that money. Clearly doing a lot of things well. So yeah, Sports Radar is a stock I haven't looked at in a while, but I know it's been asked a lot in our Fool24s lately. And yeah, I'm going to take a closer look because it seems to be doing all right. It's in the middle of a stock buyback and doing some things right. Jayson, you're on mute.
Sorry, guys. So Let It Ride asked, please rank the following for 5+ years. So first, before I even name the stocks, Let It Ride, thank you for asking this question that way. If you're going to invest in stocks, you have to think in long-term perspectives, because so much of what happens in the near term is based on macro, based on sentiment, momentum of the market. Economic things can happen, cycles can turn. When you stretch out stock ownership to 5+, 10+ years, the quality of the business tends to do the vast majority of the heavy lifting for the returns of the investment. So thank you for putting it that way. And the 5 stocks that Let It Ride asked about: Williams-Sonoma, tickers WSM; Walmart, ticker WMT; TJX Companies, ticker TJX; Five Below; and DG, which in this case is Dollar General, not David Gardner, Motley Fool co-founder, an investing legend. So here I want to just take a minute and talk about each of these businesses and kind of like my synopsis of each of these companies. So we talked about Williams-Sonoma. The one thing I will add is that not only is it well run and been a smart capital allocator in a cyclical business that's highly discretionary, but it's been a massive value creator. Over the past decade, the stock is basically a 5x. That's incredible. You're doubling your money every couple of years. That's pretty good by any standard. TJX Companies, that's TJ Maxx, Marshalls, Home Goods, and I think it's TK Maxx, their international operations. And the interesting thing about this business is we think of it as like a heavily discount retailer, which it is, but it's not looking, it's the economic strata of its customer base is incredibly diverse, from people on the lower discretionary income cohort that needs to find the least expensive thing they can to make ends meet, all the way up through upper middle class that they just love the idea of the value, and trying to find that that discount. So they've done an exceptionally good job in the business's history of being really, really good buyers of products from retailers, distributors, even manufacturers on closeout. That they just need to, the owner of that goods needs it gone. They need that inventory out of the warehouse because they need to get new inventory in. They're not moving it. They manufactured it and they can't find a buyer for it. So they're really good at buying deeply discounted merchandise, but also buying deeply discounted merchandise that they know there's a market for, and they can mark it up and still be deeply discounted, and they can move those goods quickly, turning their inventory quickly. That's been a real key to that business. And also they're very much an in-store focused business. They're not trying to be an e-commerce business because the vast array of merchandise they have and constantly turning it over would make it very, very difficult. And then you think about their home goods business, the home furnishings business. You don't want to sell that stuff online because the return percentages are exceptionally high. By people having to come physically see the item, sit on it, look at it, measure it, all those sorts of things, reduces the return rate substantially. And that's a big cost driver for them. Besides the pandemic, when nobody could get inventory, when it kind of upended their business model for about a year and a half, they've been exceptionally good at running their business model and delivering great returns. Five Below, we've already talked about. Dollar General, its customer base is largely people with less discretionary income in a lot of like kind of retail starved areas where they've tried to capitalize on that and build a small store that's got a lot of different things in it. And the business model has really struggled for the past 3 or 4 years with both their consumers being squeezed because of inflation, their customers being squeezed because of inflation. And that's affected some of the discretionary merchandise they'd like to sell that they get better margins on. But also they've really struggled to get the right merchandise mix. They've really, really struggled with that. So much so that they brought the CEO that kind of led them through the most of their growth, retired. And after a few years, he's come back to try to turn the ship around. They just announced finally something that they probably should have done a few years ago, which is to slam your foot on the brakes and actually start closing stores and revitalizing stores in a far more accelerated way. So they've started a turnaround. So that's the broad kind of the thoughts about each of these businesses. If I were to rank them 5 years forward, which ones I expect will probably deliver the best returns, I think the two that probably have the highest probability of delivering the best returns are TJX companies and Williams-Sonoma. Williams-Sonoma trades for about 20 times earnings right now. I think that's a really reasonable valuation considering their focus on economic returns and knowing their customers really, really well. TJX just delivers on their business model maybe better than any other retailer. They're so good at it. Even though it's a little bit higher valuation, their margins, their comps are up right now when everybody else in retail is struggling. That business is going to continue to deliver. I would put Walmart in terms of like probability of good returns in the middle, even though there's a very real case that we see Five Below and or Dollar General do better. I think there's a little more of I don't want to say binary outcome for either one, but I could see a case where both struggle from here, even though they look cheap, because there is a turnaround aspect for both of their businesses that they have to execute on. They don't have the nailed strategy that these others do, where they're good at their operations, they're good at logistics, their customer cohort is strong, they're resilient across the economic cycle. They're more exposed to the economic cycle. And they're struggling right now. So they could be the best two of this whole group, but they could easily be the worst two of this whole group as well. Rick?
Yeah. So you have Williams-Sonoma and then four, value brands for the most part. So it's definitely pretty much where you see the economy 5 years from now, whether Williams-Sonoma can continue with its strong performance the way it has lately versus the other four. I sort of agree with you. And again, I'd feel a lot better ranking this list, after the market closes, where we'd have Five Below's report to know if that third quarter was a fluke or if, hey, that was just a fluke and we're back into the stink again, like we were through the first half of the fiscal year. But I sort of agree with you that I think Williams-Sonoma, and I'm not sure if I'd put TJX or Walmart second on the list, but it's the kind of thing where Walmart, it's timeless. I think just like Williams-Sonoma is timeless as far as like on the high end TJX has these great brands. It's everyone has someone that will only shop at Marshall's, that family member. And Home Goods is a great alternative to the Williams-Sonoma. If you need to, hey, I need home stuff, but I need to get it at a good price. Home Goods is there for you. And the 2 or 3 times that I've been at a Home Goods in the last couple of years, it is crowded at a time when a lot of people aren't, because it's what you need. And I don't have the money to spring for it at a place like a Williams-Sonoma, but I can find the exact functionality of a new plate set, of a new area rug, all these things I could find here at Home Goods. So definitely a quality portfolio of companies at TJX. But and so Five Below, I'll put it at 4 now. But Dollar General, Dollar General it's for all the allure of the Family Dollars and the Dollar Generals. This whole dollar concept, and not that Dollar Generals, everything's not just it's not a dollar store. It's not Dollar Tree. Right. Where sort of everything's sort of like $8 roughly. It's just a thrift store, and it has you can get good stuff there. Has been struggling, so I would put it in sort of in that order. I don't mind putting Williams-Sonoma first, and then either TJX or Walmart second and third, Five Below fourth, and then Dollar General fifth if you want exact rankings.
Yeah, I would go so far as to say with Dollar General, I'm not convinced that bringing the CEO that built the business back is the smart thing, because that CEO benefited from extremely low interest rates for a decade before the pandemic, and largely consistent economic growth. The business environment has changed, and what worked before was actually part of the problem too, because the company levered up on the way up. They took on a lot of debt. So we're going to find out if his skill set's going to apply for the turnaround too. So. All right, what's next?
So Matt asked, again, this is just an off-the-cuff question, but have either of you ever been to the Chuck Williams Culinary Arts Museum in Napa, California, or is that place still somewhere on your bucket list? Jayson, I don't know if you've talked about this. I've been to Napa once as an adult. My wife and I and 2 other couples were there like about 4 or 5 years ago. Oh, actually, it was pre-pandemic, so it must have been 6, 7 years ago. And we had a great time, but we just did the basic touristy thing. We just went on the little, you hop on a little bus tour, and it takes you to a bunch of different wine tastings and stuff like that. But I did not, I did not check out the Chuck Williams Culinary Museum. Jayson, is that an interest of yours, something that Matt would direct us our way?
15 years in Southern California, and we were lucky enough to be, there's a great in Santa Barbara County, in southern Santa Barbara County, and all the way up through northern Santa Barbara County. There's a great wine region, and it was driving distance. So we would go up there. Before kids, we would go 10 times a year. Only went to Napa once, and a similar experience. We had a small group, and we had it was more of a van than a bus that we went on a tour, and we did the typical thing. But no, going to the French Laundry, and going to Chuck Williams Museum, those are, I'd like to go back. I have an 8-year-old now, so it might be a little while before we make that trip, but I would like to spend some time in that part of Northern California just for the culinary aspect. It'd be a lot of fun. It would be a lot of fun. I think I'm going to grab, if you don't mind, I'm going to grab, I'm going to try and not totally brutalize the name here. Leviathan's question about one of the companies that I don't talk much about, but is part of the Brookfield family. So I said Brookfield, Oaktree Specialty Lending, whether or not I think it's an attractive investment. So Oaktree is interesting because it's I think about 2/3 owned by Brookfield. The founder of Oaktree, Howard Marks, is a legend in the investing world for a lot of reasons. I believe he's in his 80s now. Oaktree is an interesting business in that its model is really kind of being the payday lender, you could almost say, of the corporate world, because Oaktree can get you capital when you need it quickly. And generally it's the terms are extremely favorable for Oaktree, to the point that they make sure that they're in a place in the line in the capital stack where they're going to get their money back. But also not so onerous that these businesses are eventually going to just be sold off for parts. Right. So, the business structure might sound kind of aggressive, and it is, but, it's something that the capital market needs. You need an institutional style capital allocator that can provide capital for businesses when they are in trouble. They're, in kind of dire straits and they need it. So the business model works well. It fit well within Brookfield because they are conservative about how they allocate capital, and they create a lot of margin of safety when they do lend to make sure that they're in a place where the capital can be secured in a worst case situation, like a liquidation or something like that. So I do like the business. I've actually never owned shares directly, interestingly enough, either before it became a subsidiary of Brookfield or since. But since I do own shares of Brookfield Corporation, ticker BN, I have exposure to Oaktree through that investment. But I do think it is a solid business, and likely to remain a solid business. I actually haven't done a deep valuation on it in at least a year, so I couldn't really give any feedback on whether or not I think the current price makes sense. But the business itself is exceptionally high quality.
So Cyber Mikey asks, Applied Materials, ticker symbol AMAT, is benefiting from semiconductors and services with a focus on AI-driven innovations and advanced packaging technologies. Thoughts on AMAT, Applied Materials? So Applied Materials has always been sort of like the thinking investors play. There are a couple plays when you're playing, I want to play the chip market, and again, a very cyclical market. And then there's hey, I want the pick and shovel plays. I want the companies that make this possible, that provide the equipment, provide the machinery, provide everything to make for companies, the actual chip makers and the chip designers that rely on the chip makers, provide the parts that are necessary. To me, what disappoints me about Applied Materials is you were talking about this AI revolution. When is it going to trickle down to Applied Materials? Their last 2 fiscal years, revenue growth of less than 33% in back-to-back years. It's going to be another year of single-digit growth, at least according to analysts. I pulled up kind of like a forward-looking quote when I saw the question, forward-looking estimates, and it's not till 2029 when analysts see anything other than a single-digit revenue increase. Obviously, there's ways to improve the bottom line faster than the top line, and a lot of companies that know what they're doing are doing that, and that's the case with Applied Materials. They're doing doing well on that. But it's still 20 times earnings, of 4 or 5 times trailing sales. Not necessarily a very attractive valuation at a time when right now the reason why a lot of these companies, a lot of these chip companies are getting hit harder than the most of the market is the whole trade war, tariff wars, all these things. It's harder to make a presence internationally as a global business, and more importantly for them, it is for AI specifically, which has been the thesis for so long for companies like NVIDIA and so many other stocks that now have AI in their tickers and AI in their corporate monikers, is when will its reduction is the capital expenditure, will it be there? Obviously, in a softening economy, companies may have to cut back. They think, well, we have to invest in AI, but we saw what something as simple as DeepSeek did when a Chinese company said, hey, we can do this with old chips. We can do this with aging hardware. We can do these language learning models and be able to do it without having to upgrade to the shiniest new NVIDIA chip or just general new stuff in general, just recycled chips. So you do have a case where it is problematic. And again, for a company like Applied Materials, they're sort of at the mercy of that. They haven't really fully benefited from the trends that you mentioned, but it's a quality company, obviously, and they're large enough at what they do that they have a very strong position. So, but I don't really see the if they didn't participate in the AI rally until now, and revenue did accelerate. It went up from like 2-3% to like 7%, I believe, in its latest quarter. That may not be enough to excite me and say that this turnaround is finally ready to ride those coattails at a time when the coat may be taken off. So not overly impressed by Applied Materials as far as their participation in this, but I think it's a quality, steady company trading at a reasonable to slightly elevated valuation.
So I can take that and segue to Mark H's question about ASML. I love the lead-in question to that, Rick. Mark, Rick and I are very, very rich. That's why we have lots of shares of lots of different. I'm kidding. Rick's really rich. I'm just sort of rich. No, so I want to answer that part of the question first about weightings of investments after the ASML, because it does apply to what we were just talking about with Applied Materials. So thoughts on ASML at present? I think ASML is getting really, really attractive to me. I think the pricing and the valuation for, again, it's a cyclical business, the semiconductor industry. And as much as the AI part of the business is doing well, we look at the NVIDIAs, we look at how the GPU business is really driving TSMC, right? Because there's so much demand that's helping TSMC, even though like industrial demand, the automotive industry has largely been very weak for a few years now. That part's in a down cycle. Coming out of the pandemic, the demand for PCs fell, right? So that was a really soft, that wasn't growing as quickly. We've just only recently started to see semiconductor units for things like smartphones start to grow again over the past year and a half, has returned to pretty steady growth. So a lot of that sector has been a mess, and that's one of the things that's affected Applied Materials, but it's also affected ASML, because I don't think a lot of people realize, but their legacy machines, the DUV machines, still make up a massive portion of its business, a huge portion of its business. And in terms of number of chips, it's the vast majority of chips are coming off of their legacy machines that are kind of like the workhorse of the industry. Like the memory industry uses them a lot. They're used to make all of the more commodity chips. They're pretty, and again, they have competition from some Japanese lithography machine makers in that sector as well. But they're still like, it's the workhorse of the industry. An interesting data point about ASML last year, their high NA machines, which is the next version of their EUV extreme, their bleeding edge machines, they recognized revenue for one in the prior quarter, and they delivered a second one that hadn't been fully installed and recognized by they hadn't recognized revenue yet. It wasn't fully accepted by the customer. So they're in this weird period where the acceleration of growth from AI is helping their business, but there's kind of a negative cycle aspect for a lot of their business as well. That's before we even talk about all the stuff with China that's potentially headwinds for their ability to grow in the higher end part of the business. But the key that I wanted to get to is I think about the valuation today and thinking about it across the cycle, kind of the midpoint of the cycle, it looks really, really compelling to me. And there's a very good chance if I wasn't answering this question, I would be buying that stock tomorrow, because it is on my list. So I'll have to wait a few days before I reevaluate that decision again. But I do think it's compelling right now, because across the cycle over the long term, it's still in the best position of any of the picks and shovels companies that make hardware that's used to manufacture chips. David Gardner snap test. If you snap your finger, there's literally nobody else that can replace ASML for the most advanced chips. Nobody can, they wouldn't exist anymore. We couldn't make them. So that's a pretty good position to be in. And I think they can build on that. But I do want to take the kind of the first part of that, that question too. Rick, you and I both, we have, I don't know how many, do you know exactly how many stocks you own right now? I have about 96.
I own about, it's about 48, 50, like half of what you own. Yes.
But
I also own a lot of ETFs and mutual funds too. But yeah, stocks. Yeah, it's several dozen. Yeah.
So thinking about how do you? So I'll give my answer first, and then you can weigh in too. So the way I think about it, when I have all of these different stocks that I own, is I kind of have a barbell, and I have kind of two different buckets that I invest in. The more stalwart businesses that are more proven, the businesses that I know better, that I feel really confident in, my thesis and their ability to generate return going forward. I make larger investments in those, call it, say, 2% of my cost basis. I'm comfortable investing that, kind of even at a starting point for those businesses. I'll make larger investments at a time. And then and then on the other end of the barbell are businesses that I tend to start with small starter positions, and I add to them over time or don't, based on the performance of the business, right? How is the business growing, or checking the box off on the things on my thesis? Or are they missing, right? Am I missing? Are they not performing? And then I'm not going to allocate more capital to those businesses. So I have, probably more than half of my portfolio is in 15 or 20 stocks. So it's more concentrated than it might seem, because I have a lot of very small positions, a lot of laggards that I haven't invested anymore in because they haven't done anything. Do you have a similar approach or different approach?
Yeah, yeah. Obviously, I don't make the same initial investment each time, and I know we're at 9 o'clock, so I'll answer this quickly. That I do think that I'll put in a little more of a stock that I have more conviction in. But again, if I start with a small position, it's only because I think I'm going to add more over time, but I just wanted to prove it or not. I want to point out that Williams-Sonoma did not finally report. Maybe they're going to report now around 9, so we weren't able to discuss it. StoneCo, which is another company that we had sort of planned to talk about, reported after the close yesterday. The stock's up 10, 11% in after hours, so clearly a good report. But yeah, again, it's 9 o'clock. It's not for us to wonder why. We just move on. So Jayson, yes, I'll let you close up, but thank you.
Perfect. Well, Rick, thank you for another fantastic hour. Looking forward to doing this with you more than one more time in the future before we open for the actual morning show. Time to give it over to Bill Barker, Jayson Moser, and none less than Nick Sciple. Good morning, gentlemen.
Thanks, fellas. Howdy. Good morning. Welcome in, fools. It is 9 o'clock on the East Coast. It is Wednesday, March 19th, 2025. This is the morning show on Motley Fool 24. I'm Nick Sciple here with my friends and colleagues, Jayson Moser and Bill Barker. Fellas, how you doing this morning?
Morning. Doing well. How about you?
Doing great. I don't know if y'all caught the basketball game last night. Great start to the NCAA tournament. I think we've already got our first clip for One Shining Moment. So that's a great way to get things going. I hope y'all are getting some work done today, because I think tomorrow going to be a little bit less than optimal work day. But excited to be here with you on the morning show.
Yeah, that was Alabama State, right? That last second heave ho from end to end, right?
That's right. The baseball pass, 3/4 length of the court, bounced around, looked like a Hail Mary. Yeah, always fun to get that kicked off and keep things exciting. And we've got exciting news in the stock market. As always, NVIDIA had their big annual event yesterday, their GTC conference. Certainly the market was on bated breath watching what Jensen Huang would say. Jayson, you paid some attention to that conference. What are your takeaways from the NVIDIA conference occurring over the past few days?
Yeah, I mean, this kind of feels like sort of an Apple-like situation where these events now, the hype leading up to them is probably bigger than the actual event itself, because you kind of know what's coming down the pipe here. But nevertheless, I mean, it's exciting to see what the future holds. And NVIDIA is, they'll be rolling out this new AI chip called Blackwell Ultra, and that'll be coming out in the back half of this year. Again, that was something that we were more or less looking for. And if we look at what Blackwell has done for the company thus far, I think, let me see here, just looking back to the results from this most recent quarter, Blackwell, yeah, they delivered $11 billion in Blackwell over the last quarter. So it's clearly something that's been in high demand. And I suspect that this new Blackwell Ultra chip will very much be the same. And it's kind of like that Steve Austin thing, right? The Bionic Man, right? Better, faster, stronger, all that good stuff. I mean, that's kind of what this is just the evolution of AI into being able to do more things. And it seems like this is all kind of leading towards this robotics theme. I think robotics is starting to become a bigger theme for a lot of these companies. And there's an interesting side note there where we saw Disney and NVIDIA and Alphabet partnering up to develop humanoid robotic technology as well. Alphabet and NVIDIA, that makes sense. Disney, I thought, was kind of an interesting third there. But maybe they're going to be employing more robots in their parks and whatnot. But I mean, not a lot to see here. It certainly was a long presentation Jensen gave. I think it was over 2 hours. But yeah, it seems like a company that keeps on spinning that hamster wheel of progress in this industry that requires it so much.
Yeah, Jayson, what do you make of kind of the market's response? Because as you say, a lot of new news out there about our next generation chips, what we're going to do in robotics, but stock kind of down about 3% yesterday. The market kind of unimpressed, although NVIDIA continues to, the technology they're putting forward is incredible, but the market is kind of seems to be looking for more.
Yeah, well, it's had a pretty good past couple of years, so I guess we could keep that in mind as well. But sure. I mean, I think part of that is kind of it, as I mentioned, a lot of this really, there were no surprises. And I think that's kind of, what do they say? You buy the rumor and sell the news, right? This was the news. And we obviously don't read into the day-to-day machinations of the market as it goes. But yeah, I mean, when we were looking at the most recent quarter, and looking at estimates for this coming year. I mean, estimates are for the company to earn about $4.50 per share. And, I mean, that puts it at what, like 26 times earnings or something like that? Yeah, 26 times earnings. I mean, that's not, that's not absurd, I don't think. Not for a business like this. I mean, I'm not saying it's a screaming buy by any stretch. I mean, it's obviously had one heck of a run. But given the run that it's had, I think it's just worth noting, looking at these estimates, these average estimates that Wall Street has for the full year earnings picture there, the stock looks reasonably valued for a company that is clearly continuing to innovate and obviously going to play a very big role in our lives, our economy, industry over the next decade plus, really.
Yeah, I think, historically the chip business has been cyclical, but it seems just year after year, you look back, 10 years, you've got the big gaming cycle, crypto, and then, now we've had the AI big super cycle that's driven demand for NVIDIA chips. Now we maybe have humanoid robotics coming down the line. They'll drive another, at some point we'll run out of cycles to keep spinning up, but it's been incredible just that how demand has continued to materialize. And if you look forward, they're continuing to generate demand that didn't exist previously.
And I'm glad you mentioned crypto, because I think that's one of the more recent sort of phases the business went through. I mean, remember there was a point where there were all these there was a lot of volatility and some questions in crypto and whatnot. And NVIDIA up to that point had been witnessing a lot of success in that line of work. And then the question kind of came from that. Well, is this something that's going to impair NVIDIA's business going forward? Is it relying too much on crypto? And I think we've seen the answer. I mean, obviously the answer is no. But when we look back to the quarterly results, I mean, data center is the gist of this business, right? But they've done very well. I mean, gaming revenue, professional visualization, automotive and robotics. Automotive and robotics actually stood out to me. That was up 103% from a year ago. And again, I think that just speaks to some big trends there, not only in automotive, but again in the robotics side of things. And I think we're going to see more and more talk about robotics here in the coming year plus. And I think that's going to be fun to pay attention to. I mean, I'd love to ask this question of all three. I mean, I don't know. I know I have my answer. I'd be curious to know what you all would think. But just looking at like Tesla's Optimus humanoid robot, whatever it is, would you ever want one of those in your house? Like, would you ever want a robot like walking around your house?
I mean, I would love to have Rosie from the Jetsons. You kidding me? That's a great show. Yeah,
it's a great show. But do you want a robot skulking around your house at all hours of the day?
Not from Tesla.
Yeah.
Nope.
Yeah. I tend to say
maybe from
no.
Disney. Maybe.
I'm okay with our vacuum cleaner, and I think that's kind of where I draw the line. So I think it's going to be interesting to pay attention to exactly how this robotics revolution, as it were, unfolds, because I think we all have this picture in our mind of a robot, like a human form robot. But that may not necessarily be how it all unfolds, right? I mean, these robots, you think about like what Amazon does in its warehouses. They have robots at the yin yang running those things, and they've had it for a while, right? What was that, Kiva, that they acquired many years ago? So it's all to say that robots don't necessarily have to take human form. And I think there's probably a little bit of a hang up there with a lot of folks on having a human form robot. It's fascinating technology. I mean, to me, it's a little creepy, and I would never want one. But, if you're giving me some little Kiva robot or something that can get around the house, like, or if it's like R2-D2 or something like that, I mean, that could be pretty cool. I mean, now I'm a little bit more open-minded.
You're like a robot dog or something. I mean, I wouldn't mind a more trainable dog.
Well, as the owner of 3 dogs, I can empathize.
There's pluses and minuses to the real thing, right?
Yes. It's a give and take. It's a constant give and take.
Yeah, we'll see where it goes. Maybe we will finally get the alien dreadnought factory that Elon Musk talked about, with no people in there building all the vehicles all the way through. We'll see. But Bill, let's talk about the total opposite end of the spectrum, from humanoid robots and AI to breakfast cereal. What do people need to know about General Mills this morning?
I suppose that it is the opposite in the sense it's much more about the past than the future, or even the present for General Mills, which is the owner of many fine breakfast cereal brands that you would know, including the flagship Cheerios and several others, and also got a significant pet food segment, and sales are down. And that is at least in part attributable to less snacking going on. The guidance for the year was for a decline in organic sales, and especially in constant currency, and that includes, and so there is some regulation of the snacking. Maybe the GLP-1 drugs are making some inroads there, but also cost is coming into the equation as people trade down a bit from some of the premium brands, and also the numbers are down slightly for the pets. In my experience, pet food, the pets do not ever choose to stop snacking as much. That's really on the people they're living with, not the pets themselves, who, in my experience, again, have never decided to cut down on snacking. So this is a choice by the purchasers of the food rather than the consumers of the food there. And across the board, not a big decline. I mean, it's diversified. People still eat breakfast cereals, but you're seeing sort of flat to down guidance for low to mid single digits, and that is not including any incorporation for the possible effects of tariffs. So the numbers could end up being less than they're guided to today, and the market's, it's already a stock that is squarely in the value category at about 13 times earnings, declining today. So is this a value trap? I don't know. There's a solid business there, profitable business, but the growth is something that you have to question.
Yeah, that's right. Is this a scenario where it's like almost like the tobacco business, where cereal sales are declining, but they're taking? Yeah, it's not that bad. But where you got to take price to outstretch the decline in consumption, that sort of thing, or
I mean, it's not that bad and it's not that good either, right? Because I mean, as much as you might like your cereal, it's not technically addictive. Which tobacco always has had and always will have in its back pocket. So selling addictive items has got its own consequences, but also its own rewards if you're in the business of doing so. So, I mean, I think you're looking at the highlight, I guess, of the report is the plans to take costs out to get $100 million or so of additional efficiencies, given the scale of the operation. That's something that they could do. But yeah, you're looking at trying to do as much or more with less as an ongoing project, and that includes the costs of implementing such systems. So that the costs they're not immediate. But it's a stable company, pays dividend. But if growth is something you're looking for, you're going to look elsewhere. And if this doesn't figure out a way, I mean, there's plenty of free cash flow. You can keep acquiring more brands. Maybe you're getting less and less from each incremental bolt-on acquisition kind of thing. But there are things to do with the free cash flow, and look for more. Blue Buffalo was one of its bigger acquisitions in the last, I don't know, 8 years or so, and that's the leading dog food brand, apparently, number 6 in cat food. We've got some here, and the dogs are always asking for more. So I think that the surge in pet food, which resulted from COVID, a lot of pets acquired, that's kind of evaporated now, and while you can hope that people keep upping the care for their pets, that the total number of pets is not going to see a surge like it did again anytime soon.
Right on. We'll see what they can do to try to reallocate that cash to maybe more attractive businesses, or up the dividend, or what have you. It's certainly a business that management's got a little bit of a melting ice cube to deal with. Maybe one last story I can throw out here before we go to questions. Have either of y'all bought a car in the past few years?
Yes.
We did buy a car, I guess it was like 3.5 years ago, or maybe at the most. That was our most recent purchase, a brand new Jeep.
Yeah. We bought a minivan last year, right before my son was born. Cars have gotten expensive, significantly expensive. So if you look back in 2012, average selling price just over $30,000. Today, here in 2024, about $48,000 average selling price. That's good for a 60% increase over that time frame. Really, the big jump started in 2020 during the pandemic. Obviously, supply chains impacted such that there was a tightening of supply at the same time that lowered rates led to increased demand, and so you really saw significant increase in car prices. Really post pandemic, up over 20% over that time period. We're kind of flirting with the $40,000 range, now up over $48,000. And I saw a headline over the past few days that really says to me, maybe we're at the point where those prices are gonna start coming down. We've already seen, I think, transaction prices peaked out in 2023, but we've again are starting to see those decisions by the automakers to try to bring more affordable cars to market. The headline I saw yesterday: Ram owner, that's Stellantis, is going to bring back their cheaper Ram Classic pickup to the market. Last year, they pulled it off the market in the U.S. In order to kind of try to get supply back in line because they'd taken so much price. Now they're in an environment where they think, hey, we need to fill this I guess lower cost hole in the market. And for me, I think it says a few things about kind of where we're at in the economy. Certainly, we've seen the headlines out there that consumer confidence is as low as it's been, since post-pandemic, since 2021. We're seeing interest rates increase meaningfully, such that those prices that weren't hitting the consumer, back in 21, 22 because of lower interest rates are now hitting that much harder with those increased auto prices plus higher rates. And now we're in an environment where automakers are having to push prices down to stimulate demand. And we're starting to see that with Stellantis. You've seen other automakers as well start to bring down prices. And I guess if I had a bold prediction, we're doing this new bold prediction show now at 7:00 on Fool24. I guess my bold prediction would be that 5 years from now, we're going to see auto prices lower than they are today. I think we took too much price in the auto market in that kind of post-pandemic period, and now we're in a normalization environment in the market where I think prices are gonna come down. Certainly not an attractive environment to be in as the automakers. You're dealing with this tariff mess. You're dealing with kind of a tapped out consumer having to either engage in kind of more incentives, whether that's kind of rate buy downs, that sort of thing, or lower your prices in order to move the metal on the lot. I don't think now is a super attractive time for automakers, but for consumers, maybe where there's an opportunity for prices to start coming down and for affordability to improve, which I know has been a big issue for consumers out there the past few years. I think it reflects just the state of the economy.
I mean, it's certainly possible, given the questions about many of the tariffs specifically applying to autos. You might get some decent odds on your bet that the prices will be lower or more affordable in 5 years. 5 years takes you outside of this particular administration's 4-year cycle. But given the aluminum and steel tariffs, given everything, including I think what will be some very specific tariffs meant to harm Japanese and German car manufacturers and their exports to this country, which allows American brands, if let's say that happens, as if any of us can predict the final outcome or the intermediate outcome or step one of however many steps there might be. But if that happens, then that allows American car manufacturers to increase their prices because they're competing against things which might have 25% tariffs on them. Who knows? So it not to say that your prediction won't come true. It's just there'll be plenty of people in the market betting many different ways because there's too many moving parts for anybody to really have insight on what ultimately will happen. I'm whether the decision makers themselves know how they are expecting to play this out, I don't know.
And where they likely will be doing all of that betting, Bill? Robinhood. Robinhood introducing the sports event contract style gambling, wagering, right? I mean, it's sort of a predictions market they're introducing into their app. Ricky and I talked about it yesterday on Motley Full Money, and I don't mean to sidetrack the conversation there. I just thought it was fascinating, and I don't know that I like equating gambling with investing. To me, that two very different things, and especially when you're talking about younger investors, we're trying to introduce them to the benefits and the lifelong impacts of good investing. And when you bring gambling into that mix, it gets messy. Though I guess you could argue, I mean, you get cryptos in there, and I equate crypto with gambling. I mean, so I don't know. Yeah. Maybe that's
the Venn diagrams for investing and gambling overlap. Those circles, especially meeting around day trading and crypto, I would say fits into the meeting of those two. I don't know. A lot of crypto can't possibly qualify as investing in the most generous sense of the term, but some might. Yeah, I think that Robinhood is, I suppose, going where the opportunities are, and probably a lot of their clientele, I don't know what percent, is engaged in, types of day trading that would be more closely aligned with sports gambling and other, similar things. So from a business perspective, what was your take, leaving the morality out of it?
Well, I mean, I think I would assume, now I don't know this for fact, but I would assume that Robinhood's demographic skews younger. Yep. I think based on the data we saw yesterday, it's around 25 million. Yeah, 25.6 million funded accounts as of February 2025. I would imagine it skews young. And in that case, that is a demographic that is, we've seen a lot of data here, very interested in the sports betting market, right? As sports betting has come online and become very popular. And so to me, yeah, morality, ethics, whatever you call it aside, from a business perspective, it makes sense, assuming that they can actually run it efficiently and effectively. It seems to me to be an effort to juice that average revenue per user number. I mean, because that's really what it boils down to for them at the end of the day. And I guess you have to wait and see. I mean, it's important to note. I mean, it's not betting, right? It's sports event contracts, right? It's event contract wagering, which is essentially that functions more like a marketplace where traders can buy and sell those contracts based on the predictions and sort of the up to minute forecast that anyone may have, as opposed to just like a straight bet that you would place, you know, in DraftKings, where you're putting $5 down on Alabama State to win the game, and you know, you're either going to win or you're going to lose, and you're betting against the house. I mean, this is a little bit of a different, more nuanced, and a few more moving pieces, right? A few more moving pieces. But I mean, I don't blame them for trying it from a business perspective. I mean, you give your audience what they want, and if the audience wants it, then they're going to do it, and if they don't want it, well, then they're not going to do it, and they'll move on.
Yeah, I mean, it makes the site stickier. I don't know if you saw by any chance the John Oliver piece from last week tonight on HBO or Max or whatever it's called these days on Sunday, which was an excellent piece, both in terms of the comedy and the actual news delivery. But the sports gambling market is thriving. Obviously, it's a target for a lot of satire. But also, I went to a game for the first time in, you know, sort of post-COVID or something like that last year, and just taking the metro there and getting off and walking to the stadium, I was educated that what I was doing was going to a gambling event, basically, at which maybe there would be a little baseball played. But the primary thing that I needed to be aware of was the opportunity to bet on that game and all others. And it really has fundamentally changed every part of sports. Every part of Sports Center, you know, is targeted at your gambling opportunities. We're about to be awash in one of the biggest gambling, you know, events of the year, at least in this country, being March Madness. So it's a place where Robinhood sees a lot of rewards, whether they realize them or not.
Yeah. I mean, I think $3 billion is supposed to be bet over the course of the tournament, which, you know, it's only that in the Super Bowl in terms of kind of individual events. But yeah, I mean, if you look at Robinhood, where they get their revenue, I mean, the vast majority of it is coming from transaction-based revenue related to kind of cryptocurrency and options and things like that. And you know, the smallest chunk of their revenue is kind of from equity trading. So it's in the same way that DraftKings and FanDuel want to push you to parlays, because parlays are significantly more profitable than straight bets. You see some of these other platforms trying to push you to things that are more profitable for them. I think that's no different than the casino, if you want to use that analogy, pushing you to the slot machine instead of, you know, the blackjack table or what have you. And I don't begrudge the companies by offering these. If there's demand for anything, the market will supply that demand, and the folks will try to profit from it. But with more options than ever, I think keeping your discipline as an individual investor and focusing on the areas of the market where there is positive expected value for you, which is not going to be in these prediction contracts and is not going to be in, you know, most options contracts. That's where you're going to have more success in an investor. And I think there's more distraction than ever, and more things to wade through and ignore. It's almost like walking into a casino and having to ignore all the flashing lights and things like that. It's more like that than it's ever been before. And if you can be disciplined, you could argue there's probably more opportunities out there, because people that would have been, you know, investing in equities are now putting their cash to work in other places, or putting their cash, you know, spending their cash in other places. And, you know, on the margin, maybe that creates more opportunities for folks that kind of stick to their knitting in equities. I know I haven't participated in any of these prediction contracts on Interactive Brokers or Robinhood or anywhere else, but I'll probably put a few dollars on the tournament, you know, for fun. Alabama's in there, so I'll pull for them. But listen, it shouldn't be part of your core investing strategy. If you want to grow wealth for your family, it's about owning, you know, equities, owning companies for the long term, less about predicting who's going to win on Saturday.
That's exactly right. And I mean, like you, Nick, I mean, I love to put $5 down on a football game, right? I'm not a big gambler, but you know, it's fun. I mean, it's entertaining, right? That's at the end of the day, it's entertainment. I think what's going to be interesting to see with the Robinhood sort of predictions market or whatever is, because it's not just sports, right? I mean, I think it's going to be sports, but do you want to bet on the Fed's decision? You can do that. You want to bet on who's going to win an election? You can do that. You want to bet on when the tariff war is going to be over? You can do that. I mean, that to me is kind of, so you're kind of betting on the news. It's not just sports. I mean, they're expanding this opportunity you could bet on virtually anything. And that, honestly, to me, I mean, I know I have no interest in doing that. It's just not my thing. But going back to Bill's point there earlier about companies that sell addictive things, I mean, gambling is addictive.
Yeah, I was
it can be a real problem.
Yeah,
it can be a real problem, and it's
well,
open up a world of pain for a lot of people.
I mean, it is addictive. It is legal, so it falls into that category for businesses of having, you know, a legal and it regulated. So it's in a way that's a, you know, a legal addiction. Caffeine and coffee are also legal and addictive, and we've all got some coffee, maybe, again. It's usually the case. But yeah, it's a slightly different type of addiction, an incredibly healthy one, by the way.
I love whenever I see those articles, it reminds me when Chris Hill was here. And every time he would see any of those articles, I mean, it was always a point. He would either tweet it or we would talk about it on Market Foolery. Because, hey, listen, when you find the data that supports what you want to be true, I mean, you shine as many lights on it as possible.
I mean, but the number of things for which coffee has been identified as potentially beneficial is truly gratifying to those of us who drink way too much of it. And
say if it's healthy, I'm going to be around for a while.
Nobody has come up with the supporting data showing the health benefits of addiction to gambling, of which there are none. But
very true.
It is legal. It's addictive. It therefore is a very powerful potential business opportunity, and Robinhood is getting in on that, and they're far from the first, but they're I guess tweaking it. I mean, if it's contracts and not gambling, are you sort of taking a position on a game and then hoping to sell it at a better price in the middle of the game? You know, and so I'm not really gambling. I'm just betting on where, you know, this contract is going to trade later.
Like options for gambling.
Yeah.
Right. It's a brave new world. We'll see where it goes. I would predict it will be a meaningful revenue line for some of these brokerages before too long, for better or worse. All right, let's go to some questions.
Well, I did see in Slido, someone noted that Williams-Sonoma finally released their earnings report. I mean, I could give you a quick look at that. I mean, the stock, I think, is down about 9% right now, and just open up down about 9%. And I mean, real quick look at the release here. I mean, nothing that really lights the world on fire. Comps up 3.1%, not bad. Gross margin ticked up 130 basis points. I think full year results, not all that exciting. Comps down 1.6%. The guidance, I think, is what probably has the market a little bit less than enthused here. It looks like at the midpoint, revenue is going to be flat. They're going to see some operating margin pressure there. This is a company that certainly could witness some impacts from any potential tariff policies. And I think the good part, they raised their dividend. The quarterly dividend 16% to 66 cents per share. So at least you are being paid to be patient. But this is a stock advisor recommendation, at least, that I feel like has done very well for the service through the years. And if you look at the 5-year chart, I mean, the stock has done pretty well. I mean, I think, it's up better than 200%. But yeah, it didn't look like a bad quarter. Just doesn't look like the rosiest of outlooks. And I think that kind of goes back to your conversation you were having, Nick, there, in just regard to the state of the consumer and prices and kind of where we stand. Obviously, Williams-Sonoma is a little bit of a higher price point.
But yeah, I mean, we've seen other retailers kind of comment on that. I mean, Walmart had a kind of a negatively received guidance by the market when they reported earnings. I think it was close to a month ago. Now, they had been the really strong spot in 2024 when it came to kind of retail performance. Abercrombie and Fitch had been performing incredibly well in apparel retail. They also guided for, kind of a tepid growth here in 2025. So, if you could choose to read between the lines there to say, it's kind of a tough environment for the consumer. As I said earlier, consumer confidence, relatively low. And so, maybe that's trickling through into discretionary purchases at Williams Sonoma. I do wonder how much of this is, headline driven as opposed to, true kind of economic kind of hurt, right? Because there's a lot of chaos in the news. But I don't know, how much has trickled down to kind of individual purchase, that sort of thing. So, we'll see how long this kind of, I don't know, as vibe. Have you heard the vibe session term? How long this kind of vibe session continues, or whether it turns into a full blown recession?
Well, it's hard to comment without having read the report. But if it's a similar dynamic with what General Mills said, here's our guidance, but on top of that, maybe tariffs. Don't know. Any kind of equation that you're trying to run, either at the management level or at the investor level, of, well, I can't really know as much as I would like to know about how things are going to go. So I'll build in, a little bit more margin for error in terms of the price of a stock, or, in terms of management decisions. The margin for error becomes like, let's hold on some of our cash. Let's make fewer investments when we don't know what kind of cash we're going to have over the course of the year. So whether that takes something beyond a vibe or not, I'm not sure.
Right.
But I think, 3 months ago, last sort of earnings cycle, there was general positivity. Like, things look great. Things look great. We expect them to be even better. And that's not, the controlling story this earnings season. And whether 3 months from now it's reversed again, who knows? But because no one knows, I think that the opportunity to build in a margin for error, and there wasn't much margin for error built into stock prices a month ago. And one could still argue there's not as much margin for error built into stock prices as reflected in the multiples today as there historically is. So how that plays out, we'll be here to watch and comment on.
Sure.
Indeed. I thought there was a good question here that probably we could all deliberate for at least a few minutes. And I'd be interested to see if we all agree or disagree. But Fool from Canada says, I'm a long time disappointed holder of Disney. Seems like there are better risk-reward opportunities in the markets. Is it time to finally move on from Disney? What say ye, Bill Barker?
A similar boat in terms of long-term disappointed shareholder, not directly, but bought some once upon a time for my kids, and they hold that against me, or should, I suppose, because although it aligned with hey, here's Disney, learn about this stock, you watch the Disney Channel, and go to Disney World and things like that. So here's a way to get interested in investing. That's all good, but the price didn't go up as much as over that sort of more than a decade long journey. I am cautiously optimistic that it's such a diversified and critical brand, and Iger's history with the company is certainly more good than bad by a lot. So this is his final chapter. One hopes he's going to actually leave at the end of his tenure for good this time. He deserves some rest, and they need, I think, to have leadership that without him looking over the shoulders of the next one. And I think because there's so much that can go right with the company, I'm optimistic, but I certainly understand anybody who's had about enough.
Nick, any thoughts there?
Yeah, I mean, I think Disney likes to say this, right? If you aggregate all their channels and platforms, they have the most viewership of all the big kind of media companies, even more so than Netflix. I think it's really an important business. Still is one of the most dominant media companies. I think, you know, you look at how Paramount and how Warner Brothers Discovery have handled the transition to streaming. Disney's certainly done much better than those kind of, if you want to call them kind of legacy media businesses. And I think Disney's going to kind of be able to make the transition to streaming. I don't think it sets the terms of engagement in the entertainment world the way it did 15, 20 years ago. That is being set by folks like Netflix and YouTube and Amazon. But you know, I don't know. For me, if I'm going to invest in media, there's other places that I'd prefer. I've talked a lot about, you know, TKO Group as a company that's really an arms dealer to all these various different streaming services. I would argue is the most important partner for the ESPN Plus platform, has been important to driving subscriptions there. I'd rather own a different part of the value chain. That said, I don't think Disney's going to go anywhere. I think it's going to be an important media company 10 years from now, just like it was 10 years ago. But I do question their ability to dictate the terms of the market that they maybe have been able to do in the past. I think that's out of their hands now.
Yeah, I think that's a good point there. They don't hold the same strong position in the value chain that they once did. It's far more competitive now than ever before. And so, like you said, they don't necessarily get to dictate those terms as they maybe once did. I think, like you, Bill, I would put myself in the cautiously optimistic camp. And Disney's not a company that I own directly. It's the first stock that my daughters ever bought. And they've owned it for, dude, it must be, golly, 12 years, something like that. I mean, they've owned it for a while. And so it's not outperformed the market, but it's made them money, right? It's just one piece of an overall diversified portfolio. There's a lot of pessimism out there in Disney right now, I think, from leadership to questions about ESPN, questions about streaming. You know, the one thing that we know that really is just almost undisruptible is the parks, right? I mean, it's not to say it's not disruptible, but it's a really strong competitive advantage that they have there in the parks. It's very difficult to replicate that experience, if not impossible. And so I think the one thing that just really irks me with them, I don't understand why their dividend yield is just 1%. I mean, I think it could go a really long way if they would just throw shareholders a bone and really start juicing that dividend, and at least give shareholders a little bit more of a reason to be patient. Who knows? I mean, maybe new leadership takes a different view, but yeah, I think they really need to get past the Iger situation. And I think they will. This time, I think, is the last time. But then it's going to be a question of who new leadership is and what their priorities are. So I tend to be a little bit more in the patient camp. I mean, I don't mind being patient if it's a business that I feel like has many strong qualities, especially if I feel like it's a business that's sort of in transition. And I think Disney is a bit in transition right now. But there are definitely things they could be doing better.
When did they cut the dividend?
Oh man, they cut the dividend. I mean, was that COVID related?
Yeah, I think so.
I think that was COVID related. So maybe it's like 2020 or 2021.
Yeah.
And they suspended it for several years. And I mean, that's the other thing, it's a semi-annual dividend. It's not like a quarterly dividend. And so that's another thing that I feel like they could just do things a little bit better on the income side of things to just throw shareholders a bone, so to speak.
I'm looking at the data now, and they had an 88-cent dividend per share in 2019, and then eliminated it. That was December 2019, so eliminated it in mid 2020. Understandably, I would say. And reinstated it at the end of 2023. As you say, it's a semi-annual. They bumped it up from 30 cents to now 50 cents over that time period, but still, still below where it was 6-7 years ago. And that is not confidence inspiring. And that's one of the reasons, one of the many reasons why the stock has not done it better than it has. It visited strange prices at the end of 2021 when, I don't know, everybody was buying everything and the world was going to have changed, and their streaming had gained some traction, and everybody was watching the Star Wars and Marvel streaming shows, and then everybody stopped doing that, and they've returned to the parks and the cruises, and they're diversified, and there's always going to be a pretty strong floor here, but I would say a more limited ceiling because of the number of different ways, the number of different places they are. They're still losing people at ABC and the Disney Channel and the cord cutting, so they make up for that with the streaming and the parks, but they've got legacy things which are shedding viewers and subscribers, and then they've got sports betting now with ESPN, so they make up a little bit here and there, and they lose in other places. So there isn't one story here, right? I mean, there are just so many different things, puts and takes, as one might say, and it hasn't added up into something that's rewarded shareholders. But I don't know, maybe if they scale down in the right way, it will.
Yeah, we'll say on the positive side, we're probably much closer to the end than the beginning of the kind of streaming capital cycle, right? Of everybody throwing as much money as you possibly could to make as many original shows as you could to try to build up your streaming service. If you've spent any time on Netflix over the past year, you've seen that's reversed, because you've seen lots of HBO shows and more AMC shows and those sorts of things on those platforms. So the intensity of spending has come down. Maybe the streaming industry is going to get more kind of mature and healthy, but you still have the question of, will streaming ever be as profitable for Disney as home video was in this new era? Is the company, can it get back to its previous strength, even if things go as great as hoped? That's where that question is tough to answer for me. Yeah. If you've held all the way through, I think it's more attractive now in the capital cycle than it would have been 2 or 3 years ago.
I mean, they'll have to continue ticking prices up, much like Netflix has done, right? And I mean, I think that's always been the question with Netflix, is like, how far can they take that? And I mean, to date, right, they've been able to exercise some very impressive pricing power. I think Disney probably have that to a degree, but I think one of the concerns that they've really exhausted some of these problems, like the Marvel and the Star Wars property. I mean, they have just flat out exhausted those things. I mean, to the point where they are annoying, and younger audiences don't necessarily identify with the nuance or the nostalgia of a Star Wars, right? I mean, like, Star Wars for us means something different than it does for 5-year-olds today. And so it almost makes you wonder if they're not going to be almost forced to make some kind of an acquisition, a la Marvel or Pixar or Lucasfilm, to kind of keep that content ball rolling, or if it just boils down to more partnerships and relationships across the streaming universe. I just don't know.
Or just focusing on the best properties, and let's go wider and wider and wider. Let's have more and more movies that introduce more and more characters, and we could have just done some more Avengers stuff, and that probably would have made a lot more money. In Star Wars, I would say Andor season 2 is coming out soon. That was probably the best Star Wars series they've done so far, and if they just do Mandalorian and Andor, rather than let's keep thinking of new and stranger things to explore in the Star Wars universe, then maybe that ends up working out better for them than thinking that there's an infinite appetite, which there is not, for every idea they can come up with.
Didn't Moana have like a pet chicken or something like that? When I see a series coming out about that pet chicken, sell Disney. Until then, let's be patient. Let's give them a shot. Let's at least see who new leadership is and what their plan looks like.
Yeah. Zach's a fool, just kind of going off of what we've been talking about. Says, did any of you follow Nintendo? I see some similarities between it and Disney, although I tend to favor Nintendo as an investment. I put Nintendo in a little bit different category, although they're similar in the sense that, maybe Mario and Mickey Mouse kind of rhyme, and that there's the kind of cartoony characters. What I said about Disney not kind of having the same control over the kind of the terms of engagement in their industry, I don't think is true for Nintendo. If you look at what they did with the Switch, I mean, the Switch is like almost double or 50% more sales, compared to the other big platforms like Xbox and PlayStation 5. They've gone a whole different way than the rest of the industry, focusing on a kind of mobile first form factor as opposed to the other ones that are kind of the tabletop console. Also, whereas everybody else has talked about, hey, we're going to push graphics further and further, Nintendo has kind of stuck to their knitting and just made high quality games and been less concerned about some of those things. So whereas Nintendo, their portfolio of characters, the legacy of the business, that sort of thing. They also have their own theme park now, right? They just opened the third Universal Park, which includes a Mario Kart world. There are a lot of similarities, but I think the Nintendo's positioning in its industry and its ability to set the terms for itself, I think put it in a much stronger position than Disney, which has had to follow Netflix into the streaming world and compete, by the rules that other folks set. I don't know. Y'all thoughts on Nintendo?
I do not have any. It's not a company that I've paid attention to. I mean, I grew up playing Donkey Kong, and that's about as far as I could take it.
Right on.
I don't have any insights on Nintendo.
Yeah, you mentioned though, it is interesting too. They've just had this Mario movie. I mean, there's opportunities for some of these video game companies to monetize in new ways that they haven't historically. You're seeing more of that, right? I mean, just had the Last of Us show on HBO. Obviously, all the Sonic movies have been incredibly successful. I think that's an interesting little angle for these video game companies where they can continue to monetize this IP in a way that they haven't been able to historically. Yeah. So anyway, all that to say, I like that category a little bit better than some of the older businesses in media, because I think they're a little bit more challenged.
I think that's fair.
Fool from Canada has a question addressed to me I can answer quickly. Nick, I think you said before you preferred the Brookfield subsidiaries like Brookfield Infrastructure Partners, Brookfield Renewable, and Brookfield Asset Management instead of Brookfield Corporation. All the rest of the Brookfield Canadian team prefers Brookfield Corporation. Is that still your opinion? Yeah, for me personally, I find the Brookfield Corporation's accounting to be a black box that is impossible to decipher, which just makes me uncomfortable. And making it a big chunky position. I do think it's a little bit easier to understand what you're buying when you're buying the subsidiaries, but they have some of their own challenges. I mean, Brookfield Property that owned malls had to be kind of taken under by the big Brookfield parent company. So I do think it's a little bit easier to understand the accounting with the subsidiaries. I don't own Brookfield as a whole, again, because I think the accounting is a black box, and it's just you kind of have to trust management, and I don't trust management maybe to the same extent that the rest of the Canadian team does, and that's okay.
Yep. That's exactly right.
Skip has a question maybe we can all weigh on. And what are the best resources to track insider buying? How do you stay on top of insider buying for the companies that you follow? I mean, you can SEC filings, Form 4s.
I mean, there's services that track that stuff. Like, I mean, what is it? Insider Monkey, I think, is one. Maybe that's a subscription that you have to pay for, I think. But there are services that track that stuff as well. But yeah, for me, mostly it's just occasionally going through looking at the Form 4s.
Yeah, we have data providers in-house that aren't going to be the same ones that most people are going to be using. So we end up, using those. But I, as Jayson says, just ask your favorite AI model the question and see. I mean, it doesn't have a lot of up-to-date information at times. You've got to ask it a couple questions about how recent its information is, but let it do the first leg of work, and then maybe point you to its sources and little trial and error probably get you a good answer pretty quickly.
I feel like, I mean, how far are we away from like prompting becoming a major in college, right? Because I mean, that's really when you're using these AI models, Gemini or Chat GPT or whatever. I mean, it all boils down to the prompt. I mean, right? It's making sure you communicate what you want effectively.
I have to say that if that occurs where prompting is a major, that will be a truly sad day for.
Well, I mean, our
university.
Courses, there's Survivor courses and Taylor Swift courses. I mean, at some
a
point,
course, sure, a course, one course on how to go about prompting probably would be very, very valuable. Certainly, like a segment of a course on that otherwise focuses on research techniques. Sure. But a whole major, that would be, I mean, you'd get hired, I suppose, if somebody like this guy's really good at prompting.
Yeah.
Where
feels get like a PhD in prompting.
Feels like it's a skill you could just ask AI, how do I prompt better?
Yeah. I mean,
like, what's going to get me a better answer? Teach me.
I kind of think that it'll be like typing, where, when the typewriter came out, there were all these secretaries and people whose job was just to type, and then it became a skill that everybody had to have to kind of be competitive in the world. And I think right now we're in the era of there's people who just do prompting and they're so focused on it. But I think, 10 or 15 years from now, it'll be a skill that everybody has to have to a certain extent. And, there will be people that can type 100 words a minute. They can prompt it that are at a superhuman level. But I think it's a skill that everybody will have to remain competitive. Just like if you can't type today, I mean, you're fighting with one hand behind your back.
It's like the evolution. It's like the evolution of search. I mean, you want to be good at search. I mean, that's prompting to an extent, right? I mean, you're typing into the Google search bar what you want or what you're looking for, and you sort of learn how to get better at it the more you do it, and it's absolutely essential today. And I think I see these. What do we call these Geminis? I mean, they're just chatbots. Is that what they are? I don't even know. I just call it Gemini or Chat GPT, but whatever. It's, chatbots, whatever they are. I mean, that's going to be more and more the way that people kind of go about this search needs, I think, because they can be very robust. I mean, they're not always right, but I think that'll get better as time goes on. And oftentimes they'll provide source material, which I think is really encouraging, because you can, much like Wikipedia, right? You say Wikipedia is not a source; it's a place where you can go find the source, right? And that's the nice part about it, is you can actually find the source to then go confirm. Like Bill, when we talk about earnings, right? Don't read the Wall Street Journal piece on the earnings. Read the company's earnings release. Yeah, go directly to the source. I don't need editorialized opinions on maybe what happened during the quarter. I want to just read the straight facts and get the straight facts from the actual source, the company itself. But to me, I view it as kind of the evolution of search. I mean, it's Search 2.0, and I think it's exciting. I mean, I think those tools are very helpful in a lot of ways.
Yeah, certainly evolving how we engage with data and information. We've got time for maybe one question. We have 2 minutes left. Maybe we can answer unknown writer's question. Talking about dividends, would you purchase a stock just because of the amount of dividends that it pays?
Not solely, because just for example, I mean, you could look at an energy stock perhaps that has, juiced up some 8-9% yield or something like that. That looks great, but you have to ask yourself, why is that the case? And that's notoriously cyclical industry. And so then you have to expect at some point. So I wouldn't buy solely based on the dividend, but it's absolutely something that, well, hey, why is this the case? And is this an attractive business? Because I mean, it's always nice to get cash in the pocket, but not solely.
If you were to do a screen for just give me the highest dividend paying stocks, that's a pretty good way to eliminate your dividends, because as something gets into 8, 9, 10%, it's fairly obvious that is going to be cut.
Yeah, there's a reason.
There's a reason why it's so outside the norm. And so dividends for the S&P 500 currently, I think the latest stat, I'll look it up, is slightly less than maybe around 1.5%. 1.35% is the dividend yield for the S&P 500 over the last 12 months. Current indicated rate is 1.38. So, you can look at your General Mills and your Disney, and not Disney at the moment, but you can construct a portfolio of reasonably sound blue chip companies that might get you, I don't know, you could get 3%, I guess. I mean, you'd be taking a little risk, I think, in the terms of the quality of the companies, but you'd probably be okay. And so it's more of a strategy historically, and with good reason, for people in or near retirement, and to have a reasonably predictable income stream, and less so for people looking to, at the start of their investing career, looking to grow the total amount. So yeah, I mean, I think that as you get to needing an income stream from your investments, being more aware of the dividends is critical.
All right, folks, that's all the time we have. We're actually 1 minute over. Thank you, everybody, for spending this past hour with us on the morning show. Hopefully, we were roughly good. We'll try to do even better next time. Now, so we've got Bro and Dan Cap here for Financial Planning Hour. Fellas, take it away.
Thank you, gentlemen, and welcome everybody to the Financial Planning Power Hour. It's Dan and Bro going to spend the next 60 minutes answering your questions about financial planning, retirement planning, tax planning, estate planning, college planning, asset allocation. Maybe if you have questions about mutual funds, where to put your cash, when to claim Social Security, we will do our best to answer your questions. We have some questions leftover from yesterday because we got so many, which is great. We love it. So please get those questions into Slido. You should see it on the right. Otherwise, go to Slido.com, enter the code Fool24. As we kick things off, I'm going to just do a little bit of a market update. I know that we are all aware that the market has been a little wonky over the last few weeks has really been the main issue. I'm going to share here. I just pulled this data from Morningstar this morning. This is as of the market's close of yesterday. I like to look at exchange-traded funds based on indexes to give us an idea what's going on in the market. And you can see here the total return year to date, total return 1 year, meaning the past 12 months, and then the annualized 5-year return. Now, this is an interesting time to be looking at this because 5 years ago is almost exactly when the market bottomed after the pandemic panic. So the market started to tank around February 19th, 2020, and it dropped by more than a third over the next few weeks. And it bottomed, I think March 23rd was the day we bottomed. So look at those 5-year returns for all those types of stocks. You got the S&P 500, you got the Dow Jones Industrial Average, you got the NASDAQ 100, small caps, international stocks, and then bonds. With the exception of bonds, the 5-year returns since the bottom of the pandemic panic have been extraordinary. Really outstanding returns. So when you look at that, I think it's reasonable to say, well, it's probably okay for the market to be taking a little bit of a breather. After all, when you have returns that good, you're going to have a market that is going to be a little pricey, above average valuations. And we know that at some point, markets, when they are at high valuations, they don't stay at high valuations forever. So part of this is, I think, what you might expect. Now, looking at total returns for year to date, they don't look so bad. That's because January was a pretty good month. February, the first half was a good month. It was really February 19th again, which again was the day the market topped during the pandemic. Things changed. So it's really over the last month or so that we've seen bigger drops. So you could see there, the S&P 500 down about 4%. Dow Jones about 2%, NASDAQ 7%. Small caps getting hit harder at down almost 9%. International stocks up 9% so far this year. And it's even better for developed market stocks, places like Germany and things like that, right? Part of it is valuation. International stocks are just so much cheaper than US stocks right now. But also, Europe is basically saying we need to build our own economy, our own defense industry, our own tech industry, due to trade wars. So they are willing to borrow more money to invest in their own economies. And then we have bonds. Bonds are doing pretty good this year as far as bonds go because interest rates have been drifting downwards. I'm just going to have one other slide, and this is all the individual sectors. And again, same things here, year to date, 1 year, 5-year return. What's interesting is despite the fact that the market has felt pretty tumultuous over the last month or so, maybe even year to date, only 3 of the 11 sectors are down for the year so far, and only 2 of them is the downward trend significant, right? So let's talk. At the top there is communication services down just a little bit. Top holding there is Meta, which is down just a little bit. The second holding there is Google, which is down 15%, and this gets into the whole Mag 7 thing. And then the next top holding for that is Netflix, which is actually up a little bit this year. Consumer discretionary, that's down the most so far this year. Its top holding is Amazon, down 12%. The big reason why this is down, its second holding is Tesla, which is down 44% this year. And then let's move on down to tech. And there the top holdings are Amazon, NVIDIA, Microsoft, and they're all down somewhere between 10 and 15%. But the point being, of course, is that if you've had a widely diversified portfolio, chances are you have plenty of stocks that are doing pretty well so far this year, which gets back to the whole idea of diversification. That's it for me, Dan. What do you got?
Yeah, so that's a good segue for what I was looking to talk about, because diversification, I mean, it's something that, and you cannot draw any conclusions from a month or a week or even a year to date in the middle of March, because 2.5 months just doesn't matter. It's just not that big of a deal. It's short-term thinking, and to draw too many conclusions from short-term thinking is not going to serve you well. But here's what I'm thinking when it comes to this. If you have seen in recent weeks some of the stocks that you've held that have been underperformers in this growth-oriented market, if they've finally started to wake up, then congratulations. I've seen some of those come up in my portfolio as well. Berkshire Hathaway, ticker BRKB, in particular, heading up to new highs, and it has been sort of a pleasant contrary performer on some days. There have been some days when the market was way down and Berkshire was actually up. Some other times when Berkshire didn't escape. It's part of the S&P 500. When you have market index issues, it's often going to get pulled down with the rest, but not necessarily down as much as some of those high flyers. And so it's always nice to kind of see that. But it also is a reminder that, you know, it can make sense in times when, whether it's a broad asset allocation where you're just talking about stocks performing relative to bonds and other asset classes in which you're invested, whether you're talking about inside of stocks allocations, sub-asset allocations to different types of stocks, whether you break that down by the size of the company, large cap, small cap, whether you break it down by investment style, growth companies versus value companies, whether you have your own kind of self-proprietary system, taking a look, seeing if your portfolio is consistent with your risk goals and your particular preferences when it comes to volatility is important. And so rebalancing is, and I put rebalancing on the topic list today just because I think it's valuable to look at. It's valuable to look at on the upside when you're at new highs, and to make sure that if there is a stock market correction, you don't end up taking a bigger hit than you expected. And then after a correction happens, if you have a situation where suddenly you are not as exposed to the stock market as you want to be, then rebalancing to get that done can be really helpful. And just to sum up kind of a lot of the guidance that we've given in the past, when it comes to rebalancing, there's a couple of things that you can do. One is just to make the outright switches in your portfolio. So if you're heavy in one area and light in another, you just take a portion of your assets in the heavy area, sell them off, and buy assets in the light area. That's easy to do with ETFs. It's easy to do with funds. And if you have individual stocks, then it's just a question of taking the positions that have done well maybe taking the position in which you have the least conviction and trimming that and taking the proceeds and looking at the stocks that have underperformed and ideally putting some of that money into your highest conviction areas in that can serve you well in the long run. I'll stop there so we can get to the questions, because we've got questions. I'd love to have questions, but I haven't had a chance to look at the questions yet. So, bro, did you have a couple that you want to grab, or should I go on the fly?
No, I'll grab a couple that we received yesterday.
Okay.
One question came from Ed. Is there any time you can convert your traditional IRA into a Roth without paying taxes on your conversion? And the answer is probably not, because when you convert money from a traditional to a Roth, it gets added to your taxable income. The only reason that I can think of where you wouldn't is basically you just have no income. And there are people in this country who basically pay no income tax because their income is so low. So it could be a situation if you have a year where you're just living off Social Security, for example, you could maybe convert a little bit and not have to pay many income taxes on that. But even that, as I'm thinking it through, the more income you have, the more you risk that your Social Security is subject to taxes. So I would say the answer is probably not. But there are definitely situations where you're going to be in a lower tax bracket. And one of the scenarios I discussed yesterday was what we often have is, people work, they're earning a certain salary, then they retire. They generally have less income when they retire. Plus, when you're 65, you get a higher standard deduction. So you often drop into a lower tax bracket when you retire, let's say 65. But you have a lot of money in your traditional accounts and you're worried about the RMDs you're going to have at age 73. What some people will do is small conversions along the way, because it's not an either all or nothing situation. You can do small conversions, just enough up until you bump up until the next tax bracket. So maybe you're just staying within the 12% tax bracket, or if you feel it's important, the 22% tax bracket, but not going higher. That's one way to do it. So you should certainly consider conversions in low income years. Dan, did you grab one? Or you want me to take another one from yesterday?
I did. Am I muted? No, I'm not. Good. So I'll take this from, I'll take a couple. First one I'll do is Mike G from 4 minutes ago. Then I'll grab Jimmy G. We'll do the G and G tag team here. Jimmy G on cash at this time. First, let's talk to Mike, a person. Mike, this is great. You guys are so good. You follow the rules. We cannot give you personalized advice. And so you don't say, my kid bought 5,000 in collectibles, or you bought 5,000 in collectibles. A person. That is great. Mike, this is great. And I'm poking fun only because I love it. Okay. So just take it in the right context. A person buys $5,000 for collectibles of collectible packs, sells 3,000 of some. I'm assuming that is a subset in a short term, less than a year or less, which is reported by eBay on a 1099K. How can taxes on this be minimized? So, Mike, obviously, I can't give general tax advice to anybody, and so the situation's going to differ depending on the particulars involved. But here's the thing, and this is one that I don't really know a whole lot about. You buy, and I'm going to use baseball cards because I'm old, and this is what I do. I know that there's Pokemons and there's all kinds of stuff, but I'm going to use baseball cards because I get them, and I think it's easy to explain. Like, when you spend $5,000, heck, when you spend $5 on a collectible pack, on buying baseball cards, it is a crapshoot. You are buying packs. You don't know what's in the pack. Maybe you get the card of the superstar of the year, and maybe you get a whole bunch of utility players nobody's ever heard of, unless you're playing in a fantasy league or something like that. When you buy the pack, it seems to me that your tax basis is in the pack. And how you allocate the tax basis across the pack, I'm not really quite sure how you would do that, because clearly the individual cards in the pack have different value, and they had different value when you purchased the pack. But you didn't know what the value of those was because you didn't know what was in the pack. They were wrapped up. And so the question becomes, okay, yeah, if you cherry pick that pack and yeah, you got one superstar and a bunch of middle players and, you know, some players nobody cares about where the card just isn't that really worth much. How do you do that? Now, I don't really know the answer. I can say that, you know, there's a couple of methods that I think if I had to guess, there's a couple methods that I would be tempted to argue and talk to my accountant about and see what they thought about it. Number one is that if I took $5,000 and in exchange for that, I got packs that had a total 5,000 cards in them, then one argument I could make is, okay, $5,000, 5,000 cards, $1 a card. My tax basis in each individual card is $1. And then if I sell some of those cards, then I'd look at the number of cards and I'd look at the number of, relative to the number of cards in the total that I bought. And I'd say, okay, I'll just allocate my basis on an arithmetic, on an average basis. And so I sell 50 cards, $1 a card is my tax basis. The tax basis for the lot of 50 cards I'm selling might be $50. That's one way that I might talk to my accountant about it. Way number two would be, I paid $5,000 for 5,000 cards. But really, the only one that was worth anything was this one superstar. And I decide I'm going to sell that. And I'm going to sell it for $3,000. You could try to make the argument that it should not be $1 a card, that most of your tax basis should be allocated to that one card. And the argument that I would make there is when you purchased the pack, when you purchased the lot of 5,000 cards, you paid $5,000 for it. You didn't know what you were buying, but the value of those cards was already defined in relative terms. You could go to a catalog, you could look to a specialty book, you could look at online pricing, you could figure out that one card was worth the bulk of it and everything else was just like a 5-cent card that's sort of like, yep, you got to fill the pack up with something. And so in reporting that, you could argue, okay, yeah, my tax basis, I'm selling one card, I'm selling it for $3,000. It's the winner of the card. I'm going to argue that my tax basis is not $1. I'm going to argue it's something higher than that. And my feeling on that is if you can document that, then it may be a position that if you get audited on, that you would feel comfortable defending, and that you may be able to defend successfully to the IRS. Now, keep in mind, the 1099-K form that eBay reported, it doesn't have anything to do with the value of what you sold. All it does is say what the proceeds were that you received. And so it doesn't have tax basis information. There's no way for eBay to know what you paid for that. They don't care. They just want their 13% of the proceeds. And so if you have a defensible position, that's how you're going to minimize the taxes, is by kind of thinking it through and trying to figure this out. There's a lot of nuance here. Did you buy the collectibles all at once? Did you buy them separately? I mean, I could spend a lot more time than I already have, Mike, kind of talking about this. But those are the issues I would talk over with your accountant in trying to figure out how to report this in a way that is going to minimize your taxes. And then Jimmy G, is it better to be more in cash at this time, given the uncertainty? Jimmy, I'm not one to tell people how to invest, but I do know that usually the time to make major asset allocation decisions, and this question, I mean, you haven't necessarily said it's a major asset allocation decision. The time to consider these things is before the uncertainty comes, not after. Now, that's a lovely thing to be able to say in hindsight. And I do apologize for that because, it's human nature. We think about these problems after they come up rather than before. It's tough to pre-plan this kind of thing. The question that, there is a mathematical aspect to this. There's an emotional aspect to this. From a mathematical standpoint, in times of uncertainty, the stock market goes through corrections. Sometimes it goes through bear markets. If you sell at the bottom of those corrections, then your performance will suffer relative to the broader market. And unfortunately, market psychology tells us there have been plenty of studies, and you can actually see this in mutual fund flows that Morningstar and other research organizations collect, that the returns that investors get on funds is less than what the market average suggests, because people tend to buy funds after they've gone up in value, and then they sell them after they've gone down in value. They tend to miss the bull markets. They tend to hang on too long in the bear markets, and then they panic at the worst possible times. And so the question here for me is, Jimmy, why do you want the more cash? Is it because you have living expenses that you're worried about? That's an argument. Is it because you're hoping to avoid the full brunt of a market downturn? Okay, then my second question, then I have a follow-up question for you. When is the uncertainty going to be over? Is it ever going to be over? A lot of the time, how people define, that market uncertainty ended, is when the stock market goes up to new highs, in which case you're going to be paying 10% more than you got by selling now. You're going to be paying 10% more by the time the uncertainty is gone. Wouldn't you rather have that 10% for yourself? That's the argument in favor of long-term investing, is that you are more prone to end up leaving money on the table if you sell out, because when you sell, the question becomes, when are you going to buy back? When are you going to pull the trigger? If your intention is to buy back at some point, when are you going to do it? And more often than not, once you get into that short-term timing mentality, it becomes a thing where you don't buy it back until you're actually worse off than if you had just left it alone for the whole time.
We'll take a question from Jazzman from 23 hours ago. Most of my investments are in a trusted company. The company claims that their beneficiary provisions will prevent a probate hassle. What are your opinions? I'm not sure, when you say a trusted company, do you mean it's a company that you trust, or it's a trust? But either one, the answer is yes. A trust will bypass probate, as will properly executed beneficiary forms. Highly, highly, highly recommend that for your retirement accounts, for your insurance policies, your 401k, you fill out and update the beneficiary forms, print out copies, and then keep those copies with your other estate planning documents, because they will bypass probate. It's going to make it a lot easier to settle an estate. And then a question from Neil. Morning, boys. I know sequence of returns risk. Sequence of returns is a big factor when entering into retirement. Any studies on entering into retirement a few years after drops or corrections? So just so we're all on the same page, sequence of returns risk is basically you could have the long-term returns of the stock market, say 10%. But if in the first, let's say over 20 years, you earn 10%, but if in the first 5 years, the market tanked, but then did really well over the next 15 years, that can be harmful to you in retirement, because you had to spend some of your money while the market was down, and therefore you had a less of a portfolio value to benefit when it recovered. So Neil is absolutely right that this is an important risk. He asked about studies. I will, this isn't exactly answer his question, but Wade Pfau, a retirement researcher, writes a great guidebook every year that I highly recommend. His last name is spelled Pfau. And he's done an analysis of basically the impact of each year's returns on a retiree's portfolio from year 1 to year 2 to year 3 and onwards. And basically, whatever happens in the first 3 to 5 years of your retirement is going to have a huge impact on whether you get close to running out of money or whether you would die with so much money you're going to enrich your heirs. So it is very important what happens in those first 5 years or so of retirement, as also the first 5 years or so right before you retire, which is why once you are within 5 to 10 years of retirement, you probably should be ratcheting down your risk, building that 5-year income cushion, that 5 years worth of income that you need from your portfolio kept out of the stock market so that you can live off that, hoping that your portfolio recovers. There's another concept that you will see talked about. It's called a bond tent. So you basically have your normal portfolio, but that 5 years before retirement and then at 5 years in retirement, you just have this heavy holding in bonds or cash that sort of protects you from a really bad market outcome in that 5 years before, 5 years after, which is often called the retirement red zone, by the way. So normal portfolio, we all love our stocks. We keep our stocks, but we have a bond tent that gets us through that first several years so that if the sequence of returns turn bad after we've already been retired for many, many years, it's not as important.
All right, going back a day, yesterday's question from Ed. If you don't take out money from your IRA at the required age, do you get penalized? And how much is that penalty? Ed, answer is yes. The current penalty is 25% of the amount that you should have distributed but did not. It is a very high penalty. That's actually down from 50%. It was 50% before one of the Secure Acts. I can't remember which of the Secure Acts cut the penalty, but it cut it down to 25%. If you inadvertently forgot and the new year comes and you realize, oh, doggone it, I forgot to do this thing, there is some relief. And you can always, one thing to keep in mind, you can always ask the IRS for penalty relief. And if you have a good reason, you might get lucky and have the whole thing waived. But under the statute, there is actually a specific reduction in the penalty, not elimination of the penalty, but a reduction to have that 25% cut to 10% as long as you fix the issue within, I think it's 2 years that you have to do that correction to get that money out from the RMD in order to get that done. And then let me see. Sandy C 23 hours ago asked, how do you value the furnishings of a home? Do you count every egg beater? Is there a way to estimate? I have to pay state level estate taxes on my sister's estate. Where to find advice? Sandy, I know that our moderator was kind enough to look up a list from a particular thrift donation store. Technically speaking, the value, furnishings have value. Market value is generally determined by what you'd get in the market. And so for items like this, using a thrift store calculation may make sense. Having a garage sale, using garage store valuations may make sense. This may be one area where if it's a bunch of stuff that doesn't really have a whole lot of value and you're kind of like, well, I'm not necessarily gonna don't want to spend a whole lot of time on it, then one thing that you might consider is, does your state's laws with respect to estate tax respect charitable gifts? Because it may well be that if the executor of the estate is enabled to make a charitable donation of unwanted tangible items from the household, then the estate may get a charitable deduction for estate tax purposes for the value of that. And the nice thing about that is that because the value of the deduction would be equal to the value of the goods, in one sense, you don't have to worry too much about, well, what's the value of the goods? Because whatever the value was for including in the estate would be the same value you'd use for the charitable deduction. You end up with zero and you're all good. With things that you actually want and things that have value, it gets a little bit more difficult, you know? Like if you have if you have furniture, you know, is it antique furniture? Do you use what price you might get at an antique store versus what price you might get at a thrift store? That's one that you're going to have to talk through with your advisors to figure out, you know, the best way to deal with it. A lot of it's going to depend on the value of the estate, how much that you're having to pay on it, and that kind of thing. If these are relatively small items compared to the value of the rest of the estate, then it may not be like a huge thing. But at the same time, you know, as the executor, you definitely don't want to get yourself sideways with the tax authorities in the state. And so it's something to pay attention to. And it is good guidance for folks if you are in a situation where that's going to be an issue, taking care of things during your lifetime rather than after you've passed away, leaving it to an executor to deal with. It may be a nice thing to take off your loved ones' hands before the time comes.
I'll just point out that here in Fairfax County, Virginia, the Commissioner of Accounts, which is the person who runs estate planning, they hold a monthly, basically Zoom call where folks can ask these types of questions. So check if your county does that as well. It can be a little chaotic. Sometimes someone gets on the Zoom and spends 20 minutes talking about their personal situation. Hopefully that won't happen to you. But yes, that might be a resource as well. Patty asked if I could send a link to the last slide that I chose. And it wasn't a link. I just looked up all the information on Morningstar. But what I will do is I'll just share it and leave it shared while I answer the other questions, Patty, so you can. Am I sharing? Do you see it? I don't see it.
You got to give Natasha a minute. It's not an instantaneous thing anymore.
Okay, got it. Oh, there we go. There we go. All right, so I'm just going to leave that up, Patty. You could do a screenshot of it because I just looked all those up on Morningstar. I'll leave it up for a second while I answer Mike G's question. Assume retiree with no more new income to invest. What are good strategies once a bear market starts? Just ride it out with the 5-year cash cushion? Yes. I mean, that's the whole point of the cushion. You know, basically, you create this 5-year income cushion, and it is ready to go on the day you retire. So you start building it up while you're working. And then you go into retirement, you spend 1 year's worth. After that year is over, if your portfolio is up, you replenish that year. So it's once again 5 years. If your portfolio has dropped over the previous year, you try to live on the income cushion, waiting for the market to recover. And sometimes it doesn't happen. Two of the bear markets we had this century, the dot-com crash and the Great Recession, it took more than 5 years for the market to recover. So your income cushion would have pretty much gotten down to zero. So, sometimes you're not able to do that. But I would say in the meantime, what to do is cut back on your income, on your expenses. It's one of the best things you could do for the longevity of your portfolio. Cut back on your expenses and then live off the dividends and interest that you earn from your investments so that you're not selling stocks when they're down. And I will also say, and I'll stop sharing my screen now about that. I will also say the income cushion is the bare minimum you should have out of the stock market, right? I think for those with more moderate to conservative risk tolerances, and they don't have maybe a good pension to rely on, probably should have more out of the stock market. And so that's another consideration as well. And then Kim asked, what level of portfolio concentration are you comfortable with in terms of individual companies? And I would say the default here at the Motley Fool is probably around 10%. If you were to ask the typical financial planner, they would say it's probably closer to 5%. But we here at the Fool tend to be more comfortable with risk, but it is up to you. I certainly know Fools, colleagues who have more than 20% of their net worth in one company, but they're very comfortable with it. They know the company very well. Some of you heard my interview with William Green, who wrote a great book about some of the world's greatest investors, and some of the folks in that book, like Joel Greenblatt. I mean, some of those folks have like just 10 stocks, which means, at any given point, maybe one stock's making 25% of their portfolio. But these are very experienced investors who know those companies inside and out. So as a default, I think it's 10%, but if you want to play it safer, 5%. And then consider the other factors, like, if you're talking company stock, where it's both, you have more than 10% in your company that you work for, so your job and your portfolio are relying on the same company, maybe cut it back a little bit more.
All right. Harlan from 23 hours ago asked us, good morning, Dan and Bro, what table is used to calculate required minimum distributions from inherited IRAs? So Harlan, just be aware, under the new rules, a lot of folks don't have required minimum distributions on the inherited IRAs. They do have the 10-year rule. However, sometimes the 10-year rule doesn't change the fact you also have the annual required minimum distribution rules. In order to calculate that, what a non-spouse beneficiary is going to use, it's called in the IRS Table 1 single life expectancy, and that's used for beneficiaries, again, who are not the spouse of the IRA owner. A spouse has the right to roll those inherited IRAs over into a new IRA in the spouse's own name, at which point the spouse's RMD rules will apply, if any. And so if, for instance, a spouse, the deceased spouse was, say, 75 and receiving RMDs under the rules that say that you have to start taking RMDs at 73 or later. If that 75-year-old was married to a surviving spouse who was 71 years old, if the surviving spouse now takes that IRA, rolls it into a spouse in the spouse's own name, then that surviving spouse at age 71 won't have to take RMDs until the surviving spouse reaches 73, the age at which that person would have to start their own RMDs. So don't get confused. Do not use the uniform lifetime table, which is sometimes the first table that shows up on the list. Uniform lifetime table is for the original account owner, the original IRA owner, in determining their own RMDs once they reach the RMD date, not for beneficiaries. Beneficiaries use the single life expectancy table. And then Sandy, was it Sandy? Yep, Sandy, see a day ago. My sister received a work bonus paid after death. All right, I lost the question. Yeah, I know it's here somewhere. There it is. Does she really have to pay Social Security and other withholding tax on it, even though she's passed away? Sandy, the answer is yes. I looked at several payroll company guidance on this, and there are requirements. So here's just generally how it works. FICA taxes, which are Social Security and Medicare payroll taxes, must be withheld even in the same year as of the employee's death. On the other hand, federal income tax withholding is not necessary. The other exception that can apply is that there's a generally pretty small amount of wages that are subject to federal unemployment taxes. And in that situation, those need to be collected as well. But yeah, I mean, it's work income, it's earned income, it's income from labor that is subject to those payroll taxes. And so yes, it is going to get put in there, even though, as you point out, that the worker is not going to get worker Social Security benefits since the worker has passed away. It will be incorporated into, if there are survivor benefits owed, then those wages will be included in the deceased person's work history and go towards the calculation of whatever the primary insurance amount is on which survivor benefits will be based. So there is some upside, but yeah, you do have to, the tax does have to be withheld.
Sunny days. Had a couple questions with 529 Sunny days questions. So 13-year-old and 17-year-old with 529 plan. Overfunding versus not affording college with change in the education departments and getting education loans. Don't want to overfund by more than $35,000 with community college free. Neither kid knows what they want to do career-wise or school-wise. 17-year-old wants to live at college versus home. So many unknowns to try to plan for. Totally agree, Sunny Day. This is a tough one, right? So I've often said that you don't need to save for every last penny for college because of this. You will have situations where kids decide not to go to college, or they decide to live at home, or they decide to go to community college. So you don't need to have every penny saved in a 529 by the time they go to college. Also, ideally, you are in your late 40s, early 50s, which for most people are their highest income earning years, so that you'll have some cash flow to help pay for it. And also, once your kid, if they do leave home for college, you will notice a little decline in your household expenses because they're not around eating your food and taking your showers and all that stuff like that. So you don't have to have everything saved. That said, you have to decide on something to save, right? So I would say it's really up to your situation. And since your kids are teenagers, you're starting to get somewhat of an idea of what they want to do. I will say that for me and my wife, we aimed to have about 2/3 of their college saved up by the time they got to college, and assuming that they would stay in state. And we told our kids, if you want to go outside of state or go to a private school, you're going to have to come up with a difference on your own. And we made that clear to the kids beforehand when they made decisions about their schooling. And it's worked out pretty well. I will say that for 2 of the kids, college ended up being more expensive than we expected due to things like health issues and things like that. Also, once they move out of the dorms and into apartments, that ended up being more expensive than the dorms. So I did not factor that in, because in the cities where our kids went to school, they expect you to sign a 12-month lease, even though they're not living there for the summer. Boy, that's lousy, paying for an apartment that your kid isn't even living in. But that's what we've done, and it's worked out well for us.
Sublets, buddy. Sublets. Gotta do it.
I think that was my first question. Let me get this other one from Rose. Yeah, sublet. Campers, RVs, tents. There are other options. From Rose, how do municipal bonds perform during economic downturns? And I would say, whenever I'm curious about how an asset class performs during good times and bad, I think of a representative ETF or index fund, or maybe even one I'm considering. And then I look and see how it did during the rough times, right? What had happened during the pandemic panic? What happened during 2022, which was a bad year for both stocks and bonds? If it's old enough, you can look and see what happened during the Great Recession. And I think what you will see is mixed with municipal bonds. I will say that, municipal bonds are generally safer than corporate bonds. So they will do better than corporate bonds, but it does depend on the municipality and the bond itself. But they're not as safe as treasuries. So when you have a significant downturn and people are fleeing the stock market, they're generally going to treasuries and not municipals. So you'll see them go down. But like all bonds, especially if you're buying individual bonds, the ups and downs don't matter as long as you hold the bond to maturity, which is why I like buying individual bonds, especially if you are doing it for retirement and building your income cushion. Most people, though, do it in bond funds. That's how I own most of my bonds. And they don't have maturity, so you don't know exactly when they're going to get back to their par value. Yeah. So for municipals, I would just say that they're sort of in between treasuries and corporates. They'll hold up better than corporates during downturns, but not as well as treasuries.
All right. Just quickly, Sandy has asked a bunch of questions about inherited retirement accounts and just simply said, can you point me to where the rules are for inheriting retirement accounts? I just now posted a link from the IRS. It goes to the IRS website. It is the discussion of required minimum distributions from the IRS. Bear in mind, it's an interesting fact, and it is counterintuitive. The IRS warns taxpayers that taxpayers may not rely on the IRS website as definitive guidance for legal precedent. In other words, the IRS, if the IRS makes mistakes with respect to the summaries that it makes on its website, sometimes the mistakes are, then you can't take advantage of it. It's not necessarily admissible if you go through a litigation process, go to tax court, that kind of thing. And so if you asked me, Sandy, show me the rules for inherited IRAs, I'd have to do a bunch of legal research and point you to statutes and Treasury regulations, and it wouldn't make sense. And so that's why I'm shortcutting and giving you a direct link at what the IRS has put together. But I will warn you that technically speaking, that's something that you're going to need to rely on a professional to walk you through that, or go look at the statutes yourself in order to have a complete picture of what's going on.
I will just add to that. I am going to put an article I wrote on the topic. I don't know, a few months ago, something like that. It's not as detailed as what Dan put in there. Always rely on the IRS. But if you're looking for a more sort of conversational introduction to the topic of estate planning and retirement accounts, maybe start with this and then go to the IRS document.
Yeah, as far as kind of good summaries and that kind of thing, one go-to person I go for IRA advice is Ed Slott, Slott. Does a really good job. He and his team do a good job of kind of parsing through these things. They're often one of the first to, when there's a legal change or some proposal, they'll be among the first to kind of walk through it and say, okay, this is what we know, this is what we don't know, this is what you're going to need to do if it turns out this way, that kind of thing. So questions. Kim, a house in Massachusetts was left to me in a trust last year. I'd like to sell it now. Am I correct to assume that I won't have to pay any tax on this sale? Kim, I get where you're coming from with that. You are correct in guessing that, well, you know what? Now I'm talking about this out loud and it kind of depends. If the trust, depends on what kind of trust it was. If the trust was a revocable living trust owned by where the owner was the one who passed away, and then the value of that trust, because it was a revocable trust, it was treated as a grantor trust for tax purposes. If the value of that trust would have been included in the estate of the person who passed away, then that home would have received a basis step up, and the step up would be to the value of the home on the date of death of the person, presumably last year. And so if that is the case, then there may be tax if the value of the home has changed between the time that it was between the time that it received the basis step up as of the date of death of the person who previously owned it, by which I mean last year, and now. And so you're right, you wouldn't have to go back to when the home was initially purchased, but you would have to go back the year and try to figure that out. Some people use an appraisal. They'll get an appraisal as of date. Some people, it depends. Your own personal advisor should give you guidance about whether it's close enough that you can use the date of death value. If they have an idea of getting a realtor involved or some kind of informal valuation, that may be helpful. If the trust was not included in the estate of the person who gave it, perhaps because the intent was to get the asset out of the person's name before some triggering event. For instance, some folks will transfer a home to kids in advance of anticipating a major medical problem later in retirement, when they may be in a situation where assets are going to need to be sold off before one can be eligible for long-term care coverage under Medicaid. Keeping in mind, Medicare does not offer long-term coverage. Medicaid being available when financial resources have dwindled to pretty much nothing. If it was given to you not because of not because of the death of a person, then it may well be that you did not get the trust did not get a basis step up in that value, and so there may be considerable tax on the sale. So, I mean, that's something, facts and circumstances that you're going to need to discuss. Then Rose, 11 minutes ago, can an accountant or an attorney help in disputing a IRS reversal of stimulus payments and other legitimate credits 2 to 3 years after they have been given, along with related retroactive penalties and interest? The answer, Rose, is yes. I'm guessing that you got a notice, an IRS notice, that informed you of the reversals of these items. I haven't gotten one as late as 2 or 3 years after, but I have gotten them 6 months, 9 months after. Me being me and having, a combination of legal experience and extreme cheapskatedness, have generally responded to those letters, at least initially on my own, feeling comfortable that I would not do anything to compromise my rights. But for most, boy, this makes me sound like so conceited. I'm going to say most people may not have the confidence and expertise that they want to even start that process by themselves. And if you are one of them, then getting an accountant, getting an attorney on your side as soon as possible can help you avoid some mistakes that some people make inadvertently when they're trying to do self-help and take care of things on their own. I wish you the best. I have had a pretty good success rate so far when the IRS has made mistakes in these areas, getting the IRS to recognize that they've made mistakes. But I know that the overall track record isn't as pretty, and so making sure that you cover yourself as much as possible increases your chances of getting the result that you want.
Question from T Stock. Somebody is looking to rebalance into REITs. Which account type makes sense to go into if the choices are taxable brokerage account, inherited IRA, or Roth IRA? So REITs, are real estate investment trusts, are very tax inefficient. They throw off a lot of income. Most of the income is not considered qualified dividend income, which has a lower tax rate. It's considered ordinary income, which is taxed at your tax bracket. So generally speaking, REITs are probably best kept in some type of tax advantaged retirement account. Now you have your choice between the Roth and the inherited, right? With the inherited one, unless you were the spouse or you're in a situation where you get to stretch the IRA, and I explain what that means in that article I put in Slido, that means you're going to have to liquidate the account within the next 10 years. And if it's been years since you've had, a couple of years, it might be even sooner. So just know that, right? That if you put it in the inherited account, at some point you're going to have to sell it. The Roth, you always want your Roth to grow the most because it's a tax-free account. So if you think that your REITs that you are buying are going to have the potential to be some of your best returning investments, then the Roth would be a consideration as well. If for most people, I would tend towards traditional because REITs, most people feel like there are other investments that will be their best investments. But because this is an inherited account that you're going to have to liquidate it within a few years, that changes it a little bit for me. So it makes me think, part of it is your time horizon. Do you see this as an intermediate term investment or something you want to hold on to for a very long time? And then from a question from Ad, I think. I understand that Fidelity has a free S&P 500 ETF. Is that true? And if yes, what's the catch? I was trying to do a little research on this. I wasn't able to finish it, but I will tell you what I think is going on. So first of all, most index funds, especially S&P 500 index funds or U.S. large cap index funds, are virtually free. I think Vanguard's ETF is like 3 basis points. That's 0.03%. Fidelity might be able to do it for free for a couple of reasons. First of all, they may not say it's an S&P 500 index fund, because every time you say something is filing something from S&P, you have to pay S&P some licensing fees. So it might instead just be, this is a U.S. large cap index fund, and we are buying the 500 biggest companies. and just leaving it at that. And they save money on licensing fees. Also, what they will do other things, such as maybe they are lending out some of the shares, and they earn some money on that, which offsets the costs. And then also, it's possible that this is just a loss leader for them, meaning they're attracting assets. Once you invest there, they hope you to sell you something that is a little bit more profitable. But again, because the cost of running a really large U.S. large cap index fund is actually pretty low already, they don't have to eat too much of a loss if they're even doing that, and they may not be, to still make it worthwhile. There have been times when Vanguard's index funds have outperformed the index because of them lending out shares and doing other things that they've managed their fund to basically beat the index despite the costs.
All right. I'll take a few because we're running out of time. Young Tom Morris, a follow-up on my question about collectibles and eBay taxation, asks, would the cards be inventory and simply be cost of goods sold? Not sure here. So, Young Tom Morris, that argument makes it sound like you'd be trying to claim that you were in the business of buying and selling collectibles, which is a defense. It is a position that some people may be able to defend, but it has consequences. Whenever you try to take a hobby, something that might be considered a hobby, and turn it into a business, you kind of have to meet tests that kind of demonstrate whether you're just doing this as a tax dodge or whether you actually are doing a business. That can involve things like how much time you're spending in the business, how active you are in participating in the business, and that kind of thing. Once you create a business, there's a whole bunch of obligations that you have. I mean, a lot of state and local entities will tax businesses, and not necessarily only on income, sometimes on property. There may be licensing fees. And yes, while you do, for tax purposes, it may allow you to claim some expenses as offsetting any income that you generate. It's a lot of work, and you may have to file business tax returns. There's all kinds of stuff. And if you're inconsistent, then you're going to get yourself in trouble. If you try to claim business treatment for only the good stuff, like taking deductions, but then you don't claim self-employment income when you make money from it, you don't claim, you don't pay licensing fees, you don't pay stuff, IRS can look at that and say, hey, facts and circumstances, you aren't really a business, you aren't acting like a business, you're just kind of trying to do this to get the deduction, and we're going to disallow the deduction. Vihan 33 minutes ago pointed us to an article on 4 ways to withdraw money from retirement accounts. One is essentially the 4% rule. The others are essentially alternatives to the 4% rule that incorporate different sorts of things. My general view on this is that the math will work on more than one withdrawal strategy. The question depends on what level of confidence that you want in outliving your money, how you assess your particular life expectancy and life expectancy of your loved ones compared to averages, how you expect the market to perform in the future. All these variables can vary. I like strategies that allow for some level of flexibility, but at the same time, all of them do. And in reality, what I have found is even when somebody says that they're following the 4% rule, which basically says take 4% of your retirement assets as of the day you retire, that's your annual distribution in year 1. From there on out, increase the distribution by the rate of inflation in year 2, year 3, and so on. When you have a bad market, nobody does that. I'm sorry. No one I know has stuck with that, with the discipline of that. When you are in a bad market, people look for ways to cut back and save. And so that's something that I have found generally is not the case. And then Patty L, I just want to clarify. Patty L said, yesterday asked a question on the impact of Roth conversions on modified adjusted gross income. I got it wrong. She was talking about, is that going to keep you from making a Roth contribution in the current year? I believe that Roth conversions are not subtracted from that for the purposes of Roth contributions in the current year either. I need to do a little more digging on that, but that's my gut instinct at this point.
Okay, we only have about a minute left or so. And I just wanted to get one more question about municipal bonds because I didn't think my answer was great. I think I need to write an article on this. But anyways, follow-up question. So have defaults typically occurred during recessions, and is the sale of a bond tax same as a sale of corporate bonds? Only the interest is tax-free. That last one is kind of complicated. The interest is definitely tax-free, but then there's this thing with bonds where you have to sort of recognize appreciation gradually. But I would say the quick answer is the interest tax-free. The capital gains in a bond, a municipal bond, could be taxable. So that's that answer. Now, I'm going to pull some other things, some stats from my guide to cash and bonds that I wrote. It's in Game Plan. I wrote it on January 10th, I think, so you can find this. But I just want to give you an idea of the default rate. So for corporate bonds, according to Moody's, over any 10-year periods since 1970, investment-grade corporates, about 2% defaulted. Speculative, junk ones, about 30% defaulted. So 2%, 30% for corporates. For municipals, over that same period, so a 10-year period anywhere since 1970s, the default rate of investment-grade munis was just 0.09%. And the default of speculative munis was just 6%. So it's really, really low, not impossible. But if you get a highly rated municipal bond, generally can feel very safe about that. Not as safe as you would feel about treasuries, but generally feel pretty good. And that is it for the Financial Planning Power Hour, a little bit over, which is too bad, because you are now going to be joined for two of the best fools of all time, Julie and Mike, answering your membership questions. Full on, everybody.
Thanks, bro. Thanks, Dan.
You bet.
Hello,
Thanks so
Julie.
much, Al. Hey, Mike, how's it going?
It's going well. How are you?
Doing good, doing good. Of course, I'm Julie Murphy, and my co-host is always Mike Mulligan. We're coming at you today from Virginia, and thank you for joining us on Fool24 for the membership hour.
Absolutely, yes. This is going to be an hour in which we discuss Motley Fool's website and flagship service, the Stock Advisor. So as a result, we will not be answering any questions regarding specific stocks or investing techniques. We won't be talking about tariffs or really the world of investing at large, but we will be showing you how to make the most out of the tools that Motley Fool provides to you as a member of the Motley Fool.
Exactly. Just like Mike mentioned, we're not able to provide any personalized financial guidance or anything of that sort either, of course. But we're ready to jump in and walk through the Stock Advisor level of membership and all the cool tools and features included in there. So, all right, what do you say, Mike? We jump in?
I'm all ready. And if you are ready, Fool, then please submit some questions through Slido. We'd be happy to answer them as we go, or we may save them for the end of the show. Depends on the question. But yeah, either way, let's get started.
Sounds good. I'm going to share my screen real quick. Sorry, just give me 1 second.
Oh, I've got plenty of time, Julie. I'll vamp a little bit while you're getting ready. Baseball season starts in 1 week. I know this is not a baseball show, but I am very excited. So I wanted to just mention it. And I am wearing my baseball cap as a result.
Oh, yeah. Are you able to see my screen?
Yes, ma'am.
Wonderful. All right, let's jump right in. So, of course, this page is our Stock Advisor or our main homepage. So when you go to Fool.com, this is the first page that you'll see. Since we are already logged in, you'll see this yellow Access Premium Services button here, along with Welcome Back Fool, of course, letting you know that you're ready to go. You can also see there's Log Out up here at the very top. So you'd be able to, just see, okay, if don't have that login option, then you are good to go. This My Full membership option up here also will lead you to the same place as this yellow Access Premium Services button. So you can click either one and it'll take you right into the site. Some other kind of neat things that are on this homepage too are some basic information about our services, what we offer here at The Fool, our different podcasts, different stock market news, personal finance questions, and a great section about The Fool and everything like that. But we'll take it on into Stock Advisor now. And from the Stock Advisor homepage, this dashboard right here, this will be the first thing you see once you're into your membership. You can also view the different highlights from the scorecard and different things here. Oop, it took us into the actual subscription by mistake. So here's the dashboard now. And this has basic information about the different kind of sections that we'll dive deeper into within the membership. So My Stocks is where you can follow or create different portfolios for the stocks that you're following and the stocks that interest you if you want to keep an eye on them. And you can also tailor the coverage for those stocks that you'd like to follow and receive updates on those from us on either a daily, weekly, or a monthly basis. And you can set those through your communication settings as well. There's also some coverage over here. So this will be all of the most recent articles from across your membership and across The Fool in the top story section there. Within Analyst Insights are little short form kind of blurbs and different additional pieces of coverage from our analysts. And then you have the My Stocks here, which is articles that pertain to anything you've added to the My Stocks list. So any new coverage that brings up, for example, we have Tesla on this account. So any of these articles here will in some way refer to Tesla or the different stocks that you might have in the My Stocks tool.
How easy is it to add stocks to My Stocks, Julie?
Oh, it's pretty easy. So let's say we'll go into the rankings tab, for example, or even in new recs. Right next to the symbol name, you'll be able to click this plus button to add that stock right into your My Stocks tool. And then you'll be able to start receiving that coverage and everything. Since Tesla is already followed by this account, you would see that check mark there, just indicating that it's already being covered within your My Stocks.
Very cool. Awesome.
Yeah, for real. And then we'll head it on over to dashboard real quick again.
There it is. There's NVO. Right
hey, right there. Yeah, so easy. And at the bottom in these lower two quadrants within the dashboard, you'll see the new recommendations from across Stock Advisor. So any buys, sells, or holds will be added into this category. And you can see here there was some pretty recent sells and holds issued. Penalty box also is an equivalent of hold. So you may see that around The Fool in some articles and things too. But that just basically means hold as well. And you can also kind of expand on these categories and move them around. And of course, since all of these recommendations come from Stock Advisor, it would list that service there. But if you have access to other services, you may see different abbreviations in this section too. They're also denoted by the investing type, so either cautious, moderate, or aggressive. And then we have the top 10 rankings for Stock Advisor right down here at the bottom. This is expanded a bit in the rankings tab, of course, but down here you can get a quick glance of that. And those are updated on the 4th Thursday of every month for Stock Advisor members.
Very cool. And those, of course, are a list of our previous recommendations, giving you another 10 stocks to consider every month.
Absolutely. Yeah. Our Stock Advisor team's highest conviction stocks for the month. All right. And then we'll jump into that new Rex category. So in this particular section, you'll be able to see, of course, the companies that we've recommended most recently in reverse chronological order. So the most recent up at the top and the most distant at the bottom. There's also the ability to follow here, of course. So if you see one of these companies that you know, even though iRobot's a sell, say if you want to keep up with it, you can follow it there. You can also click the little caret button here to open up our most recent recommendation and get a quick glance of that too, along with any previous recommendations made on this stock. So for iRobot, in December of 2022, we moved that to a hold recommendation. And then as of March 13th, a sell recommendation was issued by Stock Advisor for that particular company.
Julie, how common are sell recommendations compared to buy recommendations?
So because our investing philosophy really holds strong on that 5-year, buy and hold for 5 years at least, there aren't a ton of sell recommendations that come out in Stock Advisor, but there are still plenty that come out, of course, as our guidance changes and as our analysts update their thinking and, the market changes happen as it will. Our analysts keep up with all of that. And when they're ready to make a change, of course, they will let you know immediately. We don't usually wait until the Thursdays when we do our traditional new buy recommendations or rankings for Stock Advisor to let you know. From what I've seen, those recommendations will, if they're sell or hold, will be released as soon as our analysts make that decision.
And we notify you via email, of course. That's probably the fastest way to understand a sell was sent out. And then, of course, you'll see it right here published on the website as well.
Absolutely. And of course, on that dashboard and within the services closed recommendations and their scorecard too. And we'll show you that in a little bit as well. But this is a great.
Sorry, I did just want to clarify real quick. Our sell recommendations aren't meant to be acted on like that. It doesn't have to be an instantaneous, if I don't get out of this right now, I am in trouble kind of a thing. It's more of a long-term plan, just like with the buy recommendations. If you see a sell recommendation yesterday, no, let's do time the correct way. If you see this sell recommendation tomorrow, you're still going to be okay selling it then. It's probably not going to dramatically affect your portfolio too much, just like our buy recommendations.
Of course. And even if you do see a sell recommendation, say if you still strongly believe in a particular company or anything like that, you're welcome to act on it as you will and as you'd like to. So going from there, there's a lot of great information on this page too, just available at a glance. Say the service that it comes from, of course, those investing types are there, and the date that changing guidance was made. So if there was a buy or in this case, the sell recommendations were all made on that date, and clicking on this will, of course, open up that area where you can read that recommendation in greater detail. And will actually, if you click on the date, pull up the recommendation too, so you can dive right in.
Awesome.
And you can kind of adjust some of these categories as well and pull some of these up to the top if you want to, just by clicking on the top of the column header and bring those up to the top. Say if you wanted to look at the companies that had, maybe in this case, the highest market caps across the Stock Advisor's new recommendations, and it brings Novo Nordisk up to the top. You can also switch it around by action too. So if you want to pull all of the buy recommendations up to the top, regardless of their date, it'll still display that date here, but it'll bring all those up, and then it'll kind of recategorize everything to put it together into like the cells and their like categories.
Now, what if I'm not sure what those categories mean? Is there a way to get like a brief description of it?
On the buy, sell, and hold, I haven't seen a description of those actions necessarily.
What about like for type?
For type, yes. So you can hover over the little I next to it, and it'll bring up this little blurb about investing types. And the words investing type are a hyperlink. So you can click those and open that up, and it'll go into greater detail about the 3 different investing types and also how we use them and how they're determined as well. So lots of great information in there.
Very cool. Thank you. And
Oh, yeah.
convenient.
Right? Yeah. It's wonderful. And anytime you see that little I next to it, usually there will be a little blurb if you hover over that column header and some more information in there. For example, on the estimated returns and estimated max drawdown, you can visit the disclaimer page and it'll dive into greater detail on those particular metrics. All right. And anything else you can think of on here that we should highlight, Mike, Matt? Mike.
Oh, I've been called worse.
So many M's.
You checked all the boxes there. This seems pretty. I would say a lot of this is very self-explanatory, and like Julie just showed us, if you aren't sure what exactly we mean by a particular header, you've got the little information right there for you.
Absolutely. All right, next we'll take it over to rankings. So talked about this a little bit a couple minutes ago, but just to dive in a little bit deeper, of course, the company symbols are right here, and you can click on any of those symbols to jump directly to that company's Fool IQ page. And that's consistent across the Fool in general. So if you see a company highlighted, all you got to do is click on that. And I like to open a new tab, but it'll bring up that company's Fool IQ page. And of course, we'll dive into greater detail on this in a couple of minutes, but very helpful to have off the jump there. And you can still follow from here. It'll show you the price along with the estimated returns. And of course, you can still see that information there. Any changes, market cap for that company, our investing types listed out. And these rankings, of course, their goal is the ability to beat the market over the next 5 years. And they're made up basically of our analysts' highest conviction stocks for the month. So since this was updated February 27th, that would be the month going from February 27th to the 4th week of March.
Cool. And this list of rankings, this is created by our investing team. Is that right?
That is correct. Yes. So the analysts that work on the Stock Advisor service actually will come together and compile these rankings once a month.
Very cool. Very foolish.
Yeah. And some cool other little features in here. Of course, you can update by sector and market cap if you want to. You can also export the rankings charts and customize them too. So if you'd like to see a bit more data from any of these categories that we have predetermined under this Customize It button, you can add those to the chart, and anything that you select will be exported if you choose to export. And you can also read the most recent rankings write-up by clicking that little button there in the top right above the chart. So that'll bring up the February 2025 rankings and go into greater detail as to why each team within Stock Advisor selected those particular companies for their rankings this month.
Very cool.
Yeah,
We've got a quick question here from For the Bees. For the Bees asks, does Stock Advisor membership include access to Fool24, the video library, and game plan? And the answer is yes. Everything that Julie is showing us today is included in your Stock Advisor membership.
Absolutely. Yes. So feel free to jump in Fool24 anytime with your Stock Advisor membership, and our analysts will be around, and we'll be around too every once in a while. But the game plan is included with that as well, and Fool IQ. So within other membership levels, there may be some different content that you see in those particular tools and features. But within the Stock Advisor level, you do have access to those, and they're kind of basic forms. And then from rankings, you can also switch over to our quant rankings. So this analyst ranking is based off of the service analysts. So anybody that is working on the Stock Advisor service, any of those analysts and their selections, whereas the quant rankings, a little bit different. This is the overall conviction of our analysts from across the Fool, not just the Stock Advisor service, and their conviction on these stocks within the Stock Advisor universe. So you can see it's a little bit different with PayPal up at the top of these quant rankings versus in the analyst rankings. Novo Nordisk is number 1. So a bit of a difference in opinion between the analysts that are looking at the service and making their rankings predictions, their rankings based off of the services goals versus our general pool of analysts and their thoughts on these particular companies and how they rank them.
Right. So we have more analysts than just work on Stock Advisor. So basically, you've got the Stock Advisor team doing the analysts rankings, and then the entire Motley Fool investing team coming together for the quant rankings.
Absolutely. Yes. And you can see there's a ton of stocks in here. So this will encompass the entire Stock Advisor universe. So if you'd like to see more than just the top 10 and see kind of the overall general Fool analyst conviction on these companies, then the quant rankings is a great place to check out. If you just want to know what your services analysts think, then the analyst ranking tab is a good place to look. And of course, these quant rankings can also be customized and exported too, if you'd like. All right. Anything else on here, Mike, you can think of?
I think we've covered it all.
Nice. All right. We'll jump briefly into my stocks as well. So this is where when you add those companies to your watch list, when you click follow, this is where it brings them. And you'll be able to see these in the Motley Fool app and across the Fool in general, of course, in the My Stocks categories. And also, of course, we'll send notifications for these as well if you elect to. And on this page, you have your list of those companies. You can add, if you do own these stocks, transactions to them. So you can put in the number of shares and price and everything like that and be able to track your transactions using this as well. You can also view the different coverage from across the Fool on those companies. And you can see as we added iRobot, for example, and Novo Nordisk, it pulled more articles into the My Stocks tool under coverage. So we're now seeing an expanded view with different stocks added into the mix and not just Tesla.
Cool.
And then, of course, any transactions you enter will be in here too, so you can update those as you'd like to and kind of take it from there. All right. And like on the homepage as well, you can see the articles, analysts, insights, and videos here too. So if you'd like to take a look at, dive deeper into any of those, their options are available there. All right. And then on to coverage. So within coverage, there's articles and different, of course, insights, very similar to what you see in those different fields on the main dashboard. And like we saw under My Stocks, so those different category headers still carry over to the different pages. You can either select just to see the ones from My Stocks under articles or do all coverage, different types of guidance here. Change it to like best of the Fool or different guidance and daily news. There's all services, so you can pick from, say, the Rule Your Retirement Archive or Stock Advisor. Of course, the host on before us, he was very active in the Rule Your Retirement service and ran that one for a long time. So there's a lot of great articles in there, and those, of course, carried over into Game Plan as well. And you can also select by author too.
Going to say the Rule Your Retirement may be the second most important service we have for new fools, especially once you've taken a look at Stock Advisor and have a good understanding of what the service is. Rule Your Retirement is an incredible compendium, so definitely take a look at that when you have an opportunity.
Oh, absolutely. And a lot of that coverage from Rule Your Retirement, those archives from that service are now available within Game Plan too. And all Stock Advisor members have access to the Game Plan. So it's a fantastic resource for financial planning and getting ready for retirement. And then you can also sort the articles by the most recent, the highest rated versus based on how many stars members have given that particular article. So the more stars it has, that highest rating category will pull it to the top. And you can also view based off of the most comments. So if you want to see where there's a big discussion on some of these articles, that most comments tab might be pretty helpful for you. And then up at the top, there's also those analyst insights, like we mentioned, the very short form kind of blurbs about different companies and just some additional coverage there from analysts. It looks like Andy Cross has been pretty active with those. And you can also tailor this, say, if you have access to more services than just Stock Advisor, to see from other services that you have interest in as well and bring those ones more to the forefront. And you can also toggle on My Stock. So if you just want to see any of that additional analyst insights based on the My Stocks that you've selected, you can bring those up to the top as well. And you can also sort by most recent and highest rated in here too.
Cool.
Yeah. And then very important thing that goes together really nicely with Fool24, which is where we're at right now, the video library. So this is where you can view all of the replays of, say, Fool24 videos or different coverage from across the Fool in video form. So there's a lot of awesome things in here. You can select if you, say, really like Robert Brokamp. You can bring up all of Bro's shows and see kind of his different analysis throughout the years. And of course, there's yesterday's retirement show in there. So lots of wonderful replays in here. So if you ever miss anything on Fool24 Live, you should be able to come back likely within the next day and it'll be available on there. We do try to provide transcripts for each one of those videos as well. Those can take a couple of days to become available. So if you don't see it when you go check for the video, check back usually within a couple of business days and it should be there.
Mm-hmm. Are we listed in the authors?
You know, that's a good question. No, we're not listed in here.
Probably for the best.
But I believe you can find our show somewhere in here. So we'll have to get that added in there. But it should be under all shows, or you should be able to search for that too. And if say you wanted to see the replay of the membership hour, that'll be available in the video library, likely either tomorrow or maybe even by the end of today. Yeah. So always worth a shot to check. And then, of course, Fool24 comes right up over here and you can see the daily schedule for that and also tomorrow's schedule as well. So if you have a particular analyst that you really like to follow and want to keep an eye on their coverage, check out their schedule within the Fool24 section of your membership and you'll be able to see exactly what time they come on or be able to plan for that replay.
Very cool. And as long as you're a member of Motley Fool in any capacity, you'll be able to access Fool24 rather, pardon me.
Absolutely, yep. And then over here, back to the left again, where Stock Advisor members will see Stock Advisor. If you have access to additional services with us, you'll see a My Services button here instead. But this will take you directly to the Stock Advisor homepage. So this is specific to the Stock Advisor service and it contains the scorecard and all of the great recommendations within that service. And once you get to that homepage, it gives you an overview of the performance and returns. The latest recommendation, which we saw in Renew Rex, is that sell for iRobot. And also that coverage here with those familiar tabs right up at the top as well. And now this is more specific to Stock Advisor. So this doesn't necessarily highlight anything that you have in My Stocks unless those correlate to recent coverage within Stock Advisor. And another cool thing, update right here, our 10 foundational stocks were just updated last week for the Stock Advisor service. And you could see here where we mentioned like the hold recommendations sometimes are synonymously known as penalty box updates. So you can see that verbiage right here too, and of our most recent roundtable broadcast. And that's a live video. So those are really fun to watch and have great additional information in them. And then down here, you'll see a brief synopsis of the Stock Advisor scorecard. You can always click down here to show more and expand that out. Or you can come back up to the top and click the scorecard tab. And with this, of course, for very familiar, very similar formatting across the new recs and rankings and into the scorecard. So it makes it a bit easier to follow, of course. You'll see this symbol here.
So I was going to say, we have a couple scorecard questions we could get to.
Oh, lovely. Sure.
All right. So let's see here. We've got a couple questions from Richard O. In my holdings or even my stocks, can we switch this to look at the market cap or the sector, the beta or the Ronta?
Ronta, you can't do within the scorecard or within the My Stocks tool. I haven't seen that in there yet.
I don't think so either.
Yeah, but Ronta and like sector and some of those other categories can be updated in the customize it over here. Ronta and a couple of other of those criteria can be found in the Moneyball database for Stock Advisor members, but may not necessarily convert over into this particular chart. But that's great feedback that we'd be happy to pass along. And
absolutely. We're going to show our guests today how to enter feedback later on as well, too. So if you are using this tool and there's something that you just don't see for whatever reason, please shoot us some feedback so we can add it. Not guaranteed, of course, but the more feedback we get, the more likely it is to get added.
Yes, and we love hearing any suggestions from members. So please keep them rolling, keep them coming. We're always happy to help. One thing to note, though, through our feedback section is we are not able to make changes to your account through there. So if you're requesting any kind of updates or changes to your subscription, you would need to contact Member Services or Investor Solutions for our full portfolios and full one members to make those changes to your account. But anything.
We have one more question. I can take this one. When we may see dividend yields from ETFs in the My Holdings section, I don't believe there are any plans at this particular time to add that kind of data. But again, that's great feedback that Julie and I, of course, can pass over. And if you want to submit it yourself, please, we'll show you how to in a couple minutes. But that kind of information is stuff that isn't available currently, and we would love to hear more of that kind of stuff.
Yeah, we do share the dividend yield for the stocks. I haven't seen it for the ETFs though yet, but definitely submit that feedback because that might be something that our teams can get to work on. And just because it's so relevant right now, this little green feedback button down here at the bottom left underneath the menu options is where you can go to share your thoughts with us. You can select the star value, for example.
I think that tab is blocked by the scroll at the bottom of the screen right now.
No.
So members may not be able to see it, but Julie is just going towards the bottom of the screen. It should be on everybody's bottom left-hand corner.
Yep, it's a bright green button down there, and it'll pop out this little, I can kind of see it in the replay, but you can pop out this little window. You select a different star that you feel like how we're doing with your experience, and you can type in requests, or if a certain feature isn't working, of course, we can always investigate that as well.
Awesome. Thank you, Julie.
Absolutely. And in case you do have any questions about making changes to your subscriptions or what you have or anything like that, you can always contact Member Services at 1-888-665-3665 during typical New York Stock Exchange market hours of 9:30 a.m. to 4 p.m. Eastern. And also send emails to membersupport@fool.com, or for our full portfolios and full one members, Investor Solutions @fool.com.
Very cool. Thank you, Julie.
For sure. All right. And then back to the scorecard, you'll see the symbol, of course, how to follow that company, the date that the recommendation was made. So most recent here up at the top, and also the team. So within Stock Advisors, there's two different teams that contribute to that service: Team Hidden Gems and Team Rule Breakers. and both teams kind of alternate on selecting stocks. I believe Hidden Gems is the first Thursday of the month, and Team Rule Breakers is the third Thursday of the month, for Stock Advisor.
Is correct, and it's been that way, I think, since the inception back in 2002, when it was still run by just Tom and David Gardner. So we're if nothing else, we're consistent.
Very much so, yes. So over time, the names of the teams may have changed, but the thought process has remained very much the same. You can also, of course, in this chart, export it if you want to keep track of the Stock Advisor scorecard and for your personal records, and also customize some of those different options you see here as well. And next, you can also kind of just scroll down and we'll bring up every Stock Advisor recommendation that's currently active within the service. So within the scorecard, you will see the buy recommendations, any active buys within the service. But to see holds or closed positions, you can navigate over to these other two tabs here up at the top, and we'll dive into those in a second. The foundational stocks are next here on those tabs, so you can read the most recent write-up on those, which was published just last week. And Mike, I believe it's 1 year. We update the foundational stocks every year, right? Or is it sooner than that?
Yes. In fact, we have a great question about that that I can jump to right now. This question's from Kim. Foundational stocks are stocks that are updated annually, usually sometime in late winter, early spring, right around this time of year. And these are essentially going to be stocks that no matter when you start using Motley Fool, these are stocks that we think are going to be great for your portfolio. The rankings that we looked at earlier were previously called Best Buy Now, and those are updated every month. So these are two different sections, even though they look fairly similar. They're both 10 stocks, and they're both 10 stocks that we think are great for your portfolio. One is updated every month. This one is updated annually and is a little more, well, I guess foundational really is the best word for it, right? These are the stocks that we think everyone should have at least a couple of in their portfolio.
For sure. And for beginning investors, a great place to start out and build the foundation to kind of grow your portfolio off of.
Absolutely.
And you can also read that foundational stocks right up right here, like we mentioned, and see the original date of the recommendation or the most recent recommendation within the Stock Advisor service for that particular company. And the investing types too, because that is important, of course, to help you manage risk.
Mm-hmm.
Next, we got the hold recs up here. So like we mentioned, those can also be interchangeably called penalty box stocks. And anytime our analysts put a hold on a stock, it'll move over from the scorecard into this category. Hold recommendations don't necessarily mean sell just yet. It could just mean that maybe this stock is no longer a great value for the price, or there could be some internal workings within a particular company that our analysts have blown up a bit of a yellow flag on. So we decided to move it over into this hold category. And some stocks can move out of this category and become active buy recommendations again. Others, like iRobot, for example, can move from the hold to the sell category if our analysts feel like it's still not maybe a great value, or the price has not done so great, or there's things going on with that company that our analysts flew up now the red flag on. So those can be moved over to closed positions or back over to the active buy scorecard.
We've got a question about the change percent column. This question is also from Kim. How often does the change column actually change? If I'm not mistaken, it's almost as close to real time as we can get during market hours.
I believe that is accurate, yes. And I think we're within like 10 to 15 minutes on the different pricings and change percentages. So somewhere within that window.
That sounds correct. Yeah, I'd say it's probably about a 10 to 15 minute delay because, we are not a broker, of course. We're just taking the info as we get it. So yeah, there's a bit of a delay, but it's updated very regularly during trading hours.
Absolutely, yes. And that change percent, of course, you'll see that across other areas within the Fool too. And we do try to keep it updated. As long as the markets are open. That makes it a lot easier, of course.
Absolutely. When they're closed, it's hard to get updates.
Most certainly. Speaking of closed, what a great segue. We'll move over.
We've done this before.
Right? We'll move over into the closed positions now. So this is anything that the stock advisor analysts have indicated is a sell for the stock advisor service. And those are updated pretty regularly. It's not as frequent, of course, as the buy recommendations because our investing philosophy states that we like to buy and hold for 5 years at minimum. So some of these, I think if we looked back on one of the episodes, like the first recommendation for Costco and Stock Advisor was in like 2002 or sometime around then. So some of these companies may have been in the Stock Advisor scorecard for a long time and then moved to maybe not recommended as regularly as some of the others and then moved to the sell scorecard. So you can see different dates that those were all done, and they are pretty spread out. Over the last couple of years, there has been a bit more in the way of sell recommendations done across the Stock Advisor service. So check in here pretty regularly and see, if any changes have been made or if they have been, if those changes align with what your investing journey is.
Cool.
And then the about section. So in here, you'll see the fundamentals of the Stock Advisor service. So buy and hold 25 or more companies for over time, hold those recommended stocks for 5 years or more, as we've mentioned a lot here, and more things on that, like the FAQs, the getting started article. And this is super, super helpful if you are just getting started with Stock Advisor and don't know what to do. There's tons of recommendations and new stuff coming out all the time, and I don't know where to start. This is a great place to not only hone in on those investing principles, but learn a little bit more about how one could construct a model portfolio out of the Stock Advisor recommendations.
Very cool. Almost as useful as tuning into Fool24.
So close. And you'll also see the different analysts and members of the team that contribute to the Stock Advisor service as well. And you can click the Learn More button to dive into greater detail and learn more about each of these different analysts and how they contribute to the team. If you click on, say, their TMF handle next to their name, it will bring up their community board profile. I just learned about this yesterday. So that link brings up Andy Cross's investing profile under the TMF community, where members and our analysts can discuss different things and stocks and things like that. You can also click read more about Andy down here, and this will open up his investor profile. So it doesn't move you over to the community boards, but it'll bring you to his investing profile within Fool.com, and you'll be able to see more about the services that Andy contributes to, the latest articles from Andy, and a little bit more about him, and say if you want to follow him on different social media and things like that too. So a great resource of information to learn more about our analysts and also be able to kind of keep track of their different coverage and things if you have a particular analyst that you are pretty keen on. So fun stuff there. And we did mention the discussion board. So that's one thing I do want to briefly touch on here with Stock Advisor. So if you click on that discuss button, it will take you right into the community boards for the service. And in here is a great place to say, ask questions. If you have something that you think our analysts might be able to answer or our service guides, shout out to them because they're awesome. you can come in here and click on, say, Stock Advisor, just ask, and click this little green button right here to start a new topic, ask your question. And, it can, sometimes those questions might not always get answered, but we do try to have our analysts and different service guides try to answer as many as they can. Other members are also able to chime in and contribute their thoughts as well. So there's a lot of long-term Fool members who utilize the community boards and are wonderful about helping answer some questions for some new members as well, along with our analysts and service guides too. So a fantastic resource for additional information and context and things like that behind not only the stocks, but just questions about services and different things that you have access to within the Fool.
Absolutely. Just to reiterate, Julie and I are not investing on the investing team. Rather, we are investors. So we can't answer any personal questions that you may have, but the community message board is a great place to ask specific questions that pertain to you and get answers, like Julie said, from other members who may have been experiencing similar things, and even the investing team who can reply back in a public forum in writing. So they can offer maybe not very highly specific personalized investment questions, but we can get a little more personal in there because it's a community message board. So
exactly, yes. And then if you, in order to do this, to jump right to the community boards, you would need to create a username. And if you've never used the community boards before, you would be prompted to do that before accessing the board. So that would be the first step. You'd see a little block box that says create your username, and then you'll be good to go right in.
All right.
And then from here, if you want to go back to the premium site, you can just click Fool Premium Site right here, and it'll take you right back over to the dashboard. All right. And then from the Stock Advisor service into databases. So we did have that member question where they discussed the Rounta, and Rounta can be found in here. I also learned this yesterday, which I didn't know about, is say you want to see the tech score or something as the main criteria for the scoring within this database. By default, super score is going to be what determines the number one stock in here. So if you wanted to bring up different companies and highlight the tech scores, you can move these column headers over to the side. And of course, NVIDIA is still number one. They have great high scores in here by our database system. But it will kind of reshuffle some of these stocks to bring the highest tech score to the stock to the top, since that is the column that we selected. So you can move any of these around, and it will kind of reshuffle that information a little bit. If you want to customize this chart, you just click this little customize button right here, and it will bring up the different filter and categories available. So all of these are displayed down here, and you can toggle these little number lines to say only show companies that have higher AI scores or have, say, a 0 to 3.5% dividend yield, and it will restack the chart to accommodate that information. And if you're missing any columns or want to add any columns you're not seeing, you can just click the add column button, and it will bring up any columns that you're not seeing. So my stocks is the only one that wasn't displayed. You can even select different portfolios if you've created multiple ones within the My Stocks tool to bring those in as well. And if you don't like any of this and you want to go back to the default, you can just hit reset columns. And it will ask you if you want to do that. You just confirm, and it will take everything, all these filters that you've applied, back to the default.
Very cool. We have a couple questions in here, not specifically about Moneyball, but we also only have about 12 minutes left. So I was wondering if you wanted to answer a couple of these questions, or was there one more thing that you wanted to show everybody?
Oh, I was just going to say the last thing up here is if you ever have any questions or want to see like more information about each of these columns, you can either hover over them to bring up the little blurbs, or you can click this little blue question mark right here, and it will bring up all of that information as well, along with a link to a really handy FAQ. And if you want to search for anything in this chart, just type it in up here. Say, let's type in NVO. And it'll highlight that data down here. So really just helpful little tips and tricks there, but happy to help out with those questions.
Awesome. So this first question was actually the first we received this hour. And I think you and I will probably both have different answers for this question. But it comes from Scout for It, and he wonders what the most common misunderstanding about using these resources is. Do you want to answer first? I have an answer.
You go first. I want to hear what your answer is.
So I would say that there's a number of misunderstandings, but the one that I think probably frustrates new members the most is that the Motley Fool obviously doesn't buy or sell stocks. We recommend stocks, we research them, and we provide you with that our recommendations. That is ultimately what you're getting with your membership, but we are not a broker, so you can't buy or sell through us. And we will see a number of new members come in a bit bewildered by that. That I'd say is probably one of the more common misconceptions when it comes to Motley Fool and Stock Advisor in general. Did you have any other answers for that one, Julie?
I would say that was exactly what I was thinking too. That Motley Fool does not have the capacity to act as a brokerage firm. So we're not able to basically, when you look at our stocks or say add it to your My Stocks list, it does not indicate that you have bought that stock. So if you're adding it to there, you still don't own that stock, and you would have to go through the appropriate channels like a brokerage firm or one of those handy apps and things to be able to purchase the actual shares of stock for those companies. So that's definitely one kind of pretty common misconception, I'd say, about the Fool. The other one that I see a lot is for members who have special reports included with their subscriptions. They sometimes send us emails and feedback, rightly so, saying, I can't find this report, and it seems a bit misleading. An important handy tip is if there is a report included with your order for Stock Advisor or one of our services, it will be on your sales receipt. So the receipt that we email you automatically after you place your order. You can also find those under and I'm going to swoop back over to Fool Premium real quick. You can also find those under the My Reports section of your membership as well. So say if you got an email about 2 stocks for the sports betting explosion and you signed up on that offer in particular, and you're wondering where it is, you can come in here and see that along with any other Stock Advisor report that was included in our advertisings. So tons of different stocks in here, and these bonus reports for Stock Advisor in particular are usually composed of Stock Advisor recommendations, but for some of our other bonus reports may or may not be official recommendations of a particular service. And so that's where tools like Fool IQ come in handy, where you can see, say for Chipotle Mexican Grill, for example, come over to this tool and see exactly when and where it was recommended. And the reports really are kind of made to bring stocks of a common theme together. And of course, our analysts identify those themes within the reports. So you see like AI and dividend stocks and things like that. So that's the criteria that they've set for the report. And then the companies that they pull into that will fit that mold.
Awesome. Let's see. We got a question from Richard O. Does Motley Fool offer financial planning services? So this is actually pretty great. Julie, do you think we could go back to Fool.com and take a look at the different recommendations made by Fool Money? And then, of course, we could take a look at Fool Wealth as well.
Certainly. All right. So back over to Fool.com. There's that personal finance category here. These will take you to our sister company, Motley Fool Money. and they have vetted and done pros and cons on many different categories. So like best credit cards or bank loans or home buying or insurance. And they have done pros and cons on those. You can see any information on those companies and be taken directly to those companies if you want to dive deeper into the services that they're offering as well, directly from this homepage. And so, yeah.
So it should be noted, these are sister companies
Yes.
to the Motley Fool LLC. These are still, of course, doing business under the Motley Fool brand, but Julie and I do not work for these companies. Stock Advisor members don't have instant access to this type of tools and technology and anything else that's being recommended up there. This is being done by a different branch of the Motley Fool.
Exactly.
So to answer the question specifically that we received, we do not provide personalized financial advice or any sort of investment. What was it? Personal investment? I'm sorry, the question already disappeared, but we do have a sister company that can provide you with information like that.
Absolutely. And also for a bit more generalized coverage on personal finance and say setting yourself up maybe for success down the line as far as your financials go, we do have some tools within your membership that can help with that, like the game plan, where you can do different financial check-ins every month, and also get a bit more in the way of planning and different milestones that you can set for yourself. We have a lot of fantastic analysts and people that work on this section of your membership as well, like Robert Brokamp and Amanda Kish, who is one of the CFAs that helps handle some of our allocations and things across different portfolios. So she's very, very well enmeshed in the Fool's universe and helping with those kind of questions and creating that more generalized guidance.
Absolutely. One more question. This was about the message boards. Specifically, is there any tutorials or videos showing how to best engage with the community message boards safely and respectively? And I don't believe that there is a video specifically, but we do have the guidelines on the right-hand side once it pulls up here. But just to go through them pretty quickly, we don't allow discussions of politics or of religion. So anything, that's going to be outside of the realm of stocks and investing. Anything else, I believe, is fair game. If you want to talk about a specific company, that company's finances, the leadership at that company, or things along that line, then, by all means, we can discuss that in the community. But anything pertaining to politics or religion or things of that nature, that's typically frowned upon and will most likely get deleted.
Absolutely, yes. And over here, we do have, once you're in the community, like you mentioned, the different help videos, the navigation bar setup, and posting help too. So those can kind of help guide you in the right direction, getting acquainted with those community boards.
Oh, I apologize. It says it right there under tutorials, help videos. So yeah, my bad.
Oh, no worries. Yeah, I think these are really helpful, and hopefully we'll get you where you need to go on that. But if you ever do run into questions on these, or you're not seeing your question answered in these tutorials, feel free to reach out to Member Services or Investor Solutions, and we can help guide you in the right direction.
So we have another question here from Bob G. Bob asked about our old service Income Investor. Income Investor, I don't know exactly when it started, but it did end, I believe, back in 2017 or 2018, at which point the information it wasn't really available to members anymore. Bob was asking specifically if there is an archive of buy and sell recommendations for Income Investor, and I believe the answer is no. But any of the stocks that were recommended within it are most likely still part of the Fool universe, and you can still find updated guidance on that. But it may not pertain specifically to dividend investing, which of course was the main purpose of Income Investor. So it's going to be slightly different look at it, but that those companies do still exist within Motley Fool's universe of stocks. And
you can type those in up here. I'm not sure which one of those companies was in the income investor service, but let's say we'll pick on NVO again. You can type the ticker symbol into the search bar from any page on Fool.com, and it will bring up a bunch of different options for that, any recommendations made or coverage or videos, or you can click on the stock up here. And again, this will take you to that company's Fool IQ page where you can see any active recommendations or rankings on that particular company and any coverage we have that pertains to our current services. There's also, with income investor, you said that it was more attuned to dividend stocks and things. There are other services within the Fool that may also encompass that as well.
Very cool. Maybe the last question we have here, but a fairly good one to go out on. We have a question from Jess asking about Epic. Epic is the next service up from Stock Advisor. And specifically, is there a way to search and rank the stocks by the quant within Epic? And the answer is yes. Everything you've seen today through Stock Advisor is available to you as well as an Epic member, including much more information as well. So all of the different tools and databases that Julie has shown us today are available to you as an Epic member.
Absolutely. And to see the Epic stocks ranked by the quant, you can just go over to that rankings tab and hit quant ranking, and it'll pull everything from the Epic universe into that listing by the quant score with the highest at the top.
Awesome. Well, we have hit high noon, so I believe it's time for us to sign off. Thank you so much, Julie, for showing us how to use Stock Advisor. I feel way more educated now than I did half an hour ago, or an hour ago, rather.
Awesome. Glad we could be here today. And thank you all again for tuning in and for all of the fantastic questions. Up next, we have Seth, Jayson, and Danny Vena with the Chips, Clouds, and More show. And until next time, full on.
Have a good one, gentlemen.
Take care, guys.
Danny and I back together again.
You know, we had such a good time last time. We just had to do it again.
We'll see if do we hear applause? Is there anyone poking in?
Applause, crickets. I hear something.
Applause button, the moan, the groan button, the laugh button. Oh, look, my dog got up. He thinks it's a conference call. He likes to get up. He had surgery yesterday. Nice. He was under for 4 hours because he had a bunch of teeth he broke.
Oh my.
So he is just stumbling around the house. He is drunk on drugs. And so
poor guy.
If I get up, it's because I have to, hey, go on your bed, dude. Go lay down. See if he can understand me. Poor dog. Yeah. Anyway, Chips, Clouds, and More. We'll give the viewers at Fool and on YouTube a chance to queue up some questions. In the meantime, I don't know if there's topics on your mind, Danny. I just noticed Roku's stock price was up a little more today than I would have thought, 6% or something when I looked. And so I, of course, went to see, is there any news on this? And I didn't see anything. I didn't see any news. But what I noticed in my news feed actually was something I hadn't seen yet. And maybe we can discuss anyway, as what I see as a potential risk for Roku, which I've owned for a long time, and I've been a proponent. I've had their devices for a long time. So anyone who's a cheap geezer like me will remember when every TV had its own smart TV OS. We had a Samsung I bought to put in front of the treadmill in the basement, and those OSs tended to get left behind by the manufacturers, or the apps for those OSs tended to get stranded. And the experience, to not put too fine a point on it, the experience started to really suck. So we went to Roku years ago, plugged that into that device, and then just started buying Roku TVs after that because the OS was built in. Roku, I think, did a pretty good job simplifying that and making a decent amount of money, or making inroads in making a decent amount of money by offering different kind of ad placement and other sorts of deals with the app providers within Roku. But I read about one the other day, and it's like the second one now I've heard from them, or potentially the third, that really makes me wonder, like, are they trying to get people to hate their device? And the most recent thing I read about today was that some people's devices, when you press the power button, before it even got to the home screen, it was showing an ad for the movie Moana. Before it even went to the home screen, they hijacked the boot up to force you to watch an ad. And when questioned about this, apparently Roku management said, "Oh yes, this is working as intended, but this is just a small experiment." And of course, I defy anyone to find a single Roku user who would consider that like a tolerable experience, at least at this phase. So I hope they pull back on that, because Roku's had what I consider to be some very bad ideas that could be existential problems if they followed through. This would be one. Another one was that if you paused, they got a patent for this. And the idea was that if you paused anything on Roku, they would show you a full video ad. Now, right now, if you pause a lot of shows on Roku, like a small display ad might appear in the corner. It's not too obtrusive. You can ignore it. But this was literally like if you paused your game on your Xbox to go get a snack, they would hijack that line and start feeding you ads in the middle of your game of Assassin's Creed or something, which would kind of be one of those sort of last straw things for me. I think I would probably lump the entire thing. Anyway, just kind of a gripe of the day that I think highlights the friction between what management thinks is a good revenue opportunity and what users think is tolerable in some of these devices and ecosystems.
Right. And, I don't begrudge Roku the opportunity to test stuff out. The company has to make money. I do think that it would be in their best interest to listen, because every article that I saw about that test had something of a negative slant, essentially saying that Roku users were up in arms. Roku found a new way to piss off users. Roku is trying to find a new way to force you to watch ads. And so, it doesn't seem like that test is going particularly well from a user standpoint. And I say that as a dedicated Roku user and somebody who actually just bought a Roku 55-inch TV. We've had our TV, it was a Samsung that we've had in the family room for like 15 years. Bought it new, and it's been there, and the speaker started going out. And so when I when my wife said we needed to get a new TV, I asked her what she wanted, and she said, "I want a Roku," because she really likes the interface. But I can also tell you that if they started showing commercials that boot up, she will get ticked. She's not one for being forced to watch commercials.
Yeah. I mean, I'm kind of I'm one of those people who kind of can't stand how Netflix, and maybe it's even Hulu now, like if you're trying to go through the OS just to see what you want to watch, they used to have like the still and then the description of the movie, but now that's a running video roll and it's loud, and like I literally can't read the description while that's running. And so it makes me actually like Netflix. Maybe I'm alone here, but like I watch Netflix less because I don't want to put up with that. Like if it's made the process of trying to find something I want to watch absolutely unbearable for me. And maybe I'm not the only one. Maybe I'm the only one. Maybe everyone else is so used to being bombarded by rolling video that they're able to shut that off, but my brain can't shut it off.
Yeah, I don't think you're the only one. And actually somebody else who does something similar is Paramount Plus. My mother-in-law is 98 years old. She'll be 99 in July. And one of the things that we do every day at lunchtime is we'll go get our lunch together and then sit down in front of the TV and watch an episode of NCIS. We've been doing this for 6 or 7 years. And we eventually had to get Paramount Plus because it's got all of the NCIS episodes across all the different variations of the show. And what Paramount Plus started doing is if you click on the show and click on the episode, and when it starts up, they want to show you a video ad for some other program before the program starts. Yeah, and what I'll do is I'll exit out of it and then enter back into it, and it doesn't try to play the ad the second time.
Oh, it gets lost. They'll figure out that bug. But it's an interesting full circle moment that I mean, it's really odd if you think about the original attraction of this business model, especially if you look at it through the Netflix lens, which was, people loved not having to sit through ads and they wanted to pay for it. Right. Not everybody wanted to do that. Ad-supported programming was still more popular worldwide. Roku leaned into that because they saw the numbers. The gripe that most people had with linear television was that you couldn't escape the ads, right? But where we've come to a point now where they have as many or more ads than the competition the linear television had. But now they're putting it in even more places. So we're rapidly gotten to a place where even if you're paying a subscription fee like we do to Disney Plus for Roku or for all of these things, that you're actually seeing more ads than you were in the old days of linear TV. So I will be interested to see how far that goes before there's pushback. We do have some questions rolling in now here. The first one I'm seeing here on stock anyway is SB asks, what are your thoughts on China stocks? They have had a good run up, but valuations are still cheap. I've got the disappointing take on Chinese stocks after years of investing in stocks in that market. I entirely wrote that market off years ago and will never go back. There's always the ownership structure, which is basically that you have like a magic coupon and you don't actually hold, a real piece of any of these businesses. And the other problems are that like the Chinese government can do whatever it wants to these businesses. And then the final problem for me when I still own Chinese stocks was the competition was insane because of the myriad of ways that competing platforms could get access to capital, right? They could get capital from, local governments, national or, state governments, all of these different equivalents, and they would spend that stuff couponing like crazy. So the margins were always flying all over the place for companies that did, travel agencies or whatever, because there was always some newcomer or some recent addition that was selling the services for less than they cost. And I just finally said, I can't know enough about any of these companies to have a decent idea what that stock is possibly worth. And then on top of it, if my share is really not even, the equivalent of a share of that company, I've got that risk to add on top of it, and then throw in the bureaucratic or the regulatory risk. And then now, macroeconomic geopolitical risk. It's just not a place. I don't look for stocks there at all anymore. And I used to buy and research Chinese market stocks, and I just don't do it at all anymore.
Yeah, I would say that when the first trade war with China started, before that I held shares of Baidu, ticker BIDU. I held shares of JD.com, ticker JD. I think I also owned shares of, and perhaps still do, Tencent, ticker TCEHY, because they were at the time one of the largest e-commerce and cloud providers. Baidu is China's largest search engine, and also one of their big AI producers. JD is one of the biggest e-commerce sites in China. And I think I sold them off from my taxable portfolio for tax loss harvesting. Some of the other ones I may have kept small positions, but not anything that I actively add to anymore because of many of the reasons that you stated. And even for a company as big as Baidu, which is one of China's largest, tech giants, just a word from a government official or if the company gets scolded for its advertising practices, which actually happened, the stock can fall and stay down for an unreasonable amount of time, in my opinion. And so I too have stopped looking at Chinese stocks, even if I, still own some of the legacy ones in my portfolio.
Yeah.
I did want to mention, since you mentioned Roku and the stock is up today, I did find the reason why the stock is up roughly about 7% today. Apparently, Guggenheim Securities put out an investor note. They maintained a buy rating on the stock, and said they have high conviction that the company will experience continued improvements in engagement and better economics in 2025, and suggest that the company will exit the year at its strongest point. So apparently, those positive words from an analyst is, boosting the stock. And they also said, we expect the company will approach 100 million streaming households by the end of 2025. So that's apparently why.
That could be it. Thin gruel, but maybe some people really want it.
Right?
Yeah.
I guess we'll see what happens.
Yeah.
I did see a question in the queue. This is from Sadaf several minutes ago. What is your take on the partnership of NVIDIA, Disney, and Alphabet, tickers NVDA, DIS, and GOOG, and or GOOGL? It didn't look too impressive compared to Tesla robots, did it? Question mark. So what our viewer is talking about here is during Jensen Huang's keynote address yesterday for NVIDIA's GTC, GPU Technical Conference. He announced that NVIDIA would be collaborating with Alphabet's Google DeepMind, which is their AI laboratory, and Disney Research. And they're going to develop Newton, which is a physics engine to simulate robotic movements in real-world settings. And they also brought out a robot onto the stage that interacted with Jensen Huang. And they said basically it's a Star Wars inspired droid. They called it Blue. And essentially it's a cute little robot. Disney released a press release saying that they were going to collaborate and that, DeepMind was going to play a key role in powering future Disney entertainment robots, and that they were going to have these robots actually operate within Disney's theme parks. I guess NVIDIA also announced an AI foundational model for humanoid robots, which they dubbed Groot N1, which is inspired by the character Groot in Marvel's Guardians of the Galaxy. Whenever I see these demonstrations with robots, I always ask myself whether or not the robot is actually operating on its own on the stage, or whether or not somebody is behind the curtain, operating it with a joystick. That's something that we don't know. So I think that until we know how these robots will operate in real world situations, I'm going to withhold judgment on whether or not one robot is better than another one. And I would also say that, we are so early in the robotics, the humanoid robotics market. I think it's way too early to tell whether or who the biggest winner is going to be, or if there's going to be any big winners. it's way too early to tell, and certainly not anything that's ready for prime time yet. Seth?
Yeah, I mean, this NVIDIA event is to gin up excitement for chips and for systems, like the ones that Danny was just talking about. And so, there's not much there. I mean, how excited would I need to be that Disney's going to make like some Star Wars-ish robots that are going to possibly walk around the park? I mean, that's not much of a revenue opportunity for NVIDIA. And I feel like I saw this robot before. I feel like this news is a year old. Like, did they just tack on the Google DeepMind thing to it? I tried to find older stories, and either I'm having deja vu and I'm having a stroke or something, because I feel like I saw a very similar robot on stage with Jensen not too long ago. So yeah, this is not a surprise. You're gonna, the company that is doing an awful lot with things, smaller pieces of equipment that you can pack into a robot that will do like natural language processing and other AI work that can power a robot, are going to make their way into, Chuck E. Cheese and Disney at the end of the day, if that becomes the best way for those engineers to get the product they want for their entertainment, goals. So, as somebody who owns some of these stocks, or who owns and has recommended some of these, I'm not all that impressed by that, what I saw, or even what I heard. NVIDIA does a lot of modeling work and creates systems and services that allow people to interact with these things in like a, in a fake 3D space. I guess we called it a metaverse, a couple of years ago when we were telling everyone that we'd all be living in the metaverse. These were called like universal metaverses. Now they tend to refer to them as AI spaces. And, that makes sense. Essentially, this is some prototyping tooling that allows them to do simulations with hopefully greater fidelity to reality, so that when you actually, start making the robot, it works the way you thought it would. And comparing it to the Tesla robot, like I don't know if that's even possible. The Tesla robot demonstrations themselves have been fraught with trickery. You've seen, the one where it was folding laundry. They're like, look, an Optimus folding laundry, but they didn't even bother to crop out the hand of the person who was like actually folding, like doing the folding maneuvers that was driving the Optimus. There are other Optimus ones, all these robots walk with this weird butt out gait, because like making a bipedal robot is, in my opinion, the dumbest thing you can possibly try to do. Humans don't walk like bipedal robots. And it's not because we don't know how humans walk. It's because they can't duplicate the physical systems that allow humans to walk and run. Like most of the power from humans walking and running comes actually from stored energy. It comes from bouncing and moving along that way. It's not about like pushing off against the ground and moving forward, which is what all these robots do very, very clumsily. And you'll notice that in most of these demonstrations, or in a lot of them, they will still have like tethers holding the robots up, or there to make sure that the robot can't fall over. And these things are a long way from even moving across the room at human speed, much less like picking up and doing things. And one of the challenges I have, I will pay any of these companies. I'll give you $100,000 for a robot if it can reach under my sink and turn on, like this, blind, like you have to, because you can't see what you're holding on to, and it can like turn on two of the valves, to the faucet. These are the kinds of things that they see a 3D or a humanoid robot walking around, and they see some ginned up demonstration where it like reaches down and it grabs a K-cup and it swings it over and puts it into a Keurig machine that has been placed exactly where it's supposed to be. And then it like clumsily puts down the lid and it hits a start button, and everyone goes, oh my goodness, look at how smart the robot is. Like human, like the sensitivity of fingers is insane, and the ability of humans to kind of predict where their fingers are in relation to their thumb and just do things. Like, I don't think any of these robots will ever be able, like, like I said, I think Monday, like pull a screw out of a computer properly. I mean, industrial robots are set up and work the way they do because they have super controlled conditions, and that's why they're so good at what they're doing. and so none of these robots really impress me yet. And I really truly think that in most cases, these humanoid robots, what they actually are is attempts to generate, interest so that they can go out and sell stock on the to angel investors at high valuations, or in the case of Tesla, maybe to retail investors.
That you talked about being impressed by robots. I think the last time I was impressed by a robotic demonstration was when Boston Dynamics came out with the video of the robot that could actually jump from a standing position on the floor up onto like a raised platform and then back down again without falling over.
And they can do parkour now. Like there's videos. Go to the Boston Dynamics site and watch what their robots could do. Then come back to us and tell us how impressed you are with Optimus or Figure or whatever. Like they're light years behind what Boston Dynamics has been doing. And here's the spoiler alert: like Boston Dynamics, no market for that robot, right? And they maybe sold some of those dogs, but the dogs are all available in like Chinese knockoff already too. Right. So I'm not impressed with most of the humanoid robot stuff. I'm bullish on robots, the right kind of robots, but humanoid robots not. Yeah.
So since we're talking robotics, one of the things that came out in Jensen Huang's keynote address at the GTC yesterday was his prediction that physical AI for industrial and robotics is a $50 trillion opportunity. I've that number. I thought it was interesting that he used that number because the predictions that I have been hearing for, I don't know, several years now have been ramping up on what artificial intelligence and the market is ultimately going to be worth. And it started at $1 trillion, and then it was $2 trillion. And then I saw predictions between like 2.6 and 4.4 trillion. And the most recent, pie in the sky prediction I saw was one from PwC, which is an accounting firm, PricewaterhouseCoopers. And they've got a prediction that is above 15 trillion by 2030. So the fact that Jensen Huang is saying 50 trillion for AI-powered robotics and automation. Now, he's specifically saying that this is, use cases in manufacturing, logistics, healthcare, in other industries. And
did he put a date on that?
What's that?
Did he put a time span on this?
Not that I am aware of. He just said it was a $50 trillion opportunity. So maybe over the next, 2, 3, 4, 5 decades?
This is like when Homer Simpson bought a car and he's like, how much? And the guy's like $1,200 a month. And that's the answer, or whatever. Doesn't tell him it's for 50 years or something, right? Yeah. And we're talking about, 2,450, you probably be right. Just for context, everybody, in 2023, the entire world GDP was like 105 trillion or something. So he's talking about tacking 50% onto world GDP just with AI for robotics.
Mm-hmm.
I don't buy it.
In like industrial settings.
In industrial settings, like a ton of what has been roboticized has already been done, right? I mean, we've talked about this. Even Elon Musk, remember early he was saying, all right, we're going to have our factories are going to be so much better than everybody else's because robots are going to do everything. And then a few years later, when their productivity was terrible, he came out and said, well, it turns out, robots for everything is a bad idea. You need people to do a lot of stuff. And I know Jensen's been to factories, but I'm pretty sure that Jensen is aware that most of the people listening to him have never been to a factory. Like, again, most of what can be reliably and efficiently roboticized has been that way for quite a while, right? And it's not, It's not C3PO walking around a factory with a screwdriver, right? It's arms that are behind fences, grabbing things, spot welding them, putting the fasteners into the right torque settings. Although a lot of that is still done by people with tools that are hanging from gantries. Will there be some humanoid robots helping with some of that stuff? Everyone seems to think that's the future, but I honestly don't have that, and don't believe that. And I also think that sort of regular industrial robotics, the kind we're used to now, the kind that has made huge productivity advances for the world over the past few decades, that's like a low growth cyclical business. So I don't know where you get 50 trillion out of that.
Oh, come on, Seth, 50 trillion. Come on, by next year.
I feel like I need to say that we are right now in an era of like what I consider to be like optimal scam, and to the point where like truth is absolutely relative. Like nobody checks to see if anything even makes sense, so people are literally selling snake oil online. Everywhere you go, it's nutritional supplements and everything, right? But I mean, you have Satya Nadella coming out on a podcast interview and saying like we're going to throw away the idea of AGI, which finally, thank you. That's also a dumb idea. But then he replaces that with the question of whether AI is worth it is, will world GDP be growing at 10% rates annually? But this is absolute insanity. Like there's no way that can happen. I mean, there's just no way that can happen. And it certainly isn't going to happen because people are using AI software. But like he said this with a straight face. And to me, that's just unbelievable. I don't think he can possibly believe that. Can he?
I hesitate to say what somebody else can believe. And just so that our viewers kind of have a context. So in the fourth quarter of 2024, real GDP in the United States increased at an annual rate of 2.3%. Annual rate. So that means we would have to increase our productivity fourfold across the spectrum of productivity, not just in AI or robotics, but across everything. That's kind of a tall order.
Yeah. It's like I said, I heard it. I had to go back, or I think I read it. First. I was using Notebook LM. I was using AI to be more productive. This Notebook LM is a piece of AI that Satya talks about liking, right? So I told this LM notebook, Google Notebook LM, I gave it the URL for this thing, and in a flash, it gave me a transcript. Mostly looked good. And I read this piece in there. I went 10%. That's got to be an error, right? Like, did he say that? I went back and watched the video, and he said it. So let's just, 10% is the kind of GDP growth you get like when you pull a third world economy in the 21st century, in the 80s or the 90s, if you're lucky, right? That's that kind of growth. This simply not possible to do that to a country like the United States. Anyway, so like I was saying, like I think right now for investors, you need to be hyper aware when you hear these stories, whether or not like somebody's telling you anything that's in the ballpark of being true, because there are a lot of vested interests in making you really happy about a story, to buy a stock, and it's tough. It's tough. Big numbers like GDP, it's tough to grow. Big numbers like Nvidia's market cap, also tough to grow, right? Company itself is only doing 100 some billion in revenue a year right now on hardware. Well, Apple does almost 400 billion, so why can't Nvidia get there? Maybe they can, but then what happens to, is Nvidia a $12 billion company then? Because it's selling, 4 times as much stuff? Ask yourself, is there enough electricity to run all the chips that Nvidia would be selling if they hit a hardware number like that? I don't have all the answers to a lot of this, but these are the sorts of things that literally keep me up at night as I'm looking at some of the valuations on some of these companies.
Although, they're might be an opportunity there. NVIDIA's forward price to earnings ratio, when I looked yesterday, had dropped to, I think it was 24 times forward earnings, which is a relative bargain for NVIDIA, at least
lately.
since the AI boom started.
Yeah, lately that looks cheap. Exactly. Yeah. Any thoughts on Match Group? SB.
Ooh.
Do you follow Match Group at all?
You know, Match Group is a company that I own. It's one that I was intrigued by several years ago. One that I think Nick Sciple, who now works in the Motley Fool Canada and is a frequent, makes frequent appearances on the Canada Power Hour or the morning show. And excuse me. And one of the things that he said was, never underestimate the power of thirsty dudes. I have owned Match Group. Match Group is one of the world's largest providers of online dating services. They have a number of the biggest, most well-known sites in online dating, including Match Group, including Tinder, including Plenty of Fish, and some of the other ones that are more popular in
OkCupid.
What's that?
I say Hinge, Medic, OkCupid. I'm just reading
Mm-hmm.
their thing here.
Yeah, and so this is a company that I was initially attracted to because it had a really impressive growth rate for doing what it does. Now that growth rate has slowed somewhat in recent years. I looked at full year 2024 results, and they grew revenue by 3% year over year to 3.5 billion, although it was up 6% on a foreign exchange neutral basis. Their operating income actually declined by 10%. Their adjusted operating income was flat. They're still generating operating and free cash flow for the year. And what they said was they deployed 85% of their free cash flow for share repurchases. And to me, that's kind of a message that their growth opportunities are limited, because otherwise they'd be taking that extra money and they'd be funneling into a way that that helps the company grow. So the fact that they're spending nearly all of their free cash flow to buy back shares suggests to me that there's limited opportunity for growth. Now, the stock itself, it hasn't done badly, at least the last time I checked. I'm going to check again just to make sure that my personal information is up to date. Yeah, see,
it's been hovering in like the 30 to 40 range here for like a couple of years
now, and it hasn't really participated in the bounce back that the stock market had in, say, 2023. It's actually kind of hovered. Like you said, the stock peaked, I think it was during the pandemic, and thereafter, when everybody was basically limited in social gatherings, and since then has not done well. And even though the company continues to have engaged users, they haven't been able to translate that into any kind of impressive growth. So what I think of it is, I still own the stock. I've owned it for a number of years. It doesn't look like their opportunity is getting any better. I don't know if you follow this at all, Seth.
I don't follow them that closely, but working for a company that's a membership type company, I know that you have the constant struggle of you have a bucket and it's got a big hole in it. And so every year you're losing a lot of, in the bucket are the members, right? It's a very elegant metaphor here, but they fall out the hole, right? You've got churn, you've got people quitting. And so you're always bringing in more people, and that gets more and more difficult to do some years, depending on what you're selling, because you're competing with the entire internet, and you're competing with, people doom scrolling on Instagram and everything else, trying to get your ads seen, or however you go about filling what they mistakenly everyone calls the funnel. If ever any of our members are out there and they've heard conference calls, everyone talks about their funnel, and they're like, the top of the funnel is who comes into your website or who hears you, and then the bottom is the ones who actually go on to buy a service from you. I sometimes wonder if the people who use that term have ever used a funnel, like if they ever poured gas into a lawnmower, because if my funnel only transported 5% of what went in the top to the bottom, I'd go buy a new funnel. But that aside, it's a constant battle for membership companies. And so I don't know what Match's churn rates or retention rates are. I'd have to go look them up. But for companies like this, it's never easy. And just about any company out there, if you're selling access to dating or stock advice, stock fellowship, like we have here, it's a tough business. It's tough to attract eyeballs, and it's tough to retain people.
So I just looked that up while you were talking, and it says Match Group has a user retention rate of about 38%, which is better than its competitors who have an average retention rate of about 22%.
Yeah.
So 38% in the industry is considered good.
Yeah. So that's a tough industry. If that's the kind of industry, I hear that number and I just say, you know what, as I've said before, I can lose my money in other places than that.
Well, and what's interesting about it is if they are successful, then they lose their members. Because what they're trying to do is they're trying to find these matches. And if they are successful in finding, your soulmate, then you're not going to need a dating site anymore. So, I think it's an industry that is only fueled by increases in the population. Oh, and the 50% divorce rate. But
oh, that's a cheerful note.
I know, right?
My wife would laugh. She'd be like, "You'd be too lazy to even go on one of those things." She's like, "I know you'd never cheat on me. It'd be way too much work for you." So there you have it.
I don't know the answer to that.
I know that one of these services, the ad comes on my Roku TV once in a while. Brags that it's the last dating app you'll ever have to download. Their goal is that you delete the app once you've met your match on their platform, and you never need another one. So that's the sales pitch from one of these.
And that's also kind of a cautionary tale for investors, I would say.
Yeah. What else have we got going on here for questions?
Yeah, I just threw a quote in there from Sadaf from a little bit ago, and he said he presented a bold prediction candidate, referring to the last hour of the Motley Fool programming where we do a bold prediction show, and he wanted to know, when are we going to see robocops guarding Tesla dealerships? Fully tongue-in-cheek, I'm sure.
Actually, though, for years, I used to get this banner ad, like across the top of Bloomberg, and it was some penny stock that was selling a rolling security robot that was just sort of surveillance and so forth. I forget what they were called. I want to say Nighthawk, but I don't think that's it. But anyway, they were literally, the ad was advertising not the robot, but the stock.
Huh.
And ladies and germs, when the banner ad on Bloomberg is advertising the stock and not the product, that's when you need to watch out. It has a .pk at the end of it, and it sells for $1.50. That's your clue that the product might not be as sexy as the story they're planning to tell you about it. But one of the use cases for that, as I went down that rabbit hole a year or so ago, was shopping malls, car dealerships, and so forth.
So I just came across another interesting tidbit. I was wondering why it was that Shopify stock was up this morning. It's been up between 7 and 8% for most of the morning. And apparently Shopify dropped a press release late yesterday that said they will be voluntarily transferring from the New York Stock Exchange to the NASDAQ Stock Exchange. And that is going to happen on Monday, March 31st. So their last day trading on the New York Stock Exchange will be Friday, March the 28th. And their first day trading on the NASDAQ will be March 31st. They did not really give any information about why they chose to do that. They did mention that they would continue, to be listed on the Toronto Stock Exchange. And they will still keep their ticker SHOP. But it's interesting, I think about the fact that Palantir, ticker PLTR, made that switch. And it was interesting because they were trading on the New York Stock Exchange, and they waited until they drummed up a lot of press for being admitted to the S&P 500, and shortly thereafter they switched from the New York Stock Exchange to the NASDAQ, which kind of drummed up some more press for them, and then they were admitted to the NASDAQ 100. So over a period of time, Palantir made all these stock market moves, which for a short time ultimately drove the stock price up. But we've seen now recently, what happens after the fact, because while the stock was running pretty high for a while, I think the stock at last time I checked was down more than 30% off its peak on no company specific news other than the fact that it had an egregious valuation. And the stock market, has gone into correction. And when you have a falling stock market and stocks with really high valuations, what you tend to see is some of those valuations beginning to slip.
Yeah, we're definitely seeing the multiples compressing a little bit here. I was just interested here. I haven't checked in on some of the defense stocks I follow recently. And this was a trade we saw, a trade that got quite a bit of attention just, a couple of weeks ago. Everyone's suggesting like, oh, Europe is going to be buying, so many new arms because of the worry about the U.S. leaving NATO or so forth. And it's done a lot of kind of, the response has been very uneven. And that would make sense because defense companies offer different products, and those programs have different potential fates under this. I'm actually surprised to see that Raytheon is near a high here, and it's near a 2-year high, but that's probably, that's like an all-time high according to the charts I'm looking at. Raytheon, of course, best known for missile type stuff. And so the thought there is probably, well, they're sure going to be buying a lot more, missile systems and so forth over in Europe. Rheinmetall, which is a European arms manufacturer, is, I think, just past Volkswagen or something like that. I read the other day in market cap. But then we're seeing Lockheed Martin sort of go the opposite way. Now, Lockheed peaked back in October and is up, a little bit over the past couple of weeks. Or, geez, what do I have here? That's only a few days. It's sort of treading water, and I would have thought there would have been a stronger reaction given the scrutiny we're seeing, and maybe it's just pretend scrutiny from some of our allies about whether or not they want to buy F-35s and advanced systems like that from the U.S. on the worry that maybe this doesn't that maybe that's not the systems they want to be buying in the middle of a trade war, and they feel like their economies are being attacked and so forth. And I saw on YouTube a kind of an interesting take on this. I think it was a little bit oversimplified, but it's something to keep in mind if you invest in some of these defense companies, I think. And it was that this take this person had was that NATO is primarily a standards organization. In other words, that its main job is that, like, if you buy this gun, it fits this bullet, and that works in 30 countries or whatever we've got. If you buy this missile, that works with this missile launcher and all these different places, and so on. And how incredibly important that is if you're planning for conflict and supplying allies and doing things like that. So if you are an investor in some of these companies, and you're worried, like, is Lockheed, the F-35, what's the word I'm looking for? The intents, the contracts, or the potential contracts going to go away. You might want to keep in mind that, those standards have been around for a long time. And there are good reasons that some of these programs exist, and they should probably outlast, a few years. So don't over index on, like, the week's news, especially because, as we've seen, things completely change here these days within hours, let alone days.
So there was a question in the queue from Rufus Grekus about 3 hours ago. Hi, Fools. What's your take on Shopify's future prospects in the current context of trade wars and economic uncertainty and volatility? Well, first of all, let me say that I think Shopify, like any company in the retail business or e-commerce business, is certainly going to be impacted if the economy tanks. That's just a given. Now, what I would say is I've seen a lot of questions, heard a lot of questions about whether or not the trade war is going to impact Shopify. And I think maybe we need to consider that Shopify has many, many merchants across North America. They have a lot of merchants that sell within the geographic locations in which they operate, which is probably where the majority of their customers are for these merchants. Now, they do offer cross-border services depending on where the merchants are located. So if you want to sell across borders, you can do that. But I think the biggest concern is that some investors wonder whether or not Shopify merchants primarily get the bulk of their goods and services, say, from China, which is one of the countries that would be most impacted by the tariffs and the trade war. And I have read some commentary from analysts, from hedge funds, and some of the other folks that put out this type of commentary, and basically saying that while there might be some impact to Shopify's gross merchandise volume, and there might be a little hit to their merchant services revenue if these tariffs are fully imposed, it's probably less severe and less of a concern than some investors are worried about, because they have so many merchants. Those merchants are spread out among so many different geographical areas. They have customers that are very geographically diverse. And so it's probably not as much of a concern tariffs wise and trade war wise. Again, I think the economic, if the economy takes a turn for the worse, personally, I think that's more of a concern than, maybe what the impact of the trade war. But that's just my personal opinion. I don't know if you have a take on that.
Yeah,
Seth.
I guess it would depend on how much of the stuff being sold by the average merchant is coming straight from China, and like what the gross margins are, and whether the potential buyers are willing to absorb that, or if the Shopify shop owners are going to try to absorb that, or are they going to try to split it with customers, and so you never really know how that goes until you start seeing, is there any demand destruction from higher prices? It's possible that companies selling low priced goods from China may also want to absorb some of that tariff so that they can continue to get the sales. But how that all shakes out, you never really know until it happens. A lot of questions last hour for their personal finance types, or from a couple hours ago when Brokamp was on here.
Yeah, Jayson said we turned it to a library for a second there.
That's true. Well, that's what happens when we run out of questions.
There are some questions. Sadaf just put in, I'm surprised to see that Mercado Libre pays 8% of its total income tax to the U.S., given that it does not do business in the U.S. Thoughts? Not something that I was aware of. It's something I can take a look at. But that would be surprising to me too. I mean, I know that they own certain brands in the United States, but I can't see where that would translate to an 8% of their total income taxes paid to the U.S. So something I'll have to look into.
Yeah, I've never heard of that. Never heard of that either.
If you happen to have a source for that, and you could pop that into the queue, that would be helpful.
Yeah, I'm just asking my AI filings agent to dig through their filings and take a look for that.
There you go.
There's valuation allowance on U.S. foreign tax credits. Yeah. Subsidiaries. Yeah. Subsidies. Yeah. I would have to dig into the 10K and look at that, and then probably stare at it for several hours to try and make sense of it. Taxes, unless you're good at corporate taxes, are one of those things that will really trip you up, because not only are there cash taxes, but then there's credits, there's valuation, gives and takes, and so it starts to get very, very complex. So you need to be a real footnote friend, and I guess Emily is saying. Emily's on the chat. She'll be up next. So this is a good one for them to talk. They paid $64 million to U.S. tax out of a total $521 million. Wow. Or $764 million, she said. So interesting. Right. Yeah. I don't know why that would be. I would have to dig around to find that.
That is interesting. So here's one that I pulled from a couple of days ago. Let It Ride wants to know, of the Magnificent Seven and FANG stocks, what are your top 3 for the next 5 years? Off the top of my head, I'm still kind of a diehard NVIDIA fan. I think the company could, potentially still grow its revenue by, let's say, 50% annually over the next couple of years. I think that's impressive revenue growth. I think they turn a lot of that growth into income. So I'd say NVIDIA is probably at near the top of the list, particularly with the AI opportunity. I think the other two off the top of my head would probably be Meta Platforms and Alphabet, tickers META and GOOGL, primarily because their valuations are beginning to get interesting. I know that Alphabet is probably at its cheapest valuation in several years because of the overhang from the court cases. And Meta is just, falling with the broader market. But I think those are solid businesses that will continue to thrive. I don't know if you have a take on that question, Seth.
Yeah, I think that they all are going to remain pretty good money and cash producing businesses. The question with NVIDIA, it's a lot easier to pallet the price right now than it was a few weeks ago. That's for sure. The question is, how does your valuation model work if you have one? And I've made several, and I was always very tough to make any of the recent prices look reasonable unless I made growth assumptions that were, I thought, not really possible. Or if I if you're willing to use a discount rate of CD, like 4.5%, then it looks fine. But if you're saying okay, I could put my money in an S&P 500 index fund, maybe I'd get 8% if that's your hurdle rate, then it gets tougher to build the model that supports that. I think that whatever happens with Google/Alphabet, I think they stay on top of their position as kind of the big internet information and advertising world. And so that one would probably be in the top of my list. And then Meta's had a quick short drop here, but they've actually been, producing a decent amount of free cash flow. I have more questions there about how their platforms deal with AI than I would say about NVIDIA's or Alphabet's, because Meta's pursuing what is like a two-prong approach from my point of view. One of which is to spend a ton of money on equipment to build these giant foundational models, which they then open source most of it. And some of that is used to enhance the flywheel of their own advertising business. But then a lot of it is used to kind of create the content. And we're starting to see early rumblings that, they might be drowning in AI content. And I don't think we know for the medium to long term how that turns out. I mean, if people are just willing to just keep scrolling past a lot of this weird AI generated video, then that might be good for them. But if there's ever some kind of a blowback and people finally start moving to different platforms, who knows? And we always think but who would quit this platform? It's got so many members. Well, TikTok kind of came out of nowhere, right? Although TikTok is also full of the same kind of AI stuff. So Meta would be more of the question mark for me.
And with that,
we got Emily and Jayson coming up.
And our Chips, Clouds, and More hour is done. And now you get the song stylings of Jayson Moore and Emily Flippen.
As I like to call us, the Curly Q twins.
Nice. Oh, wow, you guys do have almost the same hair.
And it's glorious.
I'm the only one here with no hair. Have a good hour.
I think Emily and I make up for that.
Hold on, guys.
Yeah.
All right.
Thanks,
Take care,
guys.
guys. See you around. Hey, Emily.
Hey, how are you doing?
I'm good. We've got a fun hour planned. We're going to talk about Etsy's a company we're going to spend some time talking about. We're going to answer lots of questions. And I would like to encourage everybody watching, whether you're on YouTube or you're a Motley Fool member watching behind the paywall to Motley Fool, go to slido.com, event code Fool24, all one word, Fool24. Get your questions into us. And please remember that when we answer your question, don't project that we're giving you individual or personalized financial advice. This is not a forum where any of our answers should be considered personal or individual financial advice. We're happy to share our thoughts and experience. Remember, it's just our opinions, though, for a litany of reasons. You don't need to think of these as us telling you what to do. All right, Emily, where do you want to kick this off?
Yeah, let's kick it off while we wait for some questions to come in here with a little conversation on Etsy, if that sounds good to you.
I think it's a fantastic idea. This has been a befuddling, frustrating company for me.
It has been for me too. And let's go through maybe a little history lesson about why that is for anybody who lacks familiarity with the kind of ups and downs that Etsy has experienced in the past. I imagine, Etsy has tens of millions of active buyers. So there's probably a lot of listeners right now who are familiar with Etsy just as a platform within itself, but not really familiar with it necessarily as an investment. But for anybody who's unaware either, Etsy is an e-commerce marketplace that has focused on unique, handmade, otherwise special goods. So stuff that you wouldn't otherwise be able to find on a place like Amazon. Now, there have been entrants that have tried to compete with Etsy over the years. Amazon, for instance, launched its own page, Amazon Handmade, which I actually think they didn't do a great job advertising. Not very many people, when I talk to them about it, even know it exists.
Right.
But Etsy has kind of become the go-to place for unique handmade goods. During the pandemic, especially as people were shopping online, they saw a huge influx of buyers and sellers and people looking to make a little bit of money on the side, as well as people looking to make presents for people that they couldn't see in person necessarily. So
Emily, I remember during the pandemic, masks, actually like handmade masks, became a double-digit percentage of their revenues for a few quarters. It was bizarre.
They're actually breaking down their sales into sales X masks.
Yeah,
it was that significant. They wanted to have comparable year-over-year numbers for investors that were not taking into effect the obviously only semi-temporary need for masks because of the pandemic. But yes, to your point, Jayson, everybody was wearing masks, and Etsy actually had some very cute ones, and they benefited a lot from that. So they had a huge influx, and I think that kind of reset expectations, as it did for so many different pandemic-style businesses, right, about what growth looked like for this company. And one of the things that they did coming out of the pandemic was make a couple of rather expensive acquisitions, Depop and Elo7. So Elo7 was kind of what they pitched as the Etsy of Brazil, and Depop was a Gen Z focused fashion app where people would go on and resell clothing and goods, the kind of streetwear style. And they said that they wanted to turn Etsy into a marketplace of brands, right? It was no longer just going to be Etsy.com. It was going to be Etsy plus all of these other different, really unique niche retailers. And it was a interesting concept. I think there was questions around those acquisitions even at the time, but obviously as the years have gone by, those expectations didn't quite pan out. The company has effectively written down all of the money that they invested to acquire each of those businesses, and growth has really stalled. And
actually they sold the Brazilian business off.
Yes, I'd forgotten that they did. Elo7, they sold Elo. It is a business that I think, again, within investors' mind, had to reset expectations. And if you look at its relative valuation today versus where it has been in the past, those expectations have been reset. Etsy is the cheapest it ever has been on an earnings and cash flow basis. And this is a business, to their credit, that does produce relatively sustainable earnings and cash flow, even throughout its numerous ups and downs over its life as a public company. The reason
I can actually share that on the screen. I'll send that across.
That's wonderful.
So while you keep talking through it, I can bring up those things. And this, I'm going to share a chart here. This goes back, just for context, I think it's useful. Natasha, if you can release that. Yep. So this goes back to 2018. So again, pre-pandemic. I'm going to pull off the multiples, and you see free cash flow. Since the business, it was the beginning of 2018 when it really made that transition to free cash flow positive. Here's the mask margin, right? And like you said, it's consistently been cash generative, right?
Yes, exactly.
Then if we look at the multiples, price to earnings and price to cash flow, this is 8 times free cash flow, Emily. Last I checked by every metric. That's pretty good.
Pretty good until you can compare to where it was previously versus the numbers it's putting up today, which is to say it was doing 100% plus growth in 2020. Now it is barely positive. To their credit, they haven't gone negative yet, but growth on the top line, at least on a yearly basis, I think in the most recent quarter, it might have been negative. On a yearly basis, that top line growth is still 1% to 2%. So it's a small growing business, and it's understandable why the valuation on a multiple basis has contracted.
Yeah, absolutely. Natasha, I've sent another screen share over. This is from their Q4 earnings presentation. So revenue for the full year, again, up 2% for the full year. If you go back and look at each quarter, Q1, Q2, Q3, and then Q4, that revenue growth rate was consistently falling every single quarter. Now, it's important, Emily, we haven't really specified how Etsy's revenue comes to be, because Etsy isn't selling merchandise. It's taking a fee from merchants in a couple of ways. It takes a percentage off of sales on its platform, and it also has some advertising and other marketing things and other services that it provides that it sells directly to merchants. And if you look at the best, I think, reflection of like the overall health and trajectory of the business, GMS, that's gross merchandise sales. This is the dollar value of everything that's sold on Etsy. Year over year, down 4.4%. And they do have some international exposure still adjusting for that, down 4.5%. So this revenue growth rate entirely came at their merchants giving them a higher percentage of their sales, right? So that's a thing that's kind of a yellow flag, because we've seen that GMS number go from growing to kind of steady to now declining here more recently. What does that tell you about the business?
I think it can paint two different pictures, actually, Jayson. And thank you for clarifying. Yes, Etsy is a marketplace, but they're not actually holding the goods themselves for the most part. They are just facilitating these transactions. So they have what is effectively a take rate and a little fee that they charge both at the front and on the back end, as well as some ads that they run on their platform for merchants. And that's how they make their revenue. And they've raised that fee a couple of times over the past few years. Lots of pushback, especially initially when they raised that fee by something like 15% on their sellers. And there is a lot of fear that this is going to drive merchants away from the platform. So if you're looking at where these gross merchandise value numbers are today, you're seeing a combination of a decline in sellers on the platform, as well as a decline in total value of goods sold on the platform. And that can lead you to say, okay, well, they're making it up in fee hikes, but these fee hikes can't go on forever. They're driving people off of the platform. So this is bad for the long-term sustainability of Etsy's business. But I actually think the devil's in the details here. And I think management would and has continuously said that gross merchandise value is no longer one of their KPIs that they think is most important for their platform. It used to be. It used to be the thing that they attached most onto. And now they're saying, we're reconsidering what the platform actually means for people who are shopping on it today. They're actively kicking sellers off of the platform, which I actually think is the correct move for this business, because part of the challenge that they had, which we didn't get into, was as a handmade, niche good seller platform, you have to keep up the reputation that what I am buying on Etsy, I can't find on Amazon. I can't find it on Tmall. I can't find it on all these other platforms that are mass produced. What was happening in practice, especially during the pandemic, was a lot of sellers were coming onto their platforms who were effectively drop shippers, manufacturing products, or were buying from manufacturers in places like China, and then upselling, reselling on a platform like Etsy. They didn't have strict standards put into place about who their sellers were, and that diluted the value of the brand in a lot of shoppers' minds. So it no longer felt like what I was buying on Etsy was truly unique or special. I didn't know if that was actually handmade, even though it claimed to be handmade, or if that was just drop shipped from China or Vietnam or somewhere else where it was made with cheap labor. So there's this big question mark there about what exactly the Etsy platform was. What management has been doing over the course of the past year has been raising fees, adding a fee whenever you first set up the account for sellers, to deter those type of drop shippers from coming onto the platform, doing yearly seller reviews to ensure that all their products are still being handmade, kicking off sellers who are not producing handmade platforms and items. And that is leading to a reduction in sellers on the platform and a reduction in gross merchandise value. I still think they could still have some of those sustainability issues. I think this is the right move for Etsy. Mm-hmm. They need to keep that reputation up, but I'm worried it's too little too late if the brand image damage has already been done.
Well, you're exactly right, and they're definitely paying the price for it. You look at Airbnb, for example, which I think has been a little more proactive and a little less reactive about the sellers of, in its case, the owners of the properties that people are staying out on Airbnb's platform. I think it has been a little more proactive about managing that, and when there are issues with a property owner, getting them off the platform quickly. But last year they reduced, I believe, a 5-figure number of properties that were listed on Airbnb. So your question about whether it's too little too late, we're going to find out about. And here's another metric that, again, this is where they're paying the piper. Natasha, if you can release this one. They're working hard to bring people back. And a couple of numbers that they touted in the fourth quarter was reactivated buyers and repeat buyers. So all active buyers declined in the fourth quarter, almost 3% year over year. They did activate just under 10 million buyers. In other words, these are people that had bought on the platform and had lapsed and didn't meet their expectation for being an active buyer. I think it was somebody that visits the platform at least twice that quarter. I can't remember exactly. Then they may have changed it since the last time I looked at it. But they had not bought anything off Etsy long enough to no longer be considered an active buyer. But that wasn't anywhere near enough to make up for the net loss, the growth, the loss of buyers. And this is the key too, talking about the reputational potential harm. New buyers was down almost 18%. So can we see those metrics begin to turn across their platform of buyers? All of these numbers have been relatively unimpressive, really, for 7 or 8 quarters now. There was a little bit of a sign of life about 2 years ago, but the metrics in terms of, again, you have to think about this platform in terms of what are the things that make platform businesses sticky, and something like this network effect would typically be very big. The inverse side of that is when the sellers on the platform are not meeting the expectations of the buyers that you talked about. All of a sudden, the kind of sellers not providing value to bring more buyers to your platform doesn't create stickiness, right? So we've seen the inverse of that for Etsy. Look at a platform that, despite all of the complaints that you hear from users, look at all of the Meta platforms and how the stickiness of social media continues to drive modest user growth across all of their platforms. So you have to provide something that brings people there, makes them stay, and makes them continue to spend money over time. And we don't know yet, right, if that's happening with Etsy.
I agree. I will say, though, I'm willing to give Etsy a little bit of the benefit of the doubt here, mostly because so much of the initiative that they're making to make these changes seem sustainable for the long term, not intended to drive short-term improvements in these metrics. And to your point about the decline in new buyers, that's just declining growth of buyers. You're still acquiring something like 7 million new buyers, right?
Right. On a gross basis. Yeah.
Yes. So while it is still not where it was, especially coming out of some incredible years of growth again during the pandemic, there's still demand. They're still acquiring customers here. And I think there is still a place for Etsy's platform to exist. And I think when I think about the sustainability of a company long term, that's what I come down to. Does this company need to exist? And with a business like Etsy, I think I can wholeheartedly say, yes, Etsy does need to exist. And if you snapped your fingers, the David Gardner snap test, and made the company disappear overnight, there would be millions of people who would be negatively impacted and upset about that, right? Their lives would not be the same. I also think it's a great sign that Amazon and other big e-commerce platforms have attempted to create a similar niche as Etsy and largely failed to do so. So some of the changes that I'd be looking at moving forward, I know they've already made some of the changes in their platform using AI, machine learning, gifting, that sort of thing. They're trying to drive app conversions, and I think that's incredibly important. We saw how successful that was in turning around the monetization and active user growth in Pinterest post-pandemic. And I think Etsy, if they're able to effectively monetize and drive users towards their app, that's just a wonderful way to connect, especially with new customers, especially with younger customers, and those habitual, more repeat buyers. They've done very little with their app so far. So I think the app could be a critical aspect about turning around these growth numbers. And again, that's not saying getting back up to 30% plus growth, but getting back up to the, mid-single digits here in top line. And we're talking about a business that is producing something like 7% free cash flow margins, trading at 8 times cash flow. If you're able to just drive even mid-single digit top line growth here, that's pretty impressive. I'm not going to bet on bottom line growth. They've done a lot of bottom line growth over the last couple of years just by pure cost cutting. I don't know how sustainable that is. But I think the loyalty program, I think the AI improvements, and I think the app stuff could be beneficial for this company long term. And right now, the market is pricing this company like there's going to be effectively no value driven from that. I will note one thing, Jayson. Sorry, not to cut you off.
No, not at all.
I talk about free cash flow. I want to put a big caveat there that I recognize this company still does have a fair bit of stock-based compensation. Now they use effectively all of their, free cash flow on share repurchases. The share count is down something like 15% totally over the last 2 years. But that's something that investors concerned about, that they should know that about Etsy. They still issue a fair bit of stock-based compensation.
Yeah, and I'll just to kind of add on it some last thoughts here. The business definitely has some issues that they need to work through, and they've made mistakes in the past with capital allocation. Talking about the ELO7 acquisition, they spent $1 billion. They sold it for a couple $100 million, right? That's $800 million in goodwill write down. Cash is out the door, but it is a very cash generative business. And not only are they buying back the dilution, but they're net reducing the share count at a point that it looks like the stock is deeply discounted. So it feels like they're making smart capital allocation decisions with their free cash flow right now, while also maintaining a margin of safety. I think they have roughly $1 billion in cash and equivalents on the balance sheet. There's a couple $1 billion in debt, but correct me if I'm wrong, it's convertible, I believe, and the interest rate on that debt maybe 0%. I need to go back and look. Don't hold me to that. Do your own due diligence, people. But either way, I'm pretty sure that debt is exceedingly cheap. They did some debt in 2020 and 2021, I believe. But it's not costing them a lot of money to service that debt. So the company has plenty of internal resources between its balance sheet and its cash flows. If they just remain disciplined and don't mess up, I think the price creates a lot of margin of safety for investors. A lot of their growth in cash flow is that take rate. It's almost 23%. I don't think they're going to be able to continue raising the rate of their sellers. I think it's going to be challenging to continue to do that. They're going to have to make the platform more attractive to more buyers.
Yeah, to your point, Jayson, I did just pull up the interest rates they have on their debt, which it's 3 series of convertible notes, all of which have, or 2 of which have 1/8% on their interest rate. And the other one has 1/4% on their interest rate.
Okay.
So
it's not 0, but it's very, very close to 0.
Effectively 0. And they're convertible at prices ranging from around $88, which is around double where Etsy's price is today, all the way up to $250 per share.
Yeah. So a lot of the deep discount valuation that we see is the expectation that those shares, when they convert, are going to dilute. And so I don't want to say value trap, but that's one of the reasons.
If they get to the price where they do convert, which is big right there.
Even at that, it'd be a pretty big win, right? So
yeah.
Okay. All right. Let's pivot over here. We've gotten some questions that have come in. Have you had a chance to take a look at any of the questions so far?
I have not. Have you? Let's take a look
see
here.
No.
I see we still
both
have
been
some
so
questions
focused on
around
this.
global investing, which I think is one of your areas.
Say that again.
Expertise. Some questions around global investing. I have one here from Phil that I'm happy to jump on.
Sure.
Who says, I'm looking to buy an ADR company, NVO, that's Novo Nordisk. Am I better to buy it on its home exchange to avoid ADR costs? So whenever I think about investing in international companies, it is always important to look at how a business is listed, right? So some companies may actually be directly listed on US stock exchange, even if they're, domiciled elsewhere, doing business largely elsewhere. In the case of Novo Nordisk, they are an American depository receipt, which does, in my understanding, typically come with very, very small fees associated with holding those shares. I'm talking about something like a penny per share per year. In my opinion, and not that maybe I'm not investing as large amounts of money as some other investors. In my opinion, it's never been a large enough fee to deter me from owning that company, and not enough to take on the exchange and the currency risk that comes with buying a business on a foreign exchange. In my experience, at least with my brokerages, the costs associated with doing that tend to be a bit higher.
Right. Well, and then you also you have to trade when its domiciled exchange is open, which can be 4 to 8 hours difference or more for US based investors. So there's currency risk. There are those concerns. I think the main thing that I would suggest anybody that's considering investing in an ADR, less about cost and more about liquidity of shares. Do those ADRs trade at a high enough volume that that's not going to create a problem for you at some point if you decide to sell? And the other thing too is if it is a thinly traded stock where there's not a lot of volume, I always suggest anybody that's doing that consider to use limit orders to buy and to sell versus market orders. Because with modern brokerages, if it's a stock that's traded a lot, hundreds of thousands or millions of shares a day, and you put in a market order on Fidelity is going to get you a good price. You're not going to get messed up. But sometimes with these thinly traded ones, you throw in a market order out there and somebody's got in a sell order and you're trying to buy that's 10% or 15% above the market price. You might be the sucker that ends up getting that price and you didn't even realize that could happen. So it's really, really important on those thinly traded stocks. Sometimes they can be ADRs, just to be aware of that risk.
Luckily, in the case of Novo Nordisk, I believe its liquidity is very
Shouldn't
high.
be an issue.
Yeah,
especially right now.
Okay.
Yeah,
but never a bad thing to think about. Thanks, Jayson.
Yeah, absolutely. Okay, so Ed asked this for Danny, but I'm going to give my answer. So Ed asked, do you think Mercado Libre is a mature company with slower growth, which means less share price appreciation? 10% a year sound reasonable. Ed, I'm just going to say 10% a year. I mean, if that's your minimum threshold, that's pretty good for any stock. I mean, just kind of as a starting threshold, that's the market's long-term average. And the funny thing is that most stocks do worse than that, right? The outperformers generally do so much better that they make up for the quantity of stocks that do worse than average. So I think Mercado Libre is a mature company and its growth might be slowing, but man, it's still got decades of growth ahead of it, right? Emily, you think about markets like its core markets that are doing really well, like Brazil, but then think about Mexico. The growth opportunity in Mexico is that entire economy begins to accelerate, and Mercado Libre is still very early in its growth there. And that's just talking about the picks and shovels that have got to go on the ground to build out the e-commerce business. If you start talking about finance and the payments platform, so much of Latin America is still underbanked. It's still so much a cash society. They've already built the largest platform for digital payments in the countries that they operate in, where more dollars in payments through Mercado Pago, that's the payments platform, go to pay for things off of Mercado Libre than actually go to buy things on Mercado Libre. That's how strong that platform has already been. No, I think the growth story still has decades to play out. Now, I'm going to talk out of the other side of my mouth here, and I do expect that Mercado Libre probably can grow its earnings per share over the long term at low teens rate, and that should, if again, earnings per share growth, free cash flow per share growth. If you measure a company's performance, a stock's performance over the long term, it usually tracks with their ability to grow earnings per share over the long term. So what I'm saying is that my expectation is that it will probably do better than 10% a year over the long term. But I'm not investing where I have to have that. So I wouldn't be displeased if it was closer to 10%.
Mercado Libre has been a hot topic of conversation across a few different analysts at our team recently. And I have erred on the side of saying, while Mercado Libre is a large company and is increasingly diversified, increasingly profitable, it is, in my mind, extremely far away from being a mature company or being a slow growth company. In fact, I think the risk profile of Mercado Libre today is incredibly bigger than it was 5 years ago.
Because of the finance business?
Because of the finance business, which is totally fine. Which, to be clear, it has worked out well for them. To your point, Jayson, the bottom line growth is driven entirely by the financing business. But that business did not exist, or at least not in the capacity it does now, even just a few years ago. And the rate at which Mercado Libre is underwriting new loans, especially credit cards, to underbanked individuals across Latin and South America, that rate is only accelerating. That has accelerated. So while you may look at total top line and it might be slowing, Bottom line, it's accelerating. And the reason it's accelerating is because the growth that they are driving is credit.
Mm-hmm. And building a credit business and underwriting risk is very different than building an e-commerce platform.
Yes. And I can
totally
understand
different skill sets.
They're synergistic. And that's why
Yeah.
Mercado Libre got into the financing business, Mercado Pago, entirely in the first place, was because they're saying, okay, we're building e-commerce platforms. And a lot of the people that we're trying to serve don't have access to digital banking. So a lot of the merchants we have don't have the ability to set up their own online shops, don't have the ability to take credit cards online, right? So what can we do as a company to help facilitate growth in this area? Because that will encourage growth in GMV and other key metrics for our e-commerce platform. That has really only grown. And now it's gotten to the point where we're issuing credit cards, right? Not just to individuals, but to merchants, giving out small business loans, doing all of the actual financing aspects of effectively being a bank. And management has done a great job at risk control as part of this process. I believe it was about, I want to say it was this time last year. It's possible it's this time 2 years ago. My springs are getting a little mixed up here. They did go through a period where they were getting losses on a lot of their merchant receivables to higher than they were expecting. And they said, hey, look, we're increasing our credit standards here. And coming out of that, they've done a decent job of controlling their losses while still underwriting at a pretty breakneck pace. But the risk profile that's associated with that, I think, is something that every investor in Mercado Libre should be aware of. I am comfortable with it. I am, I think I would have an above average risk tolerance personally. But if somebody is looking at Mercado Libre and saying, this is a mature company with slowing growth that is incredibly profitable, I would maybe challenge that assumption by saying, this company is, what is driving their profitable growth is not mature. It is pretty brand spanking new.
Yeah, I think that's fair. I have a question for you. This is something that I've thought a lot about with Mercado Libre. One of the things that I really have come to realize is so important when evaluating management and businesses and their ability to succeed and fail are things like incentives. Mm-hmm. And maybe my biggest concern about Mercado Libre investing so much in particularly the credit part of its finance business is the incentives run counter to continuing to keep its originating standards as high as possible, because the higher those standards are, the less credit you're going to issue. The less credit you issue, the less you can optimize for growth on the e-commerce platform, right? So the easiest way to juice your e-commerce sales is to lower that threshold a little bit and issue a little more credit than maybe you normally would have if your standards were higher. So I feel like they've done a pretty good job. And like you said, really over the past year, we've seen evidence of that in the improved results and the lower late payments and write-downs they've had to take. Are you concerned about the incentives and the fact that it's one integrated business?
That's a really good point. And honestly, Jayson, not something I specifically thought about. I had always been so focused. One of the big concerns that I had with Mercado Libre was how they break down their segments of their business. They've always broken it down by geography. And as their financing business has expanded, every year that's passed, I've thought to myself, well, surely this is the year where they're going to change their reporting segments from geography to business segments, right? From e-commerce, like the way that Amazon does between e-commerce and AWS. And yet again, this year, they did not break that down. And my concern has been focused around just how much of this is potentially coming from Argentina and consumer financing in Argentina, which we don't have the breakdown, so we can't see it directly, but how those two grew the bottom line, as well as financing in Argentina grew in lockstep with each other. That being said, I did just pull up here. I'm trying to pull up their management incentive here. So what's driving their long-term value? And I see, adjusted earnings per share, shareholder return, segment EBITDA, and free cash flow. Just trying to figure out exactly what management is using here to gauge their performance. But you're right that a lot of these key metrics can be things that can be juiced by the financing business. My hope is this is a management team that has been in place a long time.
Yeah,
my hope
including
is that,
including the founder.
Yes.
Yeah.
They have their eyes focused on longevity, but money corrupts. We know that.
Yeah, no,
And,
that's exactly right.
Yeah, ultimately, you do what's best to line your pockets, and ideally, those incentives align with shareholder incentives and stakeholder incentives as well.
Yeah, and Marco Galperon still has a pretty sizable stake in the business that I do think it helps over the long term, but you never know. Things can change. So I always like to keep an eye on that. Okay, so next question here, Emily. You see anything coming up in the queue? You ready to grab?
Ooh, let's see here. There's a question here from Besties who is asking, what are the catalysts for ELF? What's the outlook for the next several quarters, and what can investors expect? This is a great question. ELF is a business, a discount and makeup brand, has been challenged incredibly recently. I mean, it's had a perfect storm of issues that has faced this company. I'm just checking to see when they report earnings next. I think it'll be a while. Yeah, they just reported in February, so we might not get updates here on ELF for a little bit. But let's talk a little bit about, actually answer this question about what its challenges are. And I lost it now. What was the actual question?
What are the catalysts for ELF? What is the
Catalysts,
outlook for the next several quarters? What can we expect?
Okay. So great questions. Outlook for the next several quarters. Let's talk about that first. Not looking great. So management was guiding. They did 30% plus growth in the most recent quarter. In the most recent quarter. And then their guidance for next quarter was, I believe, something like -1% to 2% growth. So that shook the market. It was like, how are you going in a single quarter from 30% growth to potentially negative growth? And management came back and said, okay, well, there's some headwinds that we're facing here. TikTok got shut down during the quarter. We use a lot of social networking. With all of the factors that are going on in the world, they have so much word of mouth spread. People aren't really spending their time talking about cheap discount makeup right now. They're talking about other stuff that's going on in the world. Moreover, they produce and manufacture all of their products for the most part in China, as well as the tariffs on China. I think that is also, while they haven't had the financial impact in this quarter, they're expecting it next quarter, and they're going to give guidance for investors when they report, I believe, in early May. So the outlook there is looking incredibly challenged, and it doesn't help that one of their key distribution partners, Target, has also had much softer foot traffic. ELF is one of the best-selling, I believe it's actually the best-selling makeup brand in Target, the number 2 best-selling makeup brand in Walmart. But because of the decreased foot traffic to some of these retailers, they've also seen and are expecting lower sales growth. I personally think management could be sandbagging a bit here with some guidance. They live in a pretty uncertain environment, and I think as a result, they don't want to overpromise and underdeliver. But it is still a pretty stark slowdown that has obviously concerned investors. And when you have a business that is, doing double-digit growth and guiding for negative, then you see the contraction valuation that we experienced over the last couple of months. But for me, I think one of the most important key catalysts for ELF is just its brand positioning right now, and this is the reason why I still continue to have long-term conviction in this company. So ELF is a discount makeup brand that they really do make their bread and butter by saying, hey, what's working for this premium brand over here, and how can we reproduce this product for a quarter of the cost? And when you have very cost-conscious consumers, they can get to the point where they start to trade down in tighter economic environments. And I think many people today believe that we could be heading in for tighter economic environments. We're having guidance for negative GDP growth this year. There's concerns around rates of unemployment, inflation, that sort of thing. All of that makes people tighten their belt straps just a bit more where they're spending money. But people still want to wear makeup. So it's possible that we'll see a trade down from somebody who was previously buying a premium makeup brand to say, maybe I'll give the knockoff competitor, in this case, ELF, a chance and see if it's any good. Right. And then hopefully those people realize, hey, this product it gets me 60 or 70% of the way there. Right. It's fine. I can continue to use this and save a fair penny as part of this process. So when I think about the big catalyst for ELF, it really is not just the brand, but also just the pricing positioning that it has against its competitors. And while the tariffs in China can be a headwind to that price, considering how significantly discounted they are in comparison to the people they're up against in terms of brand price, the 10%, 20% tariffs, while raising prices sure will happen for consumers, they'll still have a price edge over their competitors, which, by the way, a lot of their competitors also produce in China. So all of that is to say, I think there are some catalysts there. There's a fair bit of headwinds, though, and I understand that given the guidance that management laid out last quarter, the skepticism around this business is understandably pretty high right now.
So we had a question from Ed about Warby Parker. Conceptually, I think just having this conversation can be really useful. So the question is, does this equal a sell? Bloomberg Law warning that, quote, anti-American consumer sentiment fueled by tariff wars poses a business risk, end quote, for Warby Parker. And I think this is interesting because in the environment that we're in, again, having as much of just an investor-focused conversation and the implications for the political environment conversation as we can, without weighing in on partisanship or the politics in specifically, it's important to really look at the facts and peel the layers back on these different businesses and the risks. So Warby Parker, I'm going to send a screen share over. This is from their Q4 investor deck. Warby Parker has 276 retail locations. 5 of those are in Canada. This is a largely US-based company that is selling into the US market. Obviously, like most US brands, at some point, the opportunity to expand starts crossing over borders. I would caution, I think anytime there's a macro thing, there is a political thing that is in the news, that is the story that is driving markets and the way people are thinking, I would highly caution anybody from using those things as a buy or a sell sign, either one, on their own, because the reality is we have zero idea how the tariff story is going to play out over the next 5 weeks, much less the next 5 years. So I think it's way too early in this story to even remotely begin to think about, the long-term implications of something like anti-American sentiment on a business like Warby Parker today. Is it creating headwinds right now? Almost certainly it is, right? To some degree. I have a lot of friends in Canada. I know there's a Canadian guy that shows up on Motley Fool24 at least a couple of times a week. I think he's done a pretty good job of not wading into the political wars, but there's a lot of people making decisions to not buy American goods that live in Canada right now. That is a reality. Okay. But I don't think we can extrapolate that over the next 5+ years and make any sort of finite decisions. It's way too much in the too hard pile. So for me, if that upends part of a thesis for any investor on a particular company, usually the best thing to do is nothing, right? Learn more and let things play out, because the thesis and the reason to own Warby Parker is not because they're going to open more stores or increase their sales into Canada, right? It's a much bigger story than just that. Emily, anything to add?
I completely agree. And while obviously what's going on with Canada right now is unpredictable and it changes by the day, it is for now isolated to Canada. A lot of that pushback, I would argue, maybe you can see that with Tesla in the EU, but not with American brands largely in the EU. You're getting that with Canadian or with the American brands selling in Canada. And Canada is, for the vast majority of these companies, a very, very, very small portion of their total sales. Now, do we want this to be happening? Of course not.
Right.
But by no means do I think that the short-term kind of anti-American sentiment should be a thesis breaker for an investor who is otherwise invested in a good business that is just doing their thing while the world is changing around them, right? And when I think about the long-term implications of this, I worry less about how long tariffs are going to be here or anything like that, and more about what is this company's brand positioning, right? How are they reaching to consumers? And I think there's a case to be made for a business like Tesla, and I don't necessarily know if I agree with it, but you could argue like, oh, Tesla has suffered some brand image because of this whole, over the course of the past year, the past 6 months or so, because of the tariffs, because of the political environment in the US. However, Warby Parker, one step removed, right? Warby Parker as a brand is not what comes to mind first, I think, when Canadians are probably thinking about the American purchases, or Europeans about making American purchases. America is one of the largest consumer markets in the world. So I don't worry that this is going to lead to a broad-based feedback, but I do think about how is this company's brand specifically positioned for long-term longevity. And even now, even with companies that are thrown into the fire like Tesla, I can't make the confident argument that the brand damage that has been done is permanent. I don't know.
Yeah, it's well, and Tesla is so unique. I think Tesla might be the company that if you were to ask the average person on the street who their CEO was, 8 out of 10 people are going to know, right? 4 out of 5
over
are
any
gonna
other
get it on
company in the
first.
world.
Yes.
I would say that now.
I would bet if you ask the average person on the street who the CEO of Coca-Cola is, more people would say Warren Buffett than the actual CEO of Coca-Cola. So again, like you said, Tesla is very, very unique in where it is, like by orders of magnitude where it is. So yeah, just a mindset thing for investors. But I want to again extrapolate that beyond tariffs and in the moment right now. You could go back over the 30 years and past 30 years, and every few years you could find some macro thing that Bloomberg or Bloomberg Law or somebody on CNBC or somewhere in the journal, the Wall Street Journal, you could find here's the reason to move away from this sector or this particular company. And if it's insert macro thing here, it's almost never been the thing that actually affected the trajectory of that stock over the 5 or 10 years after it. So just be mindful of that.
I love that. And not to completely derail the conversation, but I think this is such an important point for investors because it's really easy to get lost, lose the forest through the trees, right? And try to pick out every single detail when it comes down to an investment. And I would say, and I've continued to say, the hardest part about being a good investor, being a good retail investor, individual investor, is finding the 2 or 3 things that actually matter for that company and focusing on them and ignoring everything else. So for earlier coming into the show, we talked about Mercado Libre and the fact that they're paying off income tax, right, to a portion of the United States. You can have an investor who has made a fair bit of money in Mercado Libre, never knew that about Mercado Libre. That's totally fine because it's not one of the 2 or 3 most important business driving things. It's the financing business that we should be paying attention to. It's XYZ, and picking out those 2 or 3 things is by far the hardest part. It means looking at all the trees. You can't miss the 2 or 3 things because you didn't happen to look at that specific tree, right?
Right.
But it does mean letting go of the factors that A, are outside of your control and are B, not relevant to your thesis. And Warby Parker and sentiment in Canada is just an easy example of that, but it's much harder on a broad scale level. And I actually think right now Tesla is the poster child for this challenge because for a lot of people, Elon Musk is one of the 2 or 3 things that are important to the thesis of Tesla as the brainchild in a lot of ways of this business, as one of the spokesmen, right? The fearless leader for this company for so many years. So now it is begging the question of, were we wrong? Is he not actually one of the most important things, or is he actually the most important things? And what do we make of this situation now? So those situations are a lot more complicated. But when you hear about these little trees, ignore the little trees, right? Focus on those 2 or 3 big things.
But I think they're good. I think the things that are good about it is when you see something like that and it brings a company you own to and it kind of raises the profile again. I do think it is a good opportunity to do the most important thing, which is start poking holes. Look for reasons, the thesis, look for the things that you've missed about the downside versus just here's my thesis and this is going to go right and everybody's going to make money. All you got to do is miss one important thing and it undermines all of that work you did to find the things you can be right about.
I love that. When we write up sell recommendations in Stock Advisor, one of the most important aspects of the sell recommendations is reflecting and acknowledging what was the thing that we missed, right?
Yep.
What it's not just, okay, stock's down, we're selling, what happened? It's when we look back on the investment decision that we made initially, what happened to this business or this company that we didn't see happening that caused our thesis to effectively break to the point where we no longer believe it has market beating returns. And that is by far the most important part of investing, because if you don't have the ability to go back and self-reflect and acknowledge where did you go wrong, not just where went right, but where did I go wrong and how can I do better, you're never going to grow as an investor. And we're growing. Every single person from, somebody who started investing yesterday to Warren Buffett, they're growing every single day.
So Ed, thank you for giving us an opportunity for this awesome dialogue. Ed's got another follow-up question here about ELF that I think would be worth discussing pertaining to the short report. Is it clear sailing for ELF? Did they answer all the questions to rule out the allegations, or will it come back to bite them?
Yeah, I love this question. So ELF was subject to I believe it was a Muddy Waters short report. at the end of last year, if I'm not mistaken. My timeline could be a little wrong there. But to answer your question, Ed, it's entirely possible that 2 years from now, 2 months from now, 10 years from now, we may come back and say, oh, these claims in this short report were actually substantiated by X, Y, and Z, right? If ELF's auditors aren't catching it, then, mom and pa down the street probably aren't catching it either. But the truth is, and I love this about, companies, it is not ELF's job to debunk unsubstantiated claims made against them, right? The onus is kind of on Muddy Waters or whomever is making these claims to back them up substantially. And the fact that we are so far past this short report and we've had quarters of earnings and there is no indication that anything they've said is substantiated, I think adds some credibility that a lot of the claims were unsubstantiated. But again, a lot of the claims, I believe, if I remember correctly, were about like deferring revenue, that sort of thing. They had some questions about their supply chains in China. I believe ELF came back and said, hey, you're working off really incomplete data here. Like, we changed the way that we were importing from China. So all of your import data is just inaccurate. So there's a lot more nuance here. I try not to get caught up in these things. To your point, Jayson, that you made earlier, I think it's important to go back and challenge your thesis to make sure you didn't miss something. But in a lot of cases, claims being made by short reporters are done by either boots on the ground research, right? I'm sitting at a manufacturer in China looking at these products being shipped out and it's not what I think it is, or it's making claims that their financials are not what they claim they are, which, if somebody is committing fraud, they're committing fraud, right? You can't know that until you get somebody internally to either admit that or an external auditor to examine that, neither of which we have for a business like ELF. So this is all to say, I can't sit here and say, yeah, that short report was purely accurate, or no, that short report was not accurate. We may never know the truth of it. But I can say that as of right now, there has been no indication that the claims made in this short report were substantiated by business performance from ELF.
So Besties just dropped a comment here. I want to respond to before I take Ed's question about Brookfield and an asset acquisition that they're working on. Besties writes, the macro still influence business, and they do more or less. That affects the business more or less compared to others. In the longer term, it's not to be ignored. I agree. It's good to be aware, right? Because sometimes those macro things do affect certain businesses more than others, and we do need to be aware of those things. But I think generally and directionally, I think Peter Lynch called it right. And to paraphrase, if you spend a minute a year studying macro, you've spent 45 seconds too much, right? The point, again, is not to overweight it. And that's what we tend to do with the things that are in the headlines. We put too much value in them as being signal versus noise. Signal meaning this is something that I can use to influence a better decision, a better outcome in my investing by using this information. The noise being, again, on a spectrum of 1 to 10 on the news versus noise hour we do on Fridays, we try to think about it that way. And like, as a 0 or a 1, it's just there and it doesn't serve any useful purpose as information to inform a better investing decision. 10 being, this is clearly something that we need to factor into the decision about this company or industry or whatever it may be. Most of the time it's somewhere in between on the continuum, right? And I think most of the macro stuff generally is like somewhere between 1 and 3 for most businesses. Over the long term, could they affect returns? Yes, but it's probably going to affect the returns of a broad swath of the market. And we have to invest in the environment that we're in, right? So it's not like it's going to change individual company success a whole lot, I think. So I just think we have to be careful about how we value and how we apply that information to our investing decisions.
I like that, Jayson. And I agree. I don't think macro factors should be completely ignored. And I'm known for being overly blasé about them. So for that, I apologize. But I do think the reason
your mileage may vary, ladies and gentlemen.
Yeah, exactly. I think the reason why I'm so inclined to be blasé about them is because the vast majority of conversations I have with investors around macro news and macro factors are focused entirely on the wrong things, right? It's always like, what's going to happen this week? How soon are we to a recession, right? Like what specific thing are economists predicting? And that's going to change my entire investing strategy. And the reality is that the economy is kind of like the stock market. It's going to go like this, right? But generally speaking, over the long term, it grows, right? And I think if you're sitting here trying to time the economy, it's kind of like trying to time the stock market. And just like retail investors are really, really bad at saying we're at the peak and we're at the bottom now, right? The economists are really, really bad at saying we're at the peak and we're at the bottom. In fact, you could go back and pull up articles from like 2018, 2019 saying that we've been in this bull market too long, that the economy is overheated, that, we need to raise interest rates. We're going to have a recession soon. All of these things. It's the narrative that comes up every single year. And I know at some point there is going to be a recession. There's going to be a downturn. There could even be a depression. It's not a matter of if, it is just a matter of when. And I am not in the business of saying that's going to happen next week or that's going to happen 10 years from now. But I do know that I'm going to stay invested throughout all of it. And that the best days in the market, right? If you miss out on the best days in the market, I think you hamstringed your returns something like 50% if you're an investor. And the best days in the market tend to come during bear markets. So this is all to say, just sitting on your hands is probably the best way to deal and factor in macro news. It's not that tariffs or inflation can't impact businesses. We sit here on Motley Fool Live and Fool24. We talk about it all the time, about the impact it'll have. But these are near-term, short-term impacts that very often have very little bearing on the long-term success of the market, the economy, or even the business themselves.
So you mentioned downturns. I want to share a quote from, I believe it was Tim Hansen. So Tim Hansen is a former longtime Fool. He left the Motley Fool to go to Permanent Equity, which is a really interesting private equity business. It's not the typical sort of private equity. He's the chief investment officer there. But I believe it was he that wrote that it was either him or Ben Carlson, one of the two that wrote this, and I can't remember which right now, that talked about having spoken to hundreds and hundreds of very wealthy people over their career in investing in finance, and having had exactly zero conversations with people that said that they made their money by timing the market. So there is opportunity when we see downturns, but we shouldn't focus only on the downturns. It's across an investing career where we create our wealth. We can boost our returns investing when everybody else is worried about it. Let me take Ed's question about Brookfield Asset Management here. I think this is a good opportunity to explain what Brookfield Asset Management's business really is. So Brookfield Asset Management nearing a $10 billion deal for the Colonial Pipeline. Is this a good fit? Will share price be hindered for the time being? And what about the dividend? So we'll start with Colonial Pipeline, what this is. This is mostly a fuel pipeline that goes from Texas to the Southeast. I think the end terminal is in Georgia maybe, but 5,000 miles of pipeline. So it's a pretty sizable individual collection of pipelines. KKR, I believe, has owned it for a while, and there's some other investors too. I think a Canadian pension fund is one of the owners, and there's probably a couple more that own minority stakes in it. So here's the thing. Brookfield Asset Management is an asset management business. Brookfield Asset Management isn't going to use Brookfield Asset Management's money to buy it. It's going to use capital from its investors who have already committed capital to do exactly this sort of thing, to buy these kinds of assets. So Brookfield Asset Management is the name behind the transaction, assuming that they get the deal, because there's other bidders involved. And what's going to happen is they're going to use investor capital in one of their funds to buy the asset, which is what those funds do. They buy assets and generate yield from those assets. In the case of something like pipeline, that's a big thing, is they want a steady cash flowing business. That's why they're going to be buying it, because it's a toll booth business. You get fees from users of the pipeline. Generally, you get the fees from them whether they use the pipeline or not. It's a of course the term is falling out of my head, but it's a take or pay thing, right? So you pay for the volume that you're buying on the pipeline, the capacity, whether you use it or not, right? So it's a really good business for generating steady cash flows. This is not the kind of thing that would affect Brookfield Asset Management share price. And it's not the thing that would necessarily affect its dividend, because Brookfield Asset Management makes its money managing the $1 trillion in AUM that it has. And makes money on performance fees. When each of its different asset buckets across these different funds that it operates, if they outperform the benchmarks that they're measured against, they earn performance fees on top of that. So this is not going to hinder the business. This is exactly what the business is built to do. Now, there's a good chance the Brookfield Corporation, the parent company that owns the majority of Brookfield Asset Management, ticker BN, may also make some of its capital may also be used to buy part of the Colonial Pipeline. So Brookfield Corporation may actually be taking a minority stake in it as well. And we might see Brookfield Infrastructure be the operating partner, and maybe some of its capital goes to buy a little bit of it as well. I don't know that for sure. I'm just saying this is how Brookfield often operates. So it'll be interesting to see if this is just owned inside one of the funds, or if some of the other parts of the Brookfield family get a little stake in the action as well.
We only have a couple minutes left before we're going to cede over to the next couple of hosts here, Jayson, but I'm curious, semi-related to this, it's not an industry I actually follow like you do, but how interested are you in things like domestic energy production, right? Oil, natural gas in the United States, pipelines. This was an industry that for many, many years, I mean, fell to the wayside for a focus on green energy. And obviously very recently with tariffs and the energy demands driven by data centers and AI, suddenly like everyone and their dog wants a piece of this pipeline or pipelines in general.
So it's really interesting. So yeah, you go back to the 2010s, oil prices were triple digits, and it was all about developing shale. And then the winds went out of the sails in 2014. Oil prices crashed, fell into the 20s in early 2015. And then the next decade was largely a lost decade for the industry, because so much investment in assets that were expensive to produce was made, and those assets were uneconomical for 6 or 7 years. It washed all the money out of offshore investment because nobody was making enough money to invest in these 10 or 20-year projects. A lot of the service companies went bankrupt. There was some consolidation that happened because nobody needed the services at the rates that they were needing them before. And it was really kind of like heading into the pandemic where the industry had finally grown up. You know, we went through like the drill baby drill years, and it just didn't work. It didn't work because you had to be able to be profitable and disciplined. Today's oil and gas industry is profitable and disciplined. Despite what the industry is saying, and we know a lot of the executives, the CEOs, a good number of them are actually meeting with President Trump like imminently to show some support of domestic energy production. But the dirty little secret is nobody wants the taps to get opened, because then nobody's going to make any money. The industry wants $80 oil. That is what the American energy industry wants. So even if we do see an increased access to resources on federal lands and that sort of thing, and like the regulatory threshold gets lowered, there's benefits, but they're not going to run out to produce more oil. The U.S. is already the largest producer of oil in the world. So the areas that I think are interesting and compelling are the infrastructure. I think that's really interesting. If there's one area we might see growth, is liquefied natural gas exports, because there was like a hard stop on a lot of those. And now that's been opened up, and there's a lot of places in the world that want cheap U.S. natural gas. And now we're going to see some growth there. But I'm still looking largely at renewables, because I think the value risk reward has shifted, because everybody's looked away from a lot of the renewables on the utility scale side. So like the Brookfield renewable business, Clearway Energy, some of those, while still looking at opportunities in like refining. There's some great refiners that get great economic results. Phillips 66 is a business that I've always liked that has pipeline business as well. So there's some opportunity there, but I don't think it's in the companies that are producing oil and gas, because nobody in that business wants oil prices to be where they are. All right, Emily, let's we're gonna trade you in for an Andy Cross. What do you say?
Sounds good. Hey,
that's
Andy.
a bad deal. That's a bad deal, Jayson. Nobody.
I kind of
that.
agree, Andy. I love you, but I kind of agree. Emily, this has been a lot of fun. It's been a great hour, and looking forward to do this with you again.
Thanks for chatting.
See you, Emily.
Hey, buddy.
Plaid shirt day.
Well, good job. You got the memo. That's good.
I got it.
That's good. That's
listen,
good.
I just want to say, hey, listen, I messaged you earlier about our topic here, interest rate and stocks. You never got back to me, so we're coming in cold.
Uh-oh. Now, I thought I did. I like your idea.
Okay.
So So here's the thing. So here,
Tee it
so
up for fools.
fools, as you're watching this, this is what we had planned to do from the beginning, is talk a little bit about, and today's important because the FOMC meeting has happened, and at some point during this hour, we're going to get a decision from the FOMC about interest rates, which we know they're not going to do anything.
They probably already got it, don't you think?
They have. I think it was supposed to drop at 2, either 2 or 2:30.
You keep talking. I'll check it out. Keep going.
And the Fed chair is going to speak, I believe, at 2:30. So if you've chosen us, probably chosen well, but there's that other guy that's pretty important about interest rates. But what we thought this would be a good opportunity to do is talk about the relationship between stocks and interest rates broadly, how investors should think about it, and also what Andy suggested to me that I thought I got back to him about, and apparently I didn't.
Sorry, you did. I apologize. You did say I like this idea. So
that's all I said. But the idea is we're going to look at some different sectors of businesses and think about how interest rates affect different kinds of businesses in different ways. I think it's a great idea, and it's going to be a good conversation. So do we have the results? Do we have the FOMCs?
I'm still refreshing. I'm not seeing anything yet, but if anyone sees it, put it into the Slido. Thank you, fools, for joining. I know you had Jayson and Emily for the past hour. You got me and Jayson for the next hour talking interest rates. Of course, Jayson, one of my favorite lines from interest rates is Buffett's parallel with interest rates to gravity. He says interest rates act on financial assets the same way that gravity acts on physical assets, meaning the higher the interest rate, the more stiff effect it has on financial assets. Higher the gravity, the more effect it has on physical assets. So higher interest rates tend to be lower, so they're worse for financial assets.
Yep.
The higher rates, worse for financial assets. Higher the gravity, more heavier effect on physical assets.
Yeah, that's exactly right. And we'll break down some of the specific reasons why. But Andy, you mentioned, and Emily's gone now, so I'm glad you're here, man. This is going to be a good hour.
Yeah, I think it will be too. I like breaking news when we can.
Absolutely. So just a reminder for everybody watching, questions, get those to us, whether you're watching on YouTube or you're a Motley Fool member watching behind the paywall. Go to slido.com, put in the event code Fool24. So if you're watching on YouTube, that's why we don't have comments open there. We have one forum to put questions into, slido.com, event code Fool24. And always remember too, this is not a forum where we're going to provide anybody with personalized or individual investing advice for a litany of reasons. But just remember, that's not what we're doing here. We'll give our opinions and our thoughts, but it's not advice or personalized investing advice. So, okay, Andy, where do we want to go with this?
I'm still trying to figure out what they actually did. FOMC statement. Here we go. Decided to maintain the target rate for the federal funds rate at 4.25% to 4.5%.
We knew that.
Yeah. So basically, that was in the cards, Jayson. And by the way, we got to we're having a little bit of tongue-in-cheek fun with this because there's so much focus on what goes on every month or almost every month when the Federal Reserve Market Committee meets and announces their interest rate policy. However, interest rates do have an impact on so much throughout the economy. So to some extent, it is important on the trend. And I think the expectation really is that, rates would be steadily moving down over the last maybe 6 to 9 months, but then recently we've just gotten more and more concerns about inflation staying stickier, and that might have an impact on the Fed's decisions on when to start thinking about lowering rates. And now, Jayson, as expected, I don't know what the CME forecasts were, but I think most of it was baked in that they would keep rates steady. It looks like that's just what they did.
So probably the more interesting thing, and we're not going to be able to talk about it this hour, but the more interesting thing that's going to happen as a result of this is hearing from the Fed chair. So he's going to speak, Jerome Powell. I think he speaks at 2:30.
Yep.
I don't think he's speaking yet. So, but I'll read the transcript at some point in the next day or two. And it's just always interesting to hear his insights and his broader thoughts. And he'll share some notes on the conversation that the other folks at the FOMC had to say and their thoughts. But again, let's talk about the thing that we wanted to focus on, which is, again, that relationship between interest rates and stocks. and why investors should at least be cognizant of how it works for the businesses that they're interested in.
So, and I think this is, Jayson, where we can start looking at some of the sectors. And I know very acutely you are in deep with some of the industries that are very affected by interest rates, most likely financials.
Right.
So financials is definitely one. Obviously, their job is to borrow and lend for the most part. They invest, borrow, lend.
Right. So you think about banks. Yep.
The big driver, yes. Think about banks. Think about private equity firms, those kinds of things. Obviously driven a lot by interest rates, how much they have to pay to borrow. So that one, I think, jumps almost to the top of my list, Jayson, when I think about ranking the sectors that are most impacted by financials. And I think that's very interesting as you think about the market for financial stocks, of which there are some really great, solid businesses in banks and financials. Many have had a really nice run, Jayson, through 2024. I think some of them have pulled back. But you see the likes of Warren Buffett selling Bank of America. So what are investors to think if interest rates are going to be staying a little bit elevated? And more importantly, Jayson, I guess we should say is, how does the interest rate environment really affect banks? Because it affects it on a couple different levels, both demand as well as their ability to charge interest rates on their what's called their net interest income.
Yeah. So thinking about banks, and again, a bank's core business is buying and selling money. That's the best way to think about the way that the banks work. And they buy money from you, the depositor, largely. So about 9 out of every $10 that a bank has that's its capital, one of those dollars is equity. And again, stock. That initial equity investment, about $1 of that is equity, and the other 9 is either some bit of bank borrowing that they've taken on, or it's deposits from us, right? So it borrows short and lends long.
So explain what that means, Jayson.
Yeah. So as a depositor, I can log into my online bank or go into the bank branch, go to an ATM, and ask for the money that they owe me. That money, if I have $1,000 in the bank and I go and I can make $1,000 withdrawal, they're required to give me $1,000, right? So that's borrowing short. Now they can do some things to stretch that out, like CDs, right? So those are stretched out over a term, and banks borrow money too. They can borrow money from other banks. There's an interbank lending thing, and like that interest rate.
A lot of them. Yeah, I mean, they do that all the time.
All the time. That's what that rate actually is.
Which is where the Fed funds rate comes in so valuable, because that's the overnight lending rate.
Yep. No, that's exactly right. So that key rate is exactly that. So that's why it's so important. And it's the benchmark rate for the US borrowing debt market writ large, is because it's the rate that banks use when they need to borrow money quickly.
That's right.
So that's the key. So, but again, then they go out and they make a loan.
That's right.
That could be 30 years in length, the 30-year mortgage, right?
On the commercial side or on the consumer side.
Exactly.
In general.
So the quickest debt, of course, is the unsecured debt, credit cards, personal loans, things like that are maybe 30 days in term or less for a credit card. It could be a couple years for a personal loan, and then 5 years, 10 years, 30 years, and on and on. So
Jayson, just the shorter the loan, roughly the higher the rate, the longer the loan, the better the rate. Is that generally about right?
No, it's actually the other way around.
The shorter to loan for me to borrow from a bank.
Yeah. So if you take a 15-year mortgage, you're going to get a lower rate than you are on a 30-year mortgage.
A 30-year mortgage, right? And
same way on an auto loan. It's the rate. The longer it out, the further it out is, the higher the interest rate tends to go. So now, what you do see though is there is a relationship between riskier debt, which is lent out in shorter terms. Again, credit card debt. Use a credit card. You get the statement next month. It's all due. Everything you paid, comes due, and then you go to a car loan. Right. A long car loan now is 8 years. Typically car loans are 3 to 5 years. Right. So those shorter term, and the loans on those products tend to be shorter term because they're depreciating assets, or there's not an asset besides your credit rating that backs it up. Interest rates are higher on those.
Right.
But generally, when you get to bigger assets, the longer term, the higher the rate is. So, and the reason that is the case is because, again, they're borrowing short.
That's right.
So they want to increase the rate that they can get on loans that they're issuing for longer periods of time. Here's where that relationship comes in for banks and how they make money. We're not even going to talk about the economic aspects of what makes rates go up and down. We're just going to talk about the direct relationship. If interest rates are going up, there's an aspect of that that's good for banks, because it means they can sell money for more. They can charge higher rates on the loans that they
the loans they make, they can charge more on those loans.
Right. So that should grow their net interest margin. Yeah. But at the same time, the cost to buy money goes up as well.
That's right.
They raised rates on deposits. That FOMC rate is higher, so it's costs more for them to borrow money from other banks. And the other thing too is that thinking about their total loan book, the interest yield on their loan book total is going to grow at a much slower rate than their cost of funds is going to grow.
Right.
So it in the long term it's beneficial, but in the near term it actually can squeeze their results.
That's right. And then we saw during the financial crisis, the banking crisis with SVB and the likes, when those rates went up, the value of the assets they had went down dramatically, and put the bank in financial peril. So because they hold those at. Sorry, Jayson. Yeah.
No, absolutely. Like you could look at like Truist Financial, for example, right now, and there's a reason it trades for 90% of book value, and that's because it has a substantial amount of mortgages and mortgage-backed securities on its loan book that it owns that are yielding less than 3%.
Yeah.
Now, it can remain kind of like functionally insolvent, I guess is a way to describe it, because it doesn't need to sell those assets off.
They're not held for sale short term, like within a year.
Exactly. So they can continue to hold those assets while the borrower just makes their payments.
Right.
But if it were in a situation where it needed to sell them off, it would have to sell them for as much as a 30% discount of those specific assets, because interest rates have gone up, right? And it's reduced the value of those rates. It's the inverse correlation between interest rates and bonds. It's the exact same thing.
That's right.
So
Jayson, so the Fed doesn't raise rates. In some way, if you're investing, is it true or false? In some way, if you are investing in a bank today, if you're going to buy a bank, you're going to buy 100 shares of some bank, are you making some expectation prediction on where rates are going to be over the next year to two?
I think it's something you need to be aware of and to be mindful of. But by and large, not really.
Okay. So there's other factors.
Yes.
So it's not the only factor for the bank.
No,
of course, it's not the only factor. But in a scale of 1 to 10, is it for financials and banks, it's got to be higher than it is for maybe software company.
Absolutely. If I'm buying Datadog, for example, or Synapsys or one of these companies, I'm not thinking about interest rates at all.
Right.
If I'm buying Alphabet, I'm not thinking about interest because their businesses are so cash generative that they're entirely internally funded. They do not have to rely on any capital markets for any money whatsoever, whether they're borrowing it, issuing stock, because we'll talk about this, the relationship between stock valuations and interest rates at some point too. Those things it's completely, it doesn't exist. It doesn't matter for these sorts of businesses that are they're self-funded for everything that they need to do.
Yeah.
Now for a bank, again, their business is directly tied to the cost of money.
That's right.
Directly tied to it. But the more important factor, Andy, is the health of the economy.
Right.
That is the key for banks, because eventually the economy adjusts to the interest rate environment, and it values these businesses based on that environment. So, for example, right now, mortgage business is basically dead. You know, it's a fraction of what it was 3 or 4 years ago, because interest rates have gone up and everybody's already refinanced, and the existing home sales market is half the size that it typically is in a healthy market. So there's just a lot less transactional value that's happening. But you look across auto market, corporate debt, commercial debt, things like that, where there's health. What we know is that the high quality banks, they operate in the interest rate environment that they're in effectively. And what you want to understand is their net interest margin, which is basically their gross profit on their cost of money versus what they sell the money for. Like understanding the price that you're paying and the kind of margins on the money that they can get, that net interest margin,
Yeah.
And then applying it to their cost of operations. And those are things that I think are far more important for something like a bank.
Yeah, and especially at scale, because that's what they do. They borrow and lend and repeat, rinse and repeat, rinse and repeat, do it well, manage costs, just like an insurance company to manage its costs. And that's the best banks do that, exceptionally well. And that interest rate environment, Jayson, as you mentioned, if interest rates are going down because the economy is suffering and in trouble, while that rate going down has some benefits to the banks, the bigger risk is the economic impact because of lending volumes drying up.
Right.
Demand for lending volumes just drying up.
And then what you see is the best banks, they adapt to that change by being conservative and focusing on cost.
Yeah.
The banks that eventually struggle are the ones that make the mistake of lowering their underwriting threshold. They issue higher risk debt.
Right.
Because you do that to make up for a weaker market. Eventually, when the economy softens, you've increased the threshold for defaults.
Right.
As a result, right? And that's when we find out which banks. We don't know which banks are the great banks when the economy's good. Of
course
we know
not.
the great banks when it's not good, right?
Yeah. Yeah. When the tide goes out, and like Buffett says, tide, he means it more for investing, but when the tide goes out, you find out who's been swimming naked and who hasn't.
I think for banks, it's actually the other way around. It's when the tide goes in and we find out which ones are wearing lead vests.
There you go.
They can't swim, right?
That's right.
They can't swim. So I think that's the key thing.
I've been mixing my metaphors today.
Yeah. No. I like to invert that one a little bit. Call me Charlie.
You want to hit some questions just very quickly, because we have some mostly on the financials. And Jayson, we can talk lots of other industries. Software, you mentioned valuation is important. Home building, industrial, and I want to get your take on other industries as well. But maybe a few questions we can just we can jump to. Let It Ride's question on the price to book, Jayson, I think is really interesting and nuance. It's not 100% crystal clear, but Let It Ride says, what price to book value makes a bank look like an attractive buy? So maybe define book value and then figure out why we care about it for a bank.
I'm gonna try to be as satisfying with my answer as I can, because there's parts of it that are gonna feel very unsatisfying.
Yeah.
So we'll start with the definition. So price to book value is simply whether or not the company trades for a premium or a discount to the value of the assets that it owns. So a price to book value of 1 means that, let's say the stock trades for $100 a share, but its price to book value is 1. It means that the book value of its assets are $100 a share.
Right. If so book value is basically assets minus liabilities, the equity of the
net assets, right?
The net assets, right? Exactly. So it's and you really only hear it referred to in financial companies. We don't talk about price to book or book value for software companies, industrial companies. It's really about financial companies.
Largely, yeah. I do use it every once in a while for industrial companies. If something looks really, really cheap, I think throwing it in the mix. To think about the idea of like a liquidation value.
That would have to be because then you're looking at the inventory levels, you're looking at a lot of stuff, right?
Yeah. So, but again, it's not broadly, you're 100% right. There's sometimes it can be a little informative, but definitely when you're looking at financials businesses, it's the key. So again, it's the net value of all the stuff that they own: cash, inventory, delivery vans. I mean, banks don't have a lot of delivery vans, but you get the point. That's the loans they have on delivery vans from their customers. And then you subtract all the assets. So who do they owe money to? So deposits, that's a liability, leases, like all that stuff. So that's the net out. So again, let's say they have $100 a share of assets, net asset value. If it trades for $90 a share, it trades for 0.9 times book value. So it's discount to book value. So anytime you can buy most banks for a discount to book value, historically, that's been usually a good sign that it's good, with this caveat that if it's a big outlier and it's substantially discounted to it, there's a good chance that investors already know there's trouble brewing.
Yeah.
Or the bank is opaque, or there's significant concerns. If all of the banks are trading for a discount, it's probably in the middle of some type of like economic downturn or a banking crisis, like we saw back in March of 2023, I believe. Where there's probably some really good opportunities to buy perfectly good banks during a time of fear. I will say this: I prefer, when I'm looking at a bank, to not just look at price to book value, but look at price to tangible book value. So this helps remove any value for intangibles. Like we've seen a lot of consolidation in the banking industry over the past couple of decades.
Yeah.
And if a bank acquires another bank and it pays a premium for that other bank, there's going to be goodwill on its balance sheet.
Yeah.
If it doesn't actually deliver on that acquisition and create value, eventually that goodwill is not going to be worth anything, right? So tangible book value removes things like goodwill that might not actually have any real tangible value in the long term. So almost always when I see what looks like a well-run bank and everything seems to be fun, they're not like at the risk of default, trading for 1x or less book value, it almost always gets me really, really excited.
Yeah.
Other really high quality banks, particularly ones that are maybe smaller and they've kind of nailing on a good growth trajectory, might trade for more. And I think it might be an appropriate valuation for them. So like Axos Financial, ticker AX, is a good example. Exceptionally well run, has diversified, has a lot of fees-based businesses as well. So not just living off of net interest margin from the loans that it issues. It's helped de-risk the business, help give it exposure to other industries and other and less leverage to the economy broadly. So that's another thing that I like a lot about Axos Financial. And what does it trade for now? Probably 1.5 times, roughly 1.4, 1.5 times.
Yeah. So Jayson, I just shared. So this is Axos, US Bank, and Truist. Jayson tossed another one out there. I'll add to courtesy of our friends from Y Charts. And this is the 3-year price to book value. And you can see, as you mentioned, Truist, the orange line, sells at about 0.9 times book value, and the other two sell at 1.3 to 1.45 book value. So essentially what that is telling me is that the market is currently valuing Axos and US Bank's market cap higher than its actual book value, because when you take the assets minus the liabilities,
right,
the value in the marketplace is for those two banks is higher, whereas for Truist, it's actually the reverse. It's actually lower.
Yeah, no, that's exactly right. And if you look in the middle of that chart, you see that dip for all of them. That was from late February through late May of 2023.
Yeah.
It was that second week of March. We saw the two bank failures. It was Silicon Valley Bank and what's the New York?
I
New York. Remember it.
Yeah, I know.
New York
we couldn't remember it.
Signature Bank.
Yeah.
It was Signature Bank.
Signature, right.
So we saw Silicon Valley Bank and Signature Bank were seized by the FDIC the week of March 13th.
Yeah.
And then in May, First Republic in California was seized by the FDIC. And then you see what happened during that period. There was massive uncertainty, and there was a lot of discounted valuations across the industry. And we've seen them really ramp up, right? And of course, throw JP Morgan on there. This is the biggest bank in the US by deposits, by market cap, by basically any metric. And it trades for 2 times the book value of its business. It's the gold standard, right?
It is. So I put that up there because exactly right, Jayson. It is the gold standard 2 times. But as you said, Jayson, during that great financial crisis, it got down below 1.5. But for those investors saying, oh, you know what? When it gets down to 1.25, I'm going to buy, or when it gets to price to book value, I'm going to buy JPM. It just never got there.
What makes JP Morgan different than these other three is its investment bank is substantially larger. I think Truist has a little bit of maybe a little bit of investment banking that they do, but they have more wealth management and things like that. That's part of their business, and not a lot of like true investment banking.
Yeah,
it's like half of JP Morgan is investment banking. Okay. It's a substantial driver, very, very profitable. You look at the returns, so you start looking at return on assets, return on equity that JP Morgan has delivered over the long term.
Yeah.
And it's substantially better than the 1 in 10 thresholds.
Yeah.
For those.
Yeah.
So it's earned that higher valuation because it's just been more profitable. Right.
Yeah, exactly.
So that's the key there. All right. Let's hit some other questions here. Curious how interest rate changes affect companies that have variable dividend payouts. So the interest rate change has less to do with the dividend payout than you would think. So interest rate changes for banks, we've talked about that. I want to shift into the conversation, Andy, around capital intensive businesses versus capital light businesses, because I think that's where, again, in the operations of the businesses themselves, we see the biggest impact. So over the past 25 years, we've seen the emergence of the capital light business. So many technology companies, software businesses that don't need factories, and therefore they don't need to improve those factories every few years. They don't need to manufacture boxes of software anymore. So as the capital costs for those businesses have decreased, we've seen corporate margins and corporate profits broadly at some of the highest levels ever, and they continue to increase because a lot of those companies are just more profitable because their capital demands are so much lower. So those companies, again, they can self-fund their initiatives by and large. And when they do go borrow money, they don't, like, they always get the lowest interest rate, right? Because they're just so advantaged as businesses. They're extremely safe borrowers.
Yeah.
Now, if you're a manufacturer, it's a different world, where interest rates are really, really important. Or if you're a REIT, let's talk about REITs. I think that's a perfect example of a company that uses a lot of debt.
Yeah.
And you can apply that reality across every other type of company that uses a lot of capital. So real estate investment trusts, they buy and invest in property. I'm not going to talk about mortgage REITs that all they do is invest in mortgages. We'll just talk about the ones that are basically they're buying property and then they're leasing it to a tenant. Okay. The core thing about a REIT is you have to pay out one of the things you have to pay out 90% of your GAAP net income in dividends. So this pass-through investment. So they don't have a lot of retained earnings to be able to use to invest in their business. So they issue stock and they take on debt. In higher interest rate environments, your cost of capital is higher.
Mm-hmm.
What that means is that you either have to be a better buyer of whatever type of real estate you're buying, or you have to accept a lower rate of return, right? Your interest rates moved up. Interest costs have basically doubled for your average REIT over the past, from the low points to now, which means that whatever you're earning from your tenants and leases, if you're not increasing your lease rates at least as much as your interest expense is going up, your profits are going to get squeezed.
Yeah.
So it's raised the margin of error for these businesses and narrow the margin of safety between the cost of capital and then when they go out and invest that capital. Taking it back to the conversation about stocks, we've seen REIT prices fall substantially since interest rates have gone up. Now, there's two reasons. One reason is because we've seen a lot of commercial real estate lose a lot of value, right? We've also seen more competition for REITs, which are dividend-based, yield-based investments from things like bonds.
Yeah.
If you can get a 4% yield basically on cash and treasuries, taking on the risk of being a shareholder in a REIT and that volatility, there's got to be more meat on the bone if I'm going to take on that risk, right?
Yeah.
So valuations have come down in part because of that as well, right?
Yeah.
So that's the direct relationship you see between stocks and interest rates. Companies that rely a lot on debt markets, their valuations have fallen as a result. Companies that issue dividends and also rely on debt, their stocks have fallen the most.
Right.
Because the value proposition as an investor has to make sense based on the risk I'm taking on as the owner of the business, right? Right, Andy?
Yeah. Yeah, absolutely. I mean, 100%. So REITs have a huge amount of sensitivity.
Yeah.
And by the way, they're their own sector now inside the S&P 500, right? So they have a huge sensitivity to rates, and it is impactful on the trend and which direction we're moving. So if you are still a believer, like I am, that rates will be trending down over the next 18 months. Now, I don't know if that's going to happen in 6 months, if we, and hopefully that's for positive business reasons, not negative ones. If it's negative, I think the slope is going to be much more severe, Jayson. But so understanding the trend and how that impacts your REITs that someone may own or be looking at is a very important. So I think I do think, like, for an investor in REITs, the quality of the business, but I do think the rate environment does impact that, and it's helpful to have if not a projection, just some general direction of where you think rates might be heading in the world.
Yeah, the next category of business I think is important. So we've talked about banks and financial businesses. We've talked about companies that use a lot of debt. We should also talk, Andy, about companies that their customers rely heavily on debt. The obvious conversation right now is the housing industry and companies that are heavily exposed to housing. So home builders, for example, they're actually most are pretty big consumers of debt themselves to fund their land pipelines. But the vast majority of home sales are funded by home loans.
That's right.
So that has created a headwind for home builders. Even as we've seen the opportunity continue to be there because of that dearth of supply of existing homes coming available, home builders are really trying to catch up. But a lot of them are having to do things like offer to buy down rates, to show an attractive interest rate for the mortgage for a property. And they're having to pay for that. So it's affecting their margins.
Yeah. So because rates have moved so high and it's impacting demand, they are offering an ability for borrowers to get some help from a lending side to be able to make the purchase.
Yeah. And it's at a cost of thousands and thousands of dollars per house.
Oh.
So again, taking a bite, you sell a house for $400,000 and you typically get, let's say you get 25% gross margin on that $400,000 house. What is that? $100,000 in gross margin that you get?
Yeah. How much does that get eaten?
If you're paying $7,000 or $8,000 to buy down your rates, that's a pretty big bite out of your margin that these businesses are faced with. So that's how it trickles through to businesses like that. You look at a company like Trex, which makes decking. It's the composite decking company. It's the leader in its industry. It's consistently taken a lot of market share from wood. Deck prices have a comma in them. These are 4-digit and even 5-digit investments. They can be a substantial investment. Your average buyer of a Trex deck is borrowing to do that, right? Whether they're whipping out the credit card or doing a HELOC or some other revolving credit tied to their house. It's become more expensive to do that. So that's created headwind for Trex, which if you look at their sales, it's one of the reasons Trex's sales have fallen over the past couple of years. So,
that's right.
So again, this is where you think about like the direct impact on the business and then the financial results, cost of capital, right? We've talked through all of those impacts.
Yeah.
But I think the bigger thing to understand is that historically there's an inverse relationship. When interest rates go up, valuations, particularly for those companies that are most directly sensitive to interest rates, comes down.
And Jayson, we saw just on that valuation point. So where, as we talked about at the very top, the interest rate environment, the risk-free rate essentially, which is the US, called the US 10-year. There's lots of different definitions, but called the US 10-year. The risk-free rate helps set the discount rate that investors are willing to pay for financial assets, including equities. Right. And this is why during the zero interest rate environment, the ZIRP days, we saw assets, equities do so well because the discount rate fell so dramatically down to essentially almost zero, or a few hundred basis points if you add in the equity risk premium. The discount rates fell so dramatically that, like I said before with the Buffett quote, that really impacted the valuations that investors are willing to pay on businesses, on equities. And that, at least from the macro perspective, was one reason that stocks did so well during those days.
Yeah, no, there's like I said, one reason. There were multiple reasons, but that was definitely one of the biggest drivers there. And I think we could say the same thing over from 2010 through 2019. It created a substantial amount of thrust upwards for equity. Companies were growing their earnings during that period of time, but interest rates were so low. There was a lot of money, institutional money, that historically probably would have been in a 10-year. That was in equities.
That's right, because they couldn't earn anything on that 10-year, or they couldn't earn anything on their savings, as we all know. And that started to flip a little bit to that extent, and we still have a lot of money still on the sidelines. But I think obviously, as we've seen the past couple month's a little cautious. You know, Jayson, Besties and Ed have similar questions. So comment on Brookfield, sorry, not Brookfield, Blackstone, KKR, Apollo, differences in better investment at this time. What's going on in alternatives and private equity land? And Ed talked about Blackstone and Jefferies. Now, Jefferies is a different beast than Blackstone and Apollo and KKR, which is much more private equity investors, and Jefferies is more of an investment bank.
Right.
They all are tied to the interest rate environment for sure, because they're financial assets. They basically are making investments and helping other companies, their clients, make investments. So they're clearly tied to the market. Jefferies, we recently, as I was saying yesterday, took off the stock advisor penalty box because the business is actually has done very well, had a nice rebound after a rough year or two. But the reason why we want to take it out of the box is with the valuation after that great year of 2024. Just this year, the stock is down 20% and the valuation got much more reasonable for Jefferies. And so some of the operational challenges they had are now past them, coming off low bases, and Rich Handler and that team, I think, have made some smart decisions to improve the investment bank that is Jefferies. And the valuation started to come down this year because of the drop in all the other equities, and the stock got much more reasonably priced after a nice run up in 2024.
Yeah. So thinking about Blackstone and KKR. So Blackstone historically has kind of been thought of as this real estate giant, which they are. But if you look at the business, it's really interesting. Over the past decade, their private equity business has become pretty substantial in owning other businesses, right? So it's expanded and become more diverse. The thing that's interesting to me about KKR is actually one of the things I like about Brookfield Corporation before it split Brookfield Asset Management out as a separate business, was that it kind of eats its own cooking, right? Yeah. They have KKR Capital invested alongside investor capital. So even though with Brookfield now they're separate entities, you still have that same exposure, right? Yeah. So that overlap of our capital is at risk alongside of our clients' capital. Yeah. It's one of the things I've always liked about KKR as a business. I think broadly, I don't really follow Apollo, so I can't really add a lot of value there. Yeah. But thinking about the trends for alternative asset management, these uncorrelated assets that are not mark to market, where you're constantly looking at the ups and downs. And again, thinking about institutional high net wealth, wanting exposure to long-term returns. And a lot of it, they're looking for, protecting capital while earning yield and income off of that capital over the long term. Yeah. There's still a big appetite for it, because as much as there's the thought process that as interest rates move up, it's going to reduce the appetite for that. Brookfield Asset Management and Howard buying, the Oaktree buying out the majority of Howard Marks' firm. The growth of being lenders and private debt. Yeah, these private equity businesses are perfectly aligned with that. So as interest rates have risen, I think it's more fuel for the fire for those businesses, and those tailwinds for accumulating assets under management are very, very strong. And I do think that KKR, and I put it in the same category with Brookfield, is the ones that I think that I like the most. Yeah. I've never been as drawn to Blackstone.
Yeah, it's real estate. It's the big real estate play, data centers like that. That was really that has historically been their big bread and butter, and KKR are slightly a little bit more diversified and different. Right. The stocks, I think they earn, massive fees on income on those investments for their clients. The alternative space is continuing to evolve and grow. I don't think it's going away. I think in an elevated interest rate environment, it becomes probably even more attractive because they might be able to make investments that others can't. They do have to. There are questions about, have we seen are all their investments that they're invested in, are they truly marked the right way? Are they overvalued? Depending on the environment, but that's been going on really for the past couple of years. But the stocks have done very well, and Jayson, the valuations again just got a little bit elevated going into the end of 2024 for both those businesses. And I think that's one reason why the stocks have pulled back, but they have that massive distributed income that they can earn and do things with, pay dividends, distribute to shareholders. and then make those investments. And they tend to do it very, very astutely over the years. They do pay themselves very, very well. You know, Steve Schwartzman and the team at KKR, like they get paid very well. But I think their returns at least have justified at least some of that, I'll say.
Yeah. No, I think that's exactly right. And but this is a business where the value is in your people and who they have in their Rolodex and their ability to build relationships and get that committed capital, because their investors are committing capital for many, many years.
Yeah.
So the ability to deliver on that, the expectation, the threshold is very, very high. But no, I think you're right. I think that these are businesses that are built to benefit from it. Thinking about we had a question earlier about the Colonial Pipeline, the big fuel pipeline that runs from Texas over to the Southeast, that apparently the headlines are that Brookfield Asset Management is positioned to be the winner of that opportunity. It's a $10 billion deal is what they're estimating. Being able to use $10 billion of investor capital is incredibly advantageous versus maybe an integrated oil and gas company that might want to fund some of that with debt versus cash. In this environment, it puts them in a better position to be able to make that acquisition.
It totally does. And this one, similar lines along with Berkshire, although obviously much larger, and Berkshire's stock has done great this year so far. It's just that they have so much flexibility with their capital base to be able to make smart, big, literally those big checks that are so valuable. And that's just one of the huge draws of Berkshire Hathaway, which is also combined with lots of other reasons why the business has been so resilient and the stock's done so well.
Well, and they're doubly advantaged. Number one, they have the cash to spend.
Yeah.
But because they are so cash generative and these fortress balance sheets, their cost of capital is lower.
Yeah.
So even if they choose to use some leverage for these sorts of deals, they're generally in better positions to be able to do that than some of the competitors in the industries where they're competing with them that just don't have the same access or cost of capital. So
100%.
Yeah. So I wanted to address here. Ann Bullock put a comment in about 36 minutes ago. Could you please align your schedule with the correct time Eastern Standard? Schedule says you're on 1 to 2, and now it's 2 p.m. So I went and I looked on the stream, and I'm seeing it correct. That I've been on for 2 hours. So maybe if you were looking at that, I was on from 1 to 2 and 2 to 3. But Andy, I saw it had us correctly. So
I did too as well. It might be Jayson because you were doubly special.
But of course I am. But no, and thank you for that. What I wanted to say is we're gonna pass that along to the producers and the folks that manage the website to make sure there's not somewhere else that it was put that I'm not seeing it.
Yeah.
So if you could, this would be awesome. And if you're still watching, drop a link from exactly where you found it so we can pass that along to make sure we get that right for people that are watching.
Yeah.
And I wonder if you're watching on YouTube, maybe that's it. I didn't look on our YouTube stream, so we'll double check on that. All right, we've got about 15 minutes left, Andy. What's next?
James, a couple of questions just about TFC, which is the Truist Financial Company, and it's not one that I particularly am even below book value, like really pounding the table on. I think they have some commercial tie into their book. They are much more traditional kind of banking, although they are building out their wealth management business.
Mm-hmm.
It's still a small part. They are building out. It's an exciting part of their growth, but it's one I think will do okay. I mean, just buying it below book value, assuming that book value does not, deteriorate. So the valuation very attractive, Jayson. I don't know what it is on the earnings basis, but
so it trades for about 12.4 times earnings. So it's reasonable. It was certainly very, very cheap over the past couple of years, but it's a reasonable valuation for a large, steady, not super fast growing bank. It's a reasonable valuation.
I put it in. I think it'll do fine. I think it'll make money from here, but depending on what your position is, I think it has a decent yield.
Yeah,
so,
about 5%.
So you really get some nice yield on that, but I think the market is telling you that it's not going to be one of those big growers. So maybe you get 5% with a few points on top of it, a few hundred basis points on top of it. Match the market, maybe beat it a little bit, but and probably, assuming we don't go into a recession, that they are very economically sensitive. That bank is sensitive. Right. So if we go into it, that's gonna hurt that bank. But so I think I put it in the no. I think it'll do fine. I don't think it's gonna shoot the lights out.
Yeah, no, I think that's right. And just a little bit of nuance kind of around the edges of where you think about the risk and the opportunity for Truist. One of the things that is weighing on it is the net interest margin that it earns from its loan book, because it does have a lot of low yielding mortgages, including some mortgage-backed securities and things that it owns. But honestly, I think those things are perfectly safe, because the people that have interest rates that are that low on their mortgage, they're paying that mortgage. They're not looking to give that bank back, that property back to the bank.
Yep.
I think there is, you mentioned their commercial loan book. A lot of these regional banks do have a little more exposure to like some of the office.
Yep.
And a lot of markets that especially the secondary markets, where those are the assets that they might have to take a little bit of a bath on.
Yeah.
Depending on the borrower and that sort of thing. So that's where the risk lives. I don't think the risk is so substantial that it's anything close to an existential threat to Truist. I think it's a solid business, and the dividend is probably quite safe. They haven't made a bunch of missteps that have created large risk for the business, but its ability to grow is going to be hindered by its existing loan book as much as anything. So that dividend, that 5% yield, that's probably a good floor for the business in terms of returns you can expect. But I think, high single digit returns kind of on the upside is probably about where I would put it. There is a little bit of upside that if we see rates come down, Andy, over the next few years, that could be a little bit of a catalyst for a little bit of a bump in the multiple of the bank. So maybe a little bit.
I mean, they've said that if rates are going down, like, their NIM, their net interest margins gets compressed, and that can impact, their overall earnings, but they're going to make up with that what they think on the loan book side. So
exactly.
They'll be able to ramp up the loans because that's what they do and do well. And don't forget, this was a merger of two huge banks. So they've been through these operational challenges trying to tie together two massive big banks, relative banks, not JP Morgan sized bank, but two big banks.
Right.
And so they've made the dance of the operation. So they're very astute, I think, in doing that. But I just don't. It's just, I think you're right, Jayson. It's like 5% from the yield and from the dividend. You get a few probably basis points upside from the valuation, and you kind of are in the high single digits, which I think can beat the market going forward. But it's not one that I'm kind of pounding the table on, because I just don't think they have as much flexibility maybe as around someone. I mean, like I said, they are putting more resources into the wealth side and trying to grow that out, which is the sticky margin, sticky business.
So to specifically answer Bestie's question, thinking about return expectations for the next 2 to 3 years, because that is such a narrow period of time, I would say there's a range of anything from up 25 or 30% from now in 3 years to down, depending on the economic cycle. And that's just so hard to say what happens in the near term with I would feel more comfortable in saying 10 years from now, I would expect to get that average, 7 to 8% looking out 10 years than I would to say what's going to happen in the next 2 to 3 years.
Yeah,
so.
I think that's right. Jayson, a question from Matt on Chevron, but just in general, just getting back to our sectors. So I think we said, so information tech, the valuation's obviously tied to interest rates. The businesses themselves, not nearly as tied to interest rates. Now,
almost entirely decoupled. Yeah.
Right. We have seen, just in different parts of the information tech business, who's tied to interest rates and not, and it does play a part, but mostly there are other factors. So I think when you look across all the sectors of the S&P 500, I think information tech probably falls to the bottom of the ones that are most impacted by interest rates. Not the stocks are, but the businesses not as much.
Yeah, no, I think that's fair. So when you think about, again, moving up the stack of capital intensivity, you look at the Chevrons of the world and ExxonMobil's, and they're actually kind of in a different place in the continuum that you might think, because these are also very, very cash generative businesses that have billions of dollars in cash on their balance sheet. That gives them a tremendous amount of borrowing capacity. That is affected within the interest rate environment, of course. But they also have more capacity than you would think to self-fund. And when they do take on debt, it tends to be very, very long-term debt and at relatively compelling interest rates versus their peers, especially their smaller peers and the non-integrated businesses like the exploration and production companies, which they're kind of on the bleeding edge of the highest risk, most capital intensive, most cyclical, most commodity price affected businesses in the oil and gas industry. So Matt's question is, what makes Chevron a riskier stock to own than ExxonMobil? Or else, why do you think Chevron offers a slightly greater dividend yield than ExxonMobil? So historically, I don't think that I could make a case that either one of these is necessarily any less or more risky than the other. I think the risk profile is very close to identical,
probably the same
for these two businesses. ExxonMobil has done, I think, a little more over the past 7 or 8 years to get better returns. So I don't think it's as much as that Chevron trades for a discounted valuation is the premium that ExxonMobil gets because of its historical rates of return on assets and return on invested capital that they've done a really, really good job with.
Jayson, is there anything to the assets on renewables or not that in this environment, in this shifting environment, makes one more than the other from a risk profile?
No, renewables, no. But I would say ExxonMobil, one of the things that they've done exceptionally well is prioritize large resources that can be developed extremely cheaply, is positioning the business to have that pipeline of future oil at low production costs that it can bring to market without taking 20 years to develop the resource. They've done a very, very good job of that. That is part of the reason that they get the premium, while also having really just de-risked the business with a lot of high cost assets over the past really from 2014 forward. They got smashed because oil prices falling. And they had invested and built up a portfolio of really high cost oil. And they've sweated a lot of those assets off over the past 7 or 8 years. That's finally got the business to where it's back to like the levels of returns that we get. If you're interested in renewables, I think the most interesting integrated oil company is the French giant Total Energies, ticker TTE. We also see Total Energies trade for a discount. The European majors trade for a cheaper valuation than the US ones consistently. One of the reasons is the tighter regulatory market, higher tax environments in the EU versus in North America. But Total Energies has a massive amount of cash on its balance sheet and has already started the transition to becoming a full integrated energy company, not just an oil and gas company. So moving into electrical production, they've got equity stakes in a lot of different companies that are in the renewable space. They are a co-sponsor of Clearway Energy, which is one of the larger developers and owner-operators of wind and solar assets in North America and increasingly in other parts of the world, with Global Infrastructure, which is a large infrastructure developer. So if you're interested in looking at like the full spectrum of the energy transition, and you wanted to invest in any of the majors, I would say Total Energies is like an order of magnitude further along that process and profitable in those things.
Got it.
When the other ones have just, it's been window dressing and they haven't been able to make money at it.
Yeah, got it. Hey, Jayson, I just want to take Vihan's question because we're talking to Tom Davenport, an AI expert here in the next hour or so. We're going to interview him. So that's going to be a lot of fun. Stick around for that, fools. Vihan says, from evaluation as to today, GSB of the space, I'm not quite sure what that means, Jayson.
Gold, silver, bronze.
Gold, silver, bronze. Thank you. Sorry about that.
Put them on the podium here.
Yes, of Axos, TFC, JPM, USB, SoFi, Lob, and other banks you follow closely. And I'll just do another screen share if that's okay, Natasha, and do our courtesy again of our friends at Y Charts. If you all can see that. Whoops, sorry about that. I just
scroll it up a little bit. We'll be good to go.
Sorry, I just massively made my screen super big. Sorry about that.
There we go.
Whoa, what am I doing here? Okay, let's see. Here we go. Sorry about that, team. So this is the 5-year view, Jayson, of those 5 banks. So Axos, of those 6 banks, Axos, Truist, USB, JPM, SoFi, which, Jayson, we didn't talk about SoFi. And then Live Oak, and gosh, look at those multiples again, price to book, not tangible book, price to book of some of those banks. And Jayson, as you can say, look at Live Oak, where it went during the crazy times. And it's just hard for an investment to make money off that kind of valuation, unfortunately.
Right. Well, and back then Live Oak was making free money. They know that what's the SBA process better than any other bank.
100%. And they were, so they run those verticals and they know that SBA side really well.
Well, 2020 through 2023, really, they were maximizing the payroll protection plan loans. They were literally free money. It was literally free money. And they maximized that a lot, and the valuation was pushed up. So the interesting thing, even though it trades for about 1.2 times book value right now, I put it in the silver thinking about valuation right now, because it is as strong as this bank is in small business lending, and they're getting stronger and better at it. There's so many headwinds right now because small businesses are far more interest rate sensitive than large businesses. Even ones that are growing will maybe you're a successful vet clinic, and you're a vet and you're an entrepreneur, and you launched your business and you've acquired 2 more, and now you have 3, and you see 3 more that you're really compelled to buy, and you need to borrow to buy them. And the environment that you're in right now, you're like, you know what? I'm just going to buy 1. I'm not going to move. So those headwinds are very real for small businesses. And I do think that Live Oak trades for a reasonable valuation, and 10 years from now, I think it's going to work out. But in the near term, I have some questions there. SoFi at over 2 times book, I think is really, really compelling right now, because this is a fintech and a bank together, and their fintech business should trade for a higher book value multiple. Their payments platform, they've also started to build a lending platform for third-party lenders. So they're not just taking all of these loans onto their own book. They have a very high threshold for credit rating. For loans that don't meet their threshold, they're making some of those loans, they're referring them out to other lenders. So they're maximizing and monetizing their platform in multiple ways that kind of earn a higher book value. The caution with SoFi is stock-based compensation, because they compensate employees like a tech business does.
That's right.
So dilution is a real headwind there. I think of this entire list, Axos at the risk reward is at a fair valuation, the opportunity, thinking about the safety of the business as a bank. Axos continually puts itself at the top of the list. The big banks, US Bancorp, which is one of the big regionals, JP Morgan, for them, I'm only interested in them if they're trading for an extremely discounted valuation, and I see an opportunity like we saw back in March of 2023. For the rest of them, I like these smaller banks. The cohort of small banks that have delivered extraordinary returns for investors is probably a higher hit rate than most other industries, and certainly things like the tech industry, where we see billions of dollars of capital destroyed and only a handful of big winners. That's why I love these kind of smaller, mid-sized banks and their ability to compound. And I put Axos at the head of the room right there, with Live Oak and SoFi, with a little bit of kind of risk in there that I talked about is potential, headwinds to returns, ahead of all of these in terms of value creation for investors.
Jay, I think I'm along the same lines. And one, again, this is one lens valuation that we are looking at. So we take it all. It's not just about valuation. And Jayson gave the great example of why not with SoFi. But I think Live Oak, after for the reason I think I would probably have that near the top, but up there with Axos and then JPM and Truist and US and down closer to the bronze category, I think, on that. But I think the
valuations.
I think yes. And again, tough economic times are going to hit, all of the banks. And then one reason why JPM sells and has done so well and sells at that premium is because that will be the most resilient one of them all.
Yeah. Last thing I'll say, last words. The risk when you buy these giant stalwarts at premium valuations is mediocre returns, right?
Right.
That's why valuation matters so much for those businesses, and why you can buy a SoFi that maybe is trading for a higher multiple. It can grow its way into that valuation over time. with the caveat that there's more risk involved as an investor. So
yeah, I mean, that's the risk with so many businesses selling at those higher valuations, is because just the lower returns. The businesses have to continually, beat those expectations and make sure that they can live up to that multiple. And a lot of times there's a lot of enthusiasm that goes into any investment, and certainly banks. And like we saw that with, Live Oak, and unfortunately, that there were some buys across our services at that point. And that was just very, very difficult for us to be able to live up to, Jayson. Yeah. Live up to. So, yeah, Jayson, let's just keep going until our guest is going to come online here. But Jayson, maybe you and I can just go on for a little bit longer. If there's any other thoughts you want to have with interest rates, or if there's any, I didn't see, did he say anything in the press conference? Did anybody see?
Haven't looked yet, but I can take Rose's question about Access Financial. We've talked about Access and banks a lot. So Rose has a great question. It's the question we as investors should be asking far more about every investment we make. What are the greatest risks for Access Financial? So as a starting point for every bank, the biggest risk is the reality that there's always a certain level of opacity into what is actually in their loan portfolio, right? So I would say some of the risk is that their loan portfolio isn't as diversified as we think. And the fact that they have grown their commercial and industrial businesses, those lending businesses, a lot over the past decade, those are more economically exposed parts of the business that if we do go through a downturn, it could be painful, because we really haven't gone through like a typical, forgive it if this sounds kind of goofy, but like a healthy recession. We haven't gone through a period where consumers and businesses like feel a pinch without massive amounts of government stimulus. We haven't gone through that.
Yeah.
So we don't know, again, that tide flowing out. We don't know which of Axos's borrowers on the commercial and industrial side might be more marginal. So that's an area where I do see some potential risk. And I think with every bank, there's always a certain amount of risk of that kind of thing happening and being catastrophic.
Yeah.
I don't think that that's the reality. I think the other thing is that we just see it fail to navigate the interest rate environment as well as it has.
Yeah.
The third thing, their platform sucks. It hasn't been very good. You think as an online bank, they would have a really good online platform? They never have. The good things, they do all the bank stuff extremely well. But their ability to continue to grow customers, depositors, they need to have a better platform. That top of the funnel needs to be better. And we could see subpar growth because their ability to attract low-cost capital or competitive capital, because the platform just isn't good. Like that is a little bit of a risk for the business.
Yeah, 100%, I think too. And as we get ready to welcome our guest in, Tom Davenport, to talk about AI, Jayson, very quickly, just wanted to say, if we think about international investing, which Jayson, I know has gotten a lot of attention, interest rates do start to impact, interest rates going down, interest rates going up, impacts the dollar, how that impacts international investing as well. So that's a topic for maybe another day, but we can talk, a little bit about that. But I am thinking about that. You saw Buffett going back into the Japanese markets and like, okay, I have kind of not been on the international side. And how does that plus other markets, now it's not the only factor, but it does start to impact flows of funds. The interest rates start to impact flows of funds, and that does impact financial assets.
No, it absolutely does. So the good news, I see Tom Davenport is in the green room.
In the green room.
Yeah, our green room is more metaphorical tech green room. Sadly, we don't have one there with cocktails and snacks and that sort of thing. We have to do those things at our own home. So I think we can. I think we're about ready. We can start transitioning over.
I think so too. Yeah, Jayson, thanks for the last hour. That
Absolutely.
I have not checked that, see what the Fed chair has said, but or even where the markets are, frankly.
Yeah. Well, fools, you know what the beauty is? Doing those things in the moment is not necessary.
That's 100% right.
Yeah.
Again, a little bit of tongue in cheek the past hour, but obviously interest rates are important, and we did want to give it the attention it deserves.
That's exactly right. All right. Well, let's wrap this hour again, Andy. This has been fantastic. Really appreciate it. And let's see if we can't bring, who are we going to bring on? Osset and Carl, and then they're
I think we have Osset, we have Carl. We're going to get Tom Davenport on, professor at Babson, to talk about AI, his new book, and a real thought leader on artificial intelligence. So I'm looking forward to that. A different topic, a different topic, Jayson. We're pivoting like 180 degrees, but still obviously very important in the markets today.
Yeah, no, that's exactly right. So Ricardo did say, again, no surprise on rates. Important is the speech in 2025. No, that's exactly right. It's the words that we'll hear from the Fed chair going forward. That is certainly going to matter the most. So are we gonna? I think can we go ahead and bring Andy and Osset and
Osset. Maybe we can bring Osset and Carl in, and we'll get started. Carl Yule, who's one of our AI specialists that are working here with the Motley Fool, and obviously Osset, one of the analysts and advisors on Stock Advisor, who's also been thinking about a lot about artificial intelligence. So if we can get Carl in to start the conversation, then we'll bring Tom in to start to get to the meat of AI if we can.
Yeah, that's exactly right. So one thing we can do, we can just remind everybody, you want to get questions in for this, I encourage you to do that. So go to slido.com. The event code is Fool24. Whether you're watching this on our YouTube channel, welcome. It's awesome to have you here. You're a Motley Fool member. Behind the paywall, slido.com. The event code is Fool24. Osset, Carl, we've done the hard work for you guys. Now you get to have the fun conversation.
Jayson, I was lobbying in our chat, in our green room chat, to have you force you to do stand up for a few minutes while we all waited, but they said no, it's time to get this moving. So we'll let you go.
Just saved a lot of people a lot of pain. So, all right, guys.
Thanks, Jayson.
Great hour.
Have a great day. Thanks, bud. Appreciate it. Carl Yule, Osset Sharma, thank you for joining us. We're going to get Tom on here. Tom Davenport, professor at Babson, a leading thought leader when it comes to artificial intelligence. Carl, this might be your first time on Fool24. Is that true or not?
That's correct. I'm excited to be here.
Yeah, thanks for joining us. Just give us maybe 30 seconds on some of your background when it comes to artificial intelligence and just some things you're working on at the Motley Fool.
Yeah, so I studied data and business analytics. I worked at Pepsi in data modeling, and then worked there in their Gen AI innovation lab. And then I got plucked and joined this great team in the Motley Fool, where we're working on, state-of-the-art AI-powered solutions for product and for internal organizational use. So, yeah, I don't know how much I can say about things I'm working on, honestly.
Oh,
but
yeah, behind the scenes, a lot of exciting stuff. Do you have any opinion on Poppy getting bought by Pepsi? Are you a Poppy fan? Did you see that news? The soda Poppy?
No, I didn't even see that.
Yeah, right. Osset, right? Pepsi is buying Poppy for 1.6 billion.
Yeah.
I like that. I don't know if they use Gen AI to determine the price they want to pay for that small little soda company, which was featured on Shark Tank. So, but interesting development. Yeah.
Yeah. Some would say that they did use the model and it hallucinated, and that's how we got that price tag, but it could work out.
I think awesome means a little tongue in cheek on there, but thank you, fools. We are going to welcome Tom Davenport here in a little bit. Andy Cross, Carl Yule, and Osset Sharma here joining you for Fool24. And if you're on, as Jayson was saying at the top, if you're joining us at Fool.com and as a member, you can put your questions in the Slido. And if you're joining us over on YouTube, thank you, welcome. And if you have, by all means, go over to Fool.com/Fool24 and learn more about how you can become a member and join the conversation. Tom Davenport, welcome to the Motley Fool.
Thanks. Happy to be here.
So excited to hear you, to have you here and to talk about AI. I'll give a little introduction, then we get right into it. So it is time to talk AI with one of really a leading expert around the world, Tom Davenport. You are a professor of information technology and management at Babson College. You've written or edited over 20 books, including The AI Advantage, How to Put the Artificial Intelligence Revolution to Work. And you're the author of a brand new book, Agentic Artificial Intelligence, Harnessing AI Agents to Reinvent Business, Work, and Life. Tom, welcome to the Motley Fool, and thank you for being here.
My pleasure. Yeah, I have a bigger total of books than that, but that's okay. AI Advantage was several years back.
Well, we had to pick from a whole bunch of them and a whole litany of work. And I gotta say, our original intro was very, very long, and so that was a little bit of an abridged one because you are so accomplished. But we have Carl and Osset here, and Tom. Maybe we can just start it off at the 30,000 foot level. What in this day and age, right now, what excites you the most about AI? And then what really concerns you as you look forward in AI?
Well, the thing that excites me most technologically is this development of AI agents, which can actually, do something instead of just informing us. Using generative AI and the more traditional forms, what I call analytical AI, or you can even throw in some deterministic AI, some rules related stuff in there if you want to. Rules for fools, as they might say on this show. What scares me is also agentic AI, that it will make lots of mistakes and be too complex for humans to intervene easily, and that it will lay a bunch of people off who did, the kinds of tasks that could be done by agentic AI. I'm also worried, of course, about AGI, artificial general intelligence, but that's a few years down the road. Agentic is here now, so that's what I'm worried about in the short run.
And Tom, just maybe a quick follow-up, then Carl, jump in with your next question. Maybe we should just quickly how do you define agentic AI? What do you mean by that when you talk about that?
Well, that's an excellent question, because almost everybody defines it differently. But I think the primary attribute that differentiates it from other forms of AI is it actually can perform tasks, typically, information-based tasks, digital tasks, rather than just, give answers to prompts. So if you want to make a reservation, an agent could go out and find the best flight for you, and then actually sit at your computer figuratively and make that reservation and bill your credit card and so on. So therein lies both the promise and the peril, in that, what if it gets something wrong and you're stuck paying for it? Maybe too late. So.
Awesome. Carl, you got a question for Tom?
Yeah, I wanted to start, step back a little bit and just thinking about AI-driven ways of working in companies, in organizations. And I know you've advised on AI transformation for massive companies, different companies. So I wanted to ask you, what's the biggest blocker, obstacle that large organizations face when they're trying to implement this transformation of AI-driven ways of working?
Sure. Well, I think the biggest blocker is the inability to put things into production, put AI use cases into production. Lots of big companies have many pilots, proofs of concept, prototypes. They're willing to experiment with it, but pulling the trigger and actually putting something into production deployment means you have to change the skills of the people who are going to be using it. You have to change the business process that it fits into. You have to change the underlying information systems architecture that it connects to. And that's a lot of work and a lot of money in many cases. So a lot of companies are kind of stuck in prototype limbo for way too long.
Nice.
Professor Davenport, if I can just follow up on that and stay within the theme of agentic AI, I think most of us grasp very easy to understand use cases we're familiar with. So think a customer service agent is something we can all understand. But can you describe to us maybe any use case which might be a little bit more complex, and why that's so difficult right now for companies to actually implement?
Well, I'll tell you one that I heard about just yesterday. I was doing an interview with the head of AI at Intuit, planning to write an article for tax season, mostly about TurboTax, and there are no agents that you can say, agent, go do my taxes and send me the refund. But they, of course, also have QuickBooks, the sort of mostly small business accounting software. And he was saying, Ashok Srivastava is his name, was saying that they have agents in place already working for doing all sorts of things with accounts receivable and accounts payable. So an agent can look at bills or invoices or whatever and figure out what are the salient pieces of information and embed that into your QuickBooks system. And then on the accounts payable side, it can create a payment for you. I mean, ideally, I didn't talk about this with them. I think probably you want to take a look at it before those payments go out the door. But, managing cash flow for a small business is a really tough thing to do. And if you have AI agents that can do it for you, I think it's a very, very powerful tool.
Professor Davenport, don't you think that's a big hurdle, is the trust factor? So you just mentioned one, like you want to verify something before the agents do it. Don't you think that's going to be a big hurdle for society to get over?
I think it will be. We'll have to learn to trust them. And I think initially a lot of the applications will be things that are not large scale monetary transactions or don't really involve the ability to hurt people or something in some kind of healthcare application. Somebody was suggesting to me, I think at USAA, the big insurance company, financial services company, that they would first use it for helping people reserve vacation time on their corporate calendars. Clearly, if something goes wrong there's nothing tragic has happened. I don't know. I suppose you might miss your vacation if it went awry. But I think there will be a lot of hesitation, and surveys actually suggest that like 83% of consumers would not trust agentic AI once it's explained to them what it is and how it works.
And quickly, Carl, if I can just jump in there with a similar question, but just talk, Professor, about as AI agent systems and AI systems get more and more powerful, is there a case where they get much more efficient, maybe faster, but they get less effective, which means they don't actually drive the results that we really ultimately want? And how do we recognize that difference, and how do we correct for it?
Well, yeah, one of the key issues with agents is they rely in many cases on generative AI systems, and we know that generative AI systems hallucinate. They come up with answers that really, are not correct or valid some of the time. And so I think that will mean a greater likelihood of needing human oversight. There are ways that we can limit hallucinations by using sort of carefully controlled content. And you're probably familiar with this idea of retrieval augmented generation, where you feed domain-specific content into a large language model. That tends to reduce the frequency of hallucinations pretty dramatically. But yeah, I think doing things that are less effective is a really critical thing to worry about. And we just have to find the right mix of application types that aren't too risky or dangerous if the agent does make a mistake.
Carl.
Yeah, I'll keep going about this point. So, in the AI community, there's been a lot of hype, especially in the beginning, about training your models, fine-tuning your models. Let's take all of our company's data and train our model on it. But I want to get your take. I know you've advised about that too and have put out guides about that. So I wonder what your take is about RAG, retrieval augmented generation, that you've just explained, versus trusting a model's internal information after it's learned this, whether it's company information or whatever.
Well, I think if they're fed high quality data, RAG-based models or RAG augmented models can be very reliable. I mean, I talked a fair amount about this to Jeff McMillan, who's the head of AI at Morgan Stanley. They had a very early RAG based model, and he said, if you curate the data carefully, which they did, and you kind of restrict the types of prompts that people can ask, you don't ask the system, what's the meaning of life? You ask it, how do I do a generation skipping trust, something that it knows about. It will be quite accurate, and they've done a lot of tests to make sure that it's accurate and so on. But the rub comes in where many organizations do not have well curated unstructured data. RAG system can't decide if you've got, I don't know, 10 documents that explain how to fix what was I trying to do this morning? I couldn't get my Mac laptop to shut down. If you have 10 different documents to address that issue, RAG isn't going to tell you which is the best one. So it means there's a fair amount of human effort to curate the highest quality knowledge and make sure that's what gets fed into the system as a RAG input.
And if I can just follow up real quick before you go, Acid, on this point, what I always tell people, I want to know if you agree, on this point of leveraging Gen AI as a whole, which mostly it's RAG, also agents in the future, but for now, mostly the implementations are RAG. I always say it's data governance and data modeling that's stopping companies from leveraging it well. So there's data that's siloed everywhere, teams that are siloed. What's your take on that?
I think that is generally the case. I did a survey last year for Amazon Web Services, and we found that data quality was the biggest obstacle to moving ahead with generative AI. And B, I think about 60% said they knew their data strategy needed to pivot pretty dramatically to succeed with that technology, but most of them had not done anything at all. Now, I think we've made some progress since then, but yeah, it's a big challenge. I was around in the days of knowledge management in the 1990s, and it was really hard then to curate our knowledge and decide what was the best content and so on. And that problem really hasn't gone away. Generative AI can classify the content for you and help a little bit. It can even extract, what's the most salient content in a document. But figuring out what's the best thing, that's still a human trait.
If I can just continue this conversation on RAG and model choices as well. We study a lot of enterprise businesses at the Motley Fool, and I was curious your perspective on well-capitalized businesses that have deep pockets enough to make a choice, which is either we're going to create our own model and it's going to be very robust, or for so many use cases, let's go with RAG and we're going to actually take on that cost of human curation and take that route because maybe we have, customer-facing applications. In the future, how do you think organizations will try to make this decision? How would you make this decision if you were, let's say, at the helm of an enterprise business? At this point in the game, would you be pushing your forces to go one direction or the other?
Well, yeah. I mean, when this issue first came up, I didn't really know what was the answer to that question. But it turns out creating your own model is a nightmare for many organizations. Training it from scratch is really quite difficult unless it's a very small domain-specific model. Getting the amount of data that you need to do that well, we all know, getting the GPUs to do the training, getting even enough power to do it. If you're using the cloud, it's going to cost you a huge amount of cloud processing fees. So the vast majority of organizations today, I think, are better off just taking an existing model, which has a lot of general purpose knowledge and does language well and so on, and adding that RAG capability. And that's getting easier and easier as there are various vendors out there that help you do the vector database creation and create embeddings, turning the RAG into numbers. You don't really need even a data scientist to do that sort of thing anymore.
Professor Davenport, where do you think we are overestimating AI and where do you think we are underestimating AI?
Well, I think we're overestimating the power and influence and importance of generative AI versus some of the other forms. I call it analytical AI, but machine learning based on structured data, where we're predicting unknown numbers from known numbers. That's very helpful in making decisions of all types. It's been going on for decades. It works really well, unless the world changes and our training data is no longer relevant to it. And a lot of organizations seem to think that AI was invented on November 30th, 2022, when ChatGPT came out, and I think that's a big mistake. So I spent a lot of time saying analytical AI is still quite critical in most businesses, and in some cases more valuable than generative AI. I think there's probably a overstatement of the ability of AI to, particularly generative AI, to do anything involving numerical activity. I was talking to a student I'm working with today who's starting a business, and he was trying to get generative AI to do some financial projections of business models and the how well the business was going to do, and he said it was really awful. And we still continue to try to get these models that are very good at predicting words to do things with numbers, and they just do not generally do a good job of it.
How about on the underestimating side? Where do you think we're maybe underestimating the ability of any kind of AI?
Well, I think AI is going to be dramatically effective at changing content-oriented businesses. I mean, technology, as we know, particularly in this area, changes very rapidly, and organizations change slowly. But if you look at knowledge and content-oriented businesses like healthcare or law or communications, PR, advertising, marketing, I think there's customer service functions. There's going to be a really dramatic effect in those areas. And a lot of it we can do now technically, but it's just the organizations aren't quite ready for that transition.
Yeah, entertainment for sure. Carl.
Exactly.
Carl, anything on your mind?
Yeah, just on that last point you said, that makes me want to ask you, about where the bottlenecks are of really enabling the impact of AI, because it's been 2 years or longer, and some people are still waiting around saying, it's not that big of a deal. Do you think the bottleneck is in the models that these AI labs are releasing, or it's in how we actually leverage those models in building systems and products and solutions?
I think it's mostly the fit with work processes and the trying to create effective use of these tools so that we get both productivity and quality. And this is a very interesting issue to me. I wrote a book, I think, in the 1990s about improving knowledge worker performance. It wasn't a huge bestseller, as I recall, but knowledge workers don't like to be told what to do. It's one of the reasons we went to all the trouble to get all the education that we did. And B, it's very difficult to measure the productivity and quality of what they do. And most organizations don't really measure it. So, if we've decided we're going to use generative AI to create content for us, we need to figure out some ways to experiment with it, see under what circumstances it works well, when does it not work well, develop some measures, tell people at least at the moment, we need a sort of critical thinking human at the beginning of the process to issue prompts, and at the end of the process to take a look at it and say, does this make sense? And is it accurate? And is it interesting? And most organizations haven't really gone through the effort of testing and experimenting and measuring and so on.
Yeah.
I'd love to follow that up with a similar question, which really goes to the heart of your focus areas in your career. So when we think about artificial intelligence and also data science or big data, I'm curious, is there any positive effect, or I should put it this way, how does generative AI, if in any way, improve data science? Is it in computational power? Maybe it will help us uncover some novel algorithms or something else entirely. You alluded to this earlier. if we say that AI traditionally, is a lot of machine learning, then what does generative AI bring to the discipline of data science?
Well, I think the biggest impact is the democratization of data science. Data science used to require data scientists, professional data scientists, and they had to be very well trained and educated and very expensive and so on. And let's face it, I mean, I'm getting into stereotypes a bit here, but the average data scientist, I think, was probably more interested in creating great new algorithms than they were at solving, a particular business problem. But now with AI, we can really open up data science to citizens, if you will, this idea of citizen data science, where anybody who sort of knows what they would like to do in an analysis can just say it in relatively straightforward English or whatever language terms, and they can get a complex machine learning model and the explanation of that model. Now, I said earlier that these Gen AI models are not terribly good with numbers, but they are pretty good at generating code. So what's happening is, they're generating Python code to go and analyze your model and apply different algorithms and so on, and then taking the output and interpreting it. And it's not perfect yet, but both OpenAI and Google have quite sophisticated capabilities for doing machine learning analyses. And I think, the big barrier that we've had between getting quantitative analysis out and having the people who were educated enough in statistics and so on to do that, largely going to go away. I think I wrote a book about this last year called All Hands on Tech. And it talks about citizen development in various forms, including citizen data science.
Did you use generative AI to come up with that title or to help you with that title? Because it's not that you're not creative. It just sounds like it's a good one for.
No, I used my co-author, Ian Barkin, who had the all hands on tech idea. He is a pretty aggressive user of generative AI. He might not have told me about it, but going back and forth with the editor came up the subtitle of the AI-powered citizen revolution. But it's interesting in that book contract and many of the ones I've written lately. There's a clause that says you will not use generative AI to generate substantial portions of this book. I don't know how they would prove that.
Well, I do want to have a follow-up on that later on about how you're using AI inside your classrooms and what you're seeing from the academic side, because I know it is a hot button topic and I want to get that. But I do want to talk just on another book that you wrote called Only Humans Need Apply, Winners and Losers in the Age of Smart Machines. And I do want to talk about winners and losers when it comes to AI. Maybe just give us some sense of maybe some hidden winners and some hidden losers as you look at the landscape and then looking forward over the next few years.
Well, yeah, in those days, that book was written in 2016, even before I think anybody had much of an idea that generative AI was possible. And hidden to us at the time were all the content creators who were going to end up being losers from generative AI. We thought that AI was mostly analytical machine learning at that time, and there weren't very many losers. There were decisions that could be made better with the technology, but people who make decisions often have a way to prevent themselves from being losers. They don't generally fire themselves.
Yeah.
But now I think the biggest losers will be people who generate content. We never imagined in 2016 that programmers and system developers would be losers, because it's so not totally easy, but increasingly easy to generate high quality code with this technology.
Carl's actually an AI avatar right now. He's coded himself up for this conversation.
I suspected as much. He didn't look that natural to me. No, just kidding.
Carl, go ahead.
Oh, you've thrown me off track now. No, I wanted to. You said your background was in knowledge management before this, and I see knowledge graphs as the future of kind of the brain or the memory that agents might have in the future, right? Right now, there's all this talk about vector databases, but it's purely similarity based, and there's so many issues that can come up if you're retrieving based on that. So I want to know about your thoughts. Do you agree that knowledge graphs might be the future of memory for models?
Yeah, well, I think knowledge graphs in combination with some new architectures that really look more like database architectures that let AI systems go back into the history of your interaction with a particular person or whatever. Right now generative AI does not have persistent memory, and it's a big problem. Sometimes within a few minutes, it can forget that it was just talking to you about something. So we do need better memory. And I think knowledge graphs would be a way to, just as our brains do, kind of connect one part of a memory with another part. There aren't that many people yet who know how to build knowledge graphs, so that could be a bit of a constraint. But eventually, I think we'll get some help from AI in that regard too. And in fact, I think one of the unknown things about AI is that it can actually start to help us a lot in the data quality space. Not do everything by any means, but it can certainly identify when you've got things that probably are poor quality outliers, and it can merge databases pretty effectively. That's with probabilistic machine learning. It'll say, Carl Yule at 123 Main Street is the same as Carl Yule or K Yule at 123 Main, which used to require a human or a set of very complex rules to create.
I've always felt that's a superpower of large language models, is the ability to understand what's important in a given set of data. They just do it in a way that seems so different from the way our minds work, but actually is quite similar. And so that sounds intriguing to me. It reminds me, I wanted to ask you about something that's tangentially related, which is the concept of human-centered design. So if you could explain this concept to us and why it's important when we think about a future in which most of us will be exposed to even more AI tooling than we are today.
Yeah, I fear a little bit for human-centered design or alignment, another term that's used. That these systems would be aligned with human values. We certainly in the U.S. we have no regulation that would require that, and there are some unknown but probably fairly substantial number of executives who would be perfectly happy to get rid of all of their employees if AI could do all of the work in their organization. So I think, I don't know, everybody on this call but Carl is a human, and
actually, Professor, you've been exposed to my avatar as well. But
okay, well,
proceed, please.
Yours seems a little more natural than Carl's. I don't know, but anyway, no, just kidding. I think that this is the great moral challenge of the age. Do we make these systems so that they are helpful to humans but don't replace us and don't invalidate us? And I guess I was never terribly worried about robot overlords killing us, at least anytime soon, but putting us out of work, I think is far more likely. Back in 2016, I found no examples of it. I still haven't found very many examples of large-scale job loss, but you have to wonder if it's around the corner.
Well, you've talked about and you've written about augmenting the human, AI augmenting the human, and is that still that? It sounds like that is still your belief, and that is still the future of work, at least for the next few years, as we all grapple to figure out how we integrate these tools and technologies.
It is still my belief that human augmentation of AI and vice versa is the way to go today. In almost every case, we need it in traditional generative AI, we need it in analytical AI, we need it with agents even to kind of monitor the agents and make sure they're doing a good job. Do we need quite as many humans as we used to? Maybe not, but there seems to be at least in many countries, there seems to be a labor shortage today in certain areas. There's, I think Jeff Hinton said around 2016 or so, well, we probably won't need any radiologists anymore because AI will be able to figure out, whether your MRI image says you have cancer or whatever. I don't think we've lost a single radiologist since then to AI, but we don't have enough of them. So maybe it would be a good thing if we could augment them a little bit more than we are today. So yeah, it's slowly shifting. The idea of augmentation is slowly shifting from a belief to a hope. Given if you're not paranoid about what's happening with AI, you're probably not paying attention.
Yeah, it's interesting. I know many of us are waiting for Klarna's rumored or is planning, maybe also it's planning to IPO. They got a lot of headlines when they laid off, I think 700 employees across lots of different departments, mostly tied, I think, to like recruiting, HR, and that kind of area, because they were like, we have the AI tooling now to be able to handle many of this. And so they're just one example of, I'm sure, what is going behind the scenes with a lot of different companies thinking about that balance between augmenting with human intelligence. And I was reading about Progressive, the insurance company, and they were talking really extensively about how they are using this partnership between technology and humans, but the humans are a really important point to their insurance operations. But that's not always going to be the case. And that balance between the two, as you pointed out, Professor Davenport, I think will be really fascinating to follow up and to continue to follow when it comes to certainly public companies, but really all companies across the board.
Yeah, well, Klarna is a quite interesting story that I've followed fairly carefully since they, as you suggest, have been among the most visible of organizations claiming that they've replaced humans with AI. But as best I can tell, there's maybe a little bit of excess of PR going on. B, the 700 people whom I thought were mostly in customer service, but in any case, the 700 people were all outsourced, and those are always the first to go. Not that we shouldn't worry about them, but I think it's not surprising. And C, in the last few weeks, they backed off a little bit from their claims that we don't really need humans so much anymore, and we're using them more than we thought we needed to. So I think they might have been one of the earliest practitioners of kind of AI-based PR, with the idea we're going to go public soon and let's make people think we're doing a great job with AI. I think somebody also did an analysis of looking at the financials of how much they saved, and it's a small fraction of their total revenues.
Yeah, thank you. I think you are right.
Yeah.
Oh, sorry, Asa. I was going to say, I think it is in customer service, and that's a fascinating just follow up between the headlines and what is actually really happening, and then importantly, just what are the lasting effects and how do companies adjust? Sorry, Asa, I didn't mean to cut you off.
No, just supporting Professor Davenport's point. I read something as well that it's not minuscule. It's maybe in the low tens of millions, but given their annual revenue and their cost structure, it's not some huge game changer for them so far. But yeah. I will, give them some props for being out there and forward and trying to see what they could do with these systems. And they walked away from their CRM system and tried to rebuild that from scratch. So it is an interesting story to follow. But anyway, let's keep moving.
Yeah, no, I agree. Pushing the frontier is a useful thing. And I wrote a book called All In on AI about companies that are very aggressive with their AI usage. And if I were doing that a little later, I would definitely have wanted to include them.
Carl.
Yeah, to tie in to my question with that, Asset, you were just referencing they dropped their CRM system. And I think I was listening to a podcast from their CEO or some C-suite executive that they dropped a lot of their SaaS contracts and they were just building them in-house instead. And so this is one of the main trends, like Gen AI programming gets so much more efficient. Their programmers can start building everything in-house. They don't have to be paying external contracts. And I want to ask about some overall bigger trends here. Who's the winners and losers in the AI landscape and everything? VCs have been throwing billions or millions and billions around for 2 years. OpenAI, Microsoft, all the labs have been pouring billions into making the biggest models. Their models just get distilled by everybody else for free, essentially. And then the open source community completely thrives with almost parity as the closed source AI. So what happens in a couple of years when all this money that's been poured into startups and corporations is totally available, open source, easy to develop for anybody?
Yeah, I mean, you guys are the financial analysts, but I think some investment bankers suggested that in order to justify the very high multiples that some of these AI providers, NVIDIA, et cetera, are getting, that companies would have to be saving a total of $600 billion a year in order to kind of justify these valuations. And I think it's fair to say they're not. A, nobody's really measuring, but B, I think it's fair to say that they're not saving nearly that much money. So I don't know, somebody was telling me today that he'd had breakfast with a very well-off investor in the Boston area who suspected that the whole, data center investing craze was also likely to turn out badly, that if we're going to be using smaller models, we're not going to need the kind of data center capacity that a lot of organizations are investing in. As a person worried about climate change, these systems, particularly the reasoning-oriented ones, use a lot of energy. And so I think I was really happy in a way. I wish it hadn't come from China, but I was really happy that DeepSeek came out and appeared to be more energy efficient, as well as open source and much smaller.
I'll jump in, Andy. So.
Okay, yeah, thanks. Sorry, Austin. I want, then I'll have a follow up, and then we can go.
Good. So I want to ask a question on behalf of one of our viewers today. They've submitted some great questions, and I'm sorry that this hour has gone so fast and we can't squeeze in more, but this is one from Mike E. And he says, Professor Davenport, how might AI-driven drug discovery evolve? So far, it discovers many chemical structures, but not clinically useful ones. Will it improve, and how?
Well, yeah, I'm not a huge expert in that industry, but I would say some people might beg to differ that some clinically useful drugs have been discovered. There are at least a couple that are in advanced clinical trials that were developed by AI-driven startups. And I've worked with some of the big pharma companies, and at least one of them, Sanofi, has said, we're all in on AI for drug development. I like that. I told the CEO I really like that term because I had a book by that name. But I think, that for me, the big challenge has been, it's historically been startups who have used these tools aggressively. Exscientia is one in the UK, and so on. There's a couple in China, and big companies have been more conservative about it. Sanofi is the first to, I think, really publicly commit to it in a big way. But if those startups are successful, I think there's going to be a mad rush for capabilities, and it's really going to change the industry dramatically. I think mid-sized players won't be able to invest quickly enough to keep up. I mean, if you're Pfizer or whatever, you have enough cash lying around so you can buy a few companies, or certainly Lilly or whatever. But I think it could put a lot of mid-sized companies out of business if that turns out to be the best way to develop drugs quickly.
Professor Davenport, as a professor, there's so many conversations. I know that I'm sure you are knee deep in that. I want to get your opinion on around academics, as I mentioned earlier in the show. Talk to it, maybe a twofer question, if I may. Talk to us about how you are using AI inside your classrooms and with your students, embracing it, the challenges, but then also what you are hearing from your fellow professors and the academic community about their students using or misusing or using AI to its to their advantages.
Yeah, I have to admit, Andy, it's a tough one. I teach AI courses at Babson. Babson is pretty much all in on AI. Our president is very supportive, and we've just formed a new institute to address technology and entrepreneurship. Entrepreneurship is Babson's primary focus. But it's really hard to teach with it effectively. I mean, I tell my students they can use it to do essays and research and so on, but I ask them to show their work, to show me that they're using it in the right way, show me the alternative prompts they used, and show me how they edited the output. And frankly, it's like pulling teeth sometimes to get them to do that. I think some of them think, well, gee, it was easier when I could just paraphrase a Wikipedia article or something. We get a lot, like every school these days, we get a lot of students from outside the US, and some don't have English as their first language. And I said, edit the output, and they would edit in grammar and spelling mistakes. So now I have to tell them, run it through the model again to take those out after you've done the editing. So I think it's tough. And, looking recently at some of the deep research kind of capabilities from Google and OpenAI and so on, it's hard to imagine how a student at most schools could do better than that, with lots of citations and so on. So I don't think we've figured out the answer yet, frankly. And, we don't want students to be overly reliant. We'd like them to think for themselves, but it's hard to inculcate that sort of critical thinking that I think is really important for any student these days.
Do you see a parallel of any resistance from the university side when it comes to utilizing these tools, and the resistance we might be seeing from companies or employees at companies to utilize and use these tools?
Well, the students seem to be, fine with it. Some of the faculty, more, I think, in the humanities and so on, some of our humanities faculty said, can we turn off AI on campus? And the answer was no, we can't do that. But I think the humanities faculty are probably most concerned about the issue. I feel as a business professor, we want to create people who are productive and effective in their jobs, and clearly AI is a way to do that. But if you're talking about, writing poetry or criticism of English literature or whatever, it's going to be a sad world if all of that is being done by AI.
Yeah, thank you, Carl. We have about 5 minutes left here, team. So, and then Professor Davenport will exit us. So, Carl, go right ahead.
Yeah, I thought AI for education is very interesting, and it could enable, especially at the less funded levels, or where there's not enough teachers or not enough high quality teachers, I guess, with lots of experience, or tutors, and there's too many kids to teach. I feel like the UI, the UX, the user experience and user interface design matters so much as well, and building a system that's really tailored for that task. Do you think in that case, it's a ripe area for AI to make an impact?
Well, in general, I agree with you that education is one of the industries that's going to be transformed, but it, like some of the other ones I mentioned earlier, it is a conservative industry and it's slow to change. There is some evidence that using AI systems as a kind of a personal tutor can be very effective, particularly at the elementary and secondary school levels, but I suspect it's going to be true even in colleges and universities. We just have to figure out how do you preserve the student's ability to, think creatively and critically about what the AI system is doing. And I'm not sure we fully mastered that. I know there was some criticism that the early versions of Conmigo from Khan Academy, there was too much, telling students the answer as opposed to really, taking them through an intellectual journey to find out what the right answer is. So I think there's plenty of promise on the horizon, just as I think there is in healthcare and law and a lot of these other knowledge-based industries. But we're not quite there yet, and we need to do some more thinking and some more work.
Professor Davenport, we have just a few minutes. I'm going to ask you to answer this next question in about a minute, and I'll try to keep the question short as well so Andy can ask the last question. But you are, among so many other things, a renowned expert in benchmarking and best practices. So for an organization that's trying to find its way in an AI world, build AI tools, incorporate it into the company's business, are there any overarching just benchmarks that you like to observe or advise companies to look at in terms of viewing success as they go along?
Well, as I was suggesting earlier, I think testing and measuring, A/B testing, if you will. You have one group use this, one group not use it, or use different versions of it, and see how things turn out. Particularly for generative AI is very critical and important, and just not, you've seen a few academics do that kind of testing, a few vendors, but in general, companies don't do it very much. This is new territory we're in. We need some better knowledge about how it's all going to work.
Thank you.
Professor Davenport, if I took your hundreds of books and papers that you've written in your career and put them all into one of the Gen AI tools as we wrap up here at the top of the hour, thank you for joining us. What would be the one tip for businesses to get the most out of AI tooling going forward you would leave us with?
Well, maybe that AI system could figure out that I am not only a human, I'm very oriented to the human side of these tools. I'm a sociologist by academic training, so I'm always been very interested in how humans use information, how they get it into organizations effectively. So it's the human dimension. That's always what gets in the way. That's always when we're successful, somebody has done the change management well and retrained the people and changed the organizational structure and so on. So focus on the human, the culture, the organizational side of these technologies.
And finally, is there one company or two companies out there that you point to that we could learn from about how they are embracing and utilizing AI?
Well, I'll be very exotic and point to a Chinese company. I don't know if you're familiar with Ping An, this giant, I think largest. Yeah, started out
as insurance, but
now they have these 5 ecosystems. One is healthcare. They have an intelligent telemedicine app called Good Doctor that's used by 400 million people, amazingly enough. So, and they've done similar things in some of their other ecosystems. In the US, I'm a big fan of companies like Capital One and Progressive and so on that were really good with analytics and are now really good with AI. And some of them are really, like Progressive is known for charging more if you're a bad driver, but they are trying to create better drivers too. They give you grades and so on. So I think companies that are really trying to change their customers' behavior for the better should be commended for the use of these tools.
Wonderful. Professor Tom Davenport from Babson College. He's the co-author of his latest book is Agentic Artificial Intelligence, Harnessing AI Agents to Reinvent Business, Work, and Life, among many, many other books and papers that he has written. Professor Davenport, really, thank you for joining us here on Fool24. It's been a real pleasure.
My pleasure. Great questions.
Thank you. Have a great day. Fools, Asit, Carl, any parting thoughts as we wrap up and think through what you learned, takeaways from
That was
Professor
a great
Davenport?
talk.
Yeah.
I would say one.
Go ahead.
The final takeaway I had, was, if you can identify the companies that did machine learning analytics well, those are likely the companies that are going to make the most out of the Gen AI wave. They have their things in order already, and they can leverage it.
Yeah, they're adding like on top of it, right, Carl? Building on top of that. Yeah. Awesome.
Yeah, that's a great point, Carl. And for me, also towards the end, the idea that at the end of the day, artificial intelligence tools that you're building, initiatives you're trying aren't that different from other things like marketing in your world. You should be A/B testing, outcomes of those tools, working with different users to see how effective those tools are. So that was illuminating for me. It sounds like common sense, but it's uncommon sense, right?
Well, that's the thing. I think a lot of it maybe seems like common sense, but it's very difficult to get done. And I haven't read through all of his work, but it sounds like he has a healthy, I think, balance between, hey, things are going to change, right? Job security, like that is going to change, but we also need to have the human element into it. And, I thought his point about when he talked about observing the agents, in the example he gave is, well, you want to verify that before it goes out. And I was like, well, doesn't that kind of defeats a little bit of the purpose of pure agents? So I think he has that real interest there, right? Sorry, Carl.
But only a little bit. Sorry.
Yeah, that's right. Maybe. I mean, spoken like a true agent, that Carl that you are as of right now. So, but anyway, that was really enjoyable, and I'm glad that we could take the time. He took the time to talk to us, and we hope Fools, whether you watched it on here at Fool.com as a member or on YouTube, had a chance to enjoy that conversation. So that was really super valuable. And Carl, thank you as an AI real expert person in the weeds. Thank you for joining Osset and me to bring your expertise to that. So thank you, Fools. It's been a great hour. So I think we have Rachel and maybe Neil coming up next, and so we can bring them on and you all take it away. Neil, Rachel.
Thanks so much, guys.
See y'all.
Thank you.
All right. Well, Fools, welcome to another hour of Fool24. And Neil and myself will be co-hosting for this next earnings hour. How's it going, Neil? Good to see you.
Good to see you too. Ciao. How are you?
Ciao. Good. Doing well. We're both in Euro time zones right now.
Correct. This is a European full life. First of its kind, maybe.
Yeah. We're going to start a new theme. We've been doing these earnings shows regularly every day, and we're winding down to really the tail end of earnings season. But there's still some interesting companies that are about to report earnings or have reported earnings. I know that both Neil and myself have brought some companies to talk about in this next hour, but Fools, if you have any questions for us along our theme, feel free to go ahead and get those in the Slido. The event code for that is Fool24, and we'll also do our best to go through some of the questions that are in here that either Neil or myself can answer to answer your questions. But, as we look ahead at this week or recently, it's been a very interesting earnings season. It's been a volatile time for the public markets, but there's been a lot of really fascinating companies that we've been tracking here at the Fool. I'm curious, Neil, what are some companies that you're watching this week as we head into the latter part of earnings season?
Yeah, so we are towards the end of the earnings season, which means we're very close to the start of a new one. Not far from today, but I'm looking at some companies that are reporting tomorrow. So before the market opens, I see Pinduoduo, ticker symbol PDD, not the rapper, by the way, very important to note. And after the market closes, we have Micron, ticker symbol MU, Nike, ticker symbol NKE, and for some maybe broader information, I'll be looking at FedEx, ticker symbol FDX. And then on Friday, we have NIO, ticker symbol is the same thing, NIO. And then Carnival Cruises, ticker symbol CCL. It's always interesting to hear what they see. Are bookings declining for I don't know, some holiday season or something like that, to see what the consumer thinks. Those are the names that I'm looking at for the next 2 days. What about you?
Yeah, well, there's been some companies that the ones you mentioned that are about to report. Then there's several that I've reported more recently that I've been looking at, and I might briefly go through some of those results. Nike, one you mentioned that's reporting tomorrow. That's been a really interesting business to watch, especially in recent quarters. They've obviously been facing a lot of challenges as they're trying to, right the ship, so to speak, and I think innovate their core product categories, which have faced so much competition in recent years from the likes of On Holdings and even Lululemon and some of these other businesses that we also talk about a lot. This is what I'm watching really out of curiosity to see what kind of updates we get from management in terms of the strategies they've been implementing to try to turn the business around. They have had this sort of strange dynamic in the last few years where they've almost had an over-reliance on online commerce, and they've been seeing declines in their digital revenue as well as in sales, in their stores. And there's been some analysts that have sort of cited this shift that they had made to this direct-to-consumer model and maybe an underestimation of the importance of third-party retailers as some key mistakes for the business. We've also obviously seen them, like many other companies that have core exposure to China, a significant market, obviously for this company. They've faced some struggles there as well. They've announced recent partnerships like with Skims, which was a first sort of collaboration of that kind that they had entered into in many, many years. So I'm curious to see, what other plans management has for the business moving forward, because I do think that this is a fundamentally great business, but they have a lot to execute on, I think, to win back the optimism from investors.
Yeah, I agree. I mean, the partnership with Kim Kardashian Skims is one way for them to maybe tackle the competition that's coming from a Lululemon, and then to tackle the competition that's coming from On and a Hoka, for example. I think that part might take a little bit longer unless they also release some limited edition shoes and really make sure that in the short run there is more demand than supply, just to attract the traditional buyers back to Nike. That could be a tactic. But yeah, I mean, even the CEO, although he knows Nike inside out, even the CEO admitted last earnings call, I believe he said that the turnaround is going to take longer than expected. It's not something that's going to turn around in a quarter or two, which makes sense. I mean, we're not talking about a software issue here. We're talking about, hardware, clothes, whatever you want to call it. That's usually going to take some time. And then we're talking about shoes and clothes. It's not really something that, new shoes come out, I have to buy it. It's like, I could buy it. I could refresh my shoe lineup, but it will have to be something very, very good. I know that there was one analyst that said that there was a big increase in search for a new Nike shoe that popped up not so long ago. So okay, maybe that might be a data point to focus on. But yeah, I think for the quarter, I mean, okay, we're going to get the data, but the market's definitely going to be asking questions, forward-looking questions, and see where Nike's at the moment. And that could make or break the stock. Although stock is I mean, still down 25% year on year to date, only down 3%, but it is more expensive today than a year ago. And that's an important thing to know, that even if a stock declines, it's not necessarily becoming cheaper, because in Nike's case, for example, earnings went down. And so if you look at forward earnings or even last 12 months, it doesn't look great. So just because a year ago the expectations were that Nike was maybe growing faster than today, then a year ago it seems as if the company was a good buy, but we're now 1 year later and we're like, okay, business is actually struggling. Forward PE, forward expectations are actually worse than before. And so you're now here in a case where the stock is down, yet more expensive.
Yeah. I think that's a really good point as well. And something that we've been seeing from a lot of company leadership of retail-centric businesses in this earnings season has been comments about uncertainty in the consumer environment, which I think is very fair. Obviously, we're seeing continued really mixed sentiment in terms of consumer spending numbers. We do know that consumers are, being more financially cautious right now than they were in past periods. And that's something that has obviously impacted many businesses, but broadly speaking, those with exposure to, discretionary expenditures. And obviously, you know, a lot of the products that Nike sells, however popular they are very much discretionary. So I will be also curious to see whether they make any comments alluding to that. You know, we've seen management of companies that I think are broadly looked at as stable consumer entities like Walmart, all the way down to some of these very discretionary centric retail businesses talking about just really massive uncertainty looking over the next several quarters and trying to moderate expectations. And I think that that's something that management will probably speak to at some point in their earnings call. You know, FedEx is another one I follow as well. That's another one that I find interesting. I mean, they've been dealing with really a host of challenges the last few years. This is obviously one of those businesses that is, you know, very value oriented, blue chip type of stock. They're not, you know, they've never been a high growth business, but they've kind of been dealing with a perfect storm the last few years. There was obviously this surge in, you know, e-commerce during the pandemic that has subsided. There's been a decrease in overall shipping volume. You've seen inflationary pressures, you know, general weakening in certain economic indicators that have caused customers to cut back on spending, including shipping costs, which means they're going to shift to cheaper alternatives. You know, customers are willing to opt for slower and less expensive shipping options, which is something that I think the company has noted has negatively impacted their profitability. And then there's also been, you know, very practical elements like rising fuel costs, rising labor costs that have had an impact on the business. Now, they've been enacting different cost-cutting measures, including cutting flight hours, reducing their headcount. I know that they've also been working to consolidate their ground express and freight networks, which could lead to further changes in operations. And I believe they had also announced that they were ending their contract with the U.S. Postal Service, which is expected to impact the business as well. So there's a lot to watch with this one.
Yeah, I think they also, I mean, you said something interesting. People opting in for cheaper shipping, and one name pops up in my mind, and that's Amazon with Amazon Prime, which is basically free shipping. And I think we can see throughout the years that Amazon is taking more and more market share in the shipping industry, which makes sense. I mean, wonderful business, one of the best businesses out there, I think.
Absolutely. Maybe I'll take a little time and look at a couple businesses that I want to talk about that have already reported earnings. And Neil, I don't know if you have a couple you want to talk about, or if you want to scan through the questions while I do that. But one that I had did a bit of an earnings preview for and wanted to briefly go over their results was General Mills. So this is obviously a classic consumer staple stock. They primarily make money by selling a wide range of branded processed foods. They're known for, you know, brands like Cheerios and Nature Valley, Pillsbury, Betty Crocker, and some of these others. And they've also been working to expand their presence outside of human food into the pet treat industry. They had previously acquired companies called Blue Buffalo, as well as Tyson Foods pet treat portfolios. The stock itself, I believe, had a bit of a negative response to their earnings, which had come out, I believe, this morning. So this was for their Q3 of fiscal 2025. So Q3 net sales of 4.8 billion were down about 5% year over year. Organic net sales were also down 5% year over year, including approximately 4 points of headwinds from retailer inventory reductions, which they noted was a major factor there. They did report an operating profit of about 891 million. That was down about 2% year over year. Management said, you know, our third quarter organic net sales finished below our expectations, driven largely by greater than expected retail inventory headwinds and a slowdown in snacking categories. They said at the same time, we drove continued positive market share trends in pet, food service, and international, as well as improvement in their Pillsbury and Totino's segments. So one of the biggest things that they're dealing with, and again, this goes back to the changing habits of the consumer, is people are spending less money on snacks. They're focusing more on, you know, some of these essentials when they go to the grocery store. Excess inventory is something that is, you know, weighing on the top and bottom lines for the business. And I think that that's something that is not unexpected to see, but I think also just broadly indicates some of the trends that we're seeing from consumers. Looking at the first 9 months of their fiscal year, Net sales totaled about 15 billion. That was down about 1%. They reported gross margin was actually up 60 basis points to 35.2% of net sales. They did report an operating profit of 2.8 billion in the first 9 months of their fiscal year. That was actually a 6% year-over-year increase. And net earnings attributable to the company were 2 billion. That was also up 3% year-over-year. So, this is not one of those exciting businesses, perhaps, that like some of the others that we talk about here on the show, but I think it's an interesting one to follow. I mean, this is also one of those businesses we talk about in the context of dividend investing. General Mills, as well as its predecessor company, as the company has gone through numerous iterations through the years, this is a business that has paid dividends without interruption for 126 years at this point. They have a really extensive history of maintaining and also growing their dividend. It's a fairly modest amount of about $2.40 per share on an annual basis. I wanted to look up to see how the stock actually responded today to earnings. It looks like it went down by about single digits, and shares are down about 13% over the last year. The company currently is yielding, partly because of share prices having come down, about 4%. And that's quite a bit higher than the average 1.3% you see for most S&P 500 dividend stocks. So nothing that was particularly shocking about this report. I think anyone who follows this space and these types of businesses, we've been seeing for a while the impact of inflationary pressures and changes in consumer spending. I think this is a business that a lot of investors probably look at primarily for its dividend, and also it's just sort of a classic consumer staples business. It's not one I currently own, but I thought it was worth touching on briefly.
Yeah, I mean, I think General Mills and some of these types of stocks, it's purely probably because of the dividend payouts, right? If you look at the performance of the stock in the last 3 years, up 4.5%, so some underperformance, to put it lightly. So
that's true.
Yeah. So yeah, it's definitely just, you see that nice 4% dividend yield, but is it worth 3 years of just 4.5% growth? Questionable.
Yeah. Well, as a dividend-oriented investor for some of my portfolio, this is not one I have been particularly intrigued by for some of the reasons that you noted. But totally switching gears to a different industry. This is a company that reported also today. I believe they reported this morning. This is Ollie's Bargain Outlet Holdings. This is an interesting one for me to look at because, again, as we're talking about retail, this is a space that I cover a lot within the broader consumer segment. And it's also a space that I think a lot of investors are following more closely as we're seeing so many questions, about the state of the consumer. This is an interesting business, particularly to me right now in the current, operating environment that we're seeing. This is a company that makes money by purchasing discounted merchandise, including closeouts and excess inventory from manufacturers and other retailers, and then selling it at significantly lower prices to customers, creating this sort of a treasure hunt shopping experience. It's not quite to the extent of a large group of companies like TJX companies, but there are some similarities between their business model. Ollie's focus on buying and selling closeout merchandise, which includes things like overstocks, products with packaging changes, and even manufacturer overruns, has been really profitable for the business over the long run. And they source those products, those overruns, overstocks, directly from manufacturers and other retailers like Walmart, Target, Kroger, Costco, and even TJX-owned stores. And in doing so, they minimize operational and distribution costs, and they can offer really heavily discounted products to customers. They have a loyalty program. And also another thing that reminds me a little bit of what we've seen from TJX companies. Ollie's does not have an e-commerce business because they believe that treasure hunt, finding those sort of very limited inventory of items because they've sourced them as overruns or overstock from other retailers. They believe that in-person treasure hunt shopping experience is best experienced in person. And in doing so, they've had really strong financial performance with increased sales, operating income, and net income. Something as well that's worth noting is they use independent third-party freight carriers to ship merchandise to stores. And that way their stores receive shipments multiple times a week. So looking at the business for the full year, which they just reported their Q4 and full year results, total net sales increased 8% year over year to $2.3 billion. Comparable store sales increased 2.8% from the prior year, increase of 5.7%. The company owned 50 new stores and they closed 3 stores, ending the year with 559 stores in 31 states, which was an increase of 9.2% year over year. They also reported net income of about $200 million, or $3.23 per diluted share. So this is kind of an interesting one. I talk a lot about TJX companies. I'm probably still a bit more intrigued by that type of business. But it's worth noting that a company like this, with the model that they have, you could see this becoming more relevant to consumers in the next few years if economic conditions worsen. Obviously, that sort of treasure hunt, shop in person model, which TJX companies has been so successful with, can certainly be replicated by other businesses. And this is one example of that. They're still seeing some impact from changing consumer spending patterns. For example, they saw that their inventories were up at the end of fiscal 2024, but a good chunk of that was also because they have been really rapidly working on accelerating their overall store growth. They have also been in the process of acquiring dozens of former Big Lots store locations because they're working to target 75 new store openings in fiscal 2025. So kind of an interesting business. Another one that's maybe not talked about, quite as much. We get a lot of questions on, stocks all over, the spectrum in terms of industries and sectors. But this is one that I found interesting. They generated about $228 million in cash from operations last year. And that was down slightly from the year ago period, but still a pretty solid metric where that's concerned. And they currently operate about 575 stores in 31 states. So that's the results for that business. It was a pretty good quarter and full year result for the company. In terms of how shares responded, the market actually sent shares upward about 9% today. So investors seemed to like what Ollie's had to say. And actually, and I was surprised because this is not a stock that I follow as closely, shares of this business are up about 44% over the trailing 12-month period. We also saw some analyst firms raise the price target for this stock following their earnings report. So kind of an interesting business, one I wanted to highlight.
Yeah, no, I mean, this one definitely outperformed the market. In the last 3 years, up over 151%. Last 5 years, over 200%. I mean, it has a forward PE right now. I'm looking at 30 times forward PE. But it's a company that's, growing or expected to grow bottom line between 13 and let's call it 15% for the coming fiscal years. And top line, closer to 10, 11% or so. So quite interesting that we can still find these types of companies growing. I would say for that segment, still growing rapidly, I would say, compared to the others. Plus, it performed very, very well. It has a market cap of $6.6 billion, performed very well in the past. Doesn't mean it's going to perform well in the future, but it does seem like they know what they're doing, and I agree with them. I think in-person shopping is very exciting. I mean, the treasure hunt is always more exciting because you're there, you're in the store, online. You know basically that you won't find anything like, wow, well, this is a huge discount, because if it's discounted, it's probably already on the front page or in the sales section of the website. So no, I agree. I think they're doing the right thing, and it shows in the results for sure.
Yeah, it's kind of interesting as well, because there's so many of these bigger retail businesses we talk about all the time, and some of these ones that maybe aren't as widely followed are kind of fun to highlight. And again, this is an example of a stock. We've seen so many really solid businesses report really great earnings in this earnings season, and their stocks have just been, completely, hammered downward in the days that have followed. So, it's interesting to see when businesses like this report, particularly in the current environment, how investors seem to be responding. We have a bunch of questions in the queue here. There's a couple that maybe I can hit, and then if there's any you want to look through here and see if anything speaks to you, Neil. But in the meantime, I want to answer this question from Besties that came in a few hours ago. Let me just pull up some data right now because I wanted to answer this with some numbers in front of me. So Besties, I think I responded to a question you had about Stride yesterday, but I'm happy to discuss that again. So Besties was saying, what do you think of Stride, ticker LRN? Is that another Chegg? And could education cuts at the federal level going to state be an opportunity rather than a headwind? So Stride is a business that, and I mentioned this yesterday, was not one that I was as familiar with until we started getting some questions about this business. And I kind of took the time to look into it a bit further. Stride and Chegg are obviously both in the education space, but their businesses are quite a bit different. And Chegg has been struggling significantly recently. And Stride is actually doing quite well. So Stride, formerly known as K-12 Inc., they are an education services company. They provide virtual and blended learning solutions. The intent of the business is to help learners of all ages reach their potential through personalized and inspired teaching. So they focus on online and blended learning solutions for K-12 students. But they also have career learning programs for middle, high school, and adult learners. And one of the things that's really interesting about their business, a lot of it centers around school as a service solutions for school districts for K-12 students. But they also work with online private schools, tuition-free online public schools. They help to facilitate, individual courses. They also offer a range of learning solutions, including adult learning, as well as career learning solutions. And one of their most significant sources of revenue comes from working with school districts directly and sort of selling these packaged courses to them for K-12 students. Now, the question in terms of how would changes in funding on the federal level potentially impact the business? So school districts in the US specifically are primarily funded through a combination of local property taxes, state tax revenue, like income and sales tax, and then there's a smaller portion that comes from federal funding. The federal government contributes a much smaller percentage of school funding compared to these other sources. States allocate a portion of their tax revenue to public schools. Each state has its own formula for distributing these funds. And a significant portion of school funding, again, comes from property taxes within the school district. Now, obviously, Stride works with not just public schools, but private schools, individualized online schools. So it's a little bit unclear to me exactly how some of those changes might impact the business. But as it pertains specifically to their work with school districts, which is a major part of their business, that is an area that is pretty resilient because most of the funding still comes from the state level. Now, Stride is different than a business like Chegg. So Chegg has been known for things like their Chegg Study Pack, which is a subscription offering to different services like textbook solutions, tools and resources, assistance with math problems. Chegg has been essentially hemorrhaging losses as a business in recent years, and it's been a very difficult time for them, particularly as amidst the rise of generative AI solutions, there are a lot of opportunities for students to go online and find the data and information and answers they need to facilitate their studies for free. And that has created a dynamic where Chegg really does not have the valuable position within the industry that they did before. They said in their recent earnings report that they were filing a complaint against Google and Alphabet They are essentially saying that Alphabet has been hurting their traffic, claiming that AI summaries of search results have hurt their traffic and revenue. And they've also said that they're initiating a strategic review process to explore alternatives for the business. So who knows whether they would be open to an acquisition or what the future holds. That's the state of where Chegg is. They have been very, very vulnerable to changes in the world of generative AI that has significantly impacted their business. Because Stride is essentially providing education as a service primarily to school districts, but also to companies. They work with government agencies as well to facilitate career learning and educational solutions. This appears to me to be a much more resilient business. They're doing incredibly well from a financial perspective. Their revenue in their most recent quarter that they reported was about $587 million. That was a 16% year-over-year increase. Their net income was about $96 million. That was a 44% year-over-year increase. A significant portion of their overall revenue comes from that general education segment that I've been mentioning. In their most recent quarter, of the total $587 million in revenue that they reported, about $354 million came from the general education segment. Then their other reportable segment is career learning, which is broken down into middle through high school and adult courses. And that contributed about $233 million to their revenue total. They also noted that second quarter enrollments, because this was their Q2 of fiscal 2025, were up about 20% year over year. And they also said that enrollments only include those students in full service public or private programs where Stride provides a combination of curriculum, technology, instructional and support services, inclusive of administrative support, and it may include enrollments for which Stride receives no public funding or revenue. So I like this business. I mean, the more I learn about it, the more I like it. And as for the reasons I mentioned, this is definitely a business that is not facing the same headwinds as Chegg, because essentially businesses like Alphabet and others that have so many resources that enable students to find the information they need for free have created an environment where Chegg solutions are no longer as valuable. Whereas Stride is not a study homework helper business, but a full service educational solutions business working with school districts and agencies and companies and other such clients. So interesting business, solid track record of profitability that they've built over time. I've definitely found myself more interested in this one as we've had members ask about it.
Yeah, I mean, it shows that you have to have a competitive advantage, or at least, I mean, a moat, and Chegg clearly does not. And if they use like Google search, generative AI as a way to explain why their business failed, I could say that if we look at the Duolingo, for example, you would have thought that a year or so ago, that business will also be failing, but clearly not. They're doing much better today than they did a year and a half ago, or especially since ChatGPT came out, because everybody thought, oh, ChatGPT comes out. They came out with a language demo, right, when I think someone was talking Italian and it responded in English, etc., etc. And the stock dropped, I think, on that day. But since then, the stock recovered and then some. The business continues to do quite well. So it's very important to see, does your business actually have a moat, a strategic advantage over something else? Can it easily be disrupted? A Chegg, clearly yes. And a Chegg also taught me that a stock being down 90% means that it can also go down another 90%. I've checked and I've seen that in 2 years they went down 90%, and from that point they went down another 90%. So apparently lower can go lower. As Peter Lynch said, it's always darkest before pitch black. So I think that's the case here.
Yeah, it's been, I think you're right. I think that the lack of a strategic moat has been an issue for that business in a way that from all appearances that I can see is very different compared to a business like Stride. And I like the point you make about Duolingo. I talk about that business a lot. And they've been one of those companies that's been working to also kind of get ahead of the curve by leveraging, large language models and other AI technologies directly into their platform, getting ahead of the competition, so to speak. And that seems to be very effective. I mean, they are doing a really fantastic job of growing the business at this point.
Yeah, they also have that social aspect to it. You also have that streak. You don't want to lose the streak. So yeah, that's one way for them to basically tackle that problem. So, I mean, I like it, although I don't always jump in when I have to, but they remind me. Duolingo, the bird reminds me on a weekly basis.
Yes, I feel you. I too have used Duolingo, brushing up on my Italian.
I do want to touch on a question that Luella asked 3 hours ago about Mercado Libre and New Holdings, so two Latin American names that are trading on American markets. So do you see MELI and New having more overlap geography or product over time? And if so, what to watch for? So, I mean, the basics, yes, there are already today overlaps. And both of them are competing in quite similar markets in Latin America, whether it's Brazil, Mexico, you have Colombia, you have Argentina. So they are definitely competing in the Latin American market. You have, I mean, New Holdings at the moment is more of a pure fintech play, although that can expand in the future. Whereas Mercado Libre also has a fintech play with Mercado Pago, but you have, I always like to say that Mercado Libre is the closest thing to an Amazon that there is. You just don't get an AWS, which makes sense. But they've got the e-commerce side of things, they got the logistics, they've got the fintech side, advertising now, also memberships. So that's Mercado Libre. I'm a bit biased here because I hold it, but I love New as well. I think they're an incredible company that will do very well in the future. I do think that New could expand in an e-commerce market for sure. I think we've seen that with a lot of players. You start off as a big fintech player, you have your app, and then you're opening yourself up to e-commerce. And I know they've opened up to internet self-service and stuff like that. So wouldn't be crazy to think that they will tap into an e-commerce market that could be quite competitive with Mercado Libre. Then with regards to geographies, last quarter, we've seen that New has some aspirations to grow outside of their core markets, which is something that the market did not like at first. Didn't really make sense to me because they said quite specifically that they are still very, very much focused on growing in their core markets. They still see quite a lot of opportunities in their core markets, but they are taking a small percent of their workforce or whatever you want to call it to make sure that, okay, there is an option, a possibility that in the future we are going to expand into new locations. And it makes sense. It is very an asset light type of company. So would make sense if it works in Latin America. Maybe they'll try their luck in other Spanish speaking countries. I could see that happening. Of course, you start small, you see how it works out, so it doesn't really impact the rest of the business that much. With Mercado Libre, I think they will stay in Latin America. That's just my guess. I think that market is big enough, and I think they'll stay in that. Could they go into the United States? Maybe. I think that I've seen some rumors from a couple of months ago. Could happen. I don't know. But the Latin American market is quite big for them to still grow quite a lot in the next couple of years. And so, yeah, I went with Mercado Libre. I had both of them, actually. I went with Mercado Libre because I wanted just to consolidate into one player that touches all the specific points that I wanted to have from a player, which was Mercado Libre. Although I always said that if New continues to drop, I think it did go up the last couple of days. If we went under $10 again, maybe it becomes even more interesting. But yeah, that's basically what I think about both companies at the moment.
There was a question I wanted to hit that actually came in about 8 hours ago from Ed, asking about Warby Parker, which we've been getting more questions about this one recently, which is interesting. I find this an interesting business. So Warby has struggled lately, down 12% yesterday. Is it all tariff related? Do you think that this is a good price to start a starter position? So yeah, the stock is down about 25% year to date, although over the last 6 months, shares are still up about 30%. But it's been a rough time lately for the business that's down double digits over the last month. Something we say a lot on the show, but it's worth repeating. We're not able to give personalized stock advice. We can't tell you, what stocks to buy or sell, or, when to take a position or how to take a position. We are able to offer our thoughts and opinions, which is what I'm happy to do. And I'll offer some thoughts to maybe consider for anyone that's looking at this business right now. First addressing the question of, is it all tariff related? In my opinion, I think that there's a few factors at play here, right? So there's a few things that the company is dealing with right now that are impacting the business. They are working very aggressively on expanding their physical store presence and offering eye exams, which are revenue drivers, but they also increases fixed costs like rent and salaries for optometrists. This is a company that is still unprofitable under GAAP and has steadily been so through the years. Now, they've also been investing, obviously, in their growth in doing so. They've been investing in new products and services, including contact lenses, branded eye examinations. That's also impacting their margins. And while Warby Parker continues to grow its presence across the United States, its gross margin has been below expectations, broadly due to these increases in fixed costs that I've mentioned. There's also the reality that a business like Warby Parker, to survive, needs to be able to continue attracting customers from established optical retailers. And that is something that the company has done a good job with, but that's still a challenge that they need to overcome over the long run if they want to move towards profitability and have a sustained business. Their model revolves around this direct-to-consumer concept where they cut out the traditional middleman of eyewear retailers and distributors. They design and manufacture their products in-house. They sell them directly to customers, and that allows them to offer really high-quality eyewear, but at a lower than average cost to the end consumer. And initially, Warby Parker was only excuse me. Initially, Warby Parker was only online, but they have expanded significantly through the years to their brick and mortar presence. And this has been something that has been, very costly for the business. Lovely how I'm just choking. But essentially, the biggest issue that they're dealing with now is I think that there's major concerns about how tariffs are going to impact the business. And I think that that's something that, management has alluded to, but that's also something that there's some context to that. So they source some of their materials from Italy, but they also rely heavily on China for manufacturing frames. About 29% of their products are manufactured in China. And that is what has enabled them to really design their products in-house, sell them directly to consumers. They order their own materials such as acetate from Italy, and then they manufacture their frames at a lower cost than they would perhaps in other markets at the same Chinese factories as some of the other major eyewear competitors. So they're certainly not the only company in this space that has exposure to China. So while the acetate for their glasses comes from Italy, about more than 20% of their products are sourced directly from China. And I think concerns over that have weighed on the stock. The other, elements I mentioned, which is pressure on their gross margins as they invest in the growth of the business, as well as the fact that they are still unprofitable. I think that's also something that's really impacting the business. I still find this an intriguing company over the long run, but I think we've seen that investors are, shying away from growth-heavy, unprofitable businesses right now. And I think that that's something that is impacting sentiment around the stock. Now, they did provide about $35 million of free cash flow in their recent fiscal year. They did also report a GAAP net loss of about $20 million. Active customers increased about 8% to 2.5 million, and their full year revenue increased about 15% to 102 million. So I think this is an intriguing business over the long run. I think that it's important to consider for anyone looking at this company, if you think that this is a disruptor within the eyewear space over the long run, then regardless of what happens, in the coming months, this could be an intriguing company. They did talk about the impact of China tariffs in their recent earnings call. Management said that as it relates to tariffs, over the last 5 years, we have strategically diversified our sourcing to reduce tariff exposure, with China representing about 20% of our total cost of goods now, and no exposure to Canada or Mexico. They said we've worked with our vendors to mitigate cost increases. We will continue to do so, and we'll continue to make intelligent decisions around diversifying sources of production globally. They said as the China tariffs are currently structured, we anticipate a 20 to 40 basis point impact to gross margin. They said we do believe we have multiple levers in place to manage that environment going forward. So we do have direct comments from management on that. They are expecting, 20 to 40 basis point impact to margins currently. That's obviously something that could weigh on the business over the long run if these dynamics continue. In their filing, after they reported earnings, they did say that costs on a significant portion of our products may increase further, which could also reduce our margins or force us to raise prices. And that's one of the risks that they are noting as the result of current and future tariffs. I think all of these elements are what you're seeing in the stock right now. I think if you're looking at the business, this is a company with a lot of potential in its space. It has been a pretty solid, had a solid history of growth and disrupting, the industry in which it's operating. But I think there might be quite a few headwinds for this business, at least over the next few years. I do think that the fact that they have worked to decrease their reliance on, sourcing their products from a particular region and trying to diversify their supplier base is important. I like the fact that management was so transparent about that. But those are some actual numbers that they've given out in terms of what their exposure is and what the impact they think will be. And those are maybe some things to consider as you look into your long-term thesis for the business.
What I like a lot about this show is that we hear a lot about companies. I hear a lot about companies that I've never heard about before, and I learn something new on a daily basis. So thank you for that. I do want to touch. I'll give you a couple of minutes to breathe and drink water. I do want to touch on a question from Edwin for Lulz that he asked an hour ago. What do you think about Japan increasing market share of AMD GPUs for AI and other uses, in addition to Sony using more AMD hardware for their products? So I assume you're talking about Sony PlayStation, because AMD does provide the chips for the consoles for Sony and Xbox, if I remember correctly. That's Microsoft. And then for the first part of the question, I think it was GPU retail market share, so not really the AI side, so the data center side, the one that really competes with NVIDIA, but more on the gaming side of things. So they said that they are reaching, at the moment, their sales has risen and they're reaching 45% market share in Japan, and they're eyeing 70% as their next target on the newest GPU that they've launched, GPU and also CPU. This was during an event with some influencers in Japan. And well, the comments did surprise, because having already 45% of market share, targeting 70%, knowing that on the other side you have an NVIDIA, that was quite something. Then on a consumer side of things, okay, this is great to hear, but the issues that we have currently is that AMD and NVIDIA, they just don't have enough supply. So usually on the day that these products are available, it lasts a couple of hours and then it's out of stock, and then you have to buy them through third parties where the price is nowhere near MSRP. Especially in Europe, the price automatically is already 20-30% higher than what you're paying in the United States. And that's the main issue, that AMD did say that they're going to address that. They're going to make sure that there is enough supply. At the moment, it is sold out. You can check on various websites. It is sold out. So hopefully they do increase the supply, because there is definitely a lot of demand for these types of chips that performance and efficiency wise are priced very, very attractively. And that's what AMD is going for. They're not really going for, or anymore at the moment, to compete with the high-end NVIDIA ones. They are going after what they say that 85% of the market, that gamers are going for GPUs that are around $700 or less, if I remember correctly, which makes sense. Plus, If you look at the overall AMD business, I'm going a bit not off topic, but off question. Overall AMD business, we've seen that the gaming segment and the embedded one have been struggling in the last, let's say, year or so. Basically, gaming lost over $1 billion in revenue, embedded $500 million, I would say. So currently the focus is on data center revenue. We didn't really get a real number for guidance for this year, although they did say that this segment could generate them or will generate them tens of billions of dollars in revenue in the future. Okay, it's not really a real number, but fine. The client side of things, so enterprise, server, CPU, and all of that is doing very well. That's accelerating. But we've also heard that I think the headwinds that we've seen from the gaming and the embedded segment are going to turn into tailwinds in the second half of this year. So although the full focus is definitely on data center revenue and client, I think having a boost of, let's say, another billion or $1.5 billion from gaming and embedded combined could definitely boost the revenue profile and especially the profitability profile of AMD's business, because the embedded one is a very high margin business, and that should be growing quite quickly. They said that in 2024 they had around $14 billion in design wins, so not bad for something that currently generates them just under $1 billion in revenue. So good news from AMD. Good news from AMD. I am an AMD shareholder. I can also admit that NVIDIA is still the leader and will stay the leader for, I think, a long time. If you missed Jensen's GTC keynote yesterday, highly suggest you go watch it in your free time. It's quite inspiring, to say the least.
Okay. There was a question I wanted to hit that ProShop guy had asked earlier about Walmart. Walmart has seen an 18% decline, which has historically been an indicator of a weakening economy. Thoughts? So yeah, shares of the stock are down by about that amount over the last month, although it is worth noting that shares of Walmart are still up about 40% over the trailing 12-month period. I know that a lot of investors have looked at, and consumers have looked at Walmart as sort of a bellwether for the broader state of, consumer spending, retail spending, and as that relates to the economy. And I think that's understandable. But I don't necessarily think that, what we're seeing from Walmart, I think it's too soon to say, whether what they are seeing is a function of, long-term headwinds for the economy. I think what they are saying is what a lot of other company leaders are alluding to right now. And I've said this on a few recent shows, but I do think some of the market's reaction to the company's recent earnings was a stark overreaction. I think that one of the things that I like is when management tries to get ahead of what could be potentially bad news and say, we don't think we're going to be, for example, the CFO noted, totally immune from tariffs, particularly those on Mexico and Canada, and that could impact their supply chain and pricing strategy. They're saying, we think we're going to see a little bit of a slowdown this year. And, their top and bottom lines in the recent financial report that they released did come in well above what Wall Street had been projecting. Their quarterly revenue grew about 5% year over year to about $183 billion. Their same store sales for Walmart US increased about 4.6% year over year. Their e-commerce business in the US grew about 20% year over year, as they're seeing really strong growth in in-store pickup and delivery. Their subscription service, Walmart Plus, saw double-digit growth in the quarter. Membership and other income increased 33%. And then you saw mid-single-digit same-store sales growth in their US grocery business. That was boosted by an increase in foot traffic and e-commerce. And then you're still seeing a lag in discretionary items like toys, home decor, fashion. I don't think that is at all surprising, but it's worth noting that Walmart's grocery business makes up 60% of their total sales across the board. And that means that they do have, while they may have some exposure to the impact of tariffs, depending on, where they're sourcing some of their food staples and other items from, they have a lot of resilience, I think, that's baked into the business because more than half of their sales come from these essential expenditures like food. And again, for the full year, Walmart still surpassed what analysts have been projecting, with net sales increasing 5.6% year over year. Now in 2026, they're projecting net sales will increase between 3 to 4% compared to the 5.6% increase that they just reported. I don't think that is surprising given the dynamics we're seeing. I think that people are still going to be shopping, heavily at Walmart. I think we've seen even more so the last few years while businesses like Target have struggled. Companies like Costco and Walmart that have these, lower prices and create such a dynamic value proposition to the end consumer have continued to succeed. And I think that will be the case with Walmart over the long term. There's also, other elements of their business that can drive their growth and profitability over the long run. Advertising, which is still a smaller part of their business, but growing. Their Walmart Plus memberships, which are seeing exponential growth. Their third-party marketplace operations are also key as well. So even though they had a disappointing forecast for fiscal 2026, which was below analyst expectations and ultimately triggered that sell-off, this is still a business that is fundamentally doing well. They're profitable. They have a long-standing commitment to their dividend. I still think this is a solid business over the long run. I think that we are seeing some signs of a weakening economy. We might see elements that are reflected in the results of big retailers like Walmart, like some of these other big companies. But I think it might be too soon to say that affirmatively. For now, I think that it's good that Walmart's management got ahead of what could be some serious headwinds in terms of recognizing them and commenting on how they think they could impact the business. But over the long run, I think that this is a company that is built to last. I think that they have a really fundamental, value-driven business for the consumers that they serve. And I think that is something that is going to help this business succeed, even if, sales slow. And again, because so much of the growth of their business is tied to non-discretionary spending, I think that helps.
Yeah, I'd also like to add that it's been historically cheaper on a forward P perspective. If I just look here at the comparison Walmart to an Amazon forward PE. Amazon in the last 5 years has been by far more expensive, and only more recently has Amazon become cheaper than a Walmart. Walmart right now, what I'm seeing here is a forward P of 32.7 times. For example, in August, that was 27.8. And let me see, a year ago, that was closer to 25 or so. Even if we look at price earnings to growth, Walmart is now at 3.75 and then Amazon is at 1.47. So it's down, it's true. It's down year to date, but it has also gone up quite a lot. I think we've seen that with many of the stocks. They've just ran up way too fast. And now we're coming down back to reality. It makes a lot more sense for Walmart to be trading at these levels than at more elevated levels. It was at one point at close to 40 times forward PE, which quite expensive for a name like Walmart. So yeah, it's true. You see the stock down, you hear the headlines, you feel the macro and then you make the conclusion, okay, it's maybe because of a weakening economy, which might be the case. But it's, I think, important to look at what has happened before. Like, why is it down 18%? Well, why was it up so much in the last, what was it? Like you said, last 12 months, it's still up 40%. And we've seen quite a huge uptick since August of 2024. So mix all of that together, I'm not surprised to see down 18%. I was very surprised to see it at 40 times for PE, but yeah, very good company all in all.
Yeah, I think so. Well, we only have about a minute left, but there was an interesting question that came in that maybe we can both answer really fast. From Let It Ride, what are the top 3 or 4 things you look at when you analyze a stock? There's kind of the fundamental analysis of the business, and there's also the technical analysis. From a fundamentals perspective, financial statements are obviously key. Their income statement, which tells you how profitable they are, their balance sheet, assets, liabilities, equity, their cash flow statement, some of those key financial ratios like price to earnings, price to book, If they pay a dividend, looking and seeing, is this a company with an extensive history of paying their dividend and maintaining it? As how are they doing from a cash perspective to be able to, an earnings perspective to sustain that dividend? What is the percentage of their earnings that they're paying out in the form of that dividend? Then fundamentally understanding the business model, its industry, understanding the industry's growth potential and competitive landscape, looking at management, the experience of leadership in the business, and their competitive position as a company over the long term. Those are all elements of the fundamental analysis to consider.
Yeah, I agree. A quick follow-up. Management, very, very important. The track record of management of the company itself. Studying the business, because we talk about a stock, but behind the stock there is a business. So looking at the fundamentals, is the trend going up and to the right? And if not, what's going on there? So understanding that. And then to me, after that, I am looking at valuation or pricing metrics, if it makes sense to pay the price today. Because it could be an amazing business, but I'm maybe not willing to pay the price of it today. So those are quickly the three things.
Awesome. Well, Neil, it's been fun being on for this hour with you. Up next, we have Jeremy and Brian, who are coming in. Just waiting for them to be ushered into the room here. Hey, guys.
All right. Hey, Rachel.
Hello.
Hey.
Neil.
Hello.
Thanks so much.
Have fun.
Thanks for the hour. All right. Good afternoon, fools. I'm here with Brian Orelli. Brian, how you doing today?
Good. Yeah, it's sunny in Southern California here, and we've got plenty of sun behind me, which is screwed with my lighting. So, but we're doing okay here.
Yeah, well, I'm starting to see some spring flowers poking up. So,
Yeah,
so that's
supposed
always
to be
nice.
Almost 80 here today. So,
Oh wow, yeah.
yeah.
Can't complain.
We're in full spring weather here. So.
Right. Well, our theme for the hour today is bulletproof stocks. You can think of those as recession proof, or stocks that really I think can resist almost anything out there. We've a few tickers in our title card there: Johnson & Johnson, Costco, and Chipotle. So we can talk about those. Any others on your mind, or any questions at all? Please put them in the Slido. Code is Fool24. Happy to talk. Fed news, or that was probably the big event today. But any other companies on your mind as well. So feel free to share your questions with us.
Yeah.
Brian,
I could start with Johnson & Johnson. So I wrote an article, let's see, it was quite a while ago, like maybe more than 10 years ago. The title was Johnson & Johnson stock is always a buy, parentheses, if you hold it long enough. And this was in June of 2013. So we're talking about like 12 years ago that I wrote this article. But basically,
it's a test.
Yeah. So at that point, I found all the different highs. So I just looked at the multi-year chart and then just picked out all the different highs that I could find from where it went up and went back down and then went back up to potentially higher level and then went back down. And so then I compared those highs to the to the S&P 500 and then looked at how much they had returned over that time frame, and basically every high had actually beat the S&P 500 over that time frame. And then if you looked at the lows, they actually also beat all the S&P 500. The only times that I really found, so then we'd just gone through an S&P Johnson & Johnson sort of run when I was looking at that stock. So I sort of backtracked and went to like sort of the low of the S&P of the Johnson & Johnson returns and said, okay, well, let's look at the highs to the low that had just previously happened. And in that case, the Johnson & Johnson hadn't beat the S&P 500s. So from Johnson & Johnson's peak to Johnson & Johnson's, current low, each one of the peaks to Johnson & Johnson's current low, it hadn't beat the S&P 500, except if you went out far enough. If you went out far enough, which was, I don't know, 7 years, it looks like approximately, then the return for Johnson & Johnson was 24.7%, and the return for the S&P 500 was 18.8%. So maybe the exception that proves the rule, that if you wait long enough, you can eventually have a return, a better return on investment for Johnson & Johnson than the S&P 500. Now, of course, this was way before Johnson & Johnson spun off their consumer health division, which they did, in the last 2 or 3 years. This was, again, 12 years ago or approximately that I wrote this article. So I wonder how much difference is going to be in the stock going forward compared to what it was in the previous, the consumer health division was a very slow grower. So that's the reason why they spun it off, right? So but it was also a slow grower in the slow times as well as a slow grower in the fast times. So you could imagine that in places where the pharmaceutical and medical devices might not be taking off because maybe they're facing patent cliffs or whatever, the consumer health division provided sort of a bolus to allow for a small amount of growth in that time frame, regardless of what was happening with those other two divisions. And now, without that steady grower, even though it was much lower, I think overall, presumably the growth will be better. But is there going to be more volatility in Johnson & Johnson now that it spun off its consumer health division compared to the normal division, the other two divisions?
Yeah, I was a bit surprised by that move. I guess what that company became, Kenvue, right?
Yeah, me too.
Yeah, I think of Johnson & Johnson as one of those companies that's just, what I think they've been around since the 1800s, and it's sort of, I don't know them too well, but just feels like they have that business model, and that's kind of how it always has been and will be. But yeah, I think that's a good point. They probably
obviously that was the trend for pharmaceutical companies. Pfizer spun theirs off twice, and other companies, and GlaxoSmithKline combined with Pfizer in the second time Pfizer spun theirs off. And so I think there's just that had been the general trend for pharmaceutical companies, and so they decided to do the same. And so I think it made sense financially. It just was sort of surprising based on the company's history and their the fact that how do you what do you do with Johnson baby lotion, right? I mean, I guess they had to license in the name to hold on to the Johnson & Johnson baby oil license, because there's a lot of Johnson & Johnson products that are in the consumer health division, but they made it work, I guess.
Yeah. Would you see, if choosing between the two, would you stick with Johnson & Johnson?
Yeah, I mean, Kenvue seems fine as a slow grower if that's what you're looking for. That's a stable company. Obviously probably not gonna grow faster than Johnson & Johnson is, but probably, if you look from peak to low, I would imagine that Kenvue is going to grow much faster than Johnson & Johnson will, because Johnson & Johnson will have its ups and downs, and its ups and downs will be greater, in magnitude than Kenvue's will. So if you look up into the right, Kenvue's Johnson's gonna go over it in the short term, and the highs and lows are going to go up in terms of returns are going to go up and up above and down below Kenvue's returns, and eventually, over the long term, I think Johnson & Johnson will win out. But if you're looking for a steady grower, Kenvue might be a better choice.
Yeah. Yeah, that makes sense there. All right. Well, yeah. Thanks for sharing that. Still waiting on some questions to come in. Paul Shanhar has a comment here. Thanks for joining us, Paul. Yeah, well, I'll talk a bit about Costco. I know that's seems like a popular stock on Fool24. And I think when one of the things as a caveat, I think when you talk about stocks like these is I think the valuation is always a risk with any stock. So I think you have to take that into account. But I do think Costco is still trading at a quite a premium. Let's see where they are now. I'm pretty sure they're still over 50, but about price to earnings around 53. So I think that speaks to the they've earned that premium over time by proving their sort of resistance to anything that the market can throw at it. But I think there's a lot of things to like about Costco's business model from a long-term investment perspective. So I think we're pretty much everybody's familiar with what they do. It's a buy in bulk warehouse chain. Really, there are only two other large companies doing that. There's Walmart, Sam's Club, and BJ's as well. BJ's Wholesale, which tends to be more regional. I think in the Northeast and Midwest mostly. But Costco is significantly larger than both of those companies. Also has a pretty strong international presence. And I think what works so well for them, as far as being bulletproof, is that they have this low cost, low price advantage, this reputation with customers. So they have a reliable customer traffic. When you look at their financial statements, you'll notice that their gross margins are unusually low for a retailer, usually in the low teens or even 11 to 12% range. But they're able to do that because they make most of their what really becomes most of their profit from their membership income. So which is now $65 per household, or the executive membership, which is double that, I believe. And then there's some other add-on features as well, their credit card business and that sort of thing. So I think it creates this pretty neat flywheel effect there, where you join, they get that money directly, and then the low prices and the I think also the quality of their merchandise tends to be pretty good. That business model keeps you coming back. They have that low price reputation, so they're not. They also have a higher income customer base than a lot of other retailers, certainly like Walmart. So I think they're better protected from a recession than a lot of other retailers. They make most of their money from groceries, so consumer staples kind of products that we all need: toilet paper, paper products, food. Even in a recession. So that works well for them. And they're still opening new stores and investing in their e-commerce platform as well. So I think they have a solid path to growth in front of them. So I think they've proven themselves in the last 10 years. There was concern maybe for a year or two that Amazon was a pretty serious threat, but I think they've responded to that well with their their e-commerce offerings. They don't do the buy online pickup thing, but they do have some delivery options and some things that works for them. I mean, mostly they're trying to drive store traffic, but yeah, they continue to put up solid same store sales growth. So I think what they're doing is working pretty well.
I was just there today, and I forgot my executive membership bonus, payout that I got for the 1 year anniversary of my, or whatever, multi-year anniversary of my being an executive member. So it's definitely gone down since the kids have gotten older, but we're still making more than the executive membership costs us, but not much more. So they're right on the borderline, but probably whatever they're benefiting from, whatever they're paying me out in addition to that is making them more in terms of their profit margin than what I would if I didn't have an executive membership and maybe didn't go buy stuff. And I certainly bought way more stuff than I was expecting to buy. There was some pet medicine that was on sale, so it was like, normally actually that's on the Amazon automatic rebuy thing, where we buy it every 6 months as the pet medication comes, as we finish off the pet medication. But I looked at the price and it was like, that seems like really cheap. And then I went to the Amazon website and was like, wow, yeah, that's like really, really cheap. So I went ahead and bought one, even though now it's going to cost me, the time that I have to go turn off the Amazon rebuy and then remember to turn it back on. But it was like literally, $10 or $20 difference in the price for the total package of 6 to 8. And basically it was like the 8 package of 8 doses was less than the package of 6 doses. So that saved me about more than $20 per package. So it was like, okay, I guess I'll deal with this and deal with the consequences of me having to turn off that automatic, speaking of Amazon, that automatic purchases in Amazon, I think is really useful for them. I think that creates a whole bunch of sales that wouldn't necessarily happen because, when they offer that slight discount, that results in me signing up because it just makes my life a heck of a lot easier. We now have one at Chewy and we have one at Petco, and we now, we have quite a few at Amazon. The things at Chewy and Petco just aren't available at Amazon. Otherwise, probably we would have done everything at Amazon just to keep things simple. But I think that's, maybe that's what Costco really needs. Although I think it's maybe hard to figure out how long it's going to take you to work through that giant package of toilet paper or the dishwasher detergent. So maybe that doesn't work for them, but it certainly seems to be working well for the other companies.
Yeah, I wonder if they could frame themselves more as a competitor for Amazon like that when you go into the store. But yeah, it's very easy to spend money there. I've found, I always seem to leave with something I didn't plan to buy or something.
Yeah,
like
and
that,
I
but-
bought something that was more like impulse buy, like it wasn't even like, there's like they're gonna have it around, but it's on sale, so I'm gonna buy it. So like I bought, like we use melatonin to help us fall asleep, and I bought 3 packages, even though we could have gone with 1 package, and we'll be at Costco before the first package ends up, but because it was on sale, we ended up buying 3 packages, right? But then there's also like a lantern that I didn't really, I realized that I sort of needed something, that our flashlights had been sort of not being, had the flashlight, I think it just has gone missing. I don't know, maybe the kids took it or something, but it's the lantern, the flashlight that I normally use to like do, the chores or something around the house where, like I need to go look at something underneath the sink and I need a flashlight. That flashlight's missing. So there was a lantern that was there, and it was like, well, I know it's not going to be on there the next time I come here. So, I know Costco's a good buy. So I went ahead and bought the lantern, even though it definitely was not on the list of things that we were planning on buying.
Yeah, the treasure hunt effect, I think they call that, but that
exactly
works pretty well. We got a comment here from Richard O. I like this list of bullet resistant companies. Maybe we could talk about some of these, Brian. Well, I don't know the energy companies as well, but I'll go through the list here: Enbridge, AbbVie, Microsoft, ADP, Exxon, Procter and Gamble, Berkshire Hathaway, NextEra Energy, and Vertex Pharmaceutical. Any thought? A couple of those I think are in your wheelhouse, Brian.
Yeah, definitely AbbVie and Vertex Pharmaceuticals. So Vertex Pharmaceuticals is sort of in an interesting spot, right? So they've got cystic fibrosis drugs, and they've developed multiple cystic fibrosis drugs, and they've created combinations, and that's allowed them to treat patients that weren't able to be treated on their first generation and second generation cystic fibrosis drugs. So now, because the cystic fibrosis is caused by a genetic condition, so some patients have, I mean, the genetic condition causes different mutations. So some of the causes cause the protein which is responsible for passing chloride through the membrane of the cells, especially in the heart, in the lungs. The protein, some of the protein sometimes doesn't get to the surface. So they've developed molecules that help it get to the surface of the cell, and therefore can move the chloride. And then other ones, it's not really stable at the surface. So they have another drug that might keep it stable. So now we've got one that transports it, and we do a combination. We've got one that transports it to the cell and keeps it stable, and then that allows you to create more potential opportunities. So they've done quite well. They've grown, they were growing at 20 and 30% growth as they added more and more potential patients that they could treat with their additional offerings of drugs, and they kept showing that they could help patients, and they kept getting them approved both in the US and outside the US and other regions. But they're kind of getting to the point where there's nobody else left to treat. There's patients who don't have any protein, and you can't really do that with their drugs that they have. You have to do that with a gene therapy, and they're working on that as a potential treatment for that small number of patients who don't have any protein that expressed. But they've pretty much maxed out 80, 90% of the patients. And because their drugs work so well and they have no competition, they basically have the market all to themselves, which is great. And it's allowed them to grow, but they're not necessarily poised for growth in the future, at least in cystic fibrosis, because they've basically maxed them out. They're developing new drugs that are potentially better than their earlier generation drugs, and that will help them grow, that will cannibalize their old drugs. And if they can charge more for it, then maybe they can grow grow revenue a little bit. But more importantly, the later drugs, if they work even slightly better, will hopefully, when the earlier drugs go off patent, then the later drugs, because they're better, will still be able to compete with the generic versions of their earlier drugs. So that's more of a benefit to the company, is not necessarily in terms of growth, but in terms of stabilizing the sales and not seeing a patent cliff. They do have other drugs. They have one drug that they got approved in, I think, January and launched in February. It's a pain drug that's a non-opioid drug. So in theory, it doesn't have the potential for abuse like an opioid drug does. But opioid drugs are prescribed, are generics, first of all, and are only prescribed for acute setting, which is what Vertex's pain drug is approved for, for 5, 7, 10, 14 days, depending on what it was. It's basically you undergo a surgery, and then you're in pain, so they give you some drug to help you manage the pain, but eventually your pain should go away and you could be able to stop taking the drug. So the question is, like, how much worry are doctors going to have over patients potentially getting addicted to those drugs? And are they going to prescribe the higher cost Vertex drug over the lower cost generic opioid drugs? So we'll have to wait and see. And then I think that maybe it's a little bit overvalued right now, but if we're talking about bulletproof over the long term, it's not like if we hit a recession, sales of their cystic fibrosis drugs are going to go down. So there may be some decline based on the sales of the pain drug, especially if it doesn't meet expectations, which are, pretty low in the $100 billion range right now. $100 million range for 2025 sales. But I think there's more potential for, more expectations for it to grow in 2026 and 2027. And then if we look at AbbVie, I don't know. I think AbbVie has done really well in their ability to transfer patients from the current offerings to the next generation offerings, maybe even better than Vertex has, in that they've, I thought that there were so many patients on Humira that I thought that once Humira went into biosimilar, which is the generic version of biologic drugs, that I thought their sales would plummet. But they were able to, one, keep Humira on patent as long as possible through, some sort of, I don't know, sneaky, what I would say, I would characterize it as ability to keep the patent going way beyond what you would expect the patent to end. But eventually the, biosimilars came onto the market. But at that point, they were able to move them onto the second generation treatments for their autoimmune diseases, arthritis and that sort of ulcerative colitis, that sort of thing. Those diseases that Humira treated. They were able to move them into the secondary psoriasis, that sort of thing, that they were able to move those into the secondary markets, secondary offerings of drugs. And, they were obviously better, but, they were able to move the patients into the secondary drugs and therefore keep them on AbbVie branded drugs rather than having them move into generic or biosimilar drugs. And so they've done quite well. And then they also obviously added the Botox and those sort of molecules that they added in the Allergan acquisition. And so that's definitely helped them in the long run. So overall, I think, between AbbVie and Vertex, I think AbbVie right now might be a little bit more bullet resistant than Vertex, mostly because I feel like Vertex might be pumped up a little bit on the pain drug. And if they meet expectations, then it's just as bullet resistant. But if they don't meet expectations, then I could see that one falling even in a sort of in a down market.
Yeah. Sounds like maybe AbbVie is a bit more diversified.
Yeah, definitely.
Yeah. Well, I think there are three stocks here I think are great examples of, the kind of bulletproof company. Microsoft. I think what's attractive about them compared to, other of the big tech companies or Magnificent Seven, whatever you want to call them, they're very well diversified. There's the Office suite and their other software products. There's, Windows, which is, just been really at a monopoly in PC operating systems for, I think well over a generation at this point. And then Azure as well, their cloud infrastructure business. Still growing very fast. Seems to be gaining market share on Amazon, on AWS, which is generally considered the leader. I think Microsoft also has a lot of other. There's Xbox. Their gaming division. They acquired Activision Blizzard also. So I think there's and they're just at the enterprise software level too. I think they're just more entrenched than any other company, and they have the ability to like what they did with Microsoft Teams. Product like Slack is taking over the market. They have the ability more than any other company, I think, to just roll out their own product and compete there and take market share, because so many companies are already using Microsoft products, so that's going to integrate well with the Microsoft platform. I also like the Satya Nadella and the CEO a lot. I don't, the CEO is a long-term fixture, or at least you can't count on them being around forever. But certainly a good reason to invest in a company like that. Procter and Gamble too. I mean, another I think has some similarities to Costco in a way as this company that the market has kind of agreed is, gets a premium. It's very recession proof, based on I think they have more than $20 billion brands. They have, Gillette razors, Crest toothpaste, Tide detergent. So, they really have a pretty strong market share. Everything you see at the drugstore, that section of the grocery store. And they've proven their ability to pass along higher prices, during this, inflationary era that we've had, or that, we were having a couple of years ago. And still innovating with new products, coming out with, new spin-offs and that sort of thing. So, I think they're another company that, they're never going to grow super fast, but they seem to be able to deliver, a couple points in volume growth, a couple points in sales growth, so you get, 5% sales, and then throw in some share buybacks and maybe, some margin expansion here and there, and it's a solid growth there. And then Berkshire Hathaway, pretty much I think Buffett's kind of built it to be bulletproof and really carry on for the long term. Brian, what you were saying about Kenvue earlier, the Johnson & Johnson spinoff, that reminded me of a kind of company that Buffett would buy, because it might be a slow growth business, but those are I think you have brands like Tylenol and Band-Aid, and it's well-known products that are probably high margin, and that I think part of the reason why Berkshire has done so well is Buffett has acquired those kind of businesses, and then rather than being forced to grow them as a lot of publicly traded companies do to grow the value of the stock, he just takes those profits and invests them elsewhere, buys stocks or grows the acquires new businesses, so that, and based on the track record, that's worked out pretty well. But obviously Berkshire Hathaway, very diversified company, and I think it's certainly has done well through previous market cycles, and I think Buffett has sort of operated like a value investor. He's been hoarding cash recently, and he's certainly capitalized on the financial crisis, and that sort of thing. So I wouldn't be surprised to I think he's always prepared for a rainy day. I think
So-
oh yeah, go ahead.
Go ahead. Yeah, I was just thinking of like comparing Procter and Gamble's their business model compared to Costco's business model, right? I mean, obviously different, because Procter Gamble isn't selling to pay to retail. They're not selling directly to people generally. So how do you think about the ability to increase margins in a Procter and Gamble business model compared to a Costco business model?
Yeah, I think Procter and Gamble tends to be a high margin business. They have in a lot of ways it's a different business model than Costco. They're investing in they spend a lot on advertising. They're investing in those brands. They're trying to differentiate themselves from maybe a Kirkland product, right? I don't, Costco private labels all those, so maybe they are working with the Procter and Gamble as well. But are you going to buy the Kirkland toilet paper? Are you going to buy Charmin or I think that might be Procter and Gamble's brand. but so that's where I mean, certainly their Procter and Gamble's marketing history and strength comes in. So I think they're constantly managing that brand reputation and the the balance between cost and price. Whereas Costco is, I think they want to keep, they know that the low profit margin for them is reflecting their strength in keeping prices down. I mean, that's why the company has been so committed to low prices for the rotisserie chicken or that hot dog deal. The one, I think 150 hot dog plus soda, because they know that will attract customers and keep that reputation as a low price provider around.
Yeah, so it feels like in the Costco example, the only real way to increase margins is beyond lowering expenditures, keeping your lowering the amount of people that you're paying, basically. I mean, is that you've got to increase the price of the membership, right? So if you're keeping the gross margins on the products approximately equal, then I mean, I guess if you get a higher volume, then you can generate more per unit store, and therefore there's some fixed costs there. So when it trickles to the bottom line, you've got better operating costs. But it feels, I don't know, it feels like Costco. I feel like mostly it's generating more revenue rather than increasing operating. I mean, that's going to increase operating margins compared to Procter and Gamble, where trying to get their brand being the best that it can be, and therefore creating more higher, allowing them to sell it for a higher cost, and therefore creating gross margins feels like the most ideal way for Procter and Gamble to grow. So Procter and Gamble gross margins, Costco revenue is increased, and then the fixed costs for everything underneath gross margins, the sales costs, the marketing costs, that sort of those costs are fixed per unit store. And so therefore, if we just increase our revenue, we'll increase our bottom line, versus Procter and Gamble is maybe try to increase the price of the item and the gross margins to generate the most operating bottom line growth.
Yeah, I think another point you remind me of, and Costco, famously has really no marketing, or no traditional marketing. I mean, you're not going to see a TV commercial for them, or a billboard or anything. So I think they see that as a way of saving the customer money and over on the end product. But they can still gain margin on fixed costs. I thought the one other point I wanted to make about this list, and maybe we can move on to some older questions, but I think it's interesting. I mean, I think to have a Enbridge and pipeline company, and then Exxon, and NextEra Energy. I mean, I agree that those companies are well entrenched leaders, but I do I wonder if a green energy company like NextEra, I don't think the oil and gas industry is going anywhere, in the short or even medium term, but I do wonder over maybe decades a horizon if we start to see some of that, or more of that consumption shift to renewable sources like NextEra. But just a closing thought on that.
Yeah, and then maybe, do you want to compare Procter and Gamble to Johnson & Johnson's spinoff Kenvue? I mean, I feel like Procter and Gamble sort of compete against generics and Kenvue competes against generics. But I feel like, I don't know. I feel like the quality is different. So less likely to buy a generic version of a Procter and Gamble product, like let's say a cereal that, I would see as inferior. The fact that, there's Tylenol and there's generic acetaminophen, and I'm never buying the Tylenol version. I'm always going to buy acetaminophen. Maybe, I mean, obviously there's some people do because they still sell it, right? So there's some percentage of people who buy that sort of, buy that branded product in the healthcare space. But maybe it's just because of my science background, and I believe that acetaminophen is acetaminophen, and I don't feel like there's any difference where I can taste the difference between, a generic cereal and a Procter and Gamble branded cereal. Even though it costs more, I feel like it tastes better. So I mean, I don't know. What are your thoughts there in terms of competition with generic, and how those might affect the bottom lines in terms of growth of their underlying price, and gross margins?
Yeah, that is an interesting point with something like acetaminophen. I think, I mean, I generally would just buy the generics. I'm probably still working through a 500 pill bottle from Costco, but yeah,
Not
I mean,
only do I have one,
sometimes
not only do I have an open one, I have one sitting in my pantry, my pantry of drugs in the bathroom of one that hasn't even been opened yet. So yeah, I feel you there.
Yeah, but yeah, I mean, some of those products I think is maybe just brand perception, or I don't know, maybe the placebo effect or something works for some customers. I have noticed. I mean, something I've tried a lot of different Band-Aids. A couple small kids in the house, and there's definitely some that don't work very well. So
Right. Yeah.
maybe that would make me more loyal to a name brand like Johnson and Johnson. But yeah, I mean, I think it's I guess it's the consumer kind of test the market and sees what works best for them.
Yeah.
Well, I thought this question was kind of interesting. From a couple hours ago, Besties asked, and maybe they were talking about AI a bit, but says, do you think AI will replace stock pickers and do better than the best of them, and services like the Motley Fool will disappear? I think the thing with AI or with investing generally is there's no formula for I mean the stock picking, or I mean I'm struggling to think of what's a good analog for it. I mean we've it's for a while, I guess we've had computers that were better than anybody at playing chess, for example. But that's really just an algorithmic kind of thing. I mean, I think investing has this kind of perpetual feedback loop too, where what's a good stock to buy one day might not be the same in a week or a month, depending on the price or other circumstances changing. There's competitive kind of feedback loop. Valuation. I mean, I think there's quantitative and qualitative factors that you have to consider. And even the best stock pickers, we're talking about Warren Buffett and Berkshire Hathaway. I mean, I think most, even those, the top, hedge fund managers and billionaire type investors. I mean, I think they're happy if they're, they get 55 out of 100, 55% of their bets right. So I mean, but and then the other issue you run into is if there's an AI that is a perfect stock picker, then if everybody follows them into that, then the price of that stock is just going to go up, and then that edge is lost. So I think in order for the market to function, you need a difference of opinion as well. And there's always I think there will always be some kind of edge or an opportunity for an edge out there. I I don't know, Brian, if you.
I mean, I have some thoughts on this. So one, I think it depends on what the AI is doing as is using as its underlying source. So if you take an language model AI and ask it for its best stock picks, it's not picking stocks. It's not making like an executive decision on what's the best stock. It's replying to you based on what other people have said are the best stocks, right? I mean, that's what the language model is doing. Is it's creating a answer to your question based on what it's been trained on, which is the language model of what other people have said are the best stocks. So all you're getting there is just the average of all the different opinions out there. You know, what are they saying? And then that's the AI is telling you what, you know, in a language model, that's what they're telling you what they think it's not thinking, right? It's that language model is not actually thinking, right? All it's doing is regurgitating information in a way that it figures out what word should come next. Right? That's what a language model AI is. It's what words could come next. So if I say, if the language model starts off with the sentence, the best stock for your investment is, then the next word has to be whatever anybody else has used with those words close by. And so therefore it thinks that that's the next word that should be used. Right? It's not actually like thinking what is the best stock. It's not going and analyzing the best stock. It's just saying, like, if the words the best stock is, and then the next word, it's whatever the next word that everybody else that it said that it had been trained on said. So basically you're just getting the average of the responses to that it was trained on. You're not actually getting any knowledge. You're just like, you could literally just go and look at every response that everybody has said about what they think is the best stock, and you could, you know, analyze it yourself, right? I mean, they could do it. The AI can do it faster than that, but ultimately it's no different than you just looking at a whole bunch of opinions and coming up with the average of the best opinions.
Yeah, that's a good point. I mean, I think in a lot of ways, right, AI's it seems smarter than it is, because it's really only as good as the information that it's trained on, which is
right. And then if we take something more not a language model, something that's trained on actual data, right? Then we're talking about, you know, whatever data is available right now, right? Which is, you know, let's ignore any opinions. It's only facts, right? Then all those facts are based on the past, right? You can't have facts based on the future, right? But the valuation, the growth, you know, the stock growth and the ability of a company to grow its stock price, you know, the likelihood of its stock price increasing is based on its future, not on its past, right? Nobody would say in 5 years, well, it grew in 2024 this amount, so therefore it should be worth this amount in 2030, right? So that doesn't tell you anything, except you can maybe find patterns of companies that, you know, where we had a history where they had this sort of characteristics in the past, and then they resulted in the future being, you know, growing this amount. So therefore this company also has those characteristics. So, you know, the AI's guess is that will grow in the future. But I don't know, that just feels like what we've been doing for the last 15, 20 years with humans. I mean, we've been doing that, right? Some of that is a lot of that's just stock screening, right? We've been doing stock screening for as long as I've been with the Motley Fool, for 25 years, right? So I don't really know how much different AI is than a human, right? You're either taking a language model and using it, and you're basically just getting the average result of everybody who's published that was trained, that language model was trained on, or you're using a set of historical facts and trying to guess the future of those companies, which is the same thing that analysts have been doing for the last, way before I started being an analyst. So I don't know. I mean, that was a long rant, but I feel like I just don't think AI is there. I mean, I think that maybe they'll be able to find some like minuscule thing that results in a slight bump in the ability of us to detect a potential improvement in growth of a company, right? Like there's a historical fact that says, okay, well, if that historical fact happens, there's a 0.2% potential for growth compared to the fact that it didn't happen. And maybe if you add up enough of those, maybe you can find something that's growth. But humans have been looking at that data for a century, and so all the high numbers, like if you didn't know anything about the stock market and then you were like handed historical charts and data, you would immediately say, oh, look at that. If a company is growing their revenue by a lot, they continue to grow their revenue by a lot and their stock goes up. Right? I mean, like if you didn't know anything about the stock market, that would be the first thing you would say. And that would create like so much potential growth in the stock, that's I mean, I'm talking about them, potentially creating 0.3, 0.2, 0.5% growth, where that's going to potentially, designate the fact that company might grow 20, 30%. So, it seems like very incremental gains.
Yeah. Yeah. Well, I agree with what you're saying. We did get a comment from Pro Shop guy who says that he says Renaissance Technologies Medallion Fund was computer generated portfolio that achieved an average annual return of approximately 66% from 1988 to 2018. So I've heard of that fund. I did not know that figure, but maybe we'll have to dig into that one. And
no, I mean, I think that maybe it proves my point, right? That was when computers weren't being used that much in analyzing companies, and therefore they were able to find those things that humans weren't able to find, right? And now those, now humans all know those things, and so therefore it's become a lot harder to find future gains from computers, would be my argument to counter that, right? That is 100% true, and also proves my point, is that now we all know all that information that fund was able to generate based on the computers, and now they're probably not going to be able to generate the same delta from a human to a computer that they were able to over that time frame.
Yeah, well, certainly, right. I mean, going back to 1988 with a computer-generated portfolio was a pretty novel thing to do back then, I would think.
Yeah.
But yeah, no, that is something. I mean, I would be curious to see how an AI, a AI stock picking agent or something like that, how it was operating, and maybe and its track record and that sort of thing. But I think I'll have to look into that Renaissance thing as well.
Yeah, I mean, I don't know, we've had screens for a long time. That's what I don't understand. Like we've had screens that have shown like back, that have used historical data to show that a future, that over this time frame, the historical data resulted in returns that outpaced the market, right? But that doesn't necessarily mean that it's going to happen in the future.
Yeah.
which is all AI can. It can't predict I mean, it can predict the future based on the past, but that doesn't mean that the past is going to result in the same thing that happened in the, the future is not going to necessarily going to result in the same thing that happened in the past. And we saw that, I don't know, I think like the dogs of the Dow, right? That one worked really well until it didn't, right? I mean, that's a good example of where, people I mean, that was pretty simple, right? It was just literally like, look at the Dow, companies in the Dow, which ones are the ones that have the highest dividend and have the lowest price or something, right? It was something like that. That's how the dogs of the Dow worked, right? And they figured out that if over time, over in the past, those stocks outperformed the rest of the market, or at least the Dow, I guess. And so, but that doesn't mean that it happens in the future. It just like those two, like, you can't predict the future based on I mean, you can predict the future based on the past, but that doesn't necessarily mean that it's gonna happen. So.
Yeah, right. You definitely can't just extrapolate with stocks. It would be nice if it was that easy, but right, just because something's gone up last year, it's definitely not a guarantee it's going to go up this year.
Yeah, I mean, and you can argue the more things that you bring in, the more higher likelihood of success you should potentially have, right? But I would argue the more things that you bring in, the lower the potential delta between what you would expect and what the average would be, right? I mean, there would be a lower delta. The more things you bring, the more, factors you bring into that historical data. Okay, I not only want a company in a Dow and a company that's high, that has low value, and a company that has a high a dividend yield, but also a company that has this, and a company has B, and a company has C, and a company that has E, F, G, H, I, J, K, L, M, N, O, P. Then if you get to that level, then now the delta is going to be lower, right? It's going to be, instead of being 10% to 12%, it's going to be 10% to 10.2%. And then how much benefit is that to the average person to be able to gain 0.2 percentage points of potential gain that may or may not actually come about.
Yeah, well, right. Along those lines, we got another detail from Pro Shop Guy here. Says 80% of daily stock activity is generated by computer-generated quant funds now. As a result, retail investors get to ride, watching daily price takers. So yeah, right. It's in some ways you could argue that gives an advantage to retail investors. We got a couple minutes left.
If we assume that they're right? So
yeah. We got a comment from No Noise. Says infrastructure natural monopolies like Class 1 railroads, Union Pacific, Canadian National, Norfolk Southern, Canadian Pacific, CSX. I think that's all those. And water utilities like American Water Works might be the most bulletproof stocks. I mean, yeah, I think certainly a company like Union Pacific. I mean, there are only 2 railroads in the western half of the U.S., which is a pretty large piece of land. It's Union Pacific and BNSF, which is owned by Berkshire Hathaway. You look. I mean, Union Pacific is not a stock you hear much about, and then if you ever look at its financial results, I mean, their operating margins are crazy. They're like 40%. They're one of the most profitable companies out there. So I think, I mean, yeah, if you're a railroad, I mean, I don't think if just a company like Union Pacific, I don't think you're gonna face new competition anytime soon. I certainly agree with that, and the need to ship things across the country, or fuel and raw materials, and everything else that gets carried on railroads certainly isn't going to disappear. Having said that, I do, and you could say the same thing with utilities. I mean, which is, even a regulated monopoly. I do think the trade-off with railroads is that it's, tends to be a slower growing industry, and you're at the mercy of the economic cycle there. If the economy is growing and demand is growing, those stocks tend to do pretty well. In a recession, they're likely to see a decline. But yeah, I mean, I think as businesses, I mean, Union Pacific, I think, is another one with, along with Procter and Gamble, one of the oldest publicly traded companies out there. I think it's, I mean, I think it goes back to the 1850s or 1860s or something, but to the early days of railroads. So, but yeah, definitely agree with no noise on that one.
Yeah, I mean, I think that, the problem with trying to get bulletproof stocks is that oftentimes you're going to trade off potential growth for the fact that you want a bulletproof stock, and you want a stock that doesn't want to go down, right? Or you want a stock that is less likely to go down. So the higher growth companies are more likely to go down than the lower growth companies. So therefore, if you're looking for bulletproof stocks, you're also looking for companies that are are probably growing at a slower rate than the higher growth, than the less bulletproof stocks that are growing at a higher growth rate. And then when you get to something like a monopoly, like a water company, then you're even more, regulated, and therefore less likely to grow, but also less likely to fall. So, you have to figure out what your needs are over the short term and what your needs are over the long term. And, maybe you want to buy some bulletproof stocks, but maybe you don't really care that much because your time horizon is 20 or 30 or 40 years, in which case does it make sense to buy something that's slow growing but won't fall, right? I mean, you might as well just at that point potentially just hold cash, and then as your high growth companies fall in valuation, then you buy into the high growth stocks on sale, rather than worry about trying to own bulletproof stocks. On the contrary, if you're already retired, then maybe it makes complete sense to own bulletproof stocks, and you don't really care if they're growing at, let's say less than 10% a year, because, hopefully that provides enough growth that it results in you being able to, sell whatever amount that you need to out of your portfolio to live off of each year. And you feel comfortable living off of it over the course of your lifetime. So.
Yeah. I mean, I think, I was going to say that there's a relationship there between growth and risk, right? I mean, growth in the stock market, usually have to take on some risk there, which but right. I think a bulletproof stock tends to be a low risk investment. While we're waiting for our next host to come on, can talk about Chipotle, this other stock I had up here, which I think is maybe to me, others might disagree, but I think it's a good example of a company that has some growth, but I think has a kind of business model where they've proven themselves, over the long term, I guess, maybe with the exception of that E. coli setback a few years ago, which I think is, sort of a black swan event. I mean, that is, that kind of stuff does happen in the restaurant industry, but, I think there's, with almost any company, there's always the potential for, something totally unseen to knock them off track. But yeah, I mean, I think Chipotle, 10 or 20 years ago, there was this idea that, there used to be other burrito chains that some people saw as competition. I think we had, Baja Fresh was one, Qdoba, Line Mexican Grill, and really I think those companies have all kind of fallen by the wayside, and Chipotle's kind of defined, I think, the fast casual category. They still have they have more than 3,000 locations. right now they were aiming for at least 7,000. I think they've made some smart moves too with incorporating. They never had a traditional drive-through, but the digital, the app ordering is enabled them to introduce what they call Chipotle, and so it's sort of an equivalent of a drive-through. You order on your phone and then pick it up that way. It's very profitable business as well. They're all company owned, which I like because it allows them to keep basically all the profits. So I think that you could probably throw a few other restaurant chains in that category as well. But I think for a company that kind of mixes some growth in there and it is expensive, sort of like I think for similar reasons to Costco, just that brand premium. But yeah, I think I think they have a pretty smooth path to growth in front of them.
Yeah, I mean, I agree with you there that like each individual company is, I don't know, it's sort of like an intuitive surgical, right? Where each individual like Da Vinci system is going to generate X number of dollars, whether the company, no matter what happens in the stock, in the economy, right? That they're just going to generate sales. And so, yes, they may have some slowdown in the placement of Da Vinci systems or the openings of Chipotle's. Generally speaking, the fact that they have this base of whatever, in this case, whether it's stores that are going to sell, burritos to people and bowls to people, or whether it's machines that doctors are going to use to do invasive surgeries on patients, that sort of base is a good way to look at bulletproof stocks. Anytime you have these sort of bulletproof stocks, this is, we're moving in the right direction in terms of having a level of security that even though they might not be growth, at least there's this level of, baseline security.
Yeah, I like that. I like what you're saying there with the razor blade model. It's
all right.
an
It looks like
interesting comparison.
Danny and Will are up, so we should probably get
Yeah.
out of here and not take up any more of their time now that they're ready to go.
All right. Good to see you guys.
Hey,
Good to
guys.
see you.
Well,
Thanks.
Thank you.
Will
All
and
right.
Danny.
Appreciate it, guys.
Have a good show.
All
Full
right,
on.
no problem. I'll let you take it away.
Well, welcome to another hour of Fool24. I'm your host, Will Healy. I'm joined today by Danny Vena. How are you doing, Danny?
I'm doing better now that the computer gremlins have been vanquished.
Yeah, that's always a problem. It's always a worry when your computer goes out right when you want to go on. So, but I'm glad that's fixed. Now we can proceed with our show on international fintechs. Yeah, I got this idea to do international fintechs when I saw Danny and Jayson's interview with Federico Sandler last week. Sandler had experience at both Mercado Libre and New Holdings, two stocks that we have to be able to be talking about today. So I suggested this to Danny, and I got my goons to rough him up a bit, and he agreed. But no, actually, the truth is that Danny readily agreed to this, and I think he's going to start us off with Mercado Libre. International fintech is different. I mean, I suppose it can include developed world companies that are located offshore, such as Adyen. But I think we're focusing more on developing world. In my opinion, anyway, developing world is a little bit more interesting because here in the developed world, everyone has a bank account, at least one bank account or excuse me, or credit card. And we have lots of options to pay, and so if a PayPal or a Block adds another option, I don't know that it changes our lives that much. I kind of learned that the hard way when Apple Pay suddenly came onto the scene, and I found myself using that just because it was convenient. Even though Apple isn't really focused on fintech per se, and you can't really invest in Apple effectively because of Apple Pay. That's nonetheless where my usage seemed to go. So I've been paying more attention to international fintechs, specifically in the developing world, because a place like Latin America or Southeast Asia, and Latin America specifically, it's not like you have community banks and regional banks and the national banks, you may, in a country like Brazil or Mexico, you may have a small handful of nationwide banks that don't serve wide swaths of their people. So a few years ago, there was about half this population that was just on cash, no bank accounts, no credit cards. If they wanted to buy something online, they had to turn to some of the financial products sold by Mercado Libre. But those were more workarounds, really, things like digital wallets or pay cards that allowed them to transact a certain amount online. It didn't really put them fully into the financial system. Now some of these companies are actually integrating some of these people into the financial system. So I think there's more investment opportunity when you're taking people from cash to being full-fledged members of the financial system. So, companies that we listed like Mercado Libre, New Holdings, C Limited, they're doing just that. So to start this off, I'm going to have Mercado Libre, or have Danny talk about what's probably his favorite company, Mercado Libre.
Well, while we're waiting for my slides to upload, it may be no surprise to you that, I would choose a company like Mercado Libre. And I echo your thoughts there a little bit, Will. One of the things that I have noticed is that when Apple Pay came about, and all of a sudden, everywhere that I went, I could just take out my phone and put it up there, and Apple Pay would just automatically pull in, my default credit card and pay with it. And switching cards is as easy as touch, and you're done. So I tend to use Apple Pay a lot when I'm out and about. Now, I also, I historically had used PayPal quite a lot. And the thing about PayPal is that if I go to a website that I have not ever used before, there's a lot of scams out there. A couple people I know just over the past month or so have complained that they went to a website, they made a purchase, and their product never arrived. When they communicated with customer service, they never heard back. And so, essentially they think their money's lost. But with a company like PayPal, PayPal will guarantee your purchase. So I like that. I like that. There's that security. There's also the convenience. If I go to a website I haven't used before, I can click on PayPal. PayPal fills in all of the pertinent information: name, address, zip code. Uses my default payment method, and we're there. It looks like for some reason my slides are not actually loading into the Fool24 system right now. Oh, wait a minute. Looks like they just showed up. So maybe
here we go.
Those.
Perfect.
Outstanding. So I first wanted to, just cover, paint kind of the broad picture here by going over Mercado Libre's most recent results. They had revenue of just over $6 billion. It was up 37% year over year. But one of the things that I want to point out to our viewers is that, the up 37% year over year in US dollar, that metric is essentially useless to us as investors. It's required by the Securities and Exchange Commission because Mercado Libre files its financials in the United States. However, in Brazil, they make their money in Brazilian currency and they plow it back into their Brazilian business. In Argentina, they get paid in Argentinian currency and it goes back into the business. They will occasionally move money from one market to another. If they're trying to build up a newer market, they might take money out of, say, the Brazilian business to fund infrastructure expansion in the Mexico business, for instance. But they never really exchange any of their currency for US dollars, other than I recently learned to pay taxes in the United States. So the important number to me is the fact that revenue growth is up 96% in local currencies, which is much more telling than the 37% increase in dollars because of foreign exchange headwinds. Their operating income in local currencies is up 145%. Net income and earnings per share both up 288% in local currencies, which is impressive considering 96% revenue growth, 288% earnings per share growth. And that is because their net revenue in their commerce business, their e-commerce business, more than doubled, and their fintech revenue nearly doubled. So that's kind of the broader strokes. Now, some of the key metrics that kind of feed the business, and I included the commerce business in here as well, because that commerce business is the funnel that fuels the growth in their fintech business. So they had unique buyers that grew to 100 million, up 18%, gross merchandise volume up 15%, items sold up 27%. And they're also increasing the number of same day and next day shipments, akin to what Amazon Prime members get. But the fintech numbers are what we're talking about here. They currently have 61 million fintech monthly active users. Now, this isn't just people who buy stuff on their website, although they're included there, but this is also people who, people who use their digital wallet, people who avail themselves of their credit card, people who maybe buy or sell cryptocurrencies on their platform. So 61 million of those, the total payment volume for those payments, $197 billion, not million, billion. And they had 11.4 billion payment transactions. That's a huge number, and that kind of gives you an idea of why their fintech is so ingrained in their customer base. They recently have been expanding their credit portfolio. And it's worth noting that within their credit portfolio, they have the credit card. They also have consumer loans and merchant loans. That total credit portfolio is about 6.6 billion, which is up 74% year over year. Now, one of the things that's important to understand about the market in Latin America is that there are a lot of unbanked and underbanked consumers and businesses there. If you are a small to medium-sized enterprise, an SME in Latin America, it's probably extremely difficult for you to get a bank loan simply because the banks are very picky, and they have very specific rules about who they will lend to. Mercado Libre, on the other hand, has a much more specific algorithm, and it uses many more data points when deciding whether or not a merchant or a consumer is creditworthy. The other thing that's helpful to note is that in Latin America, the spread between what they pay you for interest in an interest-bearing account and what consumers are charged to borrow money is much wider than what it is in the United States. As a result of that, if you look at their net interest margin after losses, and losses meaning loans that didn't get paid back, they have a 28% margin. And that is attributed to their well-performing risk model performance. So when you're talking about fintech, Mercado Libre has several advantages. Again, their e-commerce business acts as a funnel to their fintech. Mercado Pago, which is their payments business, has been around for 2 decades. So any other Johnny come lately fintech business in Latin America is going up against the entrenched big dog. All of the merchants, if you walk into a store, you can pay with Mercado Pago. You can pay your energy bill with Mercado Pago. Most consumers pay their cell phone bills with Mercado Pago. So they are essentially everywhere in the Latin American markets where they do business. And they have done a remarkable job at now expanding beyond that Mercado Pago payments business into the digital wallet, into the credit portfolio, into merchant transactions. They offer, they have point of sale terminals in many of the stores in Latin America, as an example. So they are both in the merchant side of the house and in the consumer side of the house. And that gives them, a really solid foundation from which to expand their business going forward. And that's one of the reasons that I am really impressed by, and I really like Mercado Libre in the international fintech space.
Yeah, I wanted you to start with Mercado Libre because they really started this in Latin America, and I know you're a longtime investor. Like I said, you had that interview with Federico Sandler, who used to work for both Mercado Libre and New Holdings. I recommend if you're interested in this topic to go check that out because it was a great interview. I guess moving on, I was saying that Mercado Libre came out with some products. A lot of those were workarounds. I think that's kind of changing as they, fully bring more people directly into the financial system. But one company that's already doing that is New Holdings. For those of you who don't know New Holdings, it's the largest digital bank. It's the third largest in the world. It's the largest bank outside of Asia. Here's the slide. And it's been growing at a very rapid pace. Like I was saying, but before companies like New Holdings, there was only a few banks in each of these countries, and like Danny said, excuse me, they had very strict lending standards, and they frankly left a huge part of the population outside the financial system. Well, in Brazil alone, where Brazil is where most of New's current customers are, they've given 21 million Brazilians their first credit card. So, rather than having to rely on pay cards, they could actually fully participate in the financial system. And I think that's huge. That's really, I think it's kind of life-changing, frankly, for some of these residents who previously didn't have access to credit. So this is huge. Huge. And as you can see, the company's been growing very quickly. Revenue was up 43%. Net income up 91%. Revenue is going to slow down a bit in 2025, but it's still 29%. So still a very rapidly growing company. Like I said, almost all of their, well, not almost all, but the vast majority of their customers are in Brazil, where this company started. They have 114 million customers. 102 million are in Brazil, and that's 58% of the adult population in that country. So they've really established a huge presence in Brazil. But 58%, you're starting to get to where you're going to get saturated in the foreseeable future. A new responded to that by moving into Mexico and Colombia, and now they have about 10 million customers in Mexico, about 2.5 million in Colombia. They are planning to expand it into a different country. They haven't said which country that is yet, but I'm very interested to find out. I mean, Federico Sandler was actually implying that they could serve some customers in the United States. I don't know if that's going to happen or not, but we'll see. So the PE ratio is only about 30, with the forward PE being 22. I own the stock, by the way, as I do Mercado Libre and C. But looking at this valuation, I think this is extremely cheap, considering especially that their net income grew 91%. I think 30 times earnings for 91% growth is a big deal. We had a question from Luna Negra. Thoughts on New's lack of significant stock appreciation given their performance since 2021? That's a very good question. I think that's due primarily to the fact that they're in Brazil, mostly. Brazil is a country with a lot of problems right now, mostly on the political side. Their government is so heavily in debt that it's made investors nervous about their economy. So I was just looking at StoneCo, which is another Brazilian fintech last week, and they're growing, I think, at the 20% or so rate, a little bit up above 20% revenue growth. Yet their PE ratio is only 8. So I think just investors are very down on Brazil right now. And then there's some political problems that seem reminiscent of the problems we've had in our own country. But I won't go into that. But I think, yeah, some of those political and economic problems may be holding it back. I think if they could calm investors, maybe get some of these problems under control, I think a stock like New Holdings will shoot much higher. But yeah, 30 times earnings, I think, is way too low for a stock growing as fast as New Holdings is. So concerns, like I said, the slowing revenue growth. They've had some rising credit losses too. Right? Now, because there's giving new customers that have never had access to credit before. A lot of this is a higher risk group by and large. So just because they're growing so fast, the credit losses have grown along with it. That's a little bit concerning, but it hasn't. As you can see, they still earned a significant profit despite that. So yeah, the guidance was a little disappointing, just I think because of some of those problems and competition. For example, I just said that New Holdings is in Mexico. I think Mercado Libre, and Danny can speak to this if I'm misspeaking, but I think they plan to open a bank in Mexico, which would go head to head with New Holdings. So, before Mercado Libre and New Holdings really had not been competitors for the most part, but if this Mexican bank comes about, that's going to start to change that. So, I think that one's been very interesting for many reasons. Another one I've been following, and this one is outside of Latin America. One called C Limited, and like I said, I wanted to get Danny to go first when he did this, because C Limited is kind of operating on this off the same model that Mercado Libre did. It is even though it's based in Singapore, which is a developed country, that's only about 6 million of a potential customer base of nearly 700 million in their core region of Southeast Asia. So, like Mercado Libre, it's not just fintech. That they also have an e-commerce arm. They started off as a gaming company too, and so that's also affected the company and the stock. This is sort of on the comeback trail though, because the fintech segment of C Limited has always been fairly strong. So I believe they're the leader, at least in their region, in terms of fintech. They're also a leader in e-commerce. However, they early about the time of the pandemic, they decided they wanted to go worldwide. So they went into countries like Brazil, France, and Spain, Poland. Well, their European operations and most of their Latin American operations, I think they also tried to go into Mexico. They were shut down within months because they were such they failed so they were huge failures. Let's just say that, because and I think it's because they just they couldn't compete with the Mercado Libre or the leading e-commerce companies of Europe. They didn't have that competitive advantage like they had in their home region of Southeast Asia. And then gaming had declined too, because a lot of people were playing games during the pandemic to pass the time. Well, that kind of reversed when they had to go back to work and live their offline lives. And plus, C Limited has the #1 mobile game. It's called Free Fire. Free Fire got banned in India, and India is a country of 1.4 billion people. They say that Free Fire is going to come back to that country any time now, but despite months, maybe almost years of promises, that hasn't happened quite yet. I think it will eventually, but I think they're stuck in a lot of bureaucracy there. But despite that, they've been able to revive the gaming. As you can see, it was down 14% for the year, but it also grew by 2% in the fourth quarter. So I think a lot of people were down on the stock because of gaming, but I think now that it's on the growth mode again, I think that's caused the stock to grow. And as you can see, it's more than doubled just over the last year. So huge performance over and above the S&P 500. As you can see here, Free Fire is again the most downloaded mobile game. It wasn't for a number of years, but now it's back to #1. They've really been good about balancing growth across segments. I said that payments was always their consistent segment. That's been their fastest grower overall. I think e-commerce maybe slightly outperformed the payments part, which is called C money, by the way. But yeah, it's been the more solid part of the company. And then the Shopee, like Amazon and Mercado Libre before them, are finally investing in logistics in their home region. So I think they're going to be a great regional e-commerce company, maybe not such a great worldwide one. Of those non-Southeast Asian markets, they still have Brazil, but I think, like I said, they pretty much pulled out of the others. I'm not sure why Brazil is fascinating, because I wouldn't think they have a competitive advantage, but they are there nonetheless. So that's something to keep in mind. But yeah, they just turned profitable in recent quarters, so their PE ratio is still high. But looking at their forward PE ratio, it's down to 34. So I think when you're getting net income growth of 175%, 34 PE is a little bit low. Now that 175% income growth is not sustainable. That's going to come down over time. But even with it coming down, I still think 34 times forward earnings is a great deal for the stock, despite the increase. During the pandemic, like a lot of stocks, C Limited had a huge run up. I think it got up to almost, I think it surpassed $370 a share at one point in 2021. It's in the 120s right now, so it's still down about 2/3 from its all-time pandemic high. So I think despite the gains you're seeing here, there's still time to get into the stock. I mean, there's a few problems. There's that long wait to get that Free Fire back to India. I think they're going to have competitive pressures, particularly in Brazil, where they don't really have a competitive advantage. But overall, I like the space. And like I said, fintech, even though it's not, I guess the majority of its revenue does come from outside of fintech. But I think this has been the most consistent division within C Limited. And I think it will continue to drive this company in the future.
So we've got a question that our own ProShop guy popped in the queue here. It was from Besties about 3 days ago. Mercado Libre is going more and more into fintech and financing. Is it a competitor for new holdings? Actually, somebody asked this question when Federico Sandler and I had the interview last week. And essentially the answer is there is some overlap in the services that they provide, but not very much. He also pointed out that, in Latin America, you have a population of about 660 million people, which is nearly twice that of the United States. And so since fintech is such a, well, let me back up for just a second. Mercado Libre introduced Mercado Pago 2 decades ago. So in Latin America, Mercado Pago is the original fintech. Now, there have been a lot of new companies going into fintech. What Mercado Pago does is it's expanding into offering more services for its existing payments customers, like digital wallet and financing. So yes, there's a small amount of overlap, but not very much, according to Mr. Sandler, who is the resident expert on all things Latin America. I don't think there's an issue, particularly when you're talking a population of that many people that are unbanked or underbanked. So there is enough room for there to be, more than one player in that sandbox, as it were. The other question that came up was from No Noise about 5 minutes ago. Have you been following the Argentina peso's inflation and poverty rates following, I hope I'm pronouncing this right, MELI's election in 2023? Mercado Libre's Mexico prospects look more promising. The issue with inflation and hyperinflation in Latin America is actually one that has been there for the entire time that Mercado Libre has been operating in the region. And the reason why Mercado Libre has not been adversely affected by that inflation is because they operate what's called a take rate business. So every time something is sold on their platform, they take a piece of that. Every time there is a payment made using Mercado Pago, they get a piece of that. So that when the inflation rate goes up, that is reflected in their take rate, in the amount of money that they get paid, as a percentage of the sale or a percentage of the payment. So when poverty goes up, not poverty, but when inflation goes up, Mercado Libre's take rate actually goes up with it. And so the amount of money that they get is reflected in that. This is something that we've known about for 2 decades. Mercado Libre was actually recommended by, rule bakers back in 2009. And what's interesting about it is if you go back and look, now, this was the case about a week ago when I looked, and it's probably still the case now. Mercado Libre is the #1 performing stock across the entire rule breakers service for its entire history. And there's been hyperinflation in Latin America for that entire time. So I hope that, gives you a little bit of comfort knowing that this is a company that is well qualified to deal with commerce and payments services, even in a hyperinflationary environment. And I agree with you. I think Mercado Libre has plenty of runway in Mexico. They've only just really started expanding into that market over the past couple of years. So I think that there's a long runway of growth ahead in that market.
Yeah, and I know Mexico has a bad reputation when you hear the news. You hear about cartels, but despite that, it's actually a fairly vibrant business environment, and inflation really hasn't been a huge problem there for decades. Really, it has been a bigger problem in Argentina. Maybe they're getting control of it right now, but I think it's less of a problem for Mercado Libre because a few years. Mercado Libre started off in Buenos Aires, and they were having some conflicts with the tax authorities, and I think that probably is the biggest reason why their headquarters is now in Uruguay. So they moved to kind of get away from that. But as Denny implied, Mercado Libre has really thrived on Latin America's troubles. Hyperinflation. We'll use Mercado Fondo to help you invest to mitigate the effects of that inflation. Or you can't ship your goods because the infrastructure's not where it needs to be. Mercado Envios, which is part of Mercado Libre, has helped both merchants and others ship goods despite that. So I mean, it seems like the more trouble Latin America has, the more Mercado Libre has been able to thrive because of that. So that's one reason why it's been so successful. As for No Noise's other question, I saw it early, but I wanted to talk about all 3 companies before I answered it because I didn't want to think about it a little bit, quite frankly, because it's not that easy a decision. No Noise asked, Will, of the 3 C Limited, Mercado Libre, and New Holdings, which is your highest conviction and lowest conviction for the next 5 years? I'm actually kind of struggling with that, to be quite honest. Like I said, I own all 3 of these stocks. Highest conviction, I probably have to give the edge to C Limited, just because maybe on the valuation from a valuation standpoint, and they're coming back from a lot of terrible decisions that they made. Like I said, going into all those markets they shouldn't have, and the decline in the gaming business for what was years. So they're kind of on the comeback trail right now. So I'd probably give a slight edge to C Limited. Again, I would not jump on you if you were to if you took any of these 3 stocks and decided to buy them. I think all of them will beat the market. As for I don't know what to say about the worst. I mean, I guess new holdings because it's in the least amount of countries, and because it's so heavily in Brazil, it has it's not as diversified. But again, I'm not down on new holdings. But yeah, of the 3, I would probably if I had to, if you held a gun to my head, say this has to be lowest conviction, I'm probably going to go new holdings because of their extreme exposure to Brazil. So
I would say, I'll go ahead and chime in here too. Of the three, probably no surprise to anybody who knows me. I would rank Mercado Libre my highest conviction of these three companies, and primarily because not only does it have a large addressable market, but it's also expanding its services. So while New Holding is essentially an internet bank that doesn't have any branches, so they have a fair advantage over the existing banks. Mercado Libre has its payment services, it has its credit, it has its digital wallet, it's got its e-commerce. It's expanding into a number of different areas, and it's also located in those 18 geographic areas in those countries in Latin America. So it's less limited by its geography. It has a larger total addressable consumer market. And it's also working both sides of both the consumer market and the merchant market. So that's why I would put Mercado Libre at number one. Between the two, I don't know, maybe Federico Sandler has rubbed off on me a little bit. I'm kind of torn between C Limited and New Holdings, but I think the fact that New Holdings has the opportunity, it's going up against the legacy banks that have physical branches. And as a result of that, it can offer much more competitive rates. Just like internet banks in the United States can offer much more competitive, rates on savings accounts than can the legacy bank branches. I know that I have a checking account with a legacy bank branch. I won't mention its name. And I get paid, I think most recently it was less than 1%. I think it was more like 1/4 of 1% on my account there. Whereas I have a internet account with Ally Bank, and they pay my account's earning about 4.25%. So there's a wide disparity there. And given that New is in a similar situation in Latin America, I'm going to give the edge to New Holdings. I think C Limited has a vast opportunity in its market. But again, I think it is more geography constrained than perhaps Mercado Libre is. And I am impressed, though, by the fact that they have three different prongs, three different stools, legs on its growth stool. So what you're talking is about, they have the ability to grow in their e-commerce, which is a growing market in Southeast Asia. They can grow in their fintech, which is a growth market in Southeast Asia. And they are also, get a lot of network effect from this Free Fire game and their other, gaming offerings, mobile game offerings. So I do not own New Holdings, although it's one I've looked at. I do own Mercado Libre and C Limited. And of those, I think Mercado Libre is the clear favorite, at least for me.
Yeah, the only reason I'm disagreeing with you is valuation, basically, because everything that Danny says about Mercado Libre is correct. It is kind of factored into the stock a bit. I think, in my opinion, more so than C Limited. That's why I gave the edge. But like I said, everything Danny's saying is correct. Moving on to other questions. I saw one that from Pro Shop Guy that was interesting. U.S. fintechs rely on U.S. banks to operate, and that is true. If a fintech wants to make loans, assuming they don't have a banking charter, like say a SoFi or a Block, they have to partner with the bank in order to make loans. So incidentally, in Brazil, you don't have to worry about that. That is one advantage. And yet, U.S. banks are regulated by the FDIC. how do you research bank regulations for Latin America to understand risk? That's kind of difficult. Like I said, I found that fact about Brazil by doing some research. I mean, a lot of these, it's possible the central bank of the country or the UN might do a study. I think that's, like I said, I think that's where I found that tidbit of information. But yeah, you have to go to kind of academic type studies, I think, to really learn anything about the regulations. And even if you do find it, it's probably going to be in Portuguese or Spanish too. So you'll need a translator or some knowledge of the language. But yeah, I think if you're going to find anything, it's going to be in academic studies, in my opinion.
So we've got a question from Sergey from about 9 minutes ago. Your thoughts on StoneCo, ticker STNE. It's also a fintech in Brazil. If I'm not mistaken, Warren Buffett took a position in it a couple of years ago and then sold it. Just to clarify, I don't think it was Warren Buffett himself that took a position in this. It was probably one of his lieutenants, Ted or Todd, who actually made the purchase. And I do not believe that they hold the stake in that company anymore. StoneCo is, they are more of a fintech that provides payment solutions and banking services and credit facilities that are focused on small and medium-sized businesses in Brazil. So again, this is another company that has a small amount of overlap in the services that Mercado Libre is providing. But again, this is one country. StoneCo, in my opinion, kind of the newer kid on the block. They offer payment solutions, point of sale terminals, e-commerce gateways, mobile payments, digital banking and credit solutions. But again, most of this is to their, to the small and medium-sized businesses, and only in the country of Brazil. And to a point that one of our other viewers made, said, why would you buy new holdings if you already own C Limited and Mercado Libre? Too many fintechs. The problem is the new shiny toy that hits the market. And I already have my largest positions. I think Mercado Libre is ranked number 3 right now, behind Netflix and Nvidia. And it has grown that way over the years. I invested in the company numerous times in the early days, and it has done remarkably well. And to your point, the reason why I haven't added to a number of these other companies, New Holdings is one, StoneCo is another one, is because I already have Mercado Libre. That gives me Latin American exposure. It gives me fintech exposure. It gives me e-commerce exposure in an area of the world that I might otherwise ignore. And since it makes up about 10% of my portfolio already, trying to find the next Mercado Libre, why would I do that when I already have Mercado Libre, which in my opinion could well be the next Mercado Libre anyway? So yeah, your point is well taken. StoneCo went public at a really tough time for the company. It was, I think we were just heading into, some of the, it was either just before the pandemic or just before the economic downturn. I'm not sure which, to be honest.
I think it was just before the pandemic. It had a huge run up. Then they got caught in the bear market. They also made a lot of bad loans that really hammered them, and that basically wiped out all the gains. I'm not sure that Berkshire made any money on the stock in the end. And then they changed their CEO, and they're kind of on a growth path again. If you feel like you want to take a bigger risk, I mean, I wouldn't discourage you from buying StoneCo as a speculative stock because, like I said, I think it might lead in the niche of small and medium sized businesses. Or at least in Brazil. Not sure about that, but it's very competitive there. It's growing at 20+% revenue per year. It's under 10 times earnings. So it is extremely cheap. Like I said, if people start feeling better about Brazil's economy, I think that one will take off. I think as for the question that Danny answered about New, C Limited, and Mercado Libre, I think it was directed at me. So I'll answer that because it is a good question. Well, basically because I'm dealing with different markets. I own both Mercado Libre and New because Mercado Libre is a more diversified business. I think, as Danny said, fintech now maybe its biggest part. I think when I bought it though, e-commerce was its biggest part. And I also kind of saw Mercado Libre's financial products as workarounds more than something that would bring you into the financial system. I like New because it actually gave people their first credit card or sometimes their first bank account. I thought that was the transformation that Latin America needed. Now, I think Mercado Libre is seeing that now and starting to open banks. So I think they're bringing more people directly into the financial system now. But that's why I own both of those. And I think they're going to beat the market, so I'm probably going to hold them. And C Limited is simply a different region, and because they made some bad decisions and their stock fell by 90%, I also saw there was a valuation opportunity, and that's why I'm also in C Limited. So,
we
Ed,
have a question. Oh, sorry.
Oh, go ahead if you.
I was going to say, there's a question from Sadaf from about 26 minutes ago that I wanted to address. And I'm actually looking right now on the company's annual report to see. Sadaf said, I believe Mercado Libre also allows its users to invest in a few index funds. Does it have any negative impact if index funds perform negatively? I guess it does not. I have looked and I don't recall Mercado Libre being able to offer any brokerage services. And I have searched on their annual report for brokerage, and I didn't find anything in their 10K. I'm also looking for index funds, and I don't see any. I don't see anything in the 11 instances of the word index appearing in their annual report. So I do not believe, I could be mistaken, but to the best of my knowledge, Mercado Libre does not offer the ability to invest in index funds. Now, maybe this is an area that they are considering moving into. It's not something that I have any knowledge of. So I will just say, to the best of my knowledge, no, they do not offer their users access to index funds. I do know they do allow access for their users to certain cryptocurrencies that they allow to be traded on their platform. And much like how if you are a PayPal user, you can buy Bitcoin on PayPal's platform, similar to that. So I know they have access to cryptocurrencies. I am not aware of any access to index funds.
So Ed had a question about 6 minutes ago. SoFi, symbol SOFI, or New, which is the better of the two? Well, I have owned both at one point. I still own New, and I think I went with New because I think there was more opportunity there. And so SoFi is fascinating because it has had a lot of success as a digital bank. It's growing, and it is growing very fast. But yeah, I think there's a lot of competition. I think there's less competition with New, and like I said, I think more expansion opportunities. So, in my opinion, New Holdings is the better of the two here.
Yeah, I don't own either one. I don't believe. I think I considered SoFi at one point. I'm going to go back and check my holdings before I, tell a fib, because I do own somewhere in the neighborhood of 80 stocks, and I don't always remember the smaller positions that I bought years ago. Let's see, SoFi. Actually, I do still own a small amount of SoFi, to the tune of about 0.5% of my portfolio. So just a very, very small position, one that I invested in so I could keep an eye on the company. And the fact that I have not added to it since I bought it years ago kind of tells you how I feel about SoFi's opportunities. I agree with Will. There are a lot of fintechs in the United States. There are a lot of digital banks in the United States. And I think there's a much greater opportunity in the international market because for instance, if you look at Latin America, they are 5 to 10 years behind the United States in terms of e-commerce adoption. They are at least 5 to 10 years behind the United States in terms of credit card and checking account adoption. They are 5 to 10 years behind the United States in terms of fintech adoption. And they have twice the population. So that's kind of where the opportunity is, in my opinion, because they have so much greater of a market and so many areas, ancillary services that they can expand into. We talked about they started off as a payment method, and now they are, providing merchant payment services. Excuse me. And consumer loans and merchant loans, and cryptocurrency. And so by expanding gradually into these ancillary areas and expanding their platform of services, that gives Mercado Libre a lot more area, much greater total addressable market, let's say, than I think either of these other two.
So about 3 hours ago, this is not exactly fintech, but it is finance related, so I'll touch on it. Let It Ride asked, how do you analyze a company's debt to understand the risk in a higher rate environment? Well, I guess the short answer is if you look at the 10Q or the 10K, they'll list the various various debts they have and what interest rate they're at. That's I know it's a little bit of work to go into those SEC forms, but that usually will spell out what the debt is. And when it comes to company debt, if it's a third or less of the stockholders' equity, I usually don't even worry about it because. But if it's higher than that, I will look at the debt. How much debt they have. Most balance sheets will have long-term debt and short-term debt spelled out. Occasionally, you'll have to dig further, but most of them will tell you that. But if it's near or above the shareholders' equity, that will be that'll be a prompt to me to go in and look into the 10K and see, or the 10Q sometimes, and look at and see what debts they have and what interest rates. If they're much higher than the market rates, that is a source of concern for me. If they're very low, like I think the debt say a Microsoft has, I'm a lot less worried about that because Microsoft has a lot of cash anyway. I think they invested in debt because they felt they could get a higher return on the money than the interest was costing them back when we had rock bottom interest rates. So usually it's the SEC forms that will tell you, spell out what the debts are for a given company.
So I saw a question that maybe falls outside the realm of most of our expertise, but having done so here in the past few years, Happy Fool from 9 hours ago, ways to reduce capital gains selling your house if you're not repurchasing again. I know you can do some home improvements, other places to put money temporarily. What I will say is that it is the IRS allows you up to $250,000 in capital gains tax-free if you are single, and $500,000 in capital gains if you are married filing a joint return. Now, you can only use this exemption once every couple of years. And any improvements that you made on the house, you can use that to offset, some additional capital gains. Now, one thing that I would caution is that, if this is a position that you are in, I would definitely seek advice from someone who is a tax authority, perhaps before, you make that sale, because they can, help you with that, help you gather the documentation that you need. But again, you can only do this. You have to live in the house for 2 years out of the past 5 years. And it's only on your principal residence. So it doesn't apply to any rental properties.
Okay, well, I think we're at the top of the hour right now. Danny, it was a pleasure doing this topic with you. Maybe we'll do it again in the future.
I always find any excuse is a good one for me to talk about Mercado Libre, one of my favorite companies. And it's always a pleasure sharing the stage with you, Will.
Likewise. Okay, and now it'll be Jose and Neil for the bold prediction show. Take it away, guys.
Thank you, Danny. Thank you, Will.
Thank you both.
Hey, Neil, how's it going?
It's going well. It's going well. Long day. Yeah. It's midnight here, but fun episodes. How about you? How's your day going?
Pretty good. And first, good evening to all the fools watching. This is the final hour of Fool24. And for this final hour, we are, I think this is the kind of second week we're doing this of bold predictions. And for those that first time watching, Neil and I, we're going to make some extreme predictions in some of the companies that we find within some timeline. And throughout the episode, we're going to discuss why we believe that. We're going to go a quick back and forth. Members, if you have any thoughts on these predictions, make sure to send your thoughts or questions on Slido, maybe trying to agree or disagree with the predictions that we're making. A quick point, obviously we can't really see the future. So these are just predictions, but shouldn't be taken as personal advice. So yeah, Neil, I've done this show a few times. This is your first time here. So I'm actually gonna let you go first. So what is the first wild prediction that you have for us?
Okay, so I start with the wildest one, which is I think Elon Musk will step down as Tesla CEO in the next 5 years, which means up until 2030, I think Elon Musk will step down as CEO of Tesla. In my mind, it makes sense because by 2030, I would assume that most of the roadmap is done. So autonomous vehicles, robotaxi network, that's already scaled up by 2030. Humanoid robots, so Optimus, also ramped up in the next 5 years. Of course, I hope Tesla Semi is launched already. Should be launched later this year, but by 2030, I think Tesla could be an autonomous company, meaning I don't think it will really matter much if he's CEO or not by then. Today, although I don't think he spends that much time anymore at Tesla, he didn't really spend that much time. Well, he said he spends his majority of the time at Tesla before Doge, but remember, he still had SpaceX, Neuralink, Boring Company, X, and now XAI, and Doge. So 5 years from now, stepping down as Tesla CEO, probably still a member of the board and something like that. But by 2030, in my mind, Tesla is already super big. You have a robo-taxi network. You have the robots ramping up, maybe already working at the company. Energy side of the business is worth way more than it is today. and he will probably focus more on SpaceX and the Mars mission. That's my prediction. Next 5 years doesn't mean 2030. Could mean next 2 years, next 3 years.
So Neil, I have two questions here. First, you kind of mentioned that you hope by 2030, kind of the roadmap is done for Tesla. But wouldn't you say that with technology always innovating, and Tesla not being seen as just a car company, right? It's a AI company. It's an innovative company. Wouldn't some new roadmap come up to kind of keep them there, keep them grounded, and keep them kind of focusing on what's the next new solution for Tesla?
Yeah, no, probably. But that doesn't mean he needs to be CEO. He could be chief engineer, just like at SpaceX. So yeah, by then, a new CEO, maybe a CEO that is more Wall Street focused, could happen. Because like I said, I think by 2030, most of the huge changes would have already been made. So humanoid robots, robotaxi network, and all of that, I think those are huge changes. I think he still needs to be CEO for that. Once we're over that hurdle, could be stepping down as CEO, still a chief engineer or whatever title. Don't really think he cares that much about the titles, but I see him focusing more on the Mars mission than being CEO of Tesla as a publicly traded company.
And just a quick reminder to the fools, feel free to go, make sure to go to Slido. We have the poll up running right now. It will be closed in a few minutes. Neil, if you haven't voted, make sure to also go vote as well. A question here, Neil. So one, I do like this thought. For some reason, when you meant kind of step down as CEO, I just thought of removing completely from Tesla, but I do like that kind of movement from outside of CEO, maybe kind of going from chief engineer, CTO, or whatever. Now, how do you think the stock price would react to something like that? Especially if let's go with the two different scenarios, one where he becomes like the chief engineer, the CTO, and one where he says, you know what, Tesla, you are in the right path. And a quick follow-up to that is, do you think there would be signs of that transition happening? And what are some of the signs you'll be looking for?
Yeah, so let's go back, let's say a year, maybe 2 years. If he would have stepped down 2 years ago, stock would have been down quite a lot. I think, like step down, board seat, Tesla would have been down a lot. Today, I think if he steps down, the stock might be up a little bit because of the whole political circus that's going on right now. So there is that. By then, let's say 2030, I think the stock does not react. Because by then, like you said, I think there would have been signs, and even today already, you see a couple of Tesla executives popping up on YouTube videos, podcasts, showing off the car, talking about a couple of things about Tesla, which is something that didn't really happen that much before. So maybe there's a shift there. Although I don't know if many investors know, but Tesla does only the 4 quarterly reports, earnings calls, no investor conferences throughout the year. Yes, there is that investor day or maybe sometime a battery day or whatnot, but no traditional analyst conferences like we've seen with plenty of other companies, which again might change in the future. It's not something that they're doing right now. So yeah, those are the scenarios in my head.
Thank you for that, Neil. And I think the results are about to close in a few seconds. So make sure to get your final answers in. And Neil, this is actually the first time I've seen this. Normally it kind of leans to one way or another. But as of right now, we have 45% agree with you, Neil, where they believe that Elon will step down because he has too many things. 45 also disagree with that they believe Elon will continue as he likes the challenge, and about 9% say they don't have enough information to make the decision right now. So we've done a few of these shows. I think this is the first time that it was that close neck to neck. So I wonder if you're going to get an award after this, Neil.
Yeah, you see, my first time popping up, and look at the results, making big changes here.
All right, Neil. So I'm gonna go with my predictions, and I'm gonna start with the first one, and it's not gonna be as I don't think I can get as wild as what you just did, Neil. But let me start off with something simple. So I believe that Nintendo will enter ventures in augmented reality and virtual reality to enter the mainstream gaming by late 2028. And I really want to focus more on both these concepts, because Nintendo with the Pokemon Go, you can kind of say that Pokemon Go was kind of like the real mainstream to augmented reality. But we really haven't seen too many more of games like that come out in to that type of level, to the mainstream game. I believe as AI, as technology continues to innovate, as Nintendo becomes more open to licensing its products. And I think that's something that we're seeing Nintendo do a lot more recently, where they feel they are liking that ability to license their product. We've seen it with that Super Mario movie doing really well. We're seeing it kind of with the them moving more into the theme park. And as augmented reality and virtual reality, which I believe will start to take more and more place into the typical consumer, we're going to see Nintendo really start to have some interesting games in those two type of key technologies, so augmented reality and virtual reality. I would definitely love to have a real virtual reality kind of Mario Kart game where it's I'm able to play massively online with other players and be able to throw a banana at them so they can slip while I get to first place.
I mean, I wouldn't say no. It would be a dream, like playing Pokemon or Super Mario. Yeah, by late 2028, so 3 years from now. We know and Nintendo does move quite slowly. I mean, look at how many years it took them to release a Switch 2. And even that, I'm still waiting on the event, which I think happens in a couple of weeks. But you say they will enter mainstream gaming by, enter it, yes. I could see it. Late 2028, it would make sense, because by then we will have a couple of iterations of new AR, VR devices, especially VR, and maybe by 2028 some AR as well. I mean, imagine you can play Mario Kart in your living room just by putting on glasses, and like everything's augmented. You can see the circuit in your living room. Pretty cool, not gonna lie. So yeah, I would agree. I mean, I hope so, because I would love to see that, but I wouldn't be surprised if not, because of how slow they move. Like you said, they are moving a little bit faster with movies and games and parks and all of that, which are all great, but compared to the others, still very small. Small, yeah. Small compared to the others, yeah.
I mean, I can definitely see the hesitation a little bit there right now, because I mean, like Meta Platforms, who has really been focusing on VR, we still haven't really seen that mass production kind of move on to the consumer space. But I think things are innovating pretty quickly right now. And again, Nintendo, I think it seems to me management has understood that they've been a little bit maybe too conservative with their own IP. But it does seem like management is turning things around here. So they're trying to accept it. And I'm hoping by 3 years from now, they have accepted that aggressiveness and that innovation spec a little bit more than they are right now.
Yeah, I mean, I would love to see that. I would love to see that, and we're probably going to get some of the answers during that Switch 2 event, because a lot of people are still waiting on the specs. I think we know that the screen is not going to be an OLED one, which is maybe a shame. But let's see what the specs are inside of that device. Because I do believe that Microsoft, if I remember correctly, Microsoft or Activision for Call of Duty, they announced that it's going to be playable on a Nintendo device. So I would assume that the specs are much better than the previous ones, but remains to be seen.
Yeah, and just a quick reminder to the fools, if you have any thoughts or questions about some of our predictions, feel free to post them on Slido, and we can kind of answer any questions that you might have, maybe not understand Nintendo, the VR, AR, or some of the progress there. So feel free to, not just for this topic, but for any other topic, to just feel free to join us on Slido to get some thoughts in. Now, Neil, I do think that might be one of the interesting points, hurdles outside of just tech innovating, but Nintendo is also known for having long progress in their model, in their platforming. The Switch lasted was it almost a decade?
It wouldn't surprise. I mean, we're now 2025 and it's still not really released. So yeah, I think.
So it does seem like we are getting close. 2017. So almost a decade before we got the new prediction. And I think that's all I have here for this prediction. Right now, it was a smaller pool. Some people probably did not have as much excitement for Nintendo after Tesla, but 71% do agree that gamers will live in the Matrix by late 2028. 29% need more information, and 0% disagree at the moment.
I do have a closing question for you with this one. Do you think they'll do everything in-house or they'll partner up with a big player?
I think if they were to go with this way, it would have to go with partnering up with a player that has this kind of technological movement, so they can make it easier for them to enter into space.
Okay, no, makes sense. I mean, wouldn't mind partnering up with a Meta, for example, since they have the platform and the distribution. So yeah, would make sense. Do you want to do one back to back and then we go back to me?
No, if you want, you can jump in. We can jump back and forth and send you to the next one, Neil.
Okay. Next one, we go to a semiconductor stock. So I said AMD will be $1 trillion company by 2030. So AMD today is trading at $106.23 and a market cap of $172.3 billion. So still a long way to go. But as we've seen, or some of us have seen during the NVIDIA GTC keynote yesterday, we've seen that Jensen basically showed us that Deloro Research, I believe, projected that by 2028, CapEx worldwide for data centers is going to reach $1 trillion, maybe even more. Now, NVIDIA being the market leader, okay, they can still have 80%, 90% of the market by then, maybe in the 80s, probably. A 5% of $1 trillion, Jose, I did the math in the last 24 hours. 5% of $1 trillion, $50 billion. So $50 billion just by taking 5% of $1 trillion. $50 billion for AMD is quite some upside from where they're at today. I'm only talking about one side of their business, which of course is the biggest one right now, will probably stay the biggest one for the future. But if you think of it, only 5%, you can be a number 2 or a number 3 and take 5% of $1 trillion. That's not bad at all. That's $5 billion. Last quarter, they generated $3.8 billion from data centers. It's around $12 billion or so for the year, the last 12 months. I mean, going from 12 to 50 billion, plus you have the client side of things, the gaming embedded. Who knows what AMD will do in the future? But we're only talking here about 5%. Imagine you take 10%, you're already at $100 billion in revenue just from that. So yeah, although they're second, although NVIDIA will still be by far the leader in a market that is growing so much, where there is just so much to eat, let's say, from that pie, even taking a small chunk will leave them with considerable revenue and profits in the future. When you generate that much, I think you will grow a lot and you will get a multiple expansion in the future. And I can see them that in the next 5 years, we go from below $200 billion with 5x, a little bit more than that, and reach $1 trillion by 2030. And of course, it gets easier as they generate more free cash flow. You buy back more shares, less shares outstanding, better EPS, and all of that. So that's the prediction. Let's have it.
So first thing, Neil, it seems like for this to happen, this AI market needs to continue to grow, and a good portion of this valuation is going to be mainly due to the AI space. When do you see AMD really starting to kind of excite the market and investors? Because obviously, I mean, this year they did about $5 billion in revenue, or this past exceeded $5 billion. They didn't give us the actual number, but they said they exceeded their $5 billion target. When do you think the market, what do you think AMD has to do for the market to start giving AMD that kind of multiple valuation?
Yeah, so 2024 AI revenue just over $5 billion. Basically, we go from 0 to over $5 billion in a year. Not bad at all. Of course, we've seen NVIDIA go from 20 billion to 30 in record speed as well. And this year, analysts are projecting around 60-ish% growth year over year, so around $8.5 billion. There are some analysts that still expect $10 billion in AI revenue. We don't know. We don't know what's going to happen because AMD did not provide that guidance. Although another bold prediction I did make 2 weeks ago was that we'll get that guidance in the second half of the year as they get a better picture. Now, when will the market start to react more positively to AMD? Probably when we start seeing that accelerated growth. Because right now, okay, great. You went from 0 to 5 billion, fine. You can go from 5 to 8, that's also fine. But will we see that huge increase a quarter over quarter, just like we've seen with NVIDIA at the start? NVIDIA grew quarter over quarter, numbers that usually companies show maybe year over year. So that's one of the things probably the market is waiting for. We also know that their big launch of the MI350 has been pulled forward to mid-2025 instead of late 2025. So could see some positive results from that. And then in 2026, that's when we get the next big thing, MI400, which they said should be competing with NVIDIA's Rubin, which is also quite insane what kind of performance that brings compared to Blackwell, which is what we're getting now. Plus, we're also getting Blackwell Ultra later down the line. But to basically answer the question, when do we see Wall Street react positively or more positively towards AMD? Is I think when AMD itself starts to show that they're quite confident in growing that side of the business extremely quickly. They said it's going to generate them tens of billions of dollars, right, per year. That's fine, but what does that mean? It's like the high double-digit growth that they told us in the earnings call. High double-digit growth is a lot, right? You can go from 20 to 90%. That's high double-digit growth. So a specific number would be great. And again, NVIDIA can dominate. That does not mean that AMD cannot grow and become a substantially bigger company than what it is today.
Neil, a few things here. There have been some reports, and viewers, feel free. Polls are open right now, and as we kind of discuss more and more, you can edit your response. There is kind of a tab or a button under the poll that says edit response if you want to change it. But Neil, right now there are reports and that some of the customers of the MI300 for AMD are kind of not seeing the form of demand that they maybe expected for kind of that for those products from other external customers. And right now we know that AMD's MI300 is only being used by a few cloud server providers. I think 2 out of, if we look at the 4 cloud server providers, you have Oracle, Microsoft, Google, and Amazon. Only 2 of those are using them right now. I do think for something like this to happen, you have to have all 4 customers, all big 4 cloud server providers adopting AMD's chips. at what point do you start saying, you know what, maybe since they're not, when do you give like that timeline of, oh, look, it's been 2 years, 3 years, the other two aren't adopting it? Do you see that as maybe a bearish case for this prediction?
Yeah, so probably, I mean, in that prediction, I bake a lot of growth coming 2026 because of that MI400, because of the integration also of ZT systems. That's going to change the game for AMD to better compete with an NVIDIA. Although, like I said, second place can still grow substantially, and the first one can still dominate. So I'd say 2028, that's when, so 2 years or 1 year and a half after the launch of MI400, 2028, I think that's when I'll check and see, okay, is it feasible or not? Because they still have 2 years, but by 2028, I think it would be very clear where we're at with AMD.
Okay. So it seems like a really important, crucial point for this thesis, Neil, is the MI400 and the CT acquisition. So let's say we heard that MI350 is being pulled ahead of schedule, which is definitely very bullish for the stock. They're not going to just pull something ahead of schedule if they don't see the demand for it. But let's say the MI350 comes out and we don't have any new net cloud server providers. You're going to say, that's okay. My real check is going to be the MI400. And that's when I maybe adjust this thesis if needed.
Yeah, the big adjustment will probably happen 2028. In the meantime, of course, you can see if an NVIDIA can grow $4 to $5 billion a quarter, an AMD starting with such a small base should be able to do that on a yearly basis, right? That's why I think both of us expect them to go closer to $10 billion for the year. So they can do that even without the full suite of the top four CSPs, because $10 billion, I mean, the grand scheme of things is really not that much in the market that they're playing in. So yeah, I would like to see positive numbers, good growth already end of this year, next year. But my big change, or let's say the deadline, is probably 2028. That's when I either pull the plug or add some more plugs.
And another point is, do you think the embedded market, as we kind of getting into more like physical AI, do you think the embedded market can actually be a nice bullish point that we don't even think about at the moment?
Yes. But again, yes, but it's up to them, right? The market is there for the taking, so it's up to them to execute and take more market share if they can, right? Because they've been quite confidently and comfortably comparing themselves to NVIDIA. So when you say that, you of course have to prove yourself. Now, we're talking purely here about the data center side of things, AI revenue. For example, if we switch a little bit to a smaller segment, which is the gaming one, I know it's not a apples to apples comparison, but the more recent release does show that they have some momentum. Now, again, so some websites or some forums might be a little bit biased, and of course, if you're not supplying enough, then of course you're going to sell out and people will have to buy it at more expensive prices. But it does seem like their products are matching price to performance wise, matching quite well versus NVIDIA's. If they can do the same with data center, could be a game changer. And then of course, if we talk about physical AI, agentic and all of that, could be another player. Now, we're only talking here about AMD and NVIDIA, but there is also all of the other big tech players that are working on their own chips, custom ASICs and all of that. So it is something you have to take into consideration, although Jensen has made it quite clear yesterday that there's no competing ASICs versus their own GPUs. But at the moment, every big tech player is trying it out, right? Is trying custom chips. They're competing and not competing because all of them are also buying NVIDIA GPUs. Some of them are also buying AMD GPUs. So everybody's buying a little bit of everything. And I think, again, I think 2028 is going to be a big year, all in all, because by then we'll have a couple of years of this AI team, AI investment cycle. By then, you'll have quite a lot of application solutions, robots, autonomous vehicles, so you can really see, okay, all of this investment, does it actually make sense or not? So yeah, that's the big answer.
Thank you for that, Neil. So another, I think, back-to-back, Neil, where the fools disagree with you. 67% disagree and mentioned that NVIDIA will dominate. 33% agree that computing is the future and AMD will be able to hit $1 trillion company, more than 5xing within the next 5 years. 0% say they need more information. So Neil, I actually I disagreed on this one. Main reason is I think my first prediction in the first show here, Neil, I mentioned that I believe AMD can 2x by 2030. And I think maybe I was too conservative there. I think this one, from my own point of view, the reason I disagree is now this one's getting a little too excited. But I don't know, maybe I might just be biased from GTC being so short in my mind right now. Maybe the bias is kicking in. But maybe in the middle is where I will do next time to see where the fools really kind of start to give that even spread.
Yeah, no, I can understand. For sure. I mean, I think a lot of people are used to the 2x, especially in the last 2 years. So a 2x seems natural and a 5x is like amazing. It is possible. We've seen it happen, but of course, the business has to make sense, right? AMD's business has to grow 2x, 3x, 5x for the stock to make these types of jumps, which is exactly what NVIDIA has been doing, right? In the last 2 years or last couple of years, I mean, stock is up 2,000% or so since the low. So it makes sense. It makes sense, but it makes sense because the business grew so quickly. So yeah. Hopefully I'm right. I'll even take a 2x. You know what? I'll even take a 2x. But for the sake of our future vacations, we hope for a 5x.
Yeah, I would really enjoy this 5x on my AMD position. So Neil, before I jump into the next prediction, we do have a question here from No Noise, kind of talking a little bit about our previous stock that we talked about in Nintendo. So No Noise, quickly, Neil and Jose, Nintendo is No Noise's biggest, highest conviction gaming stock. Would either of you consider investing in the stock? Any thoughts there, Neil, on would you consider owning Nintendo?
I did consider owning Nintendo two years ago, I would say, maybe a little bit more. It was basically a stock that was trading sideways and actually going down, but still a very, very good company. I did not buy it at the end because I asked myself, do I want exposure to the gaming segment, yes or no? And the answer was no. So I like the company. I like what they do. Probably going to get the next Switch. But it's not really a company that I need in my portfolio. Let's say that. I don't need it in the portfolio.
Agree, Neil. It would definitely be in that, for me, that pile of considering. But again, the gaming market is one that I have seen not perform as well as kind of just the overall market as a whole. So it will be very hard for me to enter it. But if I did, I think Nintendo would be one of the top, at the top of the watch list in the gaming market for me. Neil, so I'm going to jump with my next prediction. And this one, I'm going to say that, within the next 5 years, originally I was thinking big tech, but I'm going to break it down even more. Within the next 5 years, Amazon or Netflix will follow Microsoft and make an acquisition of a big gaming company. For those that are not familiar, Microsoft a few years ago made that massive acquisition of Activision. And it was one of the biggest acquisitions for Microsoft. The main reason is obviously Microsoft has their gaming platform. They wanted to increase their IP. I think the reason I picked Amazon or Netflix for this, Neil, is IP is becoming very crucial. It's kind of the safest thing when you have some form of video content or gaming content. Netflix is someone who has a lot of video content, and they're also kind of testing the water still, even though it's been a few years in the gaming content world. We've already seen Netflix do many types of shows of various gaming series. They have Cyberpunk game. They have the Witcher. Various, obviously Pokemon, but the Pokemon is pretty. But yeah, The Witcher, Cyberpunk, and we hear more names coming out as well. And to all different platforms. We saw Amazon did Last of Us, which is also from a gaming company. So creating content, even in the TV show, is pretty expensive. And for you to have a higher chance of success is by owning or by having some IP that tends to do really well.